Hello all of you, I hope you all are doing good. So today we are going to start a new chapter, that is buyback of securities. That here. In examination it is observed that generally ICAI asks a question on these chapters 7 marks, 8 marks, or it is also possible that here so many times it is also observed that they ask a case scenario based the question on these chapter, that is buyback of securities. So either they will ask you a question, simple question for 7, 8 marks, or they may ask you the case scenario based. So here in this chapter, we are going to solve so many case study based question also on buyback of securities that here. Okay. So in every chapter that here, remember that here, generally students are worried for the practical questions that we solve in class. They are worried for the case study based MCQ. I agree with you. That is important, no doubt about it. But before that, what is more important? To understand the concept. To understand the concept, it is very important that you should understand the concept properly. So what happened that when I will explain you the concept in every chapter, first lecture is the most important. Why then every chapter, first chapter is the most important? Because in the first chapter I discuss with you the concept in detail that here. Okay. So I will give background there. I will explain so many things. You just have to listen me carefully that here now. Okay. And when I explain you that here now, like we are starting today the buyback of securities that when I will explain you the concept here, it might be happen that here certain time few points you won't be able to 100% understand that. It might be happen even though you understand, even though you understand 80%, when I explain the concept that even though you understand 80%, it is more than enough. I tell you why that. Because when I explain the concept that here, at that time we are not solving any question that here. After discussion of concept, we are going to the practical questions. So when we solve the practical question, your understanding level increase there. Because first we discuss about the concept. I will create so many examples there. Okay. So it might be 80%, 90%. Most of the time, 100% you will be able to understand that. But even if you understand 80%, 90%, you don't have to worry. Why? Because after the concept, when you solve the question, 100% you have to understand each and every concept there. Okay. Because we will connect that. We have numbers when we solve the questions there. Okay. So in every chapter, the first topic is the most important because I discuss in the first topic the background of the chapter right here. Okay. So in your notebook, just write it down there, buyback of securities, and I hope that all of you have solved the previous chapter questions. Okay, homework question and all that you have already done it. That is a previous chapter, that is financial statement of company. Okay. Now in your notebook, write down their buyback of securities. That is okay. So dear student, very simple chapter, just you have to listen me carefully, and whatever I am writing here, you also have to write it down in your book. So you can see that here now in a rapid gist book that here, there are so many things we are going to discuss. First today we will discuss, I will give the background today first. Okay. Then we'll discuss about the meaning of buyback, what are objective advantages, sources of buyback, conditions for buyback, maximum number of equity shares that can be. There are so many things that one by one I will discuss with you. Okay. But what happened here in these chapter, interesting part is that now, if you see that here, especially from point number 8 to point number 11, now if you see from point number 8 to point number 11 that now, they talk about the journal entries on redemption of preferences. We have mentioned in my notebook that journal entries on issue of bonus shares, journal entries on cancellation of own debentures, journal entries on exercise of ESOP. These 4 topics, they are not the part of the CA intermediate that here. Now basically redemption of preference share, bonus share, now they are the part of the CA foundation that. Okay. But you'll say, sir, if these concepts, they are not the part of the CA intermediate that here, your advanced accounting. Why? I have mentioned these topics that here in my book that here, these concepts here, I've explained the journal entries also mentioned there. Why? The reason is that even though these topics, they are the part of the CA foundation, still here in these chapters, certain time they will give the adjustment on these topics. That adjustment, in adjustment they will give the certain information, certain point that they will mention about this here. So it is important for you that here to understand that concept. And I assume that here, even though you are coming through a foundation, I assume that you all are coming after completing your graduation and you have no idea about of any of these concepts which are the part of the CA fund. I assume that when start the class, I assume that even though you have a knowledge of accounting, I assume that you have a zero knowledge of advanced account, even though you have a good knowledge of accounting. Okay, and we'll start from scratch. Okay. So what we'll do that here now, we'll start with the concept here. Write down your book that here, that is buyback notebook, buyback of securities. So let's start it that. Okay. Now, as you can see that the name of the chapter is buyback. Let me write it down here. Buyback of securities. Buyback of securities. Now understand that now. First of all, what do you mean by when I say buyback? What do you mean by buyback? Because name of the chapter is what? The buyback. So in simple language, if I say that here now, buyback is, write down there, reversal of equity shares. What do you mean by buyback? Reversal. Just understand, buyback means reversal. It means that the shares that we have issued, the shares that we have already issued, okay, we are reversing it. It means we are cancelling our equity shares. You say, why equity shares, sir? We use the name of the chapter is buyback of securities, because when I say that we are purchasing our own shares and we will cancel them, that's why I'm saying reversal. The shares that we have already issued, the shares that we have already issued, what we are doing, we are cancelling. Not all, there are certain rules of the Companies Act. Some shares of equity share we are cancelling. That's why I'm saying reversal. Reversal here means cancelling of equity shares. So the shares that we've already issued in the market, some shares we are cancelling it here. So reversal means cancelling it. Reversal of equity shares. Now you will ask me, sir, why you are saying the equity shares only? Because when we talk about these securities, when we talk about the securities that here now, we have different type of securities. Means it might be a debentures, write down there, debentures. It might be a preference shares. It might be a preference shares, or security. It may, for example, equity share. Why I'm specifically talking about the equity share only? Because in your CA intermediate, you have only equity shares, cancellation of equity shares. So what you have at inter level, okay, or CMA inter level, what you have only here you have only these. What is this? Equity share. So what about the cancellation of the debenture that we have issued in the market? What about the cancellation of preference share? They are not the part of C intermediate that here. Okay, that is the part of foundation level. So name of the chapter is that here now is the buyback of securities. When I say buyback of securities, that here now, what is going to happen that now we are cancelling the equity shares. We are reversing the equity share that we have already issued. So write down there. Okay, most of the point it is mentioned in the, what I'm writing, it is already given in the repetitions, but I'm I'm explaining the concept. So whatever I am writing, you have to write it down. Okay, now write down that it means purchase of its own equity shares, and cancelled by the company. Now remember that here now. You always have to remember that now. These chapters, they talk about the reversal of equity shares. So what we are doing that here, we are purchasing our own equity shares and then we are cancelling them. So it is not like that. Let me explain it through a balance sheet that here. So roughly if I draw it, suppose this is a balance sheet of a company. This is a balance sheet of a company. Okay, now understand. This is a balance sheet of a company. And to make it simple, I am preparing in a T form. Okay. Now, this is balance sheet. Okay. This is liabilities. And this is what? Assets. So here on my liability side, we have equity shares, we have preference shares. Okay, equity shares, we have preference shares, we have debentures, we have loans, we have creditors. But we are talking about only what here? We are talking about what here? The equity shares that here now. We're talking about what here? Only the equity share. So we are doing the reversal of equity shares. Now, I'm not saying we are going to do the cancellation of all the equity shares. That no. Some portion that, because as per the Companies Act, we will discuss about, there are certain portion only that we can do the cancellation. So when I say the some portion of the equity share, we are cancelling them. So how we are cancelling them? Suppose there is a company, we issue the shares in the market. So how to cancel them? So first we purchase the shares and then we cancel them. So the shares which is in the market, it is issued. We are not the owner of the equity shares, those, because we have given to the equity shareholders. The shareholders, they are the owner of the company. They are the owner of those equity shares that here. They are the owner. So what we do that, we purchase those equity shares and then we cancel it that way, because we are not the owner. So first we have to purchase it, then we have to cancel it. Okay. So that's why we will purchase the shares from those equity shareholders. The company becomes the owner of those shares and then we'll cancel. How to cancel it, how to purchase it, how to pass the entry, I will discuss it. But this is the concept of these chapters, that is buyback of securities. So are we talking about redemption, these debenture preference? No. The concept is the cancellation of equity shares, but in my book, that is the Rapid G's book, it is also mentioned about the redemption of preference shares, redemption, the issue of bonus share, also cancellation of own debenture, all. Why? Because in question, certain time they give the adjustment on those points also. We will discuss that also. But primarily, our agenda is to understand the concept of what? Buyback of securities, and we are talking about what? Equity shares holders. Do you understand? Yes, I'm talking to you. Yes, to you. Okay. Do you understand this point? Okay. Now, if you go to Rapid G's that here. So what they say that here, what does it mean? What do you mean by here? The buyback of securities. What they say? The meaning of buyback. Buyback of shares means company purchase its own shares. What they do? They purchase its own share, which are then cancelled. And what they do that? They purchase it. What they do that? They purchase their own share and then they cancel it. So they purchase it, then cancel it that year. It cannot held as an investment. It means that you cannot say that I purchase my own share. This is my balance sheet that year. Okay, this is my balance sheet. And we cannot say that we purchase our own share, so it will appear on asset side. No. Purchase, cancel. You cannot say that, but as per the company laws also, that you cannot hold your own. I mean, you cannot purchase the shares of your own company and held as an investment there. No. You issued there, it is appearing on liability side, equity and liability. Then you purchase your own share, it cannot be appear on asset. You have to cancel it that here. So that's why they say that here, that cannot be held as what? Investment, resulting in decrease in capital. Why there will be decrease in capital? Obviously, when you are cancelling something that here, cancelling the capital, your capital will go down. What we are doing that? We are cancelling what? Equity share. So when I say that here we are cancelling the equity shares, so obviously my share capital will go down. Okay. This is what we mean by buyback of equity shares. Now, we'll discuss about the next concept, that is what are the objectives or the advantages. So what I will do that, I will create an example for you, so it will be easy for you. So first they say, boost earning per share by reducing the outstanding. So write down there, outstanding issue. Okay, write down there, example. Example number one. You will say, what example number one? So go to that here now. Go to that here now. Write down there. Okay, example number one. Okay, go to example number one. I'm creating that. You just have to write it down. So basically, they are telling you to refer the example number one. Now go to notebook. Now write down there. Reason of buyback. Why? Reason of buyback, you can see that here, or you can see that the advantages of buyback, or objective that here, or you can see that here in objectives. Okay. Now understand this first. So let me write it down that in example number one. They say due to buyback, what happened? Increase earning per share. Write on the increase, this example, increase EPS, earning per share EPS. This is specific accounting standard on it also, on earning per share S20. But here understand what does it mean that here? What does it mean that when I say I increase EPS that here now? What happened that now? Suppose this is the balance sheet of the company. This is the balance sheet of the company. Roughly you have to draw with me, okay? This is the balance sheet of the company. Balance sheet. On their liability side, some equity shares appearing there. Okay. Now, how many, if I say in terms of number of shares, so they have here, how many number of shares? Suppose if I say that here, they have number of shares is 50,000. How many shares the company has? 50,000 shares that here. What does it mean when I say that here they have 50,000 shares that here? Now they say here earning per share. I'm writing in bracket before, write on, you also have to write before buyback. What does it mean that here? How we calculate the EPS? That is a part of accounting standard 20. But roughly I'm giving an idea that here now. The profit that we have, how much profit belong to per share? So if I say that now, I have a profit of, let's say, 2 lakh rupees. How much profit I have? 2 lakh rupees. And the number of shares I have, suppose if I say 50,000 shares, equity shares I have. It means the profit belong to per share. So the total profit that we have during the year, that is coming, suppose 2 lakh. And the number of shares that we have, that is coming 50,000. So it means that here now I have a EPS. How much EPS we have? Rupees 4. The profit belongs to per share is how much here? Rupees 4. Okay. But they say me that, they mention that due to buybacks, they think the objective advantage or the reason, whatever you call it that here. Because of buyback, my EPS is going to increase that here. What they're saying that now? Because of buyback, my EPS is going to increase that here. What does it mean that my EPS is, how EPS is going to increase that? Let's understand this one. If I say you that now, if I say you that we have done the buyback. Okay, now we are doing the buyback. So we have done the buyback of, let's say that here now, if I say that here, we have done the buyback of here is buyback. So how many shares we are doing the buyback? Let's say we purchase 10,000 shares and cancel it. So my share capital, it will not be 50. It will be 40,000. Why it will be 40,000 that here now? It will be 40,000 that here now. Because we purchase out of 50,000 that now, we purchased here the 10,000 shares that. So what is going to happen that when I say we purchase the 10,000 shares, so my equity share will not be of 50, it will be 40 only because the share that we have issued. Out of that, we cancel the 10,000 shares. Okay. Now let's understand this one, how it is going to help you to increase the EPS. When I calculate the EPS now, EPS after buyback. EPS after buyback. Now profit, how much profit we are supposed to save? 2 lakh rupees. Okay, so it will be easy for you to understand, to compare it that way. Why? Now number of shares we don't hold 50,000 because we have, because we have done the buyback that year. Now how many shares we have? 40,000. So if I write it down that here now 40,000. 40,000 shares. So 2 lakh divided by 40,000, that is coming how much? Rupees 5. Now see the comparison that you know. Previously my EPS was coming how much? That it was coming that here is the 4. Now how much it is that here? 5. And logically it is correct that here when we say that here why my EPS is going to increase in EPS, why my EPS is going to increase logically. How we are calculating the EPS here, earning per share? Basically the profit divided by number of shares. So if in denominator we have a number of shares, if my number of shares goes down, if my number of shares goes down, what is going to happen that now? Obviously denominator, if we see the formula, profit divided by number of shares, if denominator goes down, obviously the amount will come more, the EPS, that's why it's coming more. So this buyback help us to increase the EPS. This is one of the reasons people do, company do the buyback, because they want to increase the EPS in the market. It's a good message that wow, the more the EPS the company has, the more the company is good. Okay. Now we are coming to the second reason that here. Go to the rapid. They say that here now is increase in what? Increase in the promoter's holding as bought back shares are cancelled. So write down there, this is example number 2 on. Write down there, example number 2 on it. What does it mean that it increase the promoters the holding that here now? Write down that example number 2. Example number 2. Increase promoters holding. Okay, increase promoter holding. Now, what does it mean that now? Example of increase promoter holdings. Okay, write down there now. Suppose if I say that now, this is my balance sheet. Okay, this is my balance sheet. Okay. Okay, write down there. This is your balance sheet. Now here, if I say that here now, you have a capital. Is first of all balance sheet. And you have a equity capital. Let's say you have a 10 lakh rupees. How much equity capital you have? 10 lakh rupees that is. Now what is going to happen that now here, if I say that out of this 10 lakh basically, hold by, okay, out of this 10 lakh, hold by the promoters. Okay, hold by promoters that they hold 6 lakh equity shares of 6 lakhs and hold by other shareholder, they hold 4 lakhs. So how much you can say the 60% hold by the promoters and remaining 40% hold by an outsider that is. Okay, now what happened? If I say before buyback, okay, now let me say promoters holding before buyback, how much they have promoters holding before the buyback that year? They hold 6 lakh. How much shares that they hold? The shares capital of rupees 6 lakh. And what is the total capital of the company? That is 10 lakh rupees. Multiply by 100. So we can say 60%. Correct? Do you agree that? How much they hold? 60%. Correct. Now when the company do buyback, when they cancel the shares, they are not cancelling the shares of equity. They are not cancelling the shares of promoters. Now equity, 6 lakh equity shares hold by the promoters and 4 lakh share hold by the others that. So they are not cancelling the equity shares of promoters. They are cancelling, they are not cancelling the equity shares which is held by the promoters. They are talking about. So they are cancelling out of these 4 lakh. They decided to cancel that here now. They decided to cancel the share capital of 2 lakh. This is what they are doing the buyback. So here they are doing the buyback. So they are doing the buyback from, they are doing the buyback here. They are doing the buyback of rupees 2 lakh. So how much shares that they have here? Now outsider does not hold 4 lakh. 4 lakh minus 2 lakh, that is going to how much? 2 lakh. So when I say how much, we are not doing the buyback out of the shares which is purchased by the promoters that now. So when I say that here now, promoters holding after buyback. So if I write it down that here now, promoters holding after buyback. How much they hold that here now? Promoters still hold the 6 lakh. There is no change in that. Promoters still hold how much? They hold the 6 lakh. It is still the 6 lakh that is. But how much the total capital is now? The total capital is 6 plus 2 because 2 we have already done the buyback. So the total capital of the company is not 10 lakhs. So let me write it down like this. So it will be easy for you when you do the revision. 10 minus 2. How much it is coming? 8 lakh. When I do the multiply by 100, how much it will come that here? 6 lakh divided by 8 lakh. Multiply, that is coming 75%. Now understand the logic here. Now what happened that now? Now here the promoters holding, it was 60%. What we have done? We have done the buyback. So the promoters holding is increased. You'll say how after the holding, after the buyback, the holding of the promoters increase in the company, because we are not doing the buyback of promoters share. We are doing the buyback of other than promoters. So number of shares of the other shareholder goes down, but the promoters are still at 6 lakhs that year. So overall holding, if you see that here now, promoters holding obviously will increase here. This is what they're saying, increase what promoters holding. This is the logic that they have here. Okay. Now you got the point that here now. So first we discuss about the why the increase in EPS and the increase promoters holding. Then they say that here now, third point that here now, discourage the hostile. What is this? Discourage the hostile that here now is the takeover, hostile takeover. Discourage that here, beats by increasing the promoters, the control that here. Basically, what they are doing, they are discouraging the hostile takeover that here, beats by increasing the promoters holding. As we have seen in the example number 2. What we have seen in example number 2 that here now, they are increasing. What they are doing that here now, they are increasing the promoters holding. After the buyback, what happened after the buyback? Promoters holding get what? Increase that here now. So they are discouraging. What they are discouraging that here? Hostile takeover. What is hostile takeover? The best example is that here is this NDTV. You know that about NDTV that here now. So what happened in case of NDTV also that year, there's so many shares held by some people, small share that they hold by 2%, 5% like that. All of a sudden what happened? Basically those with ultimate shares hold those, this is the Mr. Adani that you know. They merge all those shares, and who have a control on NDTV? Mr. Adani that you know. So what happened that in case of, if you increase the promoters holding that now, so if you increase you are doing the buyback of outsider shares. Promoters shares, you are not doing the buyback. So overall with that, like we have seen example number 2, the holding increased from 60% to 75%. This is what we discussed there. The holding increased from 60% to 75%. That's what we discussed there. So when I say that when holding increased from 60% to 75% that now, so the chances are going to be discouraging to the outsider. So that all of a sudden one day they will come, they will merge their share and they will tell us, now we hold more than 50%, we have a control on it. It might happen that now. Okay. So we want to keep more number of shares of the promoters only. And we don't want to give the more number of shares to the outsider that, you know. And we're discouraging them. Hostility, all of it should not happen. One day they come, they say, no, we all merge together and we are holding, after merging, we are all together, we are holding more than 50, so we have a control on it. We don't want that here. So by doing the buyback, we are discouraging them. You say how? By doing the buyback, we are discouraging them. The reason is that here now. By doing the buyback, we are discouraging them that here. Because we are doing the buyback, their number of shares is going down that year in the company. Their holding is going down that year now. So if there are some small shareholder that year, they have a plan. Oh, one day we'll merge and we have a control on this. We say, okay. Even though we don't know, they might do that here. So what planning they are doing, we don't know that here. So we do the buyback. So their power will go down. We are discouraging them. This is what happened exactly in case of NDTV case that year. Okay, what they have done there. Okay. Now, next point. Support the share price if undervalued in the market. Okay. How? What does it mean that here now? Support the share is undervalued in the market. Now, you just have to listen to me carefully. What happens is that here now, when we have I'm going to say that the support the share if undervalued in the market that here now. Okay. But you understand the third example, we're discouraging the host. All of a sudden, it should not have one day that they merge together their shares and they take over the company. Okay. Now, what is this support the share price if undervalued in the market? Now, suppose the value of the shares is not, we believe that here, we are public company, suppose, okay. Our shares, which is quoted here on stock exchange that here now. Now, we believe that here, the price which is listed here, which is here in the market value of our share in the stock exchange, we believe that here it is not at the proper rate, it is undervalued that here, okay. So we believe that here, the rate is not properly quoted. So what happened is that here now, we want to keep it at the market price. Suppose if I say that here now, suppose the market price. Now what is going to happen? Suppose if I say the market price, or you can say is the rupees 75. Okay, this is stock exchange price. Stock exchange price, market price. Okay, market price. Now understand that now. Now what we will do that now, the shares which is quoted in the stock market, at what price it is quoted? It is quoted at what? 75. That. We don't want them that way now. Okay, we don't want, we believe that it is undervalued. We believe that it is undervalued. So what we can do that now? It is undervalued. We believe that it is undervalued. Their value is not 70, but it is much more than that, we believe. So what we can do that? Let's do one thing. This is what we are doing, sir. Let's do one thing. What we'll do that here now, we will offer to the existing share. These are the existing shareholders. These are existing shareholders that here. We'll tell them, listen, we are doing the buyback. We are purchasing shares and we'll cancel them. So these are existing shareholders. And I will tell them, listen. I want to purchase shares and I'm offering you, because when we purchase the shares, we have to pay a certain amount. What is the market value? 75. What price we are offering them? So we offer them rupees 90. So how it is going to, the market price is 75. We are offering them 90, which is more than that. So we are offering them more than the market price. That. Why? What we are doing that now? We are offering them more than the market price. So what is the market price? That is 75. And we are offering them for the purpose of buyback rupees 90 that here now. Why we are doing that now? What message will go in the market? Listen. The share price which is quoted in stock exchange is how much? 75. But what is the price that they have in the market? 75. But what the price they are offering? 90. It means the message will go in the market. The value of the share is much more than 75. Even though the price in the market is 75, but we want to do the buyback and we are ready to pay you more amount. We will pay you 90 rupees. Don't worry for that. So what message will go in the market? People will say, no, listen. It is market value is 75, but they are actually offering 90. It means their value is much more than 75. You know how it will help to the company? They're paying more amount, no doubt about it that year. But they are not in the buyback of all the shares. They're doing suppose 10%, 20% shares buyback. What message will go in the market? The message will go in the market that the value of the share is much more than what is quoted in the stock exchange. So what is going to happen? Even though they're paying the share more price only for those few shares, they're doing the buyback. They're not doing the buyback of all the shares. They cannot do that. So when they're doing the buyback that here now, they're doing just 20%. But value of the remaining shares, those still existed in the market, it will jump in the market, it will increase in the market. The reason is that here now, because the message is going in the market, the value is not at 75. It is much more than that they are offering, the company is offering at 90. So it is, we purchase it paying the more amount, no doubt about it. But what message it will give in the market, their value is much more. So remaining share that we're not doing the buyback, their value will increase in the market. This is one of the strategies the company does that. Okay. Now, so we discussed about that here. Because of the buyback, my EPS will increase. Because of buyback, promoters holding will increase. Because of that, we also discussed the hostile takeover, and if the shares is undervalued in the market, that will help you to increase the value. Now, distribute the surplus cash to shareholders. This is also one of the options. We have so much of cash in the company. Enough cash we have. So we say that here the surplus cash we have. Why don't we that here now? What will we do that here now? We have enough cash here. Let's do one thing that now. Purchase some shares. Why should we give the control to the outsider? Let's purchase our own shares that here now. We don't want to give the control to the outsider. It's happened that now. Okay. So if we have so obviously by this and distribute the surplus cash, we have enough cash that we have. And when we do the buyback, obviously we have to give the payment to the shareholders that day because we are purchasing their share. When we purchase it, then we'll cancel it. But when we purchase it, we have to pay to the existing shareholders. We have to pay to the existing shareholders. You got the point that we have to pay to them here. Okay. So we have a surplus cash, we will pay them. So enough cash, we will let's do the buyback that day. Okay. Now, this is about the objective or the advantages or the reason we do the buyback here. Now I'm coming to the point, sources of buyback. Okay, this we are going to discuss in detail that now. But what it says that here now, they say here that here, just give me a minute. Okay. Now the Companies Act 2013 section 60 subsection 1 permits a buyback from out of profit. So there are two sources from where we can do the buyback. First is out of profit and first is proceed of shares issue. Now please understand this one. I will explain you this in because through the entries and all that here now. But what happened is that now they tell us that when I do the buyback that here now, there are two sources from which I can do the buyback. So what does it mean sources that here now? Now, as per the Companies Act, they say as per this Companies Act section 68, they tell us that here when you do the buyback, what do you mean by buyback? We are cancelling our equity share. We are talking about the equity share in this chapter only, okay? So we are cancelling our equity shares, okay? Yes. But at the same time, they tell us that here now, you have to issue the new shares also. Say what? Yes, the Companies Act. I will tell you the logic also behind that. They tell us that now, when you do the buyback, so obviously my share capital will go down. Yes, we will see the entries and all that today only. So when we do the buyback, what will happen when we do the buyback? The share capital will go down. But as per the Companies Act, if your share capital, obviously my share capital will go down when I do the buyback, my equity share will go down. They said at the same time, you have to issue the fresh new shares in the market. So logically, due to buyback, my share capital will go down. Do you agree? Yes. But at the same time, I have to issue the new shares in the market. You say, what is this, sir? At one point, your shares is going down. Your capital will decrease. And when you're issuing the new shares in the market, your capital will increase. Yes, this is what the Companies Act say. But what say that here now? They say that, I will tell you the logic also why they tell this, okay? But what they say that here now? No buyback from proceeds of the prior issue of the same shares that here now. So basically they're saying that here now. Now, when I do the buyback, listen carefully, I'm talking about the equity shares. When we do the buyback of equity shares, we cannot issue the equity shares in the market. Otherwise, buyback equity, issue equity, what is the change here? They say when I do the buyback of equity shares, you have to issue the new shares in the market, but that should not be the same shares. If I am doing the buyback of equity shares, I cannot issue the same class of shares. I will issue the preference shares in the market. Okay. But what they are telling us that now, but Companies Act says that here, we are discussing the accounting subject, but there is a connection. What the law says, we have to do and accordingly we are going to pass the entries also. So when I do the buyback that here now, what is going to happen, Peter? Capital will go down. Equity share capital will go down that here now. But at the same time, law says that we have to issue the new shares in the market. So we will issue the new shares in the market. But those shares, when we issue in the market, it should not be the same shares. It should not be the same. It should be some different. If we are doing the buyback of equity, it will be preference shares. You got the point? But okay, now this is the point that we'll discuss that it's for the law. But I have an objection here. I say, what is this? You're on one side, I'm doing the buyback to decrease the capital, and you're telling me to issue the fresh shares in the market. I don't want to do that. I have enough cash because when I'll issue the shares in the market, we'll get some amount from the shareholders, and that will help me, in fact, to pay at the time of buyback. Because when you do the buyback, we are decreasing the capital, so we'll pay to those shareholders. But when you issue the new shares in the market, we'll receive the amount from them. That we can utilize even to do the payment to the shareholders. We are doing the buyback of them. Okay. But I have an objection here. I say, why should I do this? Why should I do this, that here? I will tell you the Companies Act. I'll say, listen, Companies Act in front of me. I'm not a teacher of law, but I'm giving an example that here. I say, listen, Companies Act. What are you talking about that here? Why should I purchase your shares? Why should I purchase? Why should I issue the shares in the market? What are you talking about? Why make it mandatory on me to issue the shares in the market? Why should I do that? Rich company we are. We have enough cash. Huge amount of cash we have. Why you are making a mandatory on us to issue the new shares in the market? We don't want to do that unnecessary that here. We have enough cash that here. We paid when we do the buyback, we'll utilize that cash. Why you want to tell us that here to issue the new shares in the market? They say, okay, no problem. If you don't want to issue the new shares in the market, yes, we say, yes, we don't want to issue the new shares in the market. So you know what they tell us that, okay, no problem. Then it will be called at that you are doing the buyback out of profit. So you will tell me, sir, what is this out of profit, sir? What is this out of profit? I will tell you the logic. What is this out of profit when I will discuss with you journal entries. So what I will do that here now, beta, I will discuss with you first about the entries, about the buyback out of fresh issue of shares. When I say buyback out of fresh issue of shares, means we are doing the buyback. At the same time, we are issuing the new shares in the market. Okay. Out of profit means we are doing the buyback, but we are not issuing the fresh issue in the market. We are not issuing the new shares in the market. That is out of profit. But when I say out of profit, what does it mean out of profit? Because we understand out of fresh issue of shares, we understand. We are doing the buyback. At the same time, we issue the new shares in the market. That we understand. But what do you mean by out of profit? When I say out of profit, what does it mean that now? When I say out of profit that here now, what does it mean that here? So we are doing the buyback, but we are not issuing the new shares in the market. But what is this out of profit that here? And they have mentioned something about the free reserve, revenue reserve, general reserve, P&L, securities. What is these reserve and all that? So have patience for half an hour. You say, why, sir? I will discuss with you journal entries now. I will discuss with you journal entries now. Okay. And then I will come back to this point here again to this point that here. Okay. Out of profit and out of fresh issue of shares. Okay. I will come to this point that. Okay. So what you will do that now in your notebook. Okay. Write on your notebook now here. Write on that now here. Section 68. Section 68. What section 68 says that now? Buyback out of, from where we can do the buyback, that from where we can do the buyback. Section 68 of the Companies Act 2013, they say buyback can be done out of. From where we can do the buyback? First, okay, now understand. The first, we can do the buyback out of fresh issue of, or you can write like this. Okay, just give me a minute now. Like this. Okay, because I will write it down here something. Okay, so you have to, I'm really sorry, you have to give the space somewhere. Okay, if you've already drawn, I'm really sorry. You have to keep this some space here. Okay, now here, out of, first we have out of fresh issue of shares. Second is out of profit. Right, like this. Okay, out of fresh issue of shares. Now, what I will do that here now, I will discuss with you the accounting entries that here. Okay. Now, first, our focus only on these here. Okay. Now, what it says that here, when it's out of fresh issue of shares, what should be the first entry? I am going to issue the shares in the market. We'll do the buyback. We'll discuss about the buyback later on. But first what we have to do as per the company that we have to issue of shares. Issue of, you can say, new shares in the market. We'll issue the new shares in the market. Fresh issue of shares in the market. Because we are doing the out of fresh issue of shares. What entry should we pass when I talk about the issue of the shares? First entry. When we say I'm issuing the shares, I have choose the option. Don't worry about what is the out of profit. I will come to that here. But what is the first entry that we have to, what is the first entry that we have to pass it here? When we say what is the first entry that we have to pass, when we say I have choose the option to issue the out of the fresh issue of shares. So we will discuss about the buyback later on. But before the buyback that here, what should we do now that here? Before the buyback, what should we do now? We have to issue the shares in the market. Okay. So it might be happen that when we issue the shares in the market, what is going to happen that now? It might be happen that I'm issuing the shares at what? Par. We're talking about the fresh issue of share that we're issuing in the market that now. So when I issue the fresh issue of shares in the market, it might be happen I'm issuing at par. What do you mean by par? The share is of rupees suppose 10. I'm issuing at what? 10. That is at par. What is premium? Suppose the share is of rupees 10. I'm issuing at more than 10. Let's say 12. I'm issuing at 12. Okay, so we'll discuss about it. But we cannot issue at discount. If the share is of rupees 10, Can we issue at 9? No. Company Act does not allow it. Okay. So suppose the share is of rupees 10 and we want to issue at what? 10. So what happened that now? Issue of shares. Suppose the bank account will be debited here now. Bank account will be debited here by rupees 10 that now. So because when we issue the new shares in the market, what happened that here now? When we issue the new shares in the market that here now, what happened that here now? Number of shares is the amount I'm going to receive that here. Okay, we were to receive the amount from the shareholder. So bank account should be debited, and we are going to credit to share capital accounts, and share capital account will be credited, because remember the basic accounting that you have to be very smart that here. When I say you have to be very smart, very careful that here. You know the basics of account. Please watch the series of basics of accounting. When I say increase in share capital, because when you issue the shares in the market, your share capital will increase that. What is going to happen? Your share capital will increase there. You got the point that here now? So bank account should be debited now and share capital account should be credited, because we issue the shares in the market. Or it might be happen either you will go for the par. It means if the share is of rupees 10 and you're issuing at 10, or it might be happen that you are issuing at premium. What does it mean? That if the share is of rupees 10 and you are issuing at what? More than the face value. Suppose the share is of rupees 10, we are issuing at 12 because the market is demand is high. So you are going to pass the entry, bank account will be debited by rupees 12. Bank account will be debited by rupees 12 because you receive rupees 12. Okay, sir. Now you will say, sir, credit to share capital account. Credit to share capital. Remember that share capital, never ever write it down the amount of premium amount, securities premium account. Never ever. Now what is always share capital? Write it down always, always and always. It will be only and only and only on face value. What is the face value of the shares? Rupees 10. If I say that here now, let's take an example that here. Face value is how much here? Rupees 10. Rupees 10 is face value. If we issue that here now at rupees 10 only, so we have issued at what? Par. If we have issued at rupees 12, we have issued at what? Premium that here now. But when we talk about entries that here now, in my share capital account, always be face value will go rupees 10. What about the remaining 2? That will go to securities premium account rupees 2. Always remember that. But when we issued at par, whole amount will go to which account? Share capital account. Always remember. Write it down. All these things you have to write it down with me. So when I say that here now, when we talk about this premium that now, the premium, so in share capital account, premium account will never come. It will come only the face value. So face value is how much is? Face value is 10 that now. So what is going to happen if I say the face value is 10 that day? What about the remaining 2? That is the premium amount. Okay. So that will come to securities premium account. That is how much? Securities premium account. That is how much? 2. You got the point that here? So it might be happen when issue the shares in the market. It might be issued at what? Par, same at the face value. Or it might be happen we are issuing at what? Premium, more than the face value. So whatever the surplus amount, which is more than the face value, we call them securities premium. That is going to appear in which account? Securities premium account. So by law, it is mandatory to issue the shares in the market. How much that I will discuss with you, but it is mandatory. So first we talk about what? Issue of shares. So issue of what? Shares. Now I am discussing with you now the buyback. Now we are discussing about what? Buyback. Buyback of equity shares. Okay. Now we are talking about now we will do the buyback. So when I talk about the buyback, you know what is the first step that here now? What is buyback? Purchase, cancel, purchase and cancel. We have to purchase our own shares. We want to purchase our own shares. So we go to the shareholders. We tell them, listen, we want to do buyback. So we want to purchase your shares. Do you want to sell your shares? Okay. So it means basically we are discussing accounting here. Okay. So we are going to purchase. First purchase and then what? Cancel. So write down there, purchase of shares. Purchase of shares. So when I say we are going to purchase our own shares, okay. So we purchase our shares. What we get? We get the equity share. It is like an investment that here because we purchase the shares. But that's a different issue. We are going to cancel those. I'm talking to you. Please listen that here. So when we purchase our own share, so better we purchase the shares and we will cancel them. So first we have to purchase that. So we got the shares that here now. Oh, shares. We purchase the shares that now. Okay. It's like an investment. When you purchase the shares of any company, forget about our company. You purchase the shares of Reliance Industry. We purchase the shares of Reliance company. What is going to happen? It's an investment. So we purchase the shares. So what we call them that near first equity shares. I'm not saying capital. Equity share buyback account. Equity share buyback account should be debited. So we purchase our own share. What we have done that we have purchased, and it can be any price. When I say we purchase our own share, it's like an investment. It might be a 10, 12, 15, 20, 30, 50, whatever is that here. We purchase our own share. First we purchase, how to cancel it I will discuss. Suppose we purchase at 10. I will create a different scenario also. We purchase at 10. So we purchase, so we got the shares. So it's like an investment. So investment account debit and we paid the amount. So bank account or cash account should be credited to bank account. So investment account debit to bank account. But you know that it's like an investment that we purchase the shares that it's like an investment. But you know that as per the Companies Act, we cannot hold it as an investment. We cannot say, oh, listen, we purchase the shares. So we debited the investment account, but we don't call it investment account. We call it equity share buyback account. That is like nothing but the share that we have purchased that year. So we call it that here now, equity share buyback account that now. It's like an investment that is. But it's the problem here. Companies like say, listen, what are you doing here? I say, what happens, sir? They say, no, listen, you cannot do that. Purchase your own share and show as an investment. Oh, it is not allowed to do that. They say, no. It is not allowed to do that. You have to purchase and cancel it. So what we have to do that now? We have to purchase it and then we have to cancel it. Okay. So we have purchased it that here now. What we have to do now? We have to cancel it now. So what I will do that here now? Now I will go that here now. Third, cancellation of shares. Now remember that it might be happen. We may have purchased at par. Okay, if you want, we can create a different scenarios also. Okay, let me make it simple for you. Okay, so it might happen that now we may have purchased at whatever price that we have purchased. We may have purchased at par or premium. So if I say we have purchased at par and here I have purchased at what? Premium that. We have paid the more amount that here. So if we are going to pass the same entry, only the amount will change. No need to write it 2 times, but to make it simple, I'm writing in that here. If I say that now equity share buyback account should be debited. Suppose we purchase at 50 to bank account. 15. You say, listen, sir. You have not debited to, you have not written down anything on security. Listen, we are purchasing. We are not issuing shares in the market. Okay. We are not issuing. No. We are not issuing shares in the market. Okay. We are purchasing our own share. It might be happen. We are purchasing at what? Par. The face value is 10. We are purchasing at 10. We are paying more amount. So it might be happen when you purchase the investment. You may purchase at the par. You may purchase by paying the more value. Nothing wrong in that. We are purchasing here. So, 2 scenario. We purchase at 10. We purchase at by paying the more amount. Now understand. If we have purchase at par. So, if purchase at par. So, what we have done that now. So, let's just focus here on this point. I say I purchase at what? We purchase at what? Par. How much we pay? 10. So can I hold it as an investment in my balance sheet on assets? No. Why? Because Companies Act does not allow it. So we purchase our own share. They say cancel. Oh, you have to cancel it. This investment, like an investment, we purchase the share. So I have to cancel this investment. Yes. So when I purchase it, we have debited there. Correct. When I purchase, we have debited there. What we have to do that now? When we purchase it, we have debited there. What we have to do it now? So we are going to cancel them. So we are going to credit to equity share. Equity share. Buyback. Equity share. Space it now. I am writing this buyback account. Okay. How much that here? Is 10. So when I say that when we purchase the shares, we debited to equity share buyback account. Correct? We debited to equity share buyback account. Now we want to cancel it. So once we have debited to equity share buyback account here, we want to cancel it. Always when the cancellation comes, we just have to give the reverse effect. So we debited here, we are crediting here. Okay. But which account should be debited here? Okay. When we do the cancellation, we purchase the shares, we are cancelling. The investment will go down. We have to credit them. Which account should be debited here? Which account should be debited here? Now we are going to debit to which account that is? Share capital. Now we are decreasing the capital. So here my equity share capital account will be debited by. So what happened that now you debited here the equity share buyback account and you credited the equity share buyback account that here now. That gets cancelled that here now. That gets cancelled that now here. But if you see the net effect, you have debited the equity share capital account, that is a decrease in capital. Okay, now say with me. Come on. Yes, say with me. Increase in capital. Say, come on. Increase in capital should be credited. Come on. Increase in capital. Do like increase in capital should be credited. Decrease in capital should be debited. So what is going to happen when I say that here increase in capital should be credited, decrease in capital should be debited. So when I do the buyback, when I'm doing the cancellation of my capital, decrease in capital should be debited. So here my capital will go down. So if you see the net effect, you have done the equity share capital account debited and bank account credited. Because when I say equity share buyback account we have debited, we have cancelled it. Okay. So first purchase and then what we have to do, we have to cancel it. But it might be happen. We have purchased here at what? By paying the more amount. Okay. So what should be the entry in that case for cancellation? Now if we have purchased at premium. Okay. So when I say if we purchase at what? Premium. So we have here debited the equity share buyback account. We have debited the equity share buyback account here. So obviously we have to cancel them. So when I say, let me cancel it. So I will say to equity share buyback account. But by how much? 15. So we debited here by 15 and we have credited here by 15. You got the point that here now. So when I say that here we debited the equity share buyback account by how much here? The 15. And we credited the equity share buyback account by how much here? Is the 15 that here now. Okay. Now, but what happened is that now we cancel it that here. But at the same time what we have to do? We have to cancel the capital. Share capital. So when I say cancellation of a capital, should I debit the equity share capital account by 15? No. Capital account it will always be recorded at what? Face value. So when we pass the entry here, what is going to happen that now? Share capital account cannot be debited by 15. It cannot be. Because the capital account always be recorded at face value. Yes. So there is a problem here. I cannot debit to share capital by 15. Correct? Because capital account will always be recorded by face value. So I will write it down that here now. Equity. I will write it down that here now. Equity share capital account should be debited by 10. It should be the equity share capital account should be debited by how much? 10 here. You got the point that here now. Now what is going to happen that now? When I say equity share capital account should be debited by 10 because it will always be recorded face value. What about the remaining 5? So we will create a new account and we call them premium on buyback account should be debited by 5. Now understand the point that now capital we cannot debit by 15 because the capital will always be recorded at face value. But we have purchased by paying how much? 15. So okay, now cancel that investment that you purchased at 15. We credited them. But capital when you're cancelling you cannot debit by 15 because it always be recorded face value. So remaining 5 will go to securities premium. Okay. Now what happened when we see the question? Either we have purchased, it can be any combination. If you have purchased at par, so this entry will come. equity share buyback account debit to bank, and these entry will come. They are connected that. Okay. If you have purchased at premium, here the entry will be same amount will change that here now. 15 it will come. But here we cannot cancel the capital by 15. We will write it on face value only, and the surplus 5 will come premium on buyback account. Now, what is the sequence here? First issue of the shares in the market, that issue of the shares in the market. It might be at par or it might be at premium. We are issuing here. Then when we come to the buyback, first step to purchase our own share. It might be purchased at par or premium. Then we have to do the cancellation. If you have purchased at par, so this entry will come. If you have purchased at premium, so this entry will come that. Okay. Now, write down the one more entry that here now. That is write down the adjustment of premium on buyback. What does it mean, premium on buyback? We have debited to one account here. Okay, we have debited to one account here, and we call them premium on buyback. You can see that the premium on buyback, correct? Now where it will come? Imagine the balance sheet. Debit balance. Where it will come that? We understand that here equity share buyback account get cancelled. My capital get cancelled that here. But we created new account premium on buyback. Where it will come? We have to adjust. We have to do the adjustment of this premium on buyback. Okay, we have to do the adjustment of this premium on buyback. We want to cancel it basically. So if we want to do the cancellation of it, we have debited a premium on buyback account. What we have to do that now? We have to credit them. So what we'll do that now? We have to cancel them. So I will write it down that here now to premium on buyback. That is 5. So what is going to happen? We are going to credit to what here? The premium on buyback account that. So what happened that now we debited to premium on buyback account. So what we have to do that now? We are crediting here. We are cancelling that premium on buyback. So it get cancelled there. So we debited there and we credited. We have to cancel them. But basically this premium on buyback, we have to adjust with something that here now. We have to adjust it with something that here. So with whom we will adjust it that? With whom we will adjust it that here now. So they say that here now, always give the priority that here now. We can adjust it against the securities premium. The first priority I will give that here to securities premium account. Okay. Or securities premium account. If we don't have a balance in any securities premium account, so you can go for the profit and loss account surplus balance, or you can go for the general reserve account also. Okay, this should be the sequence that here now. Okay, now what happened? These are the 4 entry only that you have to remember that here. Okay, what is the first step that here now? Issue. If you are going to the issue of shares, it may be at par or premium. If it is at par, so bank account debit, equity share capital account credit by 10. If it is at premium, if it is at what? The premium. So bank account debit. Always remember that capital will be recorded at what? Face value. So we recorded at what? 10. And securities premium account will be credited by 2. Now we will talk about a buyback. When we talk about the buyback, it might be at what? Par. So no problem. We purchase it like investment account debit to bank. But we don't call it investment, we call it equity share buyback account. Okay. So if you put equity share buyback account or investment account debit to bank, I'm calling it investment to make it simple for you. Investment account debit to bank. Then we have to cancel that investment against the share capital. So decrease in investment, decrease in assets should be credited, and decrease in capital should be debited. So equity share capital account debit to investment account. But if we purchase the investment at a surplus amount, we purchase 15 suppose. The investment account, here it will be recorded at the whatever price we have paid at the time of purchase. The investment account debit to bank. We have to do the cancellation. So investment will be credited. But we cannot debit to capital by the 15. The reason is that here because capital will always record face value. So we will do the debit by 10 and remaining 5 will go to premium on buyback we have paid. Okay. Then this premium on buyback is not a good thing. We have paid additional amount. It is like an expense for us. But it should be adjusted with something that here. So this is the expenses or loss we have that should be adjusted against this profit. This is what we are doing that here. This is the expense or loss we are adjusting against this profit. So this premium on buyback will be cancelled against that can be first priority should be adjusted against the securities premium account we have or the profit and loss account balance here or general reserve. These are the entry that we have to pass. Now one thing what I'm telling to you, listen carefully that now. They say that here now, what one thing you should have to remember. I'm writing it down that here now. Very important. Replacement of, okay, replacement of capital should be with capital. So replacement of capital should be with the capital. Now please understand this. What does it mean that is? Replacement of capital should be with capital. What does it mean that here? Because they say that here now, the Companies Act says that whatever amount of capital is going down, my capital is decreasing here. That when I do the buyback, when a capital is decreasing, you can see that here now. My capital will go down. In both the cases, we are debiting either the premium or par, whatever. My capital is decreasing here. Decrease in capital here. Correct? Yes, sir. Decrease in capital. Okay, decrease in capital. And it will always be decreased at what face value. So they say that here now, my capital is decreasing. But what is the replacement of capital should be with capital? They say on one side, if your capital goes down, minimum that much capital should be increased. So that's why I say replacement of capital should be with capital. So if my capital goes down, my capital, at least that much capital should be increased. So when we issue the shares that here now in the market, your capital increase there. Correct? Your capital increase there. So here it is increase in capital. Increase in capital. So you can see that here my capital increased by 10. Here my capital either it will be par or premium, whatever is that here now. It 10 or 10. You can see the increase in capital by 10, decrease in capital by 10. Don't say, sir, increase in by 10, decrease by 20, 10%. Listen, either it will be at par or premium. Okay, so increase in capital by 10, decrease it by 10. This is what the Companies Act say. The minimum that much amount should be increased. The capital should be increased by the amount that we have decreased the capital. If it decreases, but this is what Companies Act say. If the capital decreased by 10, my new capital increase in capital should be at least by the 10. That's always remember that. When you will solve the question, always cross check it that here now. When you do the buyback, your capital goes down. Whether this with the at least with the same amount there is increase in capital or not. It should be happen that. Okay. So now, but I don't want to do all this. What happened? You see, what happens? Why do you want to do all this? I say listen that now. What is this? Why should I issue the shares in the market? Rich company we are. We have enough fund we have. Why should we do all these, the issue of the shares in the market? We don't want to do this that here. Okay. So I want to go with some other option that here. What other option we have? The company have given us some other option that here. So they have given us the option that here. Okay. They have given us the option that here now is to here is the out of profit. So in case of out of profit, we are not issuing the shares. It is not applicable to us because the first entry is not applicable to me. You say why? Because we are not issuing the shares that here. We are not issuing the shares in the market. The first entry in case of issue of shares is the issue of shares in the market. But we are not doing that when you talk about out of profit. Correct. Okay. Please be focused here. Okay. Next comes the second that here now. Whether we are going to pass the same entry that here. Yes. This is going to come. When you talk, all the buyback entries will come. We purchased. Same entries will come, whether we purchase it par or premium. Same entry is going to for what? The cancellation of shares will come. And the same if we have done the buyback, we have purchased at the premium on buyback, same adjustment will come. Same to same. It means that you will tell me, sir, it means that here we have to pass just 3 entries. When we do out of profit, how many entries we have to pass? 4 entries that here now. But when we talk about out of profit that here now, when we do out of fresh issue of shares, we have to pass 4 entries. They will tell me, sir, when we do the out of profit, how many entries we have to pass? In that case, we have to pass, you'll see 3 entry. Because no need to pass the entry for issue of shares because we are not issuing shares at all. So what does it mean that here now? What entry will pass that here now? So when we talk about this, the 4th one that now. Now one additional entry will come there. And I say that here, transfer to CRR. Write down the transfer to CRR. You say, what is this, sir? Transfer to CRR. Sir, what is this, sir? Transfer to CRR. I will explain you, don't worry. They say that here now. Okay. The Companies Act. Suppose this Companies Act. I say, listen, Companies Act. Why should I issue the, I'm talking to Companies Act. Listen, Companies Act. Why should I issue the shares in the market? Why? Tell me why. I have enough fund. So much of fund I have. Why should I issue? I have so much of fund. This amount. Okay. There's so much of fund I have. Why should I issue the shares in the market? Why are you putting a burden on me to issue the shares in the market? You don't know. I'm so rich. Example I'm giving. Okay. You don't know. I'm so rich. I have so much of amount I have. My company is so big. Why should I issue the shares in the market to raise the fund? I have enough fund. Tell me the option. I'm talking to you, Companies Act. Tell me the option. What option you have if I don't want to issue the shares in the market? Can you give me some other option to do the buyback without issuing the shares in the market? Now Companies Act. Yes, I have some other option. I ask you, what option you have? They say you have one option. You can do the buyback out of profit. Oh, so you are giving me some other option to do the buyback out of profit. Yes. Now these companies are calling me. Yes, you have the option to do the buyback out of what? Profit. Okay. Companies Act. So you are giving me the option to do the out of profit. What is this out of profit, Companies Act? So they say, listen, when you do the out of profit, you have to reduce the profit. What is this? I have to reduce the profit? Yes. You have to reduce the profit. I say, what? I have to reduce the profit? They say, yes. You have to reduce the profit, and that profit should be transferred to a new account, and the name of that account is CRR. So it means, sir, you're telling me I have to reduce the profit and I have to reduce some reserve, and that reserve should be that amount that I'm reducing from the reserve should be transferred to the new account, and the name of that account is CRR. Suppose, now understand that here now, I have, this is the reserve. So I have reserve and surplus. Okay. So you are telling me that now, and this is the one account, I call it a CRR account. So you are telling me basically, this reserve should be cancelled. I have to cancel this reserve. Yes. And what I have to do that now? I have to transfer it to that. Where should I transfer it? I have to transfer it to a new account. You call it CRR. This is what you are saying me. I have to do that when I say I don't want to issue the shares in the market. Then companies like say, yes. The same you have to do. You have to reduce certain reserve and you have to transfer it to a new account. That is CRR. Okay, companies, that I will do that. But can you please tell me, why should I do this? Why should I reduce the reserve and certain reserve and transfer it to the CRR account? It's a capital redemption reserve account. I will come to that. Don't worry. So why should I reduce the reserve and transfer to some other account? Then companies that do one thing. First pass journal entry. Then I will tell you the logic. Okay, companies, like let me pass the entry and then you will tell me the logic behind that. Why you want us, when we say out of profit, why you want us to transfer the balance of reserve, how much I will tell you, to CRR account. So okay, let me first pass my entry with you, with these talented students, and then you are going to tell us the logic behind that, why we do that. Okay, now come on, write it down, dear students, write down there now. Now apply the logic that is reserves as credit balance, because reserves are the profit, that is okay, credit balance that now they say that now, if I am utilizing it, we have to debit it. Increase in reserve, always be credited. Decrease in reserve, always. It's like a capital. No, sing with me. One song will sing. Okay, come on, sing. Increase in capital. Listen. Sing with me, come on. Increase in capital, credit. Decrease in capital, debit. Okay, similarly for reserve also. Increase in reserve, credit. Decrease in reserve, debit. What a beautiful song it is. Okay, now understand this. Now what happened that now, if I say I am going to utilize certain reserve, I am going to utilize this reserve and surplus. I want to utilize that. When I say I want to utilize that here now, I am decreasing that here. So yes, so which reserve? They say you can utilize the free reserve. What do you mean a free reserve? Any reserve. From that we can give the dividend. Basically we call them free reserve, like a general reserve. So general reserve we will debit that here. Now how much? I will tell you. Don't worry. General reserve. Okay. Now profit on loss account surplus balance we can utilize that. And you know that companies that say you can utilize what you can utilize, the free reserve you can utilize. Okay. This general reserve is the free reserve. This profit and loss account balance is the free reserve balance. That is surplus balance that is. Free reserve means some reserve that we can utilize for the purpose of what dividend. So these are the free reserves. Okay. So when I say that here now, these are the free reserves. What does it mean that here when I say these are the free reserves that I can utilize that here? Now what is going to happen that here now? But Companies Act say for the purpose of buyback, free reserve and securities premium also. So I can utilize to transfer to CRR securities premium account also. Okay, we'll debit that here. So we are utilizing reserve. What does it mean? Come on. You should be a very, very, very talented student. Now utilizing what? Utilizing reserve to transfer to CRR. So what we are doing that here now? We are utilizing the reserve. To transfer to what here? The CRR that here. So we cancel the reserve that here. Okay. But to which account we are going to transfer? We are going to transfer to CRR. Increase in reserves. We are going to transfer CRR. Capital Redemption Reserve account. Okay. Done. But sir, what is the amount, sir, here? And why? I will come to logic. Later on, I will come to logic. Don't worry for that. But what should be the amount, sir? Listen carefully. When I say replacement of capital should be with capital. So where you decrease the capital, suppose by 10. You increase the capital at least by the 10. Correct? But here there is a decrease in capital will come here. Same. But there is no increase in capital because we are not issuing the shares in the market. So I will tell you the logic. But always remember that when I say CRR, it is going to always at what? Always, write down there, always at face value of shares buyback. The shares that we have done the buyback, whatever their face value, that much amount should be transferred to the CRR account. So we have done the buyback, whatever the face value of the shares, face value means this, whatever the amount that we have decreased the capital by 10 here, okay, we have to transfer the 10 here. This is what they are saying, okay. But I say, sir, okay, I understand that here. This entry, I understand the decrease in capital, increase in capital. I understand that, sir. We have passed the entry, but I have one problem here. What is the problem, sir? You tell me that, sir, but the problem is that here now. You will ask me that you told us that here, at the starting that here, replacement of capital should be with capital. Correct? Yes. Replacement of capital should be with the capital. Correct that here. Now, what is going to happen that now, when I say replacement of capital should be with the capital that now, here, the same entry you're passing that here now, you decrease the capital, but there is no increase in capital. When you say out of the profit, you're transferring certain reserve to some other reserve. This is what we are doing that. We are utilizing certain reserve, transfer to some other reserve, sir. But you will ask me, sir, but there is no increase in capital here. When you do the buyback, capital will go down. But we are not issuing the shares in the market, sir. So there is no increase in the capital. I agree with you that here now. That's why the company seeks to transfer to CRR. Now you will ask me, sir, what is this? The company that to transfer to CRR if we are not issuing the shares in the market. How it is increasing the capital? It is increasing the CRR account only, Capital Redemption Reserve account. It is not increasing my what we call them. It is not increasing the capital, sir. It is increasing the reserve. It is not increasing the capital here. I agree that here now. But let me tell you the logic behind that. Now what happened that now? As per the Companies Act also that. I am coming to the logic. Okay. They say as per the Companies Act also, this CRR account, it can be utilized only and only for one purpose. You say what? This CRR account, write down. It can be utilized only for one purpose. You know, that is what? Bonus shares. So when the company, later on that, this CRR account cannot be utilized for any other purpose. It cannot be utilized. When you transfer to CRR account, it cannot be utilized for any other purpose. It cannot be utilized for any other purpose that here now. That CRR account can be utilized only and only for one purpose. That is what? For the purpose of bonus shares. Now again you ask me, sir, okay, we understand that CRR, whenever we will bonus share means we give the free of cost shares to the existing shareholder. But in future, you are not giving today. But in future, when you will give these bonus shares to the existing shareholder that now, So the CRR account can be utilized at that place only. It cannot be utilized for any other purpose. The CRR will be utilized for one purpose only, that is for the purpose of what? Bonus shares. Now again you ask me, sir, okay, we understand that the CRR will be utilized only for the one purpose, sir. But sir, how it is going to increase the capital? It can be utilized only for the purpose of bonus share. But how it is increase my capital? This is the main agenda that we have when we talk about the buyback as per the Companies Act. The replacement of capital should be with the capital. We understand that when we issue the shares in the market, the share capital will increase, and we do the buyback, share capital will decrease. We understand. Decrease, increase, we understand there. But when we talk about the out of profit that year, there is a decrease in capital because we do the buyback. But where is the issue of the share? There is no issue of share that year. So how can I say that it is increase in capital here? So I tell you that no, we have transferred to CRR. Again you ask me, sir, yes, we transferred to CRR. But where is the increase in capital? Then again I say no, the CRR will be utilized for the bonus shares. Then you ask me, sir, but it will be utilized only for the one purpose bonus share. But where is the increase in capital? That is the twist here. There is no increase in capital today. When we talk about the out of profit, when we talk about the out of profit, there is no increase in capital today. There will be an increase in capital later on when we utilize the CRR account. Because when you issue the bonus shares, you know what happened? Your capital will increase that here now. Obviously, we issue the bonus share. So, let me pass the entry for your understanding that here. I don't want to be, I want you to be very, very sharp, talented student that here. Those who understand the root. Now understand. When I talk about the bonus share that in future, when you will give the bonus shares that here. So what entry will pass? You will tell me, sir, now share capital account will be credited because we issue the capital. To share capital account. Share capital account should be credited that is. So it will be credited by here, suppose 10. Correct? Now, can I debit to bank account here? No, because we issue the share bonus share free of cost. So here I will utilize CRR account. So don't you think so that CRR account that we have debited here, credited here, it is going to be cancelled later on in future, and that will be converted into capital only. So at that time there will be increase in capital. So today there is no increase in capital. Later on in life, when you will issue the bonus share, this CRR can be utilized only for the purpose of bonus shares. So it will be cancelled and it will be converted into capital only. It will be converted into the capital only. So there will be an increase in capital later on in the future that year. You got the point? This is how you should understand the concept that here. What the Companies Act says that increase in capital should be with the replacement of the capital should be with the capital that year. Now, what are the additional entries? When we talk about when we do the out of profit, when I say the out of profit that here now, what is going to happen that here now? Just give me a minute. Okay, when I say out of fresh issue of shares, this is the additional entry that we have. Okay, when I say out of profit, this is the addition, not the bonus will not come there. Okay, bonus is for understanding. I have write it on there. Okay, this is the additional entry that will come there. You got the point? So this is the only difference that they have here. This entry will come additional, and here this. Otherwise, all the remaining things are same that here now. Okay. Now one more thing that now one more thing which is important. And don't worry, we have not yet come to the question. It's 1 hour 23 minutes around that here. Still we are discussing concept only. I have not yet come to the question that. Okay, don't worry that here. When it will come to the question, understanding level increase more there. Okay, now understand that. So what is the here? When I talk about the, can I transfer to reserve? Yes, we can transfer to reserve that here now. Okay. Oh, now can we should we transfer CR? Yes, we should be transfer CR, but should reserve we utilize free reserve. But securities premium is not a free reserve. But remember that now. But as per the Companies Act, when we do the buyback that now, we can utilize the securities premium that here now. Okay. But I observe that in ICAI all the questions they avoid securities premium account to transfer to CRR. Here they utilize the securities premium. Here they utilize the securities. They give the priority here. So here we are giving the securities premium. We are giving at the time of to write off the premium on buyback. We are giving them priority. And here we are avoiding them. I'm in the sequence I have write it down. So here when you write it off the premium on buyback, you are giving a priority to write it off against the securities premium. But when you transfer to CRR that here ICAI observe the ICAI question, they avoided that. If I don't have enough balance in general reserve, if I don't have enough balance in P&L account, So basically, if I don't have enough balance in P&L account surplus, then we utilize the securities premium that year. Okay, remember all these points. Okay, I don't want to score you the 60 plus. To be honest, that's what you want. I want to score at least 80 plus in advanced accounting. And you are smart enough, you're a talented student. Don't worry. And in life, never ever believe that, never assume that you are not a good student. No, I am average. No, you're not at all average. You are a talented student. You just have to work hard at it. Nothing is impossible. Nothing is impossible. You have so much potential that you have. I'm telling you, you have so much potential that you have. Nothing is impossible. Okay. You have the potential, but what happens so many time in life? What happened that we don't see a situation that now. So we don't know how much caliber you have. When the situation comes in life, then you have no other option but to perform that year. So in that case, you start to perform in that year. Okay. Then you come to know how much caliber you have that. And you have so much of potential. You have that much of potential that even you don't know how much potential you have. So much caliber you have. You're very talented. Okay. Just believe in yourself, do the hard work that year. Okay. Now, go to the rapid gist. Go to the rapid gist that year. Okay. Now understand this. Do you remember that I discussed with the source of buyback? I told you I will commit later on that. Yes. The Companies Act 2013, this is section 60 subsection permits a buyback from out of profit. That is a free reserve, revenue reserve, general reserve, P&L account balance. Or that out of profit means transfer to CRR. When I say out of profit means transfer to CRR. So we can utilize this free reserve, revenue reserve, general reserve, P&L account balance. We can utilize the securities premium account as well that year, but priority give it to them. Or we have the option to out of proceed of shares issue, means out of fresh issue of shares. Okay. Now, but no buyback from the proceed means when we issue the fresh issue of shares, it should not be of the same class. We are doing the buyback. The fresh issue of shares should not be of the same class. If you are doing the buyback of equity, we are talking about equity. The fresh issue of shares will be the preference shares like. Okay. Now what we'll do that now, we'll take a break that now. We'll take a break. After break, we'll do the revision of all these entries from the rapid gist that here now. And then we have to solve a question. Now what we'll do that, we'll take a break for 10 minutes. Hello, all of you. Okay, now come to hear that the conditions for the buyback. What are the conditions that they as per the companies? Just theoretically, it is that here now. As per section 68, subsection 2, the buyback authorized obviously the article of association should be authorized to buy back. A special resolution should be passed. What is special resolution? At least 75% should be in a general meeting should be passed for the purpose of what? The buyback. Okay. All shares for the buyback must be fully paid up. Now we cannot do the buyback of the partly paid up share. Those shares should be fully paid up. No buyback within 1 year of the previous offer's closure. It means if you have done the buyback and today we have completed the buyback procedure, for the next year we cannot do for the 1 year we cannot do the buyback. It means there should be a gap of at least 1 year. Okay. Now these points I will discuss with you later on. Maximum number of equity shares that can be bought back. Okay, we'll discuss it later. Now here, come to here. The point number 6 that here. Okay. Now journal entries that here on buyback, nothing is new here. Nothing is new. We have already discussed this entry that here. So first is what? Out of fresh issue of shares. So what entry do we pass? First we pass the entry for issue of shares. So it might be at what? Par, or it might be at what? Premium. So bank account debited, share capital account credited. We already discussed it. Okay. If we issued at premium, so bank account will be debited, share capital will be recorded at face value, premium amount will go to securities premium account. Okay, this is for the issue of shares. Then we do the buyback. First, purchase our own shares. So investment account debit to bank account, but we don't call it investment here, we call it equity share buyback account. Then third entry, cancellation. If you have purchased at par, it's very simple that equity share buyback account that we have debited when we purchase it, we have to credit here. And which account should be debited? Cancelling capital. So equity share capital account debited. But if we have purchased at premium amount, so equity share buyback account will be credited with the same amount, like the 15 that we were discussing before the break. But capital will always be recorded at what? Face value, and premium amount will go to premium on buyback account. Now the fourth entry is the cancellation of premium on buyback. So premium on buyback account will be credited. But what is the first priority? Securities premium, then profit and loss account, then general reserve balance. You got the point. One more thing, revaluation reserve cannot be utilized for the buyback. It means here we cannot utilize revaluation reserve. We cannot utilize for to transfer to CRR and also to adjust the premium on buyback account. Okay. Now, if we are doing the buyback out of profit, 3 entry will be the same. Only what will come? The CRR entry. So first same entry, purchase of equity shares. So equity share buyback account debit to bank account. Here I have written just one entry, but even because the amount only change, but the entry will be same. Even you purchase at par or at what? Premium. Even you purchase at what? Par or the premium, that is the entry. Entry will be same. Equity share buyback to bank, equity share buyback to bank. Here. Amount will change here. Okay. Now we purchase. Now we do the cancellation. Now, if you have purchased at par, so we will credit to equity share buyback account, share capital account will be debit. If you have purchased at premium, equity share buyback will be credited and capital will be debited, and premium on buyback account will also be debited here. Okay. Now, third entry same, adjustment of premium on buyback. So we adjust first again the securities premium, P&L account general. Now, this is the new entry that we have. So this entry is additional entry here when we talk about out of what? The profit here. Okay. And if you're doing the out of fresh issue of shares, then this will be the entry. Okay. Additional entry that. This is only different that. So when we transfer to CRR, award, first general reserve P&L, award the securities premium. In general reserve P&L, there is no problem to utilize anything, but avoid the securities. If you don't have enough balance there, then you can utilize the securities premium account. Okay. What is CRR account? It's a capital redemption reserve account. So if buyback of equity shares or redemption of preference shares, okay. Now CRR we also do at the time of redemption, but don't worry about the preferential. That we'll discuss later on that, okay. Is made out of the profit, then CRR needs to be created. CRR is created to keep the share capital intact. What is intact? Because when we do the buyback, capital will go down, but we are not issuing the new shares in the market. That's why they say issue the CRR. So you will ask me how it will be intact. The reason is that now, because CRR will be converted into capital only when we issue the bonus shares. Okay, so in future capital will increase, it will be at same, decrease and increase. So to protect the interest of the outsider, how to protect the interest of the outsider? What is the logic behind that? Why? What is the logic? Why we have to issue the fresh issue of shares in the market? We have to do that, and why they tell us that here now? If you're not issuing the fresh issue of shares in the market, then we have to transfer to CRR. The reason is that if you see the balance sheet now, if I see the balance sheet, okay, just give me a minute. If I see the balance sheet now, this is the part of the capital, this equity share preference. So basically overall that if there decrease in capital, there should be increase in capital as well. Why? Because if suppose what is the logic behind? If the company goes into liquidation that now, so there is a hierarchy of doing the payment that now. So the company can do the manipulation that promoters know that here now. They can do the manipulation. Listen, the position of the company is not good, so we will liquidate the company after a few months. Let's do one thing, do the buyback. And they are the shareholders. So they have done the buyback of so many shares, or whatever the company that allow that. They have done that much of buyback. They have paid the amount. And then they declare that the company is going into liquidation. But now the outsider have an objection here. What the doubt the outsider has here? They will ask us that no. First, at the time of liquidation, we have to do the payment to the outsider, then preference shareholder, then equity shareholder. So the company can do the manipulation. They will do the buyback. Then they will declare in the market that they are going into liquidation. So they have already done the payment to them by the promoters. Okay, and then they say we don't have enough balance. So we cannot pay you. So it should not be happening. So they say, okay, when you do the buyback, they say do that, no problem. But there's a certain limit. We'll discuss the limit later on. But at the same time, you decrease in capital with the same amount, capital should also be increased. So it will be at intact at the same. This is a logic. Okay. Now they say that now CRR is, I told you that already. The CRR is going to be utilized So it is going to utilize only for the one purpose, that is what, the bonus share. So it will be utilized only for the purpose of what, the bonus share, that is. Okay. Now please understand one more thing that now. So first of all, I will come to this calculation of CRR, but always remember that if whether they will tell us that it is out of profit or out of fresh issue of shares in the out of fresh issue of shares, the answer is no. They will not tell you out of profit, that here. Okay. If they tell you, always, basic rule, we can write it down here also, always assume that it is out of profit only. What I'm saying, always we will assume that they are doing the buyback out of profit, unless and until it is specifically mentioned in the question that it is out of fresh issue of shares. What I said in a question, always assume that it is out of profit unless and until it is specifically mentioned in question that it is out of fresh issue of shares. Write down a note on it. Write down one note that here now. Note. If specifically mentioned, okay, if specifically mentioned in question that buyback is out of fresh issue of shares, then only it is out of fresh issue of shares. Otherwise, always assume out of profit. Otherwise, always assume that it is out of what? The profit here. You got the point? Okay. So we are going to always assume that it is out of profit unless and until it is specifically mentioned in the question that it is out of fresh issue of shares, that here. Okay. Now we're done with it. Now what happened? So there are two possibilities. It might be out of fresh issue of shares or it might be out of profit, that here. There is one more possibility also. It might be a combination of both of them. You say, oh, so it means that it might be a combination of both. So what should we do in that case here? So remember, if it is a combination of both of them, that the portion which is out of the fresh issue of shares, that we will find it out how much is the total buyback, how much is out of fresh issue of shares, and remaining will be the out of profit. Now please understand one point here now. What it says that here now, is the calculation of the CRR. CRR, that is amount on buyback of equity shares. So always remember that the replacement of, when I say the replacement of capital should be with capital. What is it? Capital. Always told you that it will always be a face value. Whenever I talk about the capital, it is face value. Whenever I talk about the capital, I don't care at what value we are doing the buyback. I don't care at what value we are issuing the shares to them. I don't care about that. When we talk about CR or when we talk about the face value, I am just caring about when you talk about the capital, I just care about what is the face value. So if suppose I have done the total face value of the equity share bought back, if you have done the buyback of shares of, let's say that 1 lakh rupees, the face value of the shares we are doing the buyback is 1 lakh, and we issue the fresh issue of shares in the market and their face value suppose is 60,000 that year. It means the remaining out of profit. It's remaining out of profit. This is how we find it. It might be a combination of both of them here. Okay. So total face value of the share, suppose we are doing the buyback, it is 100,000. And we are doing the face value of the share we are issuing in the market is 60,000. So how much we have done out of the profit? That is 40,000. Okay. So when we talk about the CRR, when we talk about the capital, it will always be the face value, and face value. The capital will always be recorded face value. And the rule is that in CRR also nominal value means nothing but a face value. In CRR account also we are going to transfer the nominal value, that is the face value of the share which we are doing the out of profit. So with the capital we are doing the buyback of 100,000, we have done the out of fresh share is 16,000. So 40,000 will be the what out of the profit. You got the point here? Okay. Now we have discussed so many things that here now. Now what we'll do that now? We will go to the question number 1 that now. Okay. One more thing is that now. So now remember, keep it in mind that now we are going to say out of fresh issue of shares only when it is specifically mentioned in the question. If it is not specifically mentioned in the question, we are going to assume that out of fresh issue, out of profit only. Okay. Now, from arrangement of fund, it can be done from anywhere. Now understand it. They are not talking about that now. So arrangement of fund can be from anywhere. So many times they will give in the question that they have sold this fixed asset, they have sold this investment. They will give in the question. So now come to point number 7, from where they are arranging a fund. For example, journal entries on the sale of investment. Very simple. Suppose this investment is of, let's say the 10,000. So you sold at 12. So you sold at profit that day. When I say you sold at profit, so the bank account will be debited by 12,000 example. But cost means we listed the WDV. What is the value of the investment? Suppose 10,000. So remaining 2 is a profit. It will go to P&L. Suppose the book value is 10,000, you sold at 9. So you sold at loss. So you receive how much? You receive 9,000 will be debited. Loss will be debited 1,000. You are going to credit by 10,000. So they might give you the question that you sold the investment at profit or loss. Accordingly, you have to pass this entry. And there is no restriction from where we are arranging the fund for the purpose of buyback. No restriction for that. But remember, the replacement of capital should be with the capital. So when we do the buyback with whatever amount we are decreasing the capital, with the same amount we have to increase the capital. If it is not out of fresh issue of shares, out of profit, we have to transfer the value to the CRR. And CRR later on will be converted into the equity, the share capital only. Okay. It's 1 hour 50 minutes. We just discussed about the concept that now. Now we are coming to the question now. Now please come to question number 1. Go to their question back. Okay. Now come to page number 46 at here now. What it says that here now, it says here now, it's ICAI study material question similar in RTP November 23 and RTP May 2024. Okay. Now KG Limited furnished the following balance sheet as of 31st March 2021 and rupees in what? Lakhs. Remember. So they give us that here now equity and liabilities, shareholders fund, share capital, note 1, 1,200, reserve and surplus, note 2, 810. Then we have non-current liabilities, long-term borrowing, note 370. You know why I covered financial statement first? Because here in this step, all the financial statement will come. You see the financial statement. This how will come to know that if you don't know, how will understand this balance sheet if you don't know about the financial statement of company as per schedule 3. That's why always I started with the financial statement of company. Okay. Now we have the long-term borrowing, that is the note 3750. Then we have a current liabilities, that is a trade payable 745 and the other current liability 195. Then they have assets, that is non-current asset, that property, plant and equipment note for 2026, non-current investment 74, current asset inventory 600, trade receivable 260, cash and cash equivalent 740. The notes to account, that when we talk about the notes to account, it is coming first. Notes to account is share capital, authorized issued subscribed capital, equity share capital, fully paid up shares of rupees 10,200, reserve and surplus, securities premium 175, general reserve 265, capital redemption reserve 200, profit and loss account 170, total is 810. Now understand, this is already a capital redemption reserve account which is appearing in the balance sheet which is given in question that now. Now what happened when I say which is already appearing this capital redemption reserve account, it means they have done the buyback in the past also. At that time they have created this CRR account. That's why it is appearing here. They have the long-term borrowing which is a 12% debenture 750, then property, plant and equipment property, plant and equipment, the land and building 1,800, plant and machinery 226, and the net carrying amount, the book value is how much? 2,026. They have given us the information, the balance sheet that they have given. Now they tell us that now on 1st of April 2021. Now please write it down with me. Now give the heading there. Okay, give the heading there. Okay, question number 1. Something I am discussing with you, so it will be easy for you to understand the concept that you know. Now, okay, now here 1st of April 2021. Okay, 1st of April 2021. That what it says that here now on 1st of April 2021, the company announced the buyback of 25% of equity share at rupees 15 per share. So what they have done that now, the company announced the buyback. How much buyback that they have done? 25% of at the rate of rupees 15. They have done the announcement here. They are not doing the buyback that here on 1st of April. Are they doing the buyback on 1st of April 2021? The answer is no. They are not doing the buyback there. What they are doing on the 1st April 2020, they are doing the announcement here. So what happened that here now? Announce. Write it down. Announce. Okay. They have done announced for
buyback, announce for buyback. Okay. Then they say for this purpose, it sold it of its investment for rupees 75 lakhs. So, but at the same date, what they have done, they have sold the investment. An investment sold. They have sold the investment here. Okay, they have sold the investment here. Okay, now then they say here on 5th of April 2021, the company achieved the target of buyback. You know what is it? Achieve the target. There are some condition as per the Companies Act. We have not yet discussed because it is going to come later on in this chapter only, obviously. There's sometimes achieve, but there's some target. So what is the target? I will discuss it later on. But they have to, for timing understand, they fulfill all the condition of the Companies Act. Okay. So they are doing, actually they have achieved the condition, but fulfill the condition 5th of April. They are doing the buyback on 5th of April. So write it on 5th of April 2021. They're doing the buyback here. Buyback. So when I say they are doing the buyback, how much buyback they are doing? They are doing the buyback. It is mentioned that now is how much buyback they are doing that now. They are doing the buyback of 25% that here. Okay. Now at what price? 15 per share. Okay. Now understand how much shares that they have. If I go to the share capital account, they have 1,200 is the amount and the share is of rupees 10. So I can say number of shares. Number of shares, if I say this is 1,200 is in lakhs and divided by rupees 10. So that is coming 120 lakh shares. Why 120 lakhs I am saying? Because the figures is in lakhs. So 120 lakh shares it is. Okay. So this is total number of shares. Now, okay, always whatever I am writing, you have to write it down. If I am writing down in the question bank, you have to write it in question bank. If I am writing down, this is my notebook, you have to write it down in your notebook. Okay. Now when I say the buyback, that now writing down 120 lakh shares. Multiply by 25%, we are doing the buyback. So how much it will come? 120 lakh shares multiply by 20, that will become 30 lakh shares. So we are doing the buyback of how much? 30 lakh shares. So how much shares we have? 120 lakh. Out of that 25% we are doing, that is coming 30 lakhs. Then they say that now, they also talk about the bonus shares here also. Then they say on 30th of April 2021, the company issue one fully paid up equity share of rupees 10 each by way of bonus share for every 4 equity share held by the equity shareholder. It means for every 4 shares, they are issuing 1 share as a bonus share. Now don't worry about what should be the entry of the bonus shares and all that I will discuss with you. But don't worry for that. But for every 4 shares, they are issuing 1 as a bonus share. What is bonus shares? Bonus share basically means we are giving the shares to the existing shareholders. We are giving them certain shares as a free of cost. So I will discuss the accounting entry. Don't worry for that. But what is this bonus shares that here? Bonus shares basically means that we are issuing the shares free of cost to the existing shareholders. So when I say that here, we are issuing the free of cost to the existing shareholders that here. How much? For every 4 shares, we are giving 1. So write down that here on 30th of April 2021. So what they are doing, they are giving the bonus shares. Bonus shares. So when I say bonus shares that here now, how much total number of shares that we have? First of all, initially 120 lakhs it was. Now write it down in details. 120 lakhs shares we have initially. Out of that here now, we have done the buyback of 30 lakh shares. 30 lakh shares. We have done the buyback of 30 lakh shares. How much shares that we have now is 90 lakh only. Why 90 lakhs? Because we have already done the buyback. We don't hold here 120 lakhs. We don't hold here 120 lakhs. How much we hold that here? We hold only 90 lakhs because we have already done the buyback of 30 lakh shares. Now, when I do the buyback, so we on that date we hold 90 lakh shares. Okay, if for every 4 shares that here now, we are going to give them what? 1 share as a bonus shares. So 90 lakhs divided by 4 multiplied by 1. So that is coming 22.5 lakh shares. Now somebody will tell me, no, sir, this is incorrect. Ask why it is incorrect. You tell me, no, sir, the reason is that The shares we cannot issue in points. So we are issuing 22.5 lakh shares. You will tell me, sir, how can we issue the shares in the fraction? No, understand this point. This is not 22.5. This is 22.5 lakhs. It means 22 lakh 50,000 shares. These are okay. Now we have discussed what is the background of the question. Okay. Now in examination, you don't have to draw this. So why we are doing this here? For your understanding, that is for your understanding. When you will do the revision, you will understand what is mentioned, what they have given in the question that now. Okay. Now what you will do that now here. Now they ask you that pass the journal entries. So they ask you to pass the journal entries for the above transaction, and then we have to prepare the balance sheet after the issue of bonuses. Okay, one by one. First we'll pass the entries, then we'll go to the balance sheet. Write on there. First they ask us to pass the entries. So write on first. Journal entries. Okay, write down their journal entries in the books of KG Limited, rupees in lakhs. Okay. Now what we have to do that now? We are going to draw it for around 1 page it will take. Okay, so now accordingly you have to draw it, but I have the option, I can draw it, I can remove it. Okay, I can do that, but you remember it will take around 1 page. So accordingly you have to draw that. So for one column is on the date, one column is on the particulars, then the debit amount and the credit amount. Okay, so date, particulars, amount. Okay, date. Done. Okay. Now for a reference, I will also write it down. First, we are doing the sale of investment. What we have done on 1st of April. On 1st of April, we have done the announcement here. So we have done the announcement here. So no entry for the announcement. But at the same time, we have sold the investment as well. So what is the value of the investment that which is appearing in balance sheet? The value of the investment which is appearing in balance sheet 74. Is how much? 74. Okay. Now the value of the investment which is appearing is 74. How much that we have here? But we sold at what price? 75. So the investment of rupees 74 we sold at what? At what price? 70. At a profit of 1. So write down there. So we are passing the entry for investment. For a reference, I'm writing it down. Investment. So okay, one more thing. Whether they have mentioned that they have issued the shares in the market? No. So we don't call it a issue of shares in the, it is completely out of profit. Only when they mention you out of fresh issue of shares, then only we'll consider it. Okay. Now write down in 2021 April 1st. So bank account debit, that is 75, to investment account, that is 74, to why? Because we receive the amount of 75. What is the value of the investment? 74. The one will go to the P&L account. So to write on to profit on sale of investment account. Write on in bracket profit and loss. So narration being investment sold on profit, being investment sold on the profit that year. Okay, done. Being investment sold on the profit that. Now then they mention that here we have done the buyback. So remember the buyback they have done the buyback what year out of profit. So no entry for the obviously issue of shares. We'll start from here. So one first purchase, cancellation, if there is any premium on buyback, adjustment of premium on buyback, and CR. These 4 entry we have to pass. That's it. First we purchase, so entry we purchase. So at what price we purchase the shares? We purchase the share at rupees 15. How many number of shares we are purchasing in that year? We are purchasing it. How many number of shares we are purchasing? 30 lakhs. Okay, so write down that here now. The face value is 10. We purchase 15. Okay, so basically this is the case of this point. Here there is no premium will come. Okay, purchase the equity share buyback account will come to bank account, and then we'll do the cancellation. The first pass the entry for the purchase of shares. Write down there. Now here buyback. Now April 5th Now equity share buyback, it's like a purchasing or investment account debit to bank account, but we don't call it investment, we call it equity share buyback account. So equity share buyback account should be debited 30 lakh shares. We can make a working note on this also, how we have calculated these 30 lakh shares. So you can say 30 lakh share bracket, write on working note number 1, make a working note on it. Multiply by, at what price we purchase? 15. So 30 multiplied by 15, that is 450 lakhs. To bank account, 450 lakhs. Okay, being the payment made on account of buyback of 30 lakh shares, 30 lakhs equity shares. So what entry do we have passed here? The purchase here. Now what is next entry? Purchase of shares. Then what entry will pass? This cancellation. Now on the same date, we have to pass the entry for the cancellation. We purchase at more amount. Okay, so this premium we have purchased. So capital will always record at face value. We are coming to this entry. Okay, so write down there now. Equity share capital account debit. Equity share capital account will be debited, but it will be recorded face value. So 30 lakh shares multiply by rupees 10, it will be recorded face value. That is coming how much? 300. Now we have premium on buyback account will be debited here. 30 lakh shares multiply by rupees 5, that is coming how much here? 150 to equity share buyback account. That investment will be cancelled now. 450. Okay. Now write down there, being cancellation of shares bought back. Okay, being cancellation of shares bought back. Done. The first purchase, then cancellation. What is the third entry? The adjustment of premium on buyback. Do we have any premium on buyback? Yes, we have a premium on buyback. How much? 150. So when I say that here now, if we have, I'm coming to here, this third entry. Okay, premium on buyback. So first priority should be given to securities premium. So how much is the premium on buyback? We want to write it off. That is 150. So we have to check it. Do we have a 150 in securities premium account? If you go to the question, if you go to reserve and surplus, we have a balance in securities premium account. How much balance we have? We have 175. So we have enough balance in that. So we are going to give the first priority to securities premium account here. Okay. And we have enough balance. We want to utilize 150. How much balance we have? 175. So we can do the adjustment. What entry do we pass? Write down there now. Securities premium account should be debited here by 152 premium on buyback account 150 being write down being premium on buyback adjusted against securities premium account. Okay, adjusted against securities premium account. That you got the point. Okay, now it is out of profit. We are going to call it out of fresh issue of shares only when it is mentioned in the question. Okay, it is out of profit. So what we have to do that now, we will pass this fourth entry. We have to transfer to CRR. How much we transfer to CRR? The face value of the shares we have done the buyback. Okay, we'll see that. But we will utilize general reserve, P&L account, revenue reserve. But securities premium can be utilized, but it should be avoided. If we don't have enough balance in general reserve, P&L, revenue reserve, then only we'll utilize the securities premium. How much we need to transfer to CRR? The face value is the shares of buyback. How many shares we have done the buyback? This, what is the face value? 30 lakh shares we have done. What is the face value? 10. So 300. So we need to transfer to CRR as per the Companies Act 2030, 300 that here. So we'll see that do we have a sufficient balance? So you will see that, how much balance we have in general reserve? 265. How much we need? 300. So we will utilize 265 from general reserve and from P&L. Okay, don't utilize CRR. CRR utilize only for the purpose of bonus. Okay, don't utilize CRR. And then remaining 265 will utilize from the general reserve. Remaining 30 because we want to transfer to CRR 300. Remaining 35 will utilize from the profit and loss account balance that we have there. Okay, now write down there. Next entry. Okay, next entry now. Here, general reserve, account debit 265, profit and loss account should be debited. 300 total we have to transfer to CRR as per law, and 265 we are doing out of general reserve. How much it is? 35. To capital redemption reserve account 300. Okay, being, write down, being amount, okay, being amount equal to face value of buyback, face value of buyback of shares transferred to capital redemption reserve account as per law. As per law. Okay. Now we talk about the first sale of investment, then the buyback. So how many entry do we pass for buyback? So you can see that now. Okay, just give me a minute. We pass 4 entries. So first we talk about that here now. We purchase shares. Then we have done the cancellation there. Then adjustment of premium on buyback. Okay, adjustment of premium on buyback. Then here transfer to CRR. Okay. Now one more thing is given in question, that is what? A bonus share. So write it down that here. I will explain you this. Write down the bonus shares. Now we'll discuss the concept of bonus share and then we'll pass an entry on it. Okay. Come to rapid gist that here now. Come to page number in rapid gist 16 that here. Come to page number, not 6 page bonus shares. Oh, yes. Yeah. That is 16 here. Come to point number 9 first. Come to point number 9. What it says that now, general entry for on issue of bonus shares. So what is the entry basically we pass when we issue the share? Normally. So normally we pass the entry when we issue the shares. We credit to share capital account. Correct, we credit to share capital account, let's say suppose 10, but we receive the amount normally, so we debit to bank account. 10. But can I say we should debit to the bank account here? The answer is no, we cannot debit to the bank account here. Why? Because it's a bonus shares. So but something should be debited, so we are going to utilize the reserve and surplus. Why we cannot debit to cash or bank account? Because we are giving free of cost. Bonus shares we give what? Free of cost. So we cannot debit to the bank account because we are not receiving any amount from the shareholders. You got the point? We are not receiving any amount from the shareholders. That okay. So some reserve should be utilized that here. Okay. And priority should be given to CRR. Why? Because CRR is a reserve which only exclusively utilized only for the purpose of bonus share. If we are issuing the bonus share, let's utilize for CRR account. Okay. So we will debit to the CRR account if we have a balance. If we don't have it, then go for the general reserve and then for the penal account. Okay. But reserves account we have debited here. So we debited to the reserve account. Okay. We debited to the, just give me a minute. Okay. We debited to the reserve account right here. Okay. But what happens, say, because we are utilizing the reserve, we cannot debit to the bank account here. Now, please understand that now. Which account should be credited? Capital, because we are issuing the share. So my equity share capital account will be credited here. But what is this bonus to shareholder? First, we pass the entry for due. So we utilize the reserve and we tell them we are liable to pay something to the shareholder. We call them bonus to shareholder. Increase in liability, we are liable to pay. Here what happened? We are liable to pay. Liable to pay increase in liability. Now here we paid, but what we are giving, paying, what we are giving shares that. Liable to pay, we are paid that, but not the cash, we are giving them equity shares that here. So what happened? First we credit to bonus to shareholder and then we debit to bonus to shareholder. So first we pass the entry reserve account debit to bonus to shareholder means we are liable to pay them and we utilize the reserve. When we pay them, bonus to shareholder, we do cancellation of liability. Okay. Now, but we are not giving actual cash, we are giving them shares. So equity share capital account will be credited. If you see the net effect is reserve and surplus account should be debited and capital account should be credited. So reserve and surplus account should be debited here and capital account should be credited. This entry we pass for the bonus shares. Now, we already discussed that here now, but we'll make a working note also on how many bonus shares we are giving them. We are giving the bonus share 22.5 lakh shares. Okay. Now, write down the entries there. Write down there. April 30. Capital first, because we have enough balance in capital redemption. How much amount do we need? We are doing the bonus shares we issue 22.5 share of rupees 10. So 22.5 multiplied by 10, that is coming 225 lakhs. So do we have a 225 lakh in CRR? Here we have 200 we have, here we have 200. We'll say no, sir, only 200. No, wait. Already previous balance in the CRR we have 200 and we have also created a CRR here by 300. So that 200 and these 300, we have 500 balance. And we want to utilize only 225. So we have enough balance there. So capital, redemption, reserve account. Should be debited. 220.5 lakh shares. We'll make a working note on it. Working note number 2. Multiply, what is the face value? 10. That is coming 225. So capital redemption reserve account debit to bonus to shareholder account 225. So being the utilization of capital redemption reserve account to issue bonus shares. Okay. Now we will issue the equity shares to those shareholders. So I will cancel bonus to shareholder. The next entry, bonus to shareholder account debit. $225 to equity share capital account. 225. Okay, now write down there. Being issue of 1 bonus equity shares, for every 4 equity share. For every 4 equity shares. Okay, now understand this point. Okay, now please understand this point. Okay, now what happened that now they ask you to prepare the balance sheet also. We'll come to that balance sheet. But now the two amount you already know how we find it out is 30 lakh shares buyback, 25% of the shares which were outstanding 120, and the bonus shares calculation. But we'll make it an examination. You cannot draw this flow here. So you have to make a working note. So write on the working note. Okay. Working note. Working note. So write down the working note there. First here, number of buyback of shares. Okay, number of buyback of shares. Write down there. Total shares is equal to total amount was 1,200 lakhs. Rupee amount were in lakhs. Okay, divided by rupees, and that is coming how much? 120 lakh shares, total shares. Okay, write down buyback of shares is equal to 120 lakh shares multiply by 25%, that is coming 30 lakh shares. Okay, now working note number 2, number of bonus shares allotted. Okay, number of bonus shares allotted. So write down, initially we have 120 lakh shares. Out of that we have done the buyback of 30 lakh shares. Now we have only 90 lakh shares. For every 4 shares we are giving them 1 shares, so that is coming 22.5 lakh shares. Okay, done. Now we are coming to the balance sheet that here. Okay, now we have to draw the balance sheet, but very important thing I'm discussing with you. Okay, what is this? What they're saying that now we're discussing basics of accounting also, but you have to remember that now. Okay, now very important thing, draw it somewhere, write it down somewhere that here now. Okay, write it down somewhere that now. Okay, liability oblique equity means capital. Equity, when I say equity means capital, let it write on equity, let it on capital or reserve. Okay, capital or reserve that here now. If we credit them here, if we credit them that now, we have to add. What I'm writing, I will explain it, just write it down. But if we debit them, we have to deduct less. Now here for asset, the debit balance, if you're debiting them, we have to add them. If we are crediting them, we have to deduct them less. Now what happened? And the equity, liability, capital, reserve has a credit balance. Something which we has a credit balance, when you increase them, we have to add them. Okay, simple maths. Let me write it down here again. Okay, now I'm right. Don't have enough space, that's why I'm writing it. Okay, don't worry. You don't have to do anything. Just listen to that here. So when I say that here now, liability capital has a credit balance that here now. So something which we have, you can write it down that here, credit balance in bracket, credit balance. And asset has a debit balance. Okay. So what, it's a simple math that here, beta. If it has a credit balance and I am again crediting it, so credit should be plus, like the plus should be the plus, same. So if I say that now here, debit, let me write it down right now. Debit should be add. Now credit should also be add, minus should be plus. Debit credit minus credit debit minus, simple maths it is that here now. Now understand that here. When it's something who have a balance, credit balance, I'm crediting, credit. What happened? Credit plus. You can see that plus. It's a credit balance. What I'm debiting it here. So credit, debit, minus. So you can see that credit, debit, minus. You got the point? Right. Asset is a debit balance. So debit, debit, add. Debit, debit, add. Debit balance. We are doing credit here. If you are crediting the debit, credit, minus. So here debit, credit, minus. It's a simple math it is. You got the point that now? So why I am discussing with you here, it is important because when we will prepare the balance sheet that year, what is going to happen when we prepare the balance sheet that now? There's a one balance sheet which is already given in the question. One balance sheet which is already given in the question. So all the liability side or capital side item, they have credit balance. In our journal entry that we have passed all these entry, if to those items we are crediting them, so we'll add them. If you're debiting them, we'll deduct them. All the asset side item, they have a debit balance. If we are in our entries, if we have debited them here, we'll add them. If we have credit, we'll deduct them. And whatever amount is coming, we'll write it down in a new balance sheet. Okay. Now we are preparing a fresh balance sheet after all these buyback, bonus issue and all that. Okay. Now write down there now. They have asked you to prepare the balance sheet. So balance sheet of KG Limited, write down in bracket after buyback and issue of bonus shares, rupees in lakhs. Okay, rupees in lakhs. Okay, now draw this, not exactly one page, little bit less than one page. Okay. Now you know how to prepare the balance sheet. The same company's account, same schedule 3. Okay. Now note amount. Okay. Now write down there. Equity and liabilities. Under equity and liabilities, shareholders fund, shareholders funds, share capital, reserve and surplus, reserve and surplus, non-current liability, long-term borrowing, write down long-term borrowing, three, current liability. Now understand, when we go for the financial statement of company chapter, where we write it down so many items, right? But whatever given in the question, only that we have to write it down. Here in their current liability, they have trade payable, other current liability. That's it. Okay, no need to write a short-term provision and all that. Okay, in the financial statement, the main chapter is the financial statement. Here, whatever that they have item that they have given in balance sheet, that much we have to write it down. So trade payable, trade payable, other current liabilities. Okay, then asset. Non-current asset, property, plant and equipment, then intangibles, non-current investment. Okay, write a non-current investment. Then here current asset. Okay, in current asset that we have here is current asset, three things: Inventories, trade receivable, cash and cash equivalent. So inventories, trade receivable, trade receivable, cash and cash equivalent. Cash and cash equivalent, done. Now, how many notes to account? We don't have to worry here. We worry about the notes to account when we in the financial statement of company chapter. Whatever is given in the balance sheet, how many notes to account? 4. Capital, reserve and surplus, long term and PP. That's it. So share capital, reserve and surplus, long term borrowing, and what? The PP, property plant equipment. That's it. Okay. Now, one by one. Okay, we will draw all these notes to account. Don't worry that. First, write it down that is notes to accounts. Okay, one by one. Now, notes to account number 1, share capital. Okay, share capital. Now, please understand. I told you, remember these rules that these are the rules of the basics of accounting. We are taking the figure from the liability side first. Okay, they have a credit balance. If in our entry we have credited to that item, we'll add them. If we have debited to that item, we'll deduct them. Okay, now go to that here now in balance sheet. So first is the share capital, notes to account number 1. So we'll go to notes to account number 1. We have an equity share capital of 1200. So 1200, type in calci 1200. Okay. Now come to journal entries that in entries whether we have done anything to capital that here. First entry, is there any capital here? No. Second entry, capital? No. Third entry, yes, we have debited that here. So I will deduct. We have debited. They have a credit balance. We are debiting them. We have to deduct them. So minus 300. You can see that here. They have a credit balance. We have debited them. So that's why I deduct that here. They've deducted this. Now here in this entry, is there any capital? No. Capital, no. But here we have issued the bonus shares. So 225 we credited. So they have a credit balance. We are crediting them. So what way we have to add them? Plus 225. That is coming 1125. There are some bonus shares. So we have to mention them. Do you remember that in a financial statement of company chapter, I mentioned you that here other than cash consideration, we have to mention them. We'll mention them. But the amount is coming 1125. So write down there now. Authorized, issued, and subscribed capital. So 1125 divided by 10, that is coming 112.5 lakh shares. Lakh shares of rupees 10 each. 1125. Now write down there. Out of the above, 22.5 lakh shares issued as bonus shares. Okay, so total is 1125. If you want, you can write it down that here. 1125. Okay, now second that, go to balance sheet again. We have reserve and surplus, notes to account number 2. There are so many items. So reserve and surplus plus first is securities premium. So whether we have done anything with the securities premium account, the balance is given 175. Go to entries that now. So here we have debited by 150 here. So we have utilized 150. So reserve has a credit balance. We have debited, so we have to minus them. 150 will deduct. Okay. Now write it down there. Notes to account number 2. That is here reserve and surplus. Reserve and surplus. Securities premium. Securities premium, that here, how much we have here? 175 less. Right on inner column 170, we have utilized. As per the companies, we have to give the proper bifurcation where we have utilized this reserve. Okay. So utilized to adjust to adjust against premium on buyback. Premium on buyback. So we have utilized this. Out of 175, utilize 150. So the balance that we have is how much coming? 25. Okay. Again, go to balance sheet now. We have there is second is the general reserve, but we have completely utilized the general reserve. 265 it is. We utilize it for transfer to CR. You can see that 265. Okay. 265. In examination, don't tick like this. Just give the point, something like that. Okay, that you can observe that. Okay, 265. Now, write down. We have utilized completely. So write down general reserve. How much balance we have? 265 less transferred to capital redemption reserve. 265. So how much balance we have in general reserve? Nothing. Nil. Okay. Now again go to balance sheet. Now after general reserve we have a balance of what? Capital redemption reserve. So 200 we have balance here. But if you remember, when we pass the entry, we credited here by 300. So we increase the CRR by 300. So 200 plus 300, 500. But we utilize also CRR by 225. So minus 225. I will explain it. In balance sheet is given 200. We credit here, credit balance reserve, we credit plus 200 plus 300, 500. Then we debited them. So minus 225. Okay. Now write it down there. Capital redemption reserve 200. Add transfer on buyback of shares. When you do the buyback, we transfer there. How much we transfer? 300 less utilize for bonus shares 225. This is 200 plus 300 minus 225, that is 275. Write in outer column 275. Okay, then we have here next is profit and loss account 170. First write it down, then I will discuss profit and loss account 170. Okay, then when we pass the entry, what we have done in the first entry, remember that we have the profit on sale of investment, it will go to P&L. We credited there, so we will add them, and we utilize remember that we utilize some portion of the P&L to transfer to CRR. So here you can see that we utilize the 35 year. Okay, so that we debited, yes, we will minus them. So write down there now. Add profit on sale of investment 1 less transferred to capital redemption reserve 35. So 170 plus 1 minus 35, that is coming 136. So write down inner column 136. So we write it all item of reserve and surplus. Now we have to do the total here. So that is here 25 plus 275 plus 136, that is coming 436. So write down in balance sheet 436 that. Okay, write down there in balance sheet 436. Okay, so 436 done. Okay, then we have here is go to the balance sheet again. Then we have a long-term borrowing. There is no change in it. Notes to account number 3. If we go to notes to account number 3, that is 12%. This same 750. We have to write it down. Notes to account number 3 now. That is long-term borrowings. 12% debentures. 750. Okay, write down in balance sheet 750. 750. Okay. Then we have here in balance sheet, we have here is the go to balance sheet. Now we have trade payable, no note stock or no change, that is 745, and other current liability 195. 745, then 195. 195. Okay. Then here asset side, that is what happened in case of asset. Note stock on number 4. Okay, 2026. They have mentioned land and building 1800, plant and machinery 226. There is no change in that. So write it down in note stock on number 4. Property, plant and equipment. Land and building, is how much here? What is how 1200? Sorry, 1800, not 200. Plant and machinery 226. 1800 plus 226, that is coming 2026. Okay, 2026. Done. Now write it down in balance sheet 2026. Okay. Then we have, there is no intangible. Okay, so keep it dash there. Now here we have, go to balance sheet. Now we have a non-current investment that was 74, but it's debit balance. If you have debited them, we will add them. If you have credited, we will deduct them. If you go to the entries there, what we have done for the investment, you remember that we sold the investment. So we credited by 74. So we are going to deduct 74 minus 74. It will be 0. So we'll write it with dash here. There is no investment. We already sold it. Okay. Now here inventories. Then we have 600. No change in it. Write down 600. Then we have trade receivable. No change. 260 as it is. Then we have, there is a change in cash and cash equivalent 740. So it's a debit. It's an asset. Now if we are in journal entries, if we are debiting them here, debit. If you're debiting them, we'll add them. If you're crediting them, we'll deduct them. Okay. So how much balance which is given in balance sheet? 740. So type in calc 740. Okay. If I go to entries, first we have debited your bank by 75. Debit. We'll add them. Plus 75. Then plus 75. Okay. Then here bank here. We credited by 450. Credit. So minus 450. Minus 450. Okay. Then it is now balance coming 365 in cash. Okay, now here bank, no bank. Okay, no bank. Okay. So balance is coming 365. Just write it down there, 365. But remember that now, before you do the total of balance sheet, always cross check whether any item is left in the journal entries that here. Okay, so you can see that now here, all items are ticked here. Okay, no problem. Now you will see, no, sir, you have not take this 450. Don't worry. This 450 is what? Equity. What is this 450? This 450 is basically a equity share buyback account. We debited here by 450. Then I credited here by the 450. So it get cancelled. Okay. Then here we'll come to the third entry. Here you'll say, no, sir, you have not take this 150. Yeah, I agree. But I debited here by 150. Then I credited by 150. So it get cancelled there. Okay. So it get cancelled. So all tick. Then here, all tick here. Here you say if we 225 we have not ticked. So now credited here, then we have debited. It get cancelled. Okay. Now we have to do the total. Now 1125 plus 436 plus 750 plus 745 plus 195. 3251. 3251. 2026 plus 600 plus 260 plus 365. 325. Yeah. Okay. Now we have solved the question number 1. Okay. Now we'll do the quick revision what we have covered today that here now. Then I will see is there any scope for the homework for today. So go to the first, go in your the notebook only that here. So okay, what we discussed that first that now. Okay. Now we are talking about the equity shares, the buyback of which security? Equity share. What is equity? What is buyback? Reversal of equity, cancellation of own shares. We are talking about the equity shares. Okay. Why we do the buyback? First of all, when you do the buyback, purchase and cancellation, both of them. Why do the buyback? To increase the EPS, correct, or to promoters holding increases that here now, and then we discuss that here now, because we discourage here hostile takeover. Okay, if the value is undervalued in the market, so we offer more price, so it message goes in the market, their value is more, so value increase in the market. Okay, and if you have a surplus cash, these are the reason. Okay, when we talk from the accounting, we have the option to go out of fresh issue of shares or out of profit. When we say out of fresh issue of shares, 4 entry, issue of new shares. So at par, bank account debit to share capital. At premium, bank account debit, premium share capital account credit to premium account credit. Always remember that we recorded the share capital always at face value. Now we pass the entry for purchase, investment account debit to bank. Okay. Then cancellation. So capital account debit to investment account. If it is a premium, the capital will be recorded at face value. Premium will come in securities premium. When I say investment, that is equity share buyback account. Then the premium on buyback, we adjust against the securities premium is the priority. If we don't have a balance, then we'll go to P&L generalism. But in case if you are not issuing a fresh issue of shares in the market, so we don't pass this, obviously issue of shares and this entry will not come, but a CRR will come. So whatever the face value of the shares we are doing the buyback, that much we have to transfer to capital redemption reserve account. We here we can utilize the free reserve including the securities premium, but avoid your securities premium account. Okay. Now we discuss about the entries that here. Now we discuss about the sale of investment. If it is a profit, so bank account debit to investment account to P&L account. If it is a loss, so bank account debit, P&L account debit to investment. Okay. Now when we discuss about the bonus shares as well. So in case of bonus shares, what we do basically we don't receive the amount. So here we cannot say bank to capital, reserve and surplus to capital. But we utilize the reserve. We first will liable to pay to the shareholders. So we say bonus to shareholder liable, increasing liability credit. When we pay, so decreasing liability debit, but here share capital will be credit. So basically bonus to shareholder, it will get what? Cancelled. So basically we pass the entry reserve account debit to capital account. And with CRR account, if we are issuing the bonus shares, so always see whether we have a CRR. If we have a CRR, utilize that. First, why? Because CRR account can be utilized only for one purpose. That is for today. Okay. Now let me see, is there in scope to give you some homework question that here now? Okay, just give me a minute now. Okay, just give me a minute now. You can solve this. Okay, easy. Okay. Okay, but just remember that one thing that here now, okay, how much investment they have? 40 lakh. Here they sold at loss. Investment of rupees 40 lakh. All the investment they have sold at 32 lakh loss. So homework is question number 10 is over. It came in January 2025. Okay. Then just give me a minute. Okay, you can do the next question also. That is very simple. Question number 11, just two questions, 10 and 11. In question number 11, just remember that here, don't get confused that here. Now they say that the company passed a resolution to the buyback 20% or 15. Okay, for they sold the investment of rupees 30 at rupees 25. Now remember, how much is the investment given in balance sheet? Investment, first of all, they 5,000 rupees in 1,000. So basically, if it is rupees in 1,000, so it is the 50 lakhs. If I say in lakhs that here, how much is 50 lakhs that here? So we sold the investment of rupees 50 lakh, not all the investment. Out of 50 lakh, we sold the investment of 30 lakh at 25. So we have not sold all the investment. Out of 50 lakh, we sold the investment of 30 lakh at 25. So we sold at a loss of 5 lakh. Okay, loss of 5 lakh, but they have written in 1,000. Okay, so don't get worried. Okay, so if you want to make it simple, 3,000, it is 2,500. Okay, now that will be easy for you. Okay, now what happened that remember this loss. Okay, and so not all the investment sold. Out of that here now 5,000, we have sold the investment of 3,000. Still in balance sheet 2,000 will appear there. Okay. And that they have mentioned in the PP, that is the cost minus here the accumulated depreciation. So you will also mention like that only. That's it. Okay. They ask you the entry for the sold of investment. Then here they have passed the entry of purchase. Then here the cancellation that here now. Then adjustment, and then here CRR. Simple. Only entries, no balance sheet. Okay. Only two questions, 10 and 11. So homework for today. Okay. Homework for today. Okay, write it down that now. Homework. Question number 10 and question number question number 10 and question number 11. Okay. Now do the revision today. Okay, whatever concept that we have discussed in class, do the revision. Then almost we have done the revision. We have also done the revision in class, but you have to read it and just two simple questions that 10 and 11 you have to solve it that here now. And if you have any doubt, you can drop me a message anytime that here. Just be consistent, be focused that here. Inter is not at all difficult, and you don't know your potential. You have so much of potential here. Just what is important, that is consistency and believe in yourself that day. Be focused that here. And very personally, I believe that avoid the social media that day. Okay, that is going to there is so much of distraction in your generation. When I became a CA in 2011, at that time we don't have the Facebook and all that day. Okay, so we don't have a smartphone at that time also that year. Okay, so but there is so much of distraction you have nowadays. You have to take care of. You have to avoid that. Okay. We'll end the session here. Okay. All the best. Do the homework properly that year. Okay. If you have any doubt, you can drop me a message anytime. That is for today. Take care all of you. Bye-bye. Hello all of you. I hope you all are doing good. So first, what we'll do that we'll do the revision what we have covered yesterday, and I hope yesterday I gave you homework question number 10 and 11. You have already solved it. Okay. Now, what we discussed yesterday, what do you mean by first of all buyback of securities? Buyback means reversal of shares. We are talking to which share? Equity share. So when we talk about the buyback of securities, it means that here that means purchase of its own equity share and cancel by the company. It means they will purchase it and then what they will cancel it. But why do the buyback of shares? We do the buyback here because of the increase. We want to increase the EPS. So when we talk about the increase in EPS, this denominator, when you do the buyback, what happens? Number of shares will go down. So when I say number of shares will go down that here now. So here amount divided by number of shares. There is some way of calculating the earning per share which is covered by accounting standard 20. We will cover there in detail, but time being understand I am saying that now is the profit you have divided by the number of shares. But when I say when we do the buyback, what happened? Number of shares will go down. So it was supposed 50, now it is 40. So denominator will go down. So obviously the figure will increase here. We call EPS is going to increase here from 4 to 5. Second reason why we do the buyback is we want to increase the promoter's contribution. Okay. How? Suppose the share capital was rupees 10 lakh. Promoters hold 6 lakhs. Other holds how much? 4 lakh. So how much is the total holding? 6 divided by total 10 multiplied by 100, that is coming 60%. So initially promoters hold 60%. Now when we do the buyback, what we do in case of a buyback, we reduce the number of shares, but we are not reducing the number of shares of promoters. We are reducing the number of shares of other than the promoters that here. So their shares will go down from capital will go down from 4 lakh to 2 lakh that is. Suppose we do the buyback of 2 lakh. So it will go down from 4 to 2. Now the total capital is 6 plus 2, that is 8. But still the shares hold, the capital hold by the promoter still that is 6 lakh. So when I say 6 lakh divided by total capital 8 multiplied by 100, that is going to 75%. So when we do the buybacks, promoters holding is going to increase. Okay. Then some other reason also, we discourage the hostile takeover. What is hostile takeover? Individually, some person take small number of shares and all of a sudden they merge it and they have a control on it. We don't want to do that. So what happens? We do the buyback. So their shares goes down. Then if the value of the shares in the market, we believe that it is undervalued. So we offer for buyback at a higher value. So what happened when we offer for a higher value? What happened that here? More number of shares. What message goes in the market? If we purchase the shares, we do the buyback at a higher value. What message goes in the market? The message which goes in the market that the value of the share is high. So it helps to increase the value in the market. And if we have a surplus cash, that is. So if we have a surplus cash, what we do that here? That we want to do the buyback, because at the time of buyback, we have to pay the amount to the shareholders. Then we discuss about how to do the accounting. We know that when we do the buyback as per the Companies Act, there are two ways. First, out of fresh issue of shares, and second, out of profit. So what we do when we talk about out of fresh issue of shares, so it might be happen we are issuing the shares at par or at premium. So when we issue the shares at par, we are going to pass the entry bank account debit to share capital. But when we issue the shares at premium, so what entry we are going to pass? Bank account should be debited, share capital will be credited, and securities premium will also be credited. Remember that here in securities premium account, only the premium will come. Or to make it simple, always remember that
share capital will always be recorded face value, and only face value. So suppose the share is of rupees, we are issuing at 12. So face value is 10. So in capital account, we are going to record 10 only, and the remaining 2 will go to securities premium account. Okay. Then when we talk about the buyback here, so first issue of share, it might be at par or at premium. Now here, when we talk about the buyback, 3 entries: purchase, cancellation, or if any premium on buyback we have paid, that we have to adjust. So when we purchase the shares, we pass the entry investment account debit to bank account. Okay, but you will tell me, sir, no, you have not written your investment account. Correct, I have not written your investment account, because when we do the buyback, we purchase and cancel it. So we call it, when we purchase it, we don't call it investment, we call it equity share buyback account. So here equity share buyback account debit to bank account, and then we cancel it. So equity share buyback we debit it, we will cancel it, we will credit them here. And what should be debited here? Equity share capital, decrease in capital should be debited. So equity share capital account should be debited here, and equity share buyback account credited. So it's like purchase of investment account debit to bank, then cancel. Share capital account debit to now investment account. But it might be happen when we do the buyback, we are paying the more amount, we purchase at a higher price. Okay. So what happened when we cancel it? Suppose we purchase at a more price. So the face value is 10, we purchase 15. So at the time of purchase, we don't record premium and buyback and all that. Whatever price we have paid, that investment account should be debited with that amount. We should not call it investment, we call it equity share buyback. So equity share buyback account debit to bank, to make it simple, I'm calling it investment. Okay, equity share buyback account debit to bank. But when we cancel it, that beta, so equity share buyback account will be credited here. But we cannot debit to share capital account by this 15, because share capital will always be recorded at face value. So we are going to do we will debit to the equity share capital account by face value, that is 10, and premium on buyback will be debited by 5 years. Okay. Now I want to adjust the premium on buyback. Okay. So we debited here, then we want to cancel it, we'll credit it premium on buyback. But with whom we can adjust it? So first priority always give to securities premium account that. Okay. Then profit and loss account, and then give it to the general reserve. Okay. Or revenue reserve, whatever is that, any combination. But first priority give to securities premium. If we don't have enough balance in securities premium account, then you can go for the other reserve. But when it is out of profit, so there is no entry here. Obviously, it is not applicable here. The reason is that when we talk about the out of profit, we are not issuing the shares. Okay. So for the purchase of shares, same entry. For the cancellation of shares, same entry. For the purpose of adjustment of premium and buyback, same entry. But one additional entry will come, because when it is out of profit, we have to transfer the face value of the shares we buy back that year to the CRR account. So CRR is the capital redemption reserve account as per the company, that we have to transfer it. But which account I can be debited? They say free reserve including securities premium. This is what says section 68 of the Companies Act. So I will debit here. Free reserve means any reserve which can be utilized for the purpose of dividend. Those are general reserve, profit and loss account, surplus balance, revenue reserve. So those accounts will be debited here. And we can adjust when we transfer to CRR, we can utilize the securities premium account, which is not recommended. Avoided that here. Why should it be avoided? Because ICAI avoided that here. So I observe in their question that they never, we can do that, but they avoid, if we don't have a balance in general reserve, free or revenue reserve or penal account, in that case, we can utilize the securities premium account when we want to transfer to the CRR account. But when I say we want to transfer to CRR account that here, what is the rule that I told you that here? Replacement of capital should be with the capital. With the amount, the face value of the share which we are reducing at the time of buyback, at least that much amount should be increased in the capital. Okay. But when I say we are doing the buyback out of profit, we are not issuing the shares in the market. How can I say that here we are increasing here? So the CRR account basically that here, it can be utilized only and only for one purpose, and what we call them bonus shares. So not today, but in future, the CRR is going to be converted into a bonus share. So this CRR, when we issue the bonus share capital will be credited. But we cannot debit to cash or bank account. The reason is that we cannot debit to cash or bank account because we are not receiving any amount from the shareholder at the time of we are issuing the bonus share. Some reserve should be debited. So I'm not saying we cannot utilize the other reserve like the general reserve, revenue reserve. Okay, we can utilize those reserve, free reserve we can utilize. But here, first priority should be given to a CRR account. Why the first priority should be given to the CRR account? The reason is that first priority should be given to the CRR account that here now, because CRR account is the most restricted reserve. It can be utilized only and only for the purpose of bonus share. Now, if we get the chance to issue the bonus share, this is the right time to utilize the CRR. If we don't utilize the CRR, if we utilize the other reserve, it is not logically correct that here. Let me tell you why that is. Why the reason is that because today we get the chance to utilize the CRR because we are issuing bonus share. If we don't utilize that, we cannot utilize for other purpose. Now in future, when I will issue the bonus share next time, then only we can utilize the CRR at that time. So it's better to utilize the CRR account at the time we issue the bonus shares. Okay, this is what we have discussed in our previous session that now. Now I hope you have solved the question number 10 and 11 which I gave in homework. Now please come to question number 2. Okay, now come to question number 2 now. Okay, now what it says that here in question number 2, that X Limited furnished the following summarized balance sheet as at 31st of March 2018 that now. Now share capital we have, how much share capital that we have here? Equity share capital of rupees 20 each fully paid 50 lakh. 10,000 10% preference share of rupees 100 each fully paid up. So total 50 plus 10 that is coming 60 lakh. Then we have reserve and surplus. Capital reserve we have 1 lakh. Securities premium 12 lakh. Revenue reserve 5 lakh. Profit and loss account 5 lakh. Profit and loss account 20 lakh. Dividend equalization fund that is 5 lakh 50,000. That is 43 lakh 50,000. The dividend equalization fund we have kept the fund for the purpose of dividend. That reserve we have maintained that. Okay. Now non-current liabilities that here 12% debenture 12 lakh 50,000. Current liabilities and provision 5 lakh 50. Then asset side property, plant and equipment 1 crore 75,000. Then we have here the current asset. Investment 3 lakh, inventory 2 lakh, cash and bank balance 15 lakh 75,000. Total is 20 lakh 75,000. Now the shareholders adopted the resolution on the date of the above mentioned balance sheet 2. First point that the buyback 25% of the paid up capital, and it was decided to offer a price of 20% over the market price. What they're saying that now they want to do the buyback, but at what price? They want to do the buyback at 20% over the market price. So what is the market price? So they say the prevailing market value of the company's share is rupees 30 per share. Understand this one. First of all, these 30 is not the face value. What is the face value which is given in question? If we go there, you can see that now the face value of equity share is rupees 20. So equity share capital of rupees 20 each fully paid up. So they have a face value of rupees 20, but what is the market price? 30. So they are saying they want to do the buyback at 20% above the market price. They are not saying face value, above the market price. So market price is rupees 30 plus 20%. If I do that, that is coming how much? 30 plus 20%, that is coming how much? 36. Now remember this is the buyback price, but when we will purchase and then we'll cancel it, always remember that share capital will always be recorded on face value. So when we do the cancellation at the time of buyback that here now, so how much is the face value? Rupees 20 is the face value, and rupees 16 remaining we'll call them premium on buyback. Premium on buyback. So what happened here now is the 30 rupees 30 is the market price. 20% is the amount they want to pay the additional over the market price, that is coming 36. But remember that, don't tell me that 30 we will share capital will be 30 and 6 in the premium buyback. No, the face value is not 30, face value is 20. So we are going to cancel the share capital by 20, whatever we multiply with the number of shares, and rupees 16 that represent what? The premium on the buyback. So you understand the premium on buyback is rupees 16. Then they say here, to finance the buyback of shares company, issue 3014% debenture of rupees 100 each at a premium of what? 20%, and issue 2510% preference share of rupees 100 each. Now remember these point that what it says that here now, obviously when we do the buyback, we need some fund for that because we have to pay to the shareholder. Is there any condition? Is there any restriction from where we can raise the fund? There is no restriction. We can raise the fund from anything. We can sell the investment, we can sell the fixed asset, we can issue the debenture, we can raise the loan from the bank. Whatever we want to do, we can do that to arrange the fund that. But as you can see that here in point number 2, they say in A point there, they issue 3000 debenture of rupees 100 each at a premium of 20%. Nothing wrong in that. we will issue the debenture, we will pass the entry of issue of debenture. Nothing wrong in that to raise the fund. But can I say that here, is the issue of debenture is the replacement of capital with the capital? No. Now listen carefully. When I say when we do the buyback, my share capital will go down. You agree that when we do the buyback, our share capital will go down. But what happened that now? When I issue the debenture, my share capital will not increase. Issue of debenture, increase in debenture will happen. We have already done the chapter financial statement of company. Where these debentures come? It's a non-current liability. So debenture is not a share capital. So when I say decrease in capital, that is because of the buyback. There should be increase in capital also. So when I say that here now, this increase in debenture is not increase in capital. So I'm not saying this is something wrong that they have done. No, nothing wrong in that. They have issued the debenture, will pass the entry, nothing wrong. Arrange the fund from wherever you want to do that. But when I say that a replacement of capital with the capital means a decrease in capital, there should be increase in capital. Issue of debenture is not going to increase the capital, it is going to increase the non-current liability. But they say that they issue also 2,500 10% preference share of rupees 100 each. So what they have done, they have issued the 2,500 preference shares there also. So they can do that, but you know that we have the options. We can issue the preference, we can do the buyback. So we have two options that here. It can be out of fresh issue of shares and it can be out of profit. But it can be also the third category. It can be a combination of both of them. So here we will discuss that now because they have issued 2,500 shares. Okay, now the capital will increase that here. But the amount should be the same that here. The amount of capital which is going down, at least that much should be increased. If that much is not increasing, it means the remaining they are doing out of the profit. So we'll discuss about it. If I give an example here, if you go to the rapid gist that here, okay, we discussed it yesterday that here. This is what they're talking about that here now. How we will calculate that here, whatever the number of shares we are, face value of the equity shares we are doing. So we'll write it down the total equity share, face value of the equity share bought back. We'll minus the face value of the shares that we're issuing out of fresh issue of share, and remaining is out of profit. So this is the case when there's a combination of both of them that here, because they are doing a certain buyback and they are issuing shares. Is the remaining amount still left? If it is left, then that is out of profit. It is a combination of both of them. So we'll discuss in detail that here now. Okay, when we'll do the calculation, how many number of shares and all. Now again, go to question. Then they sell the investment also worth rupees 1 lakh for rupees 1 lakh 50. So they sell the investment, some in investment. Maintain a balance of rupees 2 lakh in revenue reserve. What do you mean by that? They have maintained a balance of rupees 2 lakh in revenue reserve. It means that here, if I go to the balance sheet, okay, how much revenue reserve that they have? They have a revenue reserve of here. They have a revenue reserve. If we see that here, revenue reserve is of rupees here. Is the how much it is the revenue reserve is a 5 lakh. So when I say I have a revenue reserve of 5 lakh, out of 5 lakh they are saying that we have to maintain at least how much? 2 lakh. So basically they are giving us the indication that what indication they are giving us that here now, that if we have to maintain at least how much is the total amount of revenue reserve? 5 lakh. It out of 5 lakh I have to maintain a 2 lakh. It means how much revenue reserve they are telling to maximum utilize 3 lakh. Total is 5. They are telling us to maintain a balance of 2 lakh. Total is 5 to maintain a balance of 2 lakh. It means how much we can utilize maximum 3 lakh. So they indirectly they are telling us that maximum revenue reserve that you can utilize is just rupees 3 lakhs. Indirectly this is what they are saying. Okay. Then they say later the company issue the 3 fully paid up equity share of rupees 20 each by way of bonus share for every 15 equity share held by the equity shareholder. So they are telling us that now is they are going to issue the bonus share later. It means they will do the buyback, then they will issue the bonus shares. Okay. Now they ask us, you are required to pass the necessary journal entries to record about transaction and prepare what? The balance sheet. So we have to pass the journal entries and we have to record the what? Balance sheet. You understand this point here? Okay. So we will pass the journal entries first that here. Okay, when you will pass the journal entries, so we will first pass the entry from wherever they have raised the fund. For example, issue of debenture, issue of shares, the sale of these the investment, and then we'll talk about the buyback, purchase, cancellation, adjustment of premium, buyback, like that. Okay, so I will explain you each and every point.
write it down that here. Okay, now write it down that question number 2. Write down there. Question number 2, that is journal entries. Journal entries. Okay, journal entries. Okay. In the books of X Limited. So at least draw for one page. It will take more than one page, but at least first draw for one page. Okay, then we'll see it. Okay. Now write down there. Debit amount, credit amount. Okay. Now write down there. Now first. Now, okay, draw this for at least one page. Okay, very simple. Just listen me carefully, slowly, one by one. I will explain each and every point to you. Okay. Now, when we pass the entry that here, from where first pass the entry, we will do the buyback, but from first we have to raise the fund. So we'll pass this entry first. Point number 2A. They issue how many debentures? They issue 3,000 debenture, 14% debenture. What is 14%? It means in future they will give the interest on these debenture 14%. The debenture is of rupees 100. They want to issue at 20% premium. The same entry we passed, the entry we passed for the issue of share. But here, instead of writing the share capital, we'll write it down debenture. So when we issue the debenture, we want to receive the amount. So write down there, bank account should be debited. Okay, so 3,000 debentures multiply by rupees 120. I will tell me, sir, how you calculate this 120. What is the face value of share? 100 plus 20%. So they issue at what price? It's not share, debenture at 120. So 3,000 multiplied by 120. That is coming how much? 3,60,000. Okay. Now here they are issuing debentures. So we'll write it down that to 14% debentures. 3,000 to 14% debenture account, 3,000 debentures multiply by rupees 100. So that will come how much here? 3 lakhs. Okay. Then here to securities premium account, 3,000 debentures multiply by rupees 20. That will come 60,000. Okay, remember the date is not mentioned. That's why I'm writing 1, 2, 3 like this. Okay. Now always remember, like the share capital in debenture account, we always record face value. Same like the share capital. Unless we record share capital always at face value. So similarly for debenture also, it will always be recorded at what? The face value. And these debenture, is it a capital? No, these are non-current liability. So write down there, being 14% debentures issued at 20% premium. Okay, 20% premium. Now from where they have raised the funds? Second, then they issue the shares. The second, how many shares that they have issued? It is mentioned in question. They issued 2,500 preference share. 10% premium, 10% preference shares means in future when they will give the dividend, they will give 10% to this preference share. But they are issuing at par at 100 only. So write down bank account debit, 2,500 shares multiply by rupees 100. That will come how much? 2,50,000. To 10% preference share capital account, 2,50,000. Okay, being correct, 2,500 multiplied by 2,50,000 years, being 10% preference shares issued at par. Okay, issued at what? Par. Okay. And from where they raise the fund, they also sell the investment. Okay. So third entry will pass for sale of investment. Okay. So remember this when you talk about a sale of investment, they say the sell investment worth rupees 1 lakh for rupees 1 lakh 50. It means they're selling the investment of rupees 1 lakh at rupees 1 lakh 50. It means they're making a profit of 50,000. But what is the amount of investment which is appearing here? That is the amount of investment which is appearing 3 lakh. It means out of 3 lakh, they are selling the investment of rupees 1 lakh at rupees 1 lakh 50. Okay, so they're not selling the 100% investment. Out of 3 lakh, listen carefully. Out of 3 lakh, they're selling the investment of rupees 1 lakh at rupees 1 lakh 50,000. Okay, so they're making a profit of 50. So investment of rupees 1 lakh, they're selling at rupees 1 lakh 50. Out of 3, they're selling 1 lakh only. It means still they have an investment of rupees 2 lakh. Okay, but here when we sell the investment, we have to receive the amount. So bank account should be debited here. Bank account should be debited here 1 lakh 50,000 to investment account. How much investment? 1 lakh is their value, but we sell it 1 lakh 50. It means we make a profit of 50,000. So to profit on sale of investment, okay, account, write down in bracket profit and loss. That is how much? 50,000. Okay, now write down the narration. Being investment sold on profit. Okay, done. Now we pass the entry from wherever they have raised the fund that year. Okay, now what it says that, but out of these, in which they have raised the fund from these 3 sources that year, from debenture, from preferences, and from what? The sale of investment. But out of these 3, which is the replacement of capital with capital? Only one, because share capital is a share capital is basically the capital that they have, increase in capital. So when we issue this is a basically increase in capital because they issue the shares in the market. I'm not saying the other point that it is, they can raise the fund from wherever they want that. But when I say increase in capital, out of these 3, only one that here. Okay, so we will see the requirement of the companies, right? So we'll cross check it when we do the buyback of equity share. At that time, what is the face value of the buyback of shares? What is the face value of issue of shares? And if it does not cover completely, the remaining that is out of profit, and that much we have to transfer to CRR. So this question might be a combination of both of them, out of fresh issue of shares and out of profit. Okay, and we always assume that it is out of profit only, unless and until it is specifically mentioned in the question that it is out of fresh issue of shares. Now here, write down that here now. Okay, now here point number 4. What it says that now we will purchase the shares. But how many shares we are purchasing? But we are doing the buyback, purchase and cancel. So they are saying we want to do the buyback of 25% shares. Okay, so how many number of shares we have? The total share capital amount is how much? 50 lakh. So I will say that here now 50 lakh is divided by here rupees. What is the face value? 20 is the face value. So number of shares that we have here, 50 lakh divided by 20. That is coming how much? 2,50,000 shares. And we want to do buyback. Is it visible? 25%. We want to do buyback. How much capital we want to do the buyback? 25%. So that will come here 62,500 shares. So we want to do the buyback of 62,500 shares. You got the point? For how many shares we want to do the buyback? 62,500 shares we want to do the buyback here. Okay, don't worry, but you have to write it down. Whatever I'm writing down here, you have to write it down with me, but we'll make a working note on it. Okay, that the number of shares that we're doing the buyback is 62,500 shares. Okay, so here now write it down that here you understand how we calculate this 2,50,000 shares. Total amount of capital is 50 lakh. And what is the value of one share? 20. It means how many number of shares that they have? 2,50,000. We want to do the buyback of 25%. That is going to 62,500. Now write down there. We will purchase the shares now. Equity share. Buyback account debit. That is just 62,500 shares. Working note number 1. Multiply by. We are purchasing at what price? 36. Okay. So here 62,500 multiplied by 36. That will come 22,50,000. At whatever price we are purchasing, we have to write it down this. Okay. But when we will do the cancellation, so remember in share capital account, face value will come, and remaining amount will come in premium on buyback. So, but we purchase it. So here to bank account. Yes, 22,50,000. Give the reference of your working note number 1 because I will make a working note on it. Okay. So here being buyback of 62,500 equity shares of rupees 20 each at a rate of rupees 36 per share. At the rate of rupees 36 per share. Okay, now we have done the purchase of shares. Now what we'll do that now? Purchase of shares we have done. Now what we'll do? We will do the cancellation now. So fifth entry. Now equity share capital account debit. We are doing the cancellation. Equity share capital account debit. How many number of shares we are doing the buyback? 62,500 shares. What is the face value of the shares? 20. Okay. So capital will always be cancelled at what? Face value. So 62,500 multiplied by 20. That is coming how much? 12,50,000. What about the remaining 16? I told you what about the remaining 16 that here? That is the premium on buyback. So write down that here now. Premium on buyback. Premium on buyback account debit. 62,500 shares multiplied by rupees 16. That is coming how much at 10 lakh. Now 2, we have debited here equity share buyback account. We'll cancel them now. To equity share buyback account. That is coming how much? 22,50,000. Being cancellation of shares bought back. Being cancellation of shares bought back. Okay. Now we purchase the shares, we cancel the shares. Now what we'll do that now with the adjustment of premium on buyback. How much is the premium on buyback? That is 10 lakh. And we always give the priority. Okay, we always give the priority to the securities premium account. So let's check, do we have a 10 lakh in a securities premium account that here? Okay, we'll cross check it that. So if you go to the question that now, you will see that here in the reserve and surplus, we have in securities premium, we have 12 lakhs. How much we want to utilize? 10 lakhs. So we have enough balance in securities premium account. So we have a balance of 12 lakh and we want only 10 lakhs. So we can do that. Okay. So now adjustment of premium on buyback 6 now. Here securities premium on buyback account should be debited here 10 lakh. Okay. Oh, no, you can say it's just securities premium account, not on buyback. This premium on buyback account that will be credited. So securities premium account should be debited. Okay. We are adjusting that. So this here premium on buyback we have debited here. To cancel them, we have to credit them. So here to premium on, write down there, premium on buyback account So we debit it by how much here? 10 lakh. So when we'll cancel that, we'll credit by 10 lakh that year. Okay. And against which reserve we adjusted? Securities premium account. So here being premium on buyback, being premium on buyback adjusted against securities premium account, adjusted against what? Securities premium account. Okay. Now here, seventh one. Now please understand this one. You'll say, no sir, that we have passed the entry that of the purchase. We have passed the entry for what? Just give me a minute. We will tell you now. We have passed the entry for purchase. Okay, we have purchased here. Then we have done the cancellation here. And then we have done the adjustment of premium. So you will tell me that, sir, we have passed the entries of these three. And now, fourth entry will come transfer to CRR. Now you will tell me, sir, why you are saying transfer to CRR? We'll make a working note on it also. But why, you tell me that, sir, why you are telling us to transfer to CRR that here? We've already issued the shares in the market. I agree that here. We issue the shares, how much shares that we have issued? We issue the shares of face value of rupees 2,50,000. But we have done the buyback here. We have done the buyback here of how many shares? That equity share capital account is debited by how much here? We debited here by how much here? Is 12,50,000. So here, when I say that here, we here basically credited by 2,50,000. Just give, okay, it's okay. 2,50,000. But we are debited by 12,50,000. Now understand the point. My increase in capital, let me first write it down that here now. It's an increase in capital, and here this is decrease in capital. So already it is given in a rapid gist that how to do the calculation. If I write it down that here, go to rapid gist. Okay, page number 15. What is the total face value of equity shares bought back? Face value 12,50,000. Okay, what is the total face value of the shares I'm to issue that here? In our example, that is 2,50,000. So how much is out of profit? That will come 10 lakh. This is how we calculate that here. Okay. The face value of the shares bought back 62,50,000 shares. Multiply by rupees. What is the face value? 20. Okay. Correct. Yes. And we issue 2,500 shares at rupees 100. Okay. Don't worry. We'll make a working note, not here, in a proper in question that is. So we have to transfer to CRR. How much? That is 10 lakh. Okay. Now understand this point. We'll make a working note on those 10 lakh, how we find it out. It's a combination of both of them. Okay. Now what it says that here now, when we talk about that here, what is the first priority that we have to give when we talk about the CRR account? I told you that here. What should be the first priority? Any reserve other than the general free reserve, general is the P&L account balance. So how much we need? 10 lakh. Let's see, do we have a 10 lakh in that? So in revenue reserve that here now, they are giving us, now listen very carefully. They have a balance of rupees how much? 5. You will tell me, sir. It is mentioned in question that they have to maintain a balance of rupees 2 lakh. It means how much we can utilize? How much we can utilize? 3 lakhs. Okay. But we can also utilize the profit and loss account. Total we need 10 lakh. So you will tell me, sir, we have enough balance in P&L account. 20 lakhs we have. So you will tell me, sir, do one thing. If we have 20 lakh, why don't we utilize these? We need only 10 lakh. Why don't we utilize 10 lakh from this P&L account? Your argument is correct that here. Because to transfer to CRR, we need a balance of 10 lakh rupees. Now, do we have a balance of 10 lakh in profit and loss account? Yes, we have 20 lakh. So you will ask me that, sir, utilize that 20 lakh. I agree with you. But I have one objection here. The point is that it is mentioned in question that they have to maintain a balance of rupees 2 lakh in revenue reserve. So indirectly they are telling you that here, utilize the remaining balance. Indirectly they are telling you, utilize the remaining balance. They want a balance of rupees 2 lakh there. So indirectly they are telling us to utilize the remaining balance. So that's why that here. What I will do that here, out of this 5 lakh that here, we will keep it aside the 2 lakh, but remaining 3 lakh I will utilize.
and whatever amount remaining required for the purpose to transfer to CRR, I will utilize that from the profit and loss account balance. Some of you may think so that utilize the complete amount of profit and loss account. I mean to say from the complete amount that CRR to CRR we have to transfer from this profit and loss account balance, that is 20 lakh. No, we can, but here it is not appropriate to do that. Why? Because they mention us in the question that the 2 lakh amount of revenue reserve we have to maintain. It means indirectly they are telling us utilize the remaining. So we will utilize the 3 lakh rupees from revenue reserve, and whatever require remaining to transfer to CRR, that we take it from the profit and loss account balance. Okay. Now write it down that here now. Okay. Now write it down that here now. Okay. Now here write down revenue reserve. Revenue reserve account debit 3 lakh. Now why 3 lakh? Let me write it down for your reference. 5 lakh minus 2 lakh. Why? Because it should be maintained. Okay. Okay, that's why 2 lakh it should be, because it should be maintained. 2 lakh should be maintained there. Okay. So, but for the CRR, how much we want? We need 10 lakhs. So we'll make a working note on it, but I explain you why we needed 10 lakh. We have done the calculation here. Okay. Now, but remaining we have enough balance in profit and loss account. We'll utilize from there. So profit and loss account should be debited here. The total amount to transfer to CRR is 10 lakh, and we have already utilized from the revenue reserve 3 lakhs. So here remaining we are to utilize from the profit and loss account balance. Okay. Now here to capital redemption reserve account. Capital redemption reserve account. Okay. We'll make a working note on it. Working note number 2. 10 lakh. Okay. Write on being amount equal to face value of buyback out of profit transferred to CRR account as per law. As per law. Done. Okay, now understand this. As per law. Now understand this point. What happened that here now? Now the next they also ask about the bonus shares that here. Okay. But we will make a working note on it that here. But how many bonus shares we are going to issue that here? Because they tell us that here now, here, later the company that here, we have passed all the entries that we have already passed that. Now fourth we have, okay, now fifth, last one. They say that here now, later the company issue 3 fully paid equity shares of ₹20 each by way of bonus shares for every 15. To understand how many shares we hold here on it, we'll make a working note on it. But how many shares we hold here? The total share that we have is 2,50,000 shares. Do you agree? Yes. Okay. Now out of 2,50,000 shares, let me write it down. We'll make a working note on it, but roughly write it down. 2,50,000 shares initially we have. We have done the buyback of 62,500 shares. Okay. So how much left? 2,50,000 minus 62,500. We have 1,87,500. For every 15 shares, we are giving them 3 shares. So divided by 15 multiplied by 3. That is coming 37,500 shares. We are issuing as what? Bonus shares. We are issuing as what? Bonus shares. So you will ask me that here now. Why? You will ask me that here now. Why we are basically, is it visible to you? No. Oh, okay. Now 2,50,000 shares. You will ask me, sir, why we deducted this 62,500? Because we have done the buyback already. Later we are saying after the buyback. So share does not exist here 2,50,000. Out of 2,50,000, we have already done the buyback of 62,500 that year. So how many shares left there? How many shares left there? 187,500, I think. So for every 15, we are giving them 3. So divide by 15, multiply by 3. That much is the bonus shares. Okay. Now, when we talk about the bonus shares that year, first priority. Okay. 2 entries will come that year now. So accordingly, you can draw that here. Okay.
7, no, 8 point. Now understand that. So here we are talking about the bonus shares now. So here we are talking about what? Bonus shares now. Buyback done. So what happened now? Obviously, we want to utilize certain the reserve, but first priority we should give to what? To capital redemption reserve account. I told you that here. First priority we have to give to capital redemption reserve account or capital redemption reserve account. Priority should be given to CR. So do we have a balance of how much we need that here? So we are doing the buyback of 37,500, not buyback, sorry, bonus share, 37,500 shares of rupees 20 each. So 37,500 multiplied by 20, that is coming rupees 7,50,000. But do we have a balance of 7,50,000 CR? If we have, we will utilize. Otherwise, we will go for the P&L and other reserve balance. So there is no capital redemption reserve account in balance sheet. Okay. But what happened that now, just now, we pass the entry here and there is a balance in CRR account. How much balance we have in CRR account? We have a balance of 10 lakh rupees. Perfect. How much we need? How much we need that here to transfer to CRR? We need a transfer to CRR. How much we need? That is 7,50,000. So we have a balance of 10 lakh, but we need, how much we need? That we need a 7,50,000. Perfect. So we'll utilize the capital redemption reserve account. If suppose there is no sufficient balance in CRR account, in that case, we'll go for the other balances. Okay. Other reserve. So write down that here now. Decrease in reserve should be debited. So capital redemption reserve account should be debited here. 37,500 shares. We'll make a working note on it. So write down the working note number 3. Okay. Multiply by rupees 20. That is coming 7,50,000. So we will credit to share capital. But first we are passing entry of due. We are liable to pay to the shareholder. So we call it, we're liable to pay. So to bonus to shareholder account. We'll cancel it. Bonus to shareholder account. Just write it down first. Bonus to shareholder account. Shareholders account. 7,50,000 being utilization of capital redemption reserve, being utilized capital redemption reserve to issue 37,500 bonus shares. Bonus shares. Okay. Now we will give them. So first we are liable to pay. So increase in liability should be credited. So bonus to shareholders account credit and we will pay them. So last entry. Bonus to shareholders account debit. $7,50,000 to equity share capital account. $7,50,000. Okay. Being write down issue of 3 bonus shares for every 5 shares held. For every 5 shares held that. Okay. Just 1 minute. Okay, done. Now what we'll do that, we'll make a working note first. Is the first working note is on the, what we call that first working note is the number of bonus shares, that working note number 1. The second working note on the calculation of amount of CRR, and third is on the bonus shares. Okay, now write down it. Working note. Working note. Write down there. First, number of buyback of shares. Number of buyback of shares is equal to, so total number of amount, first of all, capital is of rupees 50 lakh divided by if face value, so face value 20. Okay, so here that will come here, how much, 50 lakh divided by 20, 2,50,000. We want to do the buyback 25% only, multiply by 25%, that is coming how much, 62,500 share. Okay, 62,500 shares. Okay, second point. Now buyback out of profit, write down in bracket, amount to be transferred to CRR account, amount to be transferred to CRR account. Okay, now write down there. Okay, face value of buyback of shares. How many shares we are doing the buyback? 62,500. Multiply by, what is the face value? 20. Okay, that is coming 12,50,000. Okay, 12,50,000. Okay, then here less face value of fresh issue of shares. So how many shares we issue? Preference shares 2,500 shares, and their face value was rupees 100. That is coming how much? 2,50,000. So remaining is out of profit. Out of profit. That is 10 lakh. How much? That is 10 lakh. Okay, now here third, number of bonus shares to be issued. So initially we have 2,50,000 shares, minus we do the buyback of 52,500 shares, divided by 15, divided by 15, multiply by 3. Okay, 2,50,000 minus 62,500 divided by 15, multiply by 3. 37,500 shares. Done. Okay, so we have passed all the general entries that here now. Now we have make all the work unit, but they also ask us to prepare the balance sheet. But remember that here, then when we talk about the balance sheet, don't forget these basic rule. Okay, what is the basic rule? I told you that earlier also. Always remember that when you prepare the balance sheet. Okay, these rule. Just give me a minute. Always remember these rules that, okay, when you're going to prepare the balance sheet that here now, always remember these rules that here. Okay, we are going to take the item from the balance sheet. Liability, capital, reserve they have a credit balance that here. If they credit, and if in entries that we have passed, if we credit, we'll add them. If debited, we'll deduct them. Asset side is debit balance. If we have debited in the entries, we'll add them. If we have credit, we'll deduct them. Okay, now draw balance sheet. So balance sheet, okay, balance sheet of X Limited after buyback and issue of bonus shares. Date is not mentioned there. Okay, after buyback and issue of bonus shares. Okay, draw this balance sheet here now. Okay, draw this. Okay, write down there. Note. Amount. Okay. Now first here, equity and liability. Equity and liabilities. Okay. Here, first shareholders fund, shareholders funds. We write it down, share capital and reserve and surplus. Okay, write down share capital, reserve and surplus. Then here second, non-current liability, non-current liability. In that we have a long, write down the long-term borrowings. Then we have a current liability. As such, we don't have a much current liability which is mentioned in question. If you go to the question, you will see that here we only one, they have just mentioned current liability in provision, so they have not specified. Okay, then here only current liability, that then we'll do the total here. Then write it down that here now is assets. In assets, two category, non-current and current assets. Write down there non-current asset A, B, C. Property, plant and equipment, intangibles, non-current investment. Then we have here current asset. How many current asset which is mentioned in balance sheet here? That 3: investment, inventory and cash and bank. So write down there investment. Okay, investment, not always necessary that investment should be the non-current. It might be current as well. And as it is specifically mentioned that here it is under the category of current asset, so that investment will consider the current asset only. Okay, so investment, inventory, cash and bank balance. Okay, now then we do the total here. Generally we make a 4 notes to account, that is share capital, reserve and surplus, and the long-term borrowing and PP. But what happened here, there is no need to prepare the notes to account on property, plant and equipment. What is the reason that here there is no need to prepare a notes to account on property, plant and equipment? If you go to the balance, you will see the single amount is given there. There is no bifurcation of PP like land and building, plant and machinery. So there is no need to make a notes to account for that. Okay, done. So we will prepare notes to account one by one. So here notes to accounts. Okay, remember that here now. First, we will take a item here of liability side. So remember that here they have a credit balance. If you're crediting them in the entries, we'll add them. If you're debiting, we'll deduct. Whatever amount come, that will write it down in a new balance sheet. Okay, so here we have a equity share capital that here. Okay, how much it is mentioned that here now? It is mentioned that is 50 lakhs. Okay, so type in calci that here now is 50 lakhs. Type 50 lakhs. Okay, now go to entries that here. In entries that here, whether we have here bank, debenture, no, preference we'll write it down separately that here. Okay, now here we have debited the equity share capital account. So this 12 lakh 50. So minus 12 lakh 50. So we are at 37 lakh 50,000. Okay, then here we issue a bonus shares. Go to entry number 10. We credited by 7 lakh 50. So plus 7 lakh 50. That is 45 lakh. But remember that here, whatever number of shares comes, that 37,500 shares are a bonus shares. You know that here we have already covered the financial statement of company chapter. Any shares issued other than cash consideration, we have to mention them separately in the inner column. Just we have to give the information there. So right, total amount is coming 47 lakh. So write down that here 47 lakh divided by 20. So the number of shares is 2 lakh 25. So write down first notes to account share capital. Okay, first notes to account share capital. 2 lakh 25,000 equity shares of rupees 20 each. That is coming how much here? 45 lakh. Okay. Out of the above, 37,500 shares issued as bonus shares. As what? Bonus share. Okay. Now they have issued preference share also. Not given in balance sheet, but they have given in balance sheet as well. How much preference shares that they have? 10 lakh shares of rupees 10 each. Okay, the 10,000 shares of rupees 10 of rupees 100 each, 10 lakh. But in journal entries, if you see that here, they also issue the preference share 10%, that 2 lakh 50. So 10 lakh plus 2 lakh 50, that will come here 12 lakh 50,000. So write down there. Write down there in notes to account number 1, 12,500 10% preference shares of rupees 100 each. How much it will come here? 12 lakh 50. Okay, we have done the calc. 12 lakh 50. Okay. Now do the total and write down in notes to account. That is a 45 lakh plus 12 lakh 50. Total coming 57 lakh 50,000. Write down in balance sheet. 57 lakh 50,000. Okay, 57 lakh 50,000. Done. Okay. Now what happened here? Second notes to account will prepare on reserve and surplus. So write down here notes to account number 2. Reserve and surplus. Okay, reserve and surplus. So first item that they have given is a capital reserve 1 lakh. There is no change in capital reserve. Okay, there is no entry that we pass of the capital reserve. So same as it is, it will come 1 lakh. So write down here capital reserve. Capital reserve. That is how much? 1 lakh. 1 lakh. Okay. Now here we have a second capital reserve is how much? Is a 1 lakh. Then we have securities premium. How much we have? 12 lakh. If you go to journal entries, that okay, we have utilized at some places the securities premium. First entry we have credited by how much? 60,000. So we'll add 60,000 because this is the securities premium come when we issue the debenture. And we have debited here by 10 lakh. So we'll deduct 10 lakh. Okay, because we're debiting that here. So we need to write up the premium on buyback. So write down that this reserve and surplus always present in detail. How much is the opening? How much we have utilized? Okay, write down this securities. Securities that here now is premium. How much balance is given? 12 lakh. Add premium on issue of debentures. Not 2 lakh, 60,000. We credited, we'll add that. Less adjusted for premium on buyback. Okay, premium on buyback. So 12 lakh plus 60 minus 10 lakh. That is coming how much? 2 lakh 60. Write down in outer column 2 lakh 60,000. Okay, 2 lakh 60,000. Okay. Then next item we have here revenue reserve. So 5 lakh is the amount, but we utilized only 3 lakh because they mentioned that we have to maintain a 2 lakh. Okay. So we debited here by 3 lakh. So minus 3. 5 minus 3, 2. So write down there revenue reserve. 5 lakhs rupees. Write down, come on. Less transferred to capital redemption reserve 3 lakhs. Okay, so we have balance of how much here is 2 lakh. 2 lakhs. Okay, then we have here is how much we have. Profit and loss account is how much? 20 lakhs. So remember that in case of a profit and loss account, we credited here to profit and loss account when we sell the investment, because this profit on sale of investment will also come to P&L. So we'll add in that 20 lakh, this 50,000 will add, and then we'll utilize to transfer to CRR how much? 7 lakhs. So we'll deduct 7 lakhs. So write down that here now is profit and loss. Profit and loss. We have a balance which is given in balance sheet 20 lakhs. Then add profit on sale of investment 50,000. Okay, then here deduct less transfer to capital redemption reserve. That is coming how much? Capital redemption we utilize 7 lakh. So we have a balance of here 13 lakh 50,000. 20 plus 50, 20 lakh plus 50,000 minus 7 lakh, that is coming 13 lakh 50,000. Okay, done. Next item then we have here is the dividend equalization fund as it is. Just write down that dividend equalization. Basically, these are the dividend, the fund that they've maintained, that is specifically keep it aside for the purpose of dividend. Okay, but they have not declared the dividend, but keep it aside for some fund for that 5,50,000. Okay, now understand this part here. Now all the items of reserve and surplus which is given in balance sheet we have taken, but wait, what happened that here now? If we go to the entries that we have passed, we created CRR also, that is also reserve and surplus. The first entry, no. Okay, first entry no, second no, third no, fourth, fifth, sixth no, seventh. You can see that here we have CRR we created by 10 lakh, but we utilized in the entry number 8 by 7 lakh 50. So 10 lakh minus 7 lakh 50, that is going to come how much? 2 lakh 50. We utilize for the purpose of bonus. Okay, now write down here capital redemption reserve. Capital redemption reserve. Okay, how much it is? 10 lakh less utilize for bonus issue 7 lakh 50,000. So how much is coming that here in outer column? It is coming 2 lakh 50,000. 2 lakh 50,000. Done. Okay, now do the total and write it down in balance sheet of this reserve and surplus. That is 1 lakh plus 2 lakh 60 plus 2 lakh plus 13 lakh 50 plus 5 lakh 50 plus 2 lakh 50. 27 lakh 10,000. Okay, 27 lakh 10,000. Now write down here 27 lakh 10,000. Okay, now third point which is very important, the long-term borrowing. When I go to this debenture, this is very interesting that here. How much debenture that we have here? 12%. They give the name 12%. It means they give the interest on it 12%. 12 lakh 50. You'll say me, no sir, but we have issued some debenture, correct? We have issued some debenture. But if you go to that here, this is not 10%, this is 14%. These are two different category of debentures. So one is the 12%, second is the 14%. So we cannot just club it. We have to mention them separately. So these we will mention them 12% debenture 12 lakh 50 and 14% debenture 3 lakh. If you club it 12 lakh plus 12 lakh 50 plus 3 lakh and write it on one figure, that is incorrect because these are different class of debentures. Okay, so we'll show them in the notes to account number 3 long-term borrowing, but we'll show them separately. So write down that here now. Notes to account number 3. Long-term borrowings. Long-term borrowings. So 12% debentures. How much it is? 12,50,000. 14% debentures. 3 lakhs. Now write it down, this total that is coming 15,50,000 in balance sheet. Okay, 15,50,000. 15,50,000. Okay, now again go to balance sheet. When you go to balance sheet that here now, is there any change in the current liability amount? No, as it is 5,50,000. So write down that here 5,50,000. Then asset side, is there any change in PP? No, as it is 1,75,000. 1,75,000. Okay, then we have here investment is 3 lakh is mentioned. So type in calculate 3 lakh. But when we pass the entry here, we credited the investment by what amount? 1 lakh. So minus 1 lakh. Asset as debit balance, we are crediting them, we have to deduct them. 1 lakh, that is coming 2 lakh. So write down here in investment 2 lakh. Okay, then we have here inventory. There is no change in inventory, 2 lakh as it is. Okay, then we'll come to the cash and the bank balance. So how much cash and bank balance which is given? 15,70,000. For your reference, I'm writing it here because there are so many entry on cash and bank. So how much is given that here? 15,75,000. So 15,75,000. In our first entry that here, we debited the bank by 3,60,000. So I will add here 3,60,000. Okay, then here second entry, we debited by 2,50,000. So plus 2,50,000. Okay, then here third entry, we debited by 1,50,000. So we'll add 1,50,000. Okay, fourth entry, no bank in your bank. We paid him. We paid the amount 22,50,000. So minus 22,50,000. Okay. Then here, fifth no bank, sixth no bank, seventh no bank. Okay, eighth no bank, 10th no bank. Now we have to do the calculation. How much it is coming? 15,75,000 plus 3,60,000 plus 2,50,000 plus 1,50,000 minus 22,50,000. That is coming here 85,000. So how much bank balance that we have? 85. But wait, before we do the total of balance sheet, be careful that here now. You just have to see that. You just have to see that here now. Is there any entry which is not yet we have covered? So you can see that first all covered. Okay. Then here second all covered, tick tick. Okay. Now when we go to 4 that here now, you see that here it is coming 22 lakh. We have not yet ticked, but we have debited here. That is equity share buyback account, and we credited here. So it gets cancelled. Okay. Then here it is untick that premium on buyback. We debited here premium on buyback and we credited premium on buyback 10 lakh. So it gets cancelled. 7th entry all tick. 8th entry, this 7,50,000 is untick. That 7,50,000 we credited and we debited. It's also get cancelled. So all the items, it not a single one should be pending. Otherwise the balance sheet will not get tallied. Okay. Now we'll do the balance sheet. Total say 57,50,000 plus 27,10,000 plus 15,50,000 plus 5,50,000. That is coming here 1 crore 6 lakh. Oh no, 1 crore 5 lakh 60,000. 1 crore 5 lakh 60,000. So 1 crore 75,000 plus 2 lakh plus 2 lakh plus 85. That's coming 1 crore 5 lakh 60,000. Done. Okay. Now the balance sheet get what? Tallied here. Okay. Now what we'll do that here now? All notes are yes. Balance sheet gets tallied here. Okay. Always remember that here. Okay. When you pass that here entries that here, always remember that when you prepare the balance sheet, this is a thumb rule for the balance sheet that here. Liability capital reserve has credit balance. If an entry we have credit, add. If debited, deduct. If it is asset as debit balance. If we have the entries, we have debit them, and if we have credit, we have to deduct them. Whatever amount is coming, we have to write it down in new balance sheet. Now, very important concept that I will discuss with you now, but I will go to that concept in detail. I have to discuss. We will take a break. Okay, very important concept that here. if you see that here in your rapid gist book page number 30, the maximum number of shares that can be bought back. Very interesting, very important as well that is. So we'll discuss in detail after the break. Now we'll take a break for 10 minutes. Okay.
Hello, all of you. Okay, now come to in Rapid G's page number 13. Now come to Rapid G's page number 13. Okay, what happened is that very important thing is that whatever question that we have solved till now, what they mention is that in those questions that here this much amount of equity shares that they want to do the buyback, either they will use some percentage like the 25%, 20% like that. But what happened as per the Companies Act 2013, there are certain restriction. They cannot do a beyond that. They cannot do a buyback within a year. So there are three tests. There are how many tests that they have? There are three tests that here, and we call to those tests that here is a resource test. Okay, wait. Okay, we call to those tests is the resource test, share outstanding test, and the debt equity ratio test that here. So if they want to do the buyback, there should not be violation of any of these tests that here. So now the question that we're going to solve is based on these tests that here. So there are three tests. So what I will do that here, we'll take one simple question which is on these tests only. Okay, so do one thing that here now, go to question number 5th, which is in page number 50. Go to question number 5th. So what we'll do that here now, we'll solve this question, and this is basically on test. Okay, the three tests, and I will discuss those three tests with you. Okay, so what they say that here first is the SMA. What are those tests? First of all, that here, those tests basically says that here there should not be a buyback beyond those the limit which is mentioned in those tests that here. Okay, to make it simple, there should not be violation of any those tests. Maximum number of shares that can be do the buyback which is mentioned in those tests. So there should not be violation of any of those tests. Okay. So they say that here, the SMM Limited that here has the following capital structure as on 31st March 2017. So all figures rupees in the crores, and they have given us to two situations. Situation 1 and situation 2. First, equity share capital. Shares of rupees 10 is 1200, 1200. Then reserve, general reserve, security, general reserve 1080, 1080, securities premium account 400, 400, profit and loss account 200, 200, infrastructure development reserve, statutory reserve, they are saying the 320, 320. And the loan fund that is 3200, 3 and 6000. Now understand this. I will explain each and every point that. But if you see situation 1 and situation 2, all the figures are same except these two figures that here. All figures are except these two figures that here. Here it is mentioned that here 3200, and here it is mentioned that here how much is the 6000 that here. Okay, this is only change. If you see all other figures are what? The same here. Now they say that the company has offered a buyback price of rupees 30 per equity shares. You are required to calculate the maximum permissible number of shares that can be bought back in both situations, and also required to pass the journal entries. They ask us basically to calculate the maximum number of shares that we can do the buyback, and also they ask us to pass the journal entries. We'll come to journal entry later on that here, but first we'll calculate that here. What is the buyback price? Is rupees 30. They want to do the buyback. They have not mentioned how many number of shares they want to buy back.
They ask us to calculate the maximum number of shares that they can do the buyback. Okay, so the maximum number of shares that they can do the buyback, maximum permissible. Okay, so if they mention, they ask you to calculate the maximum, permissible number of equity shares that can be bought back. Basically, they're asking you to calculate those three tests that here. Okay, so I will explain each of them one by one. Just write it down that here. Question number fifth. So write down question number fifth. Write down there determination of maximum number of shares that can be bought back as per the Companies Act 2013. So what we are doing, we are basically doing the calculation of the maximum number of shares that we can do the bought back. Okay, now here write it down rupees in crores, all the figure which is given in question in crores. So write down rupees in crores. Okay, now what they tell us that here, go to this condition number 1, go to repeat this. Okay, now we'll discuss one by one. So they tell us that here now in condition number 1, they say there is a resource test. What say maximum permitted amount is the 25% of basically of both paid up capital and free reserve. Don't interpret that 25% of paid up capital and 100% of reserve. No. 25% of paid up capital plus free reserve. Always remember that when we talk about the buyback here in this chapter, free reserve is including what? Including securities premium account. Always remember that. Okay, only for these chapter, free reserve is including what? Securities premium account. So they say the first test, how much is the maximum permissible amount as per the Companies Act for the purpose of buyback? There is 25% of paid up capital and free reserve. Okay, then how to calculate? Very simple. What we'll do, that step number 1, we'll take the available resources for buyback. We'll calculate that available resources for buyback. There is a 25% of paid up capital and free reserve. We will take it that there is available resources for buyback. Step number 2, that is whatever is the fund which we can utilize for the purpose of buyback, and we will divide it by the buyback price, so we can find it out how much is the maximum number of shares that we can do the buyback as per these conditions. So what is the first step? We'll take the 25% of the paid up capital and free reserve. Free reserve means including securities premium. And second step, that is the total fund available divided by what is the buyback price per share. If we divide total fund which is available for the total amount for the purpose of buyback divided by the buyback price per share, what will come? That will come the number of shares that can be the bought back. Okay, now write down there. First we are calculating a, or you can say A. Okay, A resource test. Write down there maximum permitted limit limit 25% of paid up capital and free reserve. Okay, maximum permitted limit is how much? 25% of paid up capital free reserve. This is the first test that. Okay, this is the first test. Okay, resource test. Okay, now write down that there are two situations. So give the heading situation 1 and situation 2, like two different scenarios that they have. Okay, now they say 25% of paid up capital and free reserve. First do the total of paid up capital and free reserve, and then we'll take a 25% of it. Okay, now here write it down. Paid up capital, what is given in question? That we have a paid up capital of this 1200 and same 1200. Write down equity share capital. Equity share capital. 1,200, 1,200. Okay. Then we have reserve, we have general reserve 1,080, 1,080 in both the cases. So here, or you can write it down that here, the free reserve, you can write it down like this also, free reserve. You can just do the total here, 1,080, write down here 1,080, just 1 minute. Okay, 1,080 plus securities premium 400, including securities premium. When I say freezer, that is including securities premium. Okay, 400, 400, 400. Okay, in both the case it is same. Profit and loss 200, 200 plus 200, 200. Now understand this point. We cannot say this is 320, 320. No, this is not a free reserve, and it is specifically mentioned that it's a statutory reserve. It's mandatory as per the law. Some reserve that they have made infrastructure, there is some development for the purpose that they maintain a reserve. It is not a free that can be utilized for anything. Okay, so we will not consider it that here. Okay, now do the total here. 1,080 plus 400 plus 200. That is coming 1,680. 1,680. Now what we'll do that here? Now we'll do the total here. We'll do the total here. That is coming 2,880. 2,880. Okay, we've done the total here. Okay. Now, how much is the maximum available amount? If we say that here, if you go to rapid divide step number, available resources for buyback. So here write down available resources for buyback. How much that is? 25% of the to that okay amount. The 20 available resources for the buyback that here. How much is the 25%? 25% multiplied by rupees 2,880. That is coming how much is 720. 720. These are the amounts at here. Okay, 720. Okay, so how much is the maximum permissible amount? Is 720 in both the cases that here. Okay. What is step number 2 that here now? Step number 2 is that here. The number of shares that can be bought back. So write down there. Okay. Maximum number of shares that can be bought back. Okay, that can be bought back equals to available resources divided by buyback price. Buyback price. Okay, so how much is the buyback price per share? That is buyback price per share. So total amount we have is the available resources 720 and buyback price which is given in question 30. So 720 divided by 30, 720 divided by 30, that is coming 24. So 24 is a share, 24 crores, because all figures are given in crores. So here it will come that here 24 crores shares. Same in both the cases because the figures are same. 24 crores shares. Okay. Now, how much is the maximum that a number of shares that they can do the bought back as per these tests? That is 24 crore shares in both the cases because the figures are same. Okay. So what we have done, we have taken the total available resources. We take the 25% which is allowable as per the law. We have taken 25%. You can see that how much is allowable? 25%. Okay. Then we divide it by the buyback price per share. That is the maximum number of shares that can be bought back. We have find it out. Now here the second one that here. Now writing down the second one that here. B is share outstanding test. Now second test is share outstanding test. What it says that is share outstanding test. Go to repeat this again that here. They say total 25% of the share outstanding. Whatever number of equity shares outstanding, as per this 25% we can do the buyback. There is only one step on number of shares that can be bought back. 25% of existing number of equity shares. So write down that here. 25% of the shares outstanding. Shares outstanding. We are talking equity, obviously 25% of the equity shares outstanding. Okay. Now write down there. Okay. Two situation again. Situation 1 and situation 2. Situation 1 and situation 2. Okay. Now write down number of shares as per these. Number of shares that can be bought back. First, write down total number of shares. Number of shares outstanding. How many number of shares are outstanding here? You can see that 1200 is the amount, 10 is the face value, which means 120 crore shares. So let me write here total number of shares, which is out 120 crore shares. Same here, because in both the situation figures are same, 120 crore shares. How we calculate this 120 crore shares total number of shares is 1200 divided by 10. Okay, then we have to write it down that here now. Maximum number of shares that can be bought back. Maximum, as per these conditions, maximum number of shares that can be bought back. Okay, number of shares that can be bought back is equals to 25% of shares outstanding. So how much it will come? That is 25% multiplied by 120 crore shares. 120 crore shares. So how much it will come? That is coming 30 crore shares. So write down there 30 crore shares. 30 crores share. Okay, 30 crore shares. Okay, done. Okay, now we have here, as per the first, we can do maximum 24 crore share. As per the second test, 30 crore shares. Okay, now as per the third, not third, write on third here. Point number C that here. Okay, so we will decide how many we can do that, but first calculate individually that as per these tests how much maximum number of shares that we can do the bought back. Now if we go, third is the most important is the third one. First and second are simple. They say debt equity ratio test. So debt equity, what do you mean by debt first of all? So your debt means both long term debt and short term, means current liability, non-current liability, both. When I say debt, what do you mean by debt here? Non-current and current liability, both of them after buyback cannot be in excess of twice of the paid up capital free reserve. So what they are saying that is, after buyback, my debt, it cannot be more than the twice of the paid up capital free reserve. So once you have done the buyback, understand this point that is, once you have done the buyback that is, okay, whatever your paid up capital and free reserve, the twice of that, your debt cannot be twice of that. Okay, if I say that here now, if I say after buyback, sorry, after buyback, my debt, okay, no, after buyback, my paid up capital and free reserve, if it is 0.5, I'm giving example, if it is 0.5, my debt cannot be more than the twice of it. So it cannot be more than that 1. Or if it is suppose 1, so it cannot be more than 2. It cannot be more than 2. So what it says that here, whatever my paid up capital and free reserve after buyback, my debt cannot be more than the twice of that. You understand this situation? Okay, understand the point here? So I'm repeating it. Whatever my paid up capital and free reserve after buyback, my debt cannot be the twice of that. If that is 10 crore paid up capital free reserve, my debt cannot be more than 20 crore. If it is 100 crore, my debt cannot be more than 200 crore. You got the point? But what happened? Now listen carefully. There are certain steps that ICAI follow when they give the answer, solution is suggested or IC study material like that. The same step I will guide you that these six steps, I will guide you the how they do that. I will explain you that here now. When you solve, I will one by one, I will explain you that here now. And what happened that here? But there is no need to follow these six steps because there is one shortcut to follow that. Just in Galaxy, you can find it out just in less than 1 minute that way, okay? But don't do that in examination that way. But I will teach you, in examination, you will solve these six steps only that way, okay? Then ICAI will give the full marks. But ICAI's favorite question, buyback of securities, these chapter is ICAI's favorite chapter for the case study scenarios based MCQs that way. So they ask so many times, they ask the case scenario based MCQ on these buyback of shares chapter. Okay. So what happened? In MCQs, we don't have to follow these steps. We just have to find out the final answer. That's it. So for the purpose of MCQs, I will teach you, for solving the MCQs question, I will teach you one shortcut. How to follow, how to find it on the answers here. I will teach you the shortcuts that will help you for the purpose of MCQs. So if they ask you question in MCQ for the buyback, then follow these steps. Very simple. I will teach you later on. But in general, if they ask you the normal question for 8 marks like that, then you have to follow these 6 steps that here. Okay. So first we'll concentrate on these 6 steps. It is a little bit lengthy. Just listen me carefully. Now what happened that here now? First write it down that here. What's the rule? Write on debt, equity, ratio, test. What this test says that here now? It says that here now debt, long term and short term after buyback, right? After buyback cannot be in excess of twice the paid up capital and the free reserve of twice the paid up capital and free reserve. Now always remember that when I say free reserve for these chapter for buyback, free reserve is including securities premium account. Okay. Now understand, one by one I will explain each step that is. There are two situations. Situation 1 and situation 2. Now listen carefully. First, I will only discuss situation 1 because if I merge here both the situations, you might get confused. So first, our focus only on the situation 1, then we'll talk about the situation 2 later. Okay. So situation 1 and situation 2. Just write it down there. Now one by one. What is the first step? The first step that here, they say that here, write it down the loan fund that here. What is the first step? Loan fund. So how much is the amount? Loan fund means the debt. Loan fund means you can write it down. That is debt. So when I say debt, both short term and long term. So which is given in the question, how much the debt that we have here? 3,200. Okay, first focus on situation 1 only. So I will write it down that here first. First, loan fund, step number 1. How much is that here? 3,200. Write down 3,200 that here. Okay. What is step number 2? Step number 2 is that here, minimum paid up capital and free reserve that can be maintained 50% of debt. What is this? Now understand that here. They say how much is the minimum paid up capital and free reserve that we have to maintain it. If I say you that here now, what is the rule that here? If I write it on debt and the paid up capital, okay, paid up capital and free reserve. Okay, now understand that here. They say whatever paid up capital and free reserve I have, suppose this is 2, so it cannot, suppose this is 1, okay, or let's say this is 1, so it cannot be more than the twice. It cannot be more than the twice of the paid up capital and free reserve. Okay, so if I know this figure, here, how much is that amount here that is coming here? 3,200. You can see that you can see that 3,200 is. So can we find it out this how much should be the paid up capital and free reserve? Can we find it out this how much should be the minimum paid up capital and free reserve should be maintained? That is the 50%. Now understand, I'm repeating that. What these conditions say of the Companies Act, after buyback, my debt, it cannot be more than the twice of the paid up capital and free reserve. Now hypothetically, suppose my paid up capital and free reserve is 1, our debt cannot be more than 2. If here I know the harm, because there will be no change in the depth will be same that year, but there will be change in the paid up capital freezer. If I say I know the depth here, how much is the depth? 3,200. So how much should be the minimum paid up capital freezer should be maintained? The 50% of that. You can see the what is the 50% of 2? 1. So what is 50% of 2? That is 3,200. That will become 1,600. So that's why they say that here. Now step number 2. Minimum paid up capital freezer that should be maintained, that is 50% of the debt, that is. How much debt we have, and let me tell you honestly, it is not difficult at all. It needs a practice. So first time it might be challenging for you, but you will solve 1-2 questions, then it will be just a cakewalk for you. To understand this, what it says that here, now they say here, is a 3,200 is the total amount of the loan fund. They say that here, if you think from this point of view, whatever paid up capital freezer you have, your debt cannot be twice of that. If I say my debt is 3,200, so how much should be the minimum paid up capital freezer? Because we know how much is the debt. So how much should be minimum we maintain? The 50% of that here. We are doing reverse calculation we're doing. Okay. So that's why this is step number 2. Write down step number 2 here. Write down their minimum paid up capital and free reserve to be maintained after buyback. So how much it will always be? That is 50% of loan funds. So 50% of debt loan funds. So how much we have loan funds here? That is 3,200 multiplied by 50%. But do you understand why 15%, 50% that they say? We are doing the reverse calculation here. Listen. Here if I say paid up capital free reserve is 1, suppose. My debt cannot be more than twice of it. This is 1. My debt cannot be more than the 2 after buyback. Correct? But here we know the amount of this debt, that is 3,200. So these paid up capital freezer 50% of the debt. Or you can okay, so here the paid up capital freezer 50% of these 3,200, that will become 1,600. Step number 1, debt. Step number 2, just take the 50% of debt. Now step number 3. Now they say that here now is the existing, step number 3 is that here now, existing paid up capital and what? The free reserve. Existing paid up capital free reserve, that here. Okay, now understand this one. Write it down, that is step number 3. Existing paid up capital and free reserve. Existing paid up capital and free reserve. Okay. Now, if I say that how much existing paid up capital free reserve, you can take it from the resource test. Do you remember? We write it down that here. This is the paid up capital that there. This is the free reserve that there. So that is coming 2,880. So you can take the figure from the existing paid up capital free reserve that we have 2,880. Okay. Now understand 2,880. Okay. Now, very interesting point before I go to step number 4. I have to discuss with you something and which is very important. You just have to listen to me very carefully. Very interesting, very important point is that. Okay. Okay. For your reference, you can write it down like that. I just to explain you this concept I'm writing down here. Okay. Now understand that here. How much existing paid up capital and free reserve that we have? So we have 2,880. Do you agree that here? Yes. Out of that 2,880, this is existing paid up capital free reserve that we have. How much should we maintain minimum? So there is no violation of this rule. We have to maintain 1,600. This much we have to maintain. So this much we have to maintain. So I will say, okay, out of 2,880, I have to maintain how much? 1,600. I have to maintain that here. So I will say that here, this is existing paid up capital and free reserve. Okay, this is okay. This is paid up capital and free reserve to be maintained. It should be maintained that here. Now suddenly you will tell me, sir. Okay, now you will tell me, sir. Now if 2,880 is the existing paid up capital and free reserve that we have, you will tell me, sir, we have to maintain 1,600, correct? So it means remaining we can utilize for the purpose of paid up, for the purpose of buyback. No, you see, no, but why? if I say that, first listen, then we'll write it down later. If I say that here now, whatever amount will come that here, that much we can utilize for the purpose of what? Permitted. Let me write it on permitted amount of buyback. Yes, correct that. A permitted amount of buyback. So you will see, sir, very simple is that here now. Take this paid up capital, the existing paid up capital reserve. If I say that here 2,880 minus 1,600, that is coming 1,280 balance. You see, sir, if the 2,880 is the existing paid up capital reserve that we have, 1,600 that we maintain, it means remaining, remaining, we can use it for the purpose of buyback. I agree with you. But there is one twist here. You say, what's the twist here? The twist is that here now the existing paid up capital reserve that we have, how much is 2,880, and this much we have to maintain. But out of this 2,880, something also I have to transfer it somewhere. Sir, where, sir? 2,880 is the existing paid up capital reserve. We have to maintain 1,600. So something else we have to transfer somewhere. I say yes. You know what happened? There are certain amount that we have to transfer it somewhere. Where? Let me call it X. Let me call it X. So what is this X? Where should we transfer it? Student get confused here. Where should we what is this X? Where should we transfer this X? I don't know the amount, but I have to transfer it somewhere, this X. But what is this X? You know that when we do the buyback, we have to transfer to CRR. So you will tell me, sir, what is the problem? Now understand the logic here. You will tell me what is the problem, sir. The problem is that here now, when I transfer to CRR, understand the logic here. When I transfer the CRR, I am going to transfer it from some reserve that is. So I am going to transfer from free reserve to CRR. So my CRR will go, sorry, the free reserve will go down. But this CRR is not a free reserve. This is not a free reserve. So please understand this point. When I transfer from free reserve to CRR, my one reserve is going down, that is free reserve. But CRR is increasing, but this CRR is not a free reserve. This is not a free reserve. So condition is that we have to maintain that a minimum paid up capital reserve that we have to maintain is not the 50, the paid up capital free reserve we have to maintain. Free paid up capital and free reserve. So when I transfer the certain amount from my free reserve to CRR, so we are decreasing the free reserve, but we are not increasing another free reserve. That CRR is not a free reserve. So it means that here now, from these paid up capital that here, now, here paid up capital free reserve, certain amount we have to transfer to CRR. So it means that here now, what does it mean? Now understand this point here. This is my total existing paid up capital and free reserve. Now understand, this is my existing paid up capital and free reserve. 2,880. 1,600 that here now, I am going to transfer to, I have to maintain 1,600. I have to keep it aside, 1,600. Certain amount from these reserve, I have to keep it, I have to transfer to CRR also. CRR is not a free reserve. So my free reserve is going down. So free reserve, I will transfer to CRR. Now this is the remaining is, this much is utilized for the purpose of what? Buyback. So if we don't know the amount of how much we will transfer to CRR, we call them X. So how much we can utilize for the purpose of buyback, we call them Y. So this is the equation that is. Now, if I want to find it out, how much is the amount of the Y and the X, this is one shortcut. Just in less than 1 minute, I can find it out in calculus. I will teach you that. That will help you for the purpose of MCQs question. That okay. But here, what is going to happen? ICAI say no. They want to make it complicated. So they want to solve to find it out this X and Y through a simultaneous equation. It's more like a math now. They want to solve it through a simultaneous equation that here. Okay. So what you will do that here now, this is just for your reference that here. Okay. So write it down this here. Write it down this here. Okay. Now after this that keep the space of 8-10 lines. Okay. After this, you just first write it down this. If you have not written, pause the video and write it down that. Okay. And then keep the space of 7-8 lines that here. Okay. 7-8. Keep the space of 7-8 lines. 10 lines. Okay. Then write it down working note. Working note. Write down the working note. Okay. Give the space of around 10 lines and then write it down the working note. How many steps that they have? Total 6. We have only covered 3. Okay. Now write down working note that here. So what we'll do that we'll find it out the amount by which simultaneous equation that here. Okay, now write down that here. I'm writing in detail. You have to present like that in examination. Working note number 1. As per section 68 of the Companies Act 2013, amount transferred to CRR, and maximum equity to be bought back will be calculated by simultaneous equation method. Okay, simultaneous equation method. Suppose amount equivalent to nominal value of bought back. Nominal value means the face value of bought back that we transfer to CRR. Nominal value of bought back shares transferred to CRR account is X. Okay, and maximum permitted buyback of equity is Y. Okay, the amount that will transfer to CRR is X. Maximum permitted amount of equity is Y. So there are two equations that will make it. Equation number 1. Equation 1. So how to present that here? This is what the equation, I will write it down that here. Okay, but to make it simple for you, I will tell you how to present that here. Okay, now write down that here. Equation 1. Write down there present paid up capital and free reserve minus that here now minimum paid up capital and free reserve to be maintained minus that here now amount transferred face value of or nominal value face value of buyback. Okay, face value of buyback transferred to CRR equals to maximum permissible. Okay, write down maximum permissible buyback of maximum permissible buyback. Okay, now understand that here. How much is the present paid up capital? For your reference, I have written down, not necessary to write on the exam that here. Okay, how much present paid up capital freezer that we have? We have here 2,880. So write down that here now. Okay, write down that here 2,000 here 880. Okay, now this is the equation 1 that we have. Okay, the equation 1 I am talking. Then you write it down that what is the minimum that we have to maintain that here? We have to maintain minimum 1,600. 1,600 that we have to maintain. And some amount will go to CRR, we call them X, and the amount that we have maintained, we call them Y. This is the first equation that we have. Okay, now write down that here now equation 2. Okay, write down that here now equation 2. Now here, when we talk about the equation 2, that is the first equation that we have. Okay, now this is first equation that we have. Now if I talk about the equation number 2 that here, I will tell you why it's important to write in the equation number 2. Write down there now. Equation number 2 that here. So how much, let me, for your reference, I am writing down in terms of what the formula that here. Write down that here now. Maximum buyback divided by offer price or buyback price, offer price for buyback multiply by nominal value. Nominal value means face value. Okay, now understand that here. What is the purpose of this equation that here? Okay. Now, if I say that here now, what is the maximum permit of buyback that we can do the buyback? What is the maximum number of buyback? We call them Y. We don't know the amount that here. Okay. Now, if I say divided by what is the offer price per share, that is a 30. So when I say that here now, is the buyback price is 30. What is Y? That is the maximum number, but is the maximum permissible amount. So if I say that here, I have suppose whatever XYZ amount that I have. If I divide it by the buyback price per share, the number of shares will come. Now listen carefully. When I say that here now, I have total. Okay, I have total that here now. I have total here. Let's say whatever amount, XYZ amount. If I say this is a total permissible amount, we call it Y. If I divide it by the buyback price per share, so number of shares we will come that we want to do the buyback. Okay. Now, if I multiply by with the face value which is given in question is how much? 10. So, if we multiply by with the face value, what we do when we multiply face value? We transfer to CR. So, total amount that I have divided by total permissible amount I have divided by the buyback price. So, number of shares will come. Multiply by with the face value. So, this much amount we have to transfer to CR. Listen carefully. 10 times listen. Okay. Total permissible amount we have divided by buyback price. The number of shares will come that we want to do the buyback. Multiply by with the face value. So what will come when we multiply by with the face value? Then that will come when we multiply by with the face value. That is the amount we have to transfer to CR. So what we call them? We call them X here. Now we have to take into consideration both the equation 1 and 2 to find it out what that is, or you can write it down to it that like, okay, that will come here 3x equals to Y. Okay, remember these two equations. Now by solving the above equation, what we get? Okay, by solving the above equation, we get here how much X and how much Y will come. If I put how much is the Y? Y basically is equal to Y basically 3x. So put the equation, it is 3x that. Now if I solve that here, okay, how much that will come here? Let me write it down for you. So we have here 2280 minus that here 1600 minus x is equal to what is Y is 3x. Solve this equation. So 2880 minus 1600 then divided by 4, so that will come 320. So x is coming 320. Now put the value of 320. Where we'll write it on this 320 that here in equation number 2. So if we put the value of this 320, we find out the x that here. So we can find a y, 3 multiplied by x. So you will find the value of y, or even if you put it x here, 320, you will find it out the value of y that here. Okay. So if I say that here now is, you can see that here like, we put 3x here. So 3 multiplied by x is 320. So that will 3 multiplied by 320. That is coming how much here? 960 will come. Okay, 960 will come. So write it down here 960, or you can solve by some other way also. You can see that here, or you can see that here. The first here, that first equation that here is 2880 minus 1600. We already know the value of x now, that is 320. So the value of y will come there. Okay, 2880 minus that here now 1600 minus 320, that is coming 960. Done. So there is one shortcut I will discuss with the shortcut later on that here. Okay, now we have write it down this is how we have to solve the, every time when the ICAI asks you have to find the value of these x and y like this. And I'm telling you that here, please don't worry that it requires practice. Once you solve 2-3 questions, you'll be expert in that. Okay, it requires practice that here. Okay, now You have write it down here. You have write it down here. The step number how much? The 3. Now write it on step number 4 there. Step number 4. That is the future. What is step number 4? Future paid up capital free reserve. Write on future paid up capital. Paid up capital and free reserve. Okay, now please understand. When I say future paid up capital and free reserve, that I will write it down. What is it? We just keep the space of one line there and write it on step number 5. I will come to that. Step number 5 is maximum permitted amount of buyback. Write down maximum permitted. Okay, maximum permitted amount of buyback. So we have find it basically permitted amount. They're talking the Y. We have find it the maximum permitted amount is how much? 960 crores. So you can write it down that here. Working note number 1. This is situation 1. Okay. And I will discuss with you situation 2. Okay. Now here, this is how much it is coming? 960 crores at here. How much it is? 960 crores at here. Okay. Now here, last step that maximum number of shares that can be bought back. So write down that here. Last step. Maximum number of shares that can be bought back. Okay. Now bought back at a rate of rupees. We want to 30 per share. We are purchasing the shares at rupees 30. So what is the formula that they have here? Is the maximum permitted amount divided by buyback price. What is the maximum permitted amount that you write it on step number 5? So maximum permitted amount is 960. Buyback price is 30. So 960 divided by 30. That is coming 32 crore shares. So here they can do buyback 32 crores shares. Okay. Now, how many maximum number of shares that they can do the 32 crores? Let me do the revise for you not understand that here. What is the first step that here? The debt that they have debt 3,200. So what is the rule that they have here? Here they say that here, whatever the paid up capital free reserve that you have after buyback, the debt should not be twice of that here. So if I know the debt 3,200, the paid up capital free reserve that here after buyback, it should be 50% of that. So we took a step number to 50% of that. Current paid up capital free reserve that we 2,880. Okay. So when I say the current is 2,880, but out of that here, 1,600 we have to maintain and some amount will transfer to CRR that here now. And whatever left that is available for the purpose of buyback. So we solve these, we find out X and Y through a simultaneous equation that here. So we create a simultaneous equation 1 to with the help of that, we find out the amount of X and Y. Okay. Now this is the maximum permitted amount and the buyback price per share is 30. Okay, done. Now, I see write it down that here. That's why I'm just writing down that here. What is the future paid up capital free reserve that here? Write down that here. Is the 2,880 the existing paid up capital free reserve and some amount will be transferred to CRR that here. Okay. So if I say 2,880 minus 320, that is coming here. How much write down? 2,560. So why they write it down like that here now? They say that here, this is the existing paid up capital free reserve, some will transfer to CRR that here. Okay. They're not talking how much minimum should be the maintain. That's a different thing. Minimum that they have to maintain that much here. Okay. But they say this is the paid up capital free reserve that they have and this much they will transfer to the CRR account that day. Okay. They will do some buyback also that day. This is just for the reference purpose. So don't worry. This is the existing. This much they have to transfer to CRR. The future paid up capital free, not necessarily that future paid up capital free that will be that much. Why? Because when they will do the buyback, some share capital will go down. But anyways that here, but for the purpose of the reference, they write it down. You have to just write it down. Okay. Now, as per these, that is how much paid up capital free reserve that we have to maintain, that maximum number of buyback that we can do 32 crore shares. Okay, now wait. Now come to equation number 2 that here now. Okay, what is the equation number 2? They say that here in a not equation, sorry, situation number 2. So how much is the paid their debt is 6,000 there. So if I say my debt is 6,000, let me write it down as 6,000. You also have to write it down. How much should be the minimum paid up capital and free reserve we have to maintain? 50% of that. That will come how much? 3,000. How we calculate this 3,000? 6,000 multiply by 50%, that will come 3,000. How much is the existing paid up capital free reserve? That they have 2,880. Now a twist will come that here. You will say, what is the twist there? Now here, but if you see that here, how much is the existing paid up capital free reserve that they have? 2,880. Correct. How much they have to maintain? This much they have to maintain. Oh, the maintain amount is more than the existing amount. So existing they have 2,880 and they have to maintain 3,000. So already they are lesser than the amount that they have to maintain that year. So they cannot do the under situation 2. They cannot do the buyback here because it's a violation of these conditions that year. Why? What is the amount that they have the paid up capital free reserve that they have? 2,880. How much that they have to maintain? 3,000. Already the amount that they have to maintain that year, 3,000, they have the less than that. How can they do the buyback? The amount that they have to maintain 3,000 and their amount that they have current 2,880, which is already below that. So they cannot do that. Here, if you see that here, amount that they have to maintain 1,600 and then currently they have 2,880. So there's more amount for that. So they can utilize this amount for the purpose of what? Buyback. You got it? Here they cannot do that here. So here, if I say that here, now you just have to write it down, the not applicable here. Okay. Here maximum permitted amount is nil, and you can say that it does not qualify here. Here you can say how many number of shares they can do? Nil that here. So for your reference that here, now you can write it down that here for your reference that here, now does not qualify. Does not qualify. Okay, here they qualify. Okay, now understand that here. Okay, so what is the rule that here now? Okay, let me write out, but I don't have enough space here. Okay, just give me a minute. Yeah, no problem. I have the option. You don't have an option that here. Okay, I can keep. I will drag it. Yeah. Okay, now understand this point here. Okay, now please understand this point here. Okay, now understand what it says that here now. Write down there. Maximum number of shares that can be bought back least of the above 3 tests. Why is it least of the above 3 tests? To understand this point here, the maximum number of shares that we can do the buyback is 24 crore. Here 30 crore, and here is how much? 32 crore. So when I say that here, we have to take the least of the 3. Why? When you take the least of the 3, there is no violation of any conditions. Here we just focus on the situation 1. 24, 30 and what? 32. Least is 32. You do the buyback 32, there is no violation of any condition. Okay. So least of the 3, that is coming how much here? In situation 1. In situation 1, 24 crores shares, and in situation 2, okay, in situation 2, nil. Now take the least of the 3. As per the first test, they can do 24, second test 30, and the third test they can do 0. So if you take the least of the 3, so that will become 0. Why least of the 3? If you not take a least of the 3, then again the violation happen with any of these tests that is. So for example, situation 1, I have, how many figures I have? 24, 30 and 32. 24, 30 and 32. If I do that much, so it will be more than 24. So violation of these conditions will happen. These conditions. That's why they say we have to take the list of these 3. Okay. So situation 2, we cannot do the buyback because the list of the 3 is coming 0. In situation 1, we can do that. So they asked us to pass the journal entry. So we are going to pass the journal entry only for the situation 1. Okay. Now write down there. Journal entries. Journal entries, okay, in the books of SMM Limited, situation 1. Okay, rupees in crores. Now draw this for just half page. Draw this for half page. Write down the amount. Okay, now first that here 4 entries, simple. Equity share buyback, first will purchase, so equity share buyback account debit, equity share buyback account debit. We can buy back 24 crore shares, and we are doing the buyback at 30 rupees, so multiply by 30 that here. So 24 multiplied by 30, that is coming 720 to bank account. 720 being payment on buyback of shares. Being payment on buyback of shares that. Okay. Now second entry, cancellation that here. So equity share capital account debit, equity share capital account debit, equity share capital account should be debited. We cancel the capital by face value. So face value is 24 crore shares. Face value is 10. So 24 crore shares multiply by rupees 10, that will come 240. Premium on buyback account debit 24 crore shares, write down, multiply by 20. Why here? The face value is 10, we are doing the buyback at 30, so 20 is the premium, so that will come 480. To equity share buyback account 720 being cancellation of equity shares on buyback. Okay, being cancellation of equity shares on buyback. Okay, third. Now, what a premium on buyback will add this. So, how much is the premium on buyback? 480. So, how much balance we have? We have securities premium, we have 400. So, always give the first priority to securities premium. So, we will utilize 400 from that and remaining from the general reserve or P&L account. Okay, write down. Securities premium account debit 400, general reserve account debit 80. How we find it? 80. 480 is the total, and we have already utilized from the securities premium 4. So balance is 80. Okay. To premium on buyback account. To premium on buyback account 480. Okay, 480. So being premium on buyback adjusted against securities premium and general reserve. Okay, now for that here now we have to transfer to CRR. So how much is the we are doing the buyback 24 crore. So 240 is the face value that here. Okay, so free the general is that we have enough balance. We have 1080. We enough balance. We have utilized just here how much? We have utilized 80 also. So we have enough balance in that. So write down general reserve account debit. General reserve account debit. 24 crores shares multiply by the face value is 10, 240. To capital redemption. Okay, write down capital redemption reserve account. How much it is? 240. Okay, write down there being face value of equity shares. Okay, buyback transferred to CRR account as per law. As per law. Okay, so done. So let's do the revision that here now. The main that we have discussed after the break that here. What is that? These three conditions. So what this says that here about these three conditions, that what is the first condition that they have? They say about the first, okay, what is the first condition that they have here is the resource test. What the resource test say that here is the 25% of the paid up capital reserve, so that we find the resources available divided by the buyback price. This is number of shares for the resource test. What about the share outstanding? Just 25% of the outstanding equity shares. That much number of shares we can do the buyback. What is debt equity ratio test? They say after buyback, your debt cannot be more than the twice of the paid up capital free reserve. So there are 6 steps that how we find it that 6 steps that here. First, what we do that here, we write it in the debt. We take the 50% of that. Why 50%? If the paid up capital free reserve is 1, the debt cannot be more than 2. If I know the amount of debt 3,200, so here I will do the reverse calculation 50%. This is the minimum paid up capital free reserve that we have to maintain. Then they say we should have to maintain at least this much. Then they say how much we have? 2,880. So out of 2,880, I am going to maintain 1,600 that here. And this much at some amount I have to transfer to CRR, we call them X, and the remaining is the Y, that is permissible amount for the purpose of buyback. But this X and Y, we have to find it out through a simultaneous equation. So we create this simultaneous equation, we solve it from these, okay. Then here we find it out that how much is the permissible amount, then we divide it by the buyback price. So if we find it out the maximum number of buyback that we can do. And we have to take out of these 3 tests, we have to take the least of the 3, okay, done. Now let me tell you that here one shortcut that here now. I told you that here basically this is a shortcut that will help you for the purpose of what here? For the purpose of MCQ's question that here. So we can find it out these instead of doing the simultaneous equation and all that here. We can here, okay, 1 minute. Okay, we can that here find it out that here. Okay, now how we can find it out that these they say how much is the existing paid up capital and free reserve that they have. I will say, okay, I have maximum paid up capital and free reserve that have present capital and paid up free reserve. I have 2,880. Out of that, 1,600 I have to maintain. Do you agree that? But I will not transfer X there. I don't know how much you have to transfer to CRR. So if I have the current, my buyback price is how much here? 30. I will add here this 10. This is new for you. You'll say, what is this 10 that you don't understand that? Wait, sorry. This is 10 I have to add. Let me write it down again that you know. I will add back here 10. Now understand the logic here. 2,880 I have. I deduct from that the minimum that I have to maintain 1,600. Still, in a numerator, we have not reduced the amount that we have to transfer to CR. It means 2,880 minus 1,600, whatever amount comes, that is inclusive. Let me write 2,880 minus 1,600. That is 1,280. That 1,280 is the inclusive the amount of CRR we have to transfer to CR, that is including in that 1,280. So when I say divided by denominator, if in the numerator CRR amount is inclusive, then denominator also buyback price per share we have to add the CRR amount in numerator also. Why? Because in the numerator that here the CRR amount is including there. So in denominator also the CRR per share should be including there. Simple logic. Numerator we are to simplify it that here. In the numerator that here now the CRR amount is already including there. Correct? So we have not deducted. Correct? Including there. So in denominator also we have to add the CRR amount per share. Simple. Numerator add, denominator add. In a numerator we add we are not actually here, I mean to say it is already included there. So no need to just write it down again, add 360, whatever is the amount, 320. Don't do the add 320. It is already in 2280. We did a 1600. So it is already in that here, 320 is already in 2880. So it is in the numerator 320, the CRR amount. The CRR per share we have to include in denominator also. So it will get matched. Answer will come directly that here. So if I say divided by 40, that is coming 32 crore shares. So in examination that here now, so this is a basically shortcut only for MCQs question. Only for MCQs question. These are the shortcuts only for the MCQ question. Okay, very simple. Now these just, it will less than 1 minute it will take. But what we have done, that we have taken the simultaneous equation and all that, but you have to solve like that if in the main question. If they ask in MCQ, just solve like this. Okay, we'll find it just quickly, we'll find it out there. You got the point that here now? Okay. Now what we can do that here now, there is one more the question on it that here. So we can solve it that question that is only on the question number 4, which only they ask you to calculate only the debt equity ratio test. No need to calculate all the tests, just one debt equity ratio test. Quickly we saw it will hardly take 15-20 minutes. Okay. Now this is Pratham, and tomorrow fresh will start with a full-fledged question. Today our focus only on these 3 tests. Okay. Now Pratham Limited, a non-listing listed company, has the following capital structure as on 31st of March 2021. They have equity share capital, shares of rupees 10 each, fully paid 30 lakh. Now the reserve and surplus, general reserve that they have here is the 32 lakh 50,000, securities premium account 6 lakh, profit and loss account 4 lakh 30,000, revaluation reserve 6 lakh 20,000. The total amount of reserve and surplus 49 lakh. Now the loan fund is 42 lakh. You are required to compute by the debt equity ratio test the maximum number of shares that can be bought back in the light of the above information when the offer price, buyback price is 30 per share. Simple. So we have to calculate on the debt equity ratio test. Now write down there. Okay, write down. Question number 4. Write down there. Give the title debt equity ratio test. Debt equity ratio test. Write down there. Debt equity ratio test. Basically debt, write in bracket, long term and short term both. Okay. After buyback cannot be in excess of okay, cannot be in excess of the twice of the paid up capital, of twice of the paid up capital and free reserve. So we have here steps. Step number 1, loan fund. Loan fund is nothing but a paid up capital, the debt, short term, long term both. So they have given the debt here already 42 lakhs. Simple, write down 42 lakhs. Step number 2, minimum paid up capital, and free reserve to be maintained after buyback 50% of loan funds. Okay, 50% of loan funds. How much it is? 42 lakh multiply by 50%, that will come 21 lakh. Okay, 21 lakh is the minimum they have to maintain. Now, how much is the existing that here? The step number 3, existing paid up capital and free reserve. So they have a paid up capital equity. How much that they have here is 30 lakh. Okay. Now for your reference, you can write it on inner column like this: equity, paid up capital, that is here 32 lakhs, and the free reserve, that, sorry, not 32, 30 lakhs. 30 lakhs. Then we have here general reserve that they have here, securities and pay. Revaluation reserve is not a free reserve. Okay. Okay. So write down that securities premium for the purpose of buyback, we consider it also. Okay. Free reserve. Write down here in inner column. We have 32,50,000 plus we have 6 lakhs plus we have here 4,30,000. 32,50,000 plus 6 lakhs plus 4,30,000. Okay, 42,80,000. This is the existing paid up capital free reserve that they have. Okay, so that is coming here 72,50,000. So enough, that is 72,80,000. So they have existing 72,50,000 and they have to maintain 21. So here for your reference, I am writing down here. Okay. So here that they have here 72,80,000 that they have, that the existing paid up capital reserve that they have. Okay. Minus they have to maintain 21 lakh. They have to maintain it that. And some they will transfer to CRR, and whatever remaining that they can utilized, or you can say permissible, that utilized for buyback. Okay, or permissible for buyback. Okay. So to find it X and Y, we have to solve through the simultaneous equation. So keep this space of, let me write it on the next page that here. Okay. So write down that here now. Working note. Working note. Number 1. As per Section 68 of the Companies Act 2013, amount transferred to CRR and maximum, okay, equity to be bought back will be calculated by simultaneous equation method. Simultaneous equation method. Okay. Now suppose amount equivalent to face value of bought back shares transferred to CRR account is X, and maximum permitted buyback of shares is Y. Okay, maximum permitted amount of buyback of shares, maximum permitted amount of buyback of share is Y. So we are going to prepare the two equation, that equation 1. Now no need to write it down that here again and all that. That I write it down just for your reference that here, okay? I'm going to say these, all these, okay? This is just for your reference that here, okay? Now write down that here now. Equation 1. So how much that we have here is the existing paid up capital of reserve is 72,80,000. I am going to transfer to minimum that I have to maintain. How much? 21 lakh. 21 lakh I have to maintain, and will transfer to CRR, and the remaining is funds. Equation 1. Equation 2. So Y is the maximum permitted amount divided by the face the buyback price, which is 30, multiplied by face value. So here it will come X, because maximum permitted amount divided by buyback price, so number of shares will come, multiply by with the face value. So CRR amount will, that X is the CRR, or you can write it down that 3X is equal to Y. Now by solving the above equation, we get X, Y. So how much is the amount of X that we have here? That will come here is how much is 72 lakh 80,000 minus 21 lakh. The X minus and Y is equal to 3X. You have find out this Y is equal to 3X. Now solve this equation, that is 72 lakh 80 minus 21 lakh divided by 4. That is coming 12 lakh 95,000. How much it is? 12 lakh 95,000. Now just 12 lakh 95,000 X. Okay, multiply by 3, you will get the Y. That is coming 38 lakh 85,000. So how much the maximum permitted amount? 38 lakh 85. What is the amount of CRR? 12 lakh 95. Okay. Now again go to that those steps that here. Now write down that here step number 4. That is the future equity shareholders fund. Okay, future equity shareholders fund, or you can say that here now. Now let's keep, okay, to make it simple, future paid up capital of reserve, we can say, okay, future paid up capital, the paid up capital and free reserve. This is just for the reference. So existing paid up capital free reserve that we have is 72 lakh 80,000 that here, and we are going to transfer to CRR that we have calculated working number 1, 12 lakh 95,000. So 72 lakh here 80,000 minus that is 12 lakh 95,000. That is coming here 59 lakh 85,000 that here. Okay. Now fifth step number 5, write down that here now, is the maximum permitted amount of buyback. Calculate in working note number 1. So how much amount of Y is coming there? 38 lakh 85,000. So write down 38 lakh 85,000. Easy. Now we have to divide by the buyback price, so we can find the maximum number of step number 6. Now here write down maximum number of shares that can be bought back at a rate of rupees 30 per share. So amount is 38 lakh 85,000 and divided by here, what is the buyback price that here? Rupees 30. So 38 lakh 85,000 divided by 30, that is coming here 1,29,500 shares. Okay, is there any calculation that shortcut to find? Very simple. I told you the shortcut that here now. Shortcut for MCQ's question. Okay. So how much is the paid up? If you see that, how much is the existing paid up capital and free reserve that they have here is 72 lakh 80,000. Yes, 80,000. How much that they have to maintain? 21 lakh. Okay. So it means we have not deducted the CRR amount. It is including there. So what is the buyback price? 30 plus 10 face value. Why plus 10 that here? Face value. You can why? Because in a numerator it is including CRR. So denominator and also including CRR. We transfer to CRR face value. 72 lakh 80 minus 21 lakh divided by 40. 1,29,500 shares. So simple. Okay, just in one step you find the answer. Okay, but in examination for MCQ, use this shortcut trick you will use. Okay, if a full-fledged question that here, you have to solve like this only. Okay, done. So I will not give much homework today. The reason is that here I want to do the practice today. That here for just do the practice of question number these 4 and 5th. That's it. Now if I go to the homework, that I can give one question at least. I gave you 10, already 11. Okay, let's see. Can I give you the 12? Just 1 minute. No, this redeemable preferential I have not yet covered. The redemption of preference that I will cover tomorrow. So here. One question I have to give you, na? Wait. Bonus company achieve the target. This you can do that. Yes. Yeah. One question over. Good. Otherwise, what happened? There's so many questions will come at the end. Okay. There's so much burden on you otherwise. Question number 30 is homework. Simple. You can do that. Okay. Now, question number 13 is homework for today. Homework. Question number 13, and you can do the practice of class question that we have solved today. The question number, I think, which question that we have solved today in class is solve question number 4th and question number 5th. 5th and 4th you can do the as practice there. Okay. Now that is for today, but remember that is not at all a difficult idea. You just have to do a little practice is important that here. So I know that the first time when we see that is the resource test and the share outstanding, the debt equity ratio test, especially that here. But don't worry, once you solve 2-3 questions, then it will be so easy for you that here, okay? Because you have to work hard, because you are going to score 80 plus in advanced accounting. I know that. Okay, so you're going to score 80 plus in advanced accounting. I'm waiting for the day you will score the 80 plus in advanced accounting. Okay, so you're going to score that, but it requires a consistency and require a patience. If you have a doubt, you can drop me a message anytime. Okay, so that is for today. Take on one more thing, that is tomorrow we will cover the questions, almost the redemption preferences, all those I will discuss with you tomorrow that here. Okay, the main part that we have done with the calculation of what these 3 tests that here. Okay, that is for today. Take care all of you. Bye bye.
Hello all of you, I hope all are doing good. In our previous session we discussed about very important concept in these buyback of equity shares, that is 3 type of tests. There is a resource test, share outstanding test and debt equity ratio test. That so what we'll do that here, we'll do the revision of these 3 tests that through a question only. Today when we are going to solve a question in which you will find it out that here these 3 type of tests. So I hope you have solved the homework that I gave you in previous session, that is question number 13. Okay, now come to question bank and now come to question number 3. Come to question number 3. It's an ICAI study material question. Now this is following is the balance sheet of competent. Following is the balance sheet of Competent Limited as at 31st of March 2021. Now equity and liabilities, shareholders fund share capital, that is note 1, 12,50,000. Then they have reserve and surplus note to 18,75,000. Non-current liabilities, non-current liabilities, long-term borrowings note 3, 28,75,000. Current liabilities, other current liabilities 16,50,000. Assets, non-current asset, property, plant and equipment note number 4, 46,50,000. Current asset, other current asset 30 lakh. Notes to account, first share capital, authorized, issued and subscribed capital. Equity share capital, fully paid up shares of rupees 10 each, that is 12,50,000.
reserve and surplus. So they have reserve and surplus is securities premium 2,50,000, profit and loss account 1,25,000, revenue reserve 15 lakh. Then they have long-term borrowings, 14% debentures, that is 18,75,000, unsecured loan 10 lakh, total property, plant and equipment, land and building 19,30,000, plant and machinery 18 lakh, then furniture and fitting 9,20,000. The company wants to buy back. How many shares they want to do buyback? 25,000 equity shares they want to do the buyback. The share is of rupees 10 each on 1st of April 2021 at rupees 20 per share. So what is the face value of the share? 10 rupees. At what price they want to do the buyback? At rupees 20. Okay, so premium on buyback will be 10 rupees. Okay, the share of rupees 10. They want to do the buyback at what? 20. It means the premium on buyback is how much? Is 10. This buyback of share is duly authorized by its article. Necessary resolution has been passed by the company toward it. They say that it is already authorized by the article of association. Any resolution, if any, it is already passed. But this is the payment for buyback of shares will be made by the company out of sufficient bank balance available shown as part of current asset. Listen carefully. So whether it is mentioned in question that they are issuing fresh issue shares in the market, no. It means that it is out of profit only. And they tell us that they out of the sufficient bank balance, and that is a part of the current asset. What does it mean that is a part of the current asset? It means that when they're doing the payment that here, payment, cash and bank balance, cash and bank is a part of what? Current asset. So you will see that here in balance sheet, they have not mentioned there in current asset. They should, but they have not mentioned here how much is the cash and bank balance, how much is the inventory, how much is the account receivable, like that. Just they have written other current asset. So all the current asset is a part of this 30 lakh only. So cash and bank balance is also a part of these 30 lakhs. This is what they are saying. Okay. It is not mentioned in question that they're issuing fresh issue of shares in the market. So what does it mean that they are doing the out of the profit only? Now the interesting part here. How many shares they want to do buyback? They want to do the buyback 25,000 shares. So they want to do a buyback of 25,000 shares. But there is one problem that here. What is the problem? It is mentioned that comment with your calculation. Now this is the problem that they have. They ask you that comment with your calculation whether the buyback of shares by company is within the provision of the Companies Act 2013. If yes, pass necessary journal entries towards the buyback of shares and prepare the balance sheet after buyback of shares. What does it mean that? They say actually they want to do with buyback of 25,000 shares, but they want to see that whether the calculation is within the provision of the Companies Act. What does it mean comment with your calculation? They are telling us that here is those 3 tests. We have to do the 3 tests here. Now you will ask me that, yes sir, it is already mentioned in question that they want to do the buyback of 25,000 shares. I agree with you. They want to do the buyback of 25,000 shares in our previous question also. Like we solved in question number suppose 2, it is mentioned that here how many shares they want to do the buyback that here. Okay. Somewhere they should mention, for example, here they want to do the buyback 25% like here. So it is mentioned that here they want to do the buyback 25,000 shares. But the twist here is that it is also mentioned in question that comment with your calculation. It's keyword. Comment with your calculation means they are asking us that here whether the 25,000 shares that they want to do the buyback is within the provision of the Companies Act or not. So what we should do that here now? They ask us specifically comment with your calculation. It means those 3 tests. So we will calculate the maximum number of shares that they can do the buyback individually first as per those tests, and overall how many shares they can do the buyback. Okay. So if that is, if these 25,000 coming within that limit, then there is no problem. Okay. So this is what they're asking. So what we have to do that here now, first we have to calculate those 3 tests and we have to find it out the maximum number of shares that we can do buyback. And then we'll see that here now, how much is the maximum, and we want to do the 25,000, whether the 25,000 is coming within that limit or not. And then we'll decide that if yes, okay, then they will do the buyback of 25,000 shares. And then we have to pass journal entries and then we have to prepare the balance sheet here. Okay, this is the overall idea I've given you of question. Now, first test say, okay, first write it down. Write down there question number. Okay, write down there. Okay. Now here, question number 3. Okay. Now here, determination or write down determine or determination of buyback of, okay, determination of buyback of maximum number of shares as per Companies Act 2013. So they're telling us how many maximum number of shares that we can do buyback as per the Companies Act. How many tests that we have? 3 tests. So what was first test is, they say resource test. So what is the rule that is for the Companies Act? That maximum permitted limit is 25% of paid up capital and free reserve. Okay. So what we'll do that first we find it out. The maximum paid up capital. First we find out the 25% of the paid up capital and free reserve and divided by that amount will divided by the buyback price. So we can find out the maximum number of shares as per these tests. So write down that name here. First test, resource test. Resource test. Maximum permitted limit. Okay. Maximum permitted limit 25% of paid up capital and free reserve. Of paid up capital and free reserve. So write down the paid up capital and free reserve. Okay. So first we'll see that here. How much we have the paid up capital and free reserve. So write it down that here. As it is mentioned in question that if you go to the notes to account number 1, about they're talking about the equity share capital. So how much that they have here, go to there and find it out that here. Equity share capital that they have fully paid up of rupees how much? 10, that is coming to 1,50,000. So write down there equity share capital. Okay. So first test is resource test. Okay, resource test. Equity share capital. Equity share capital. Okay. How much it is? 12,50,000. Then we have here, after this, what we do that, how we calculated that here, paid up capital and free reserve. Okay, so paid up capital, how much it was? It is, that is 12,50,000 and free reserve. So you know that when I say free reserve, it means including securities premium. Okay, so we'll write it down that one by one. First is securities premium is how much? 2,50,000. So write down there, add free reserve. So when I say here in these buyback of equity shares chapter, when I say free reserve, it means including securities premium. So write down the inner column, that is 2,50,000 plus profit and loss account is also free reserve. Balance of profit and loss account, that is 1,25,000. Revenue reserve is 15 lakh. So 1,25,000. And then we have 15 lakh plus 15 lakh. So here 2,50,000 plus 1,25,000 plus 15 lakh, that is coming 18,75,000. So now do the total of this 12,50,000 plus 18,75,000, that is coming here 31,25,000. Okay, so how much we take? Step number 1 is a 25% of paid up capital and free reserve. This is the total of paid up capital and free reserve. So now we will take here, how much we take that here? 25%. Okay, write down there. So 25% of paid up capital and free reserve. So inner column write down 31,25,000 is the total, multiply by 25%. So that is coming here 7,81,250. So we calculate here the 25% of paid up capital free reserve, that is coming here 7,81,250. Step number 2 is divided by buyback price. So how much is the buyback price? The share is of rupees 10. We want to do the buyback at what? 20 rupees. So write down the buyback price is 20. So write down buyback price. Okay. Buyback price per share. Okay. Write down that here now. Okay. Maximum number of shares that can be. Okay. Now here, write down that here now. Buyback price. Or you can see that here directly, that here is number of shares that can be bought back. So write down that maximum number of shares that can be bought back. Okay, as per maximum number of shares that can be, okay, that can be bought back here as per it is. So how we calculate that here is the available resources. How we calculate is equal to available resources, okay, divided by buyback price. So what is available resources? This 25% of paid up capital. So you can write it down that here also, this available resources. Okay, what is available resources? That is here. What the law says that here now, available resources by 25% of the paid up capital and the free reserve. So available resources is how much here? 25% of paid up capital and free reserve. So equal to 7,81,250 divided by buyback price per share is rupees 20. So when you do the divided by 20, interesting point is coming here, that now understand this one. So we total available resources, that is 25% of paid up capital and free reserve, that is 7,81,250 divided by buyback price, when I say that is rupees 20. Now understand that the number of shares which is coming here in the point, what does it mean that now? Number of shares is coming that here now is 39,062.5. Correct? It is coming in your calculation also 39,062.5. Now understand this point. What happened that here now? Can I issue the shares in point? Answer is no, we cannot issue that. So generally we used to round it off. For example, it is coming 39,062.5. So you might think so that, sir, can we take 39,063, round it off to 63? The answer is no. You cannot take 63, you have to take 62 only. The reason is that here now, if I take 63, suppose let's take 63, round it off to 63 suppose. So 39,063. Type in your calci 39,063. Type in your calci 39,063. Multiply by, what is the buyback price? 20 per share, beta. So multiply by 20. That is coming 7,81,260. But the maximum available resources, that is how much here? 7,81,250 only. So, but if you take here 63, so 39,063 shares, multiply by 20, that is coming 7,81,260, that is coming here. Okay. So maximum this much available resources we have. We cannot go beyond this 7,81,250. We cannot go beyond 7,81,250. So we cannot consider here. Okay. Just whenever I change the color. Okay. If I'm using red color, that is for a reference. You don't have to write it down in exam this. Okay. So if I say 39,063 shares, which is incorrect. If I take 39,062 shares, that is correct. Okay, because if you see that here, if I say 39,062 multiplied by 20, that is coming 7,81,240, no problem, which is less than 250, no problem. This is the maximum available resource as per this. We cannot go, it can be less than this amount, but it cannot be go beyond this. Otherwise, it is a violation of this condition. Okay, so we have to take 39,062 shares only. This is the logic behind it. Okay, so write it down that here now. 39,062 62 shares. So as per these conditions, what is the maximum number of shares that we can do buyback? This is the maximum number of shares that we can do buyback. Okay. Now what we'll do that here now, we will go to test number, second test. Okay. We have done the resource test. Now write it down. Second. That is the share outstanding test. Share outstanding test. How much that is? 25% of the, how much is the 25% of the shares outstanding? 25% of the shares outstanding, that. Okay, that is the second test. So how many shares that we have? If we go to the question that now, we have total shares, share is of rupees 10ish, and the total amount is 12,50,000. So if I divide it by 12,50,000 divided by 10, it means when I say number of shares, okay, when I say number of shares, it is 12,50,000 is the amount divided by rupees 10. That is coming here. How much here? 1,25,000 shares. How much it is? 1,25,000 shares that here. So total number of shares we have 1,25,000. So write down number of shares. Okay, write down that here. Number of shares outstanding that here. Okay, number of shares outstanding is 12,50,000 divided by face value is 10. So how many shares we have? 1,25,000 shares we have. How many shares we have? 1,25,000 shares. Okay. How much maximum we can do the buyback? They say number of shares that can be bought back. So it's the number of shares that can be bought back, 25% of the existing number of shares. So write down that here. Here. Okay. So to my, okay, in the same language, let me write it down for you. Number of shares that can be bought back. Okay. Now write it down that here now. Maximum number of shares that can be bought back. Okay, that can be bought back. Okay, done. Now here is equal to 25% of shares outstanding. So shares outstanding is 1,25,000 shares multiplied by 25%. That is coming here 31,250 shares. 31,250 shares. Okay, done. Now third test. Okay, so as for the first test, we can do maximum number of shares buyback is 39,060. Here 31,250. Okay. Now third test, that is debt equity ratio test. So what this test says that here now, write down, is debt. Debt means here both long term and short term. So write down in bracket long term. Okay. Long term and short term, bracket close, after buyback cannot be in excess of twice, cannot be in excess of twice the paid up capital and free reserve. So what this test says that here now, your debt after the buyback, it cannot be more than the twice of the paid up capital and free reserve. Okay. So if you remember that we discuss about this, it cannot be in excess of twice the paid up capital free reserve. It means that after buyback, whatever my paid up capital free reserve, my debt cannot be more than twice of that. Okay. So these are the steps that we do. There are 6 steps. Okay. So write down one by. Step number 1. Okay, write down that here now. Step number 1. Okay, first is that here debt. So when I say debt, what do you mean by debt? It is both. That is the long term as well as what? Short term. So go to balance sheet that here. When I see the debt that here, we have you can take the figure from how much we have that here now. Is it 14% debenture? We have 18,75,000. We have unsecured loan of 10 lakh. Okay, this is a long term debt. But we have a short term debt also, that other current liability, that is coming 16,50,000. So we have to write it on all long term and short term. So we have a long term, that is 18,75,000 plus 10 lakh. So write down that here now. 18,75,000 plus 10 lakh. Okay. Then we have here the other current liability 16,50,000. 16,50,000. 18,75,000 plus 10 lakh plus 16,50,000. That is coming 45 lakh 25,000. Okay, 45 lakh 25,000. Okay. Then next is that here now. This is the existing debt we have. Now writing down how much a minimum paid up capital and free reserve we should have after buyback. That is 50% of debt. So minimum paid up capital. Minimum paid up capital and free reserve to be maintained. How much minimum paid up capital free reserve to be maintained? Okay, after buyback. After buyback is 50%. That is 45 lakh 25,000. Okay, 1/2 or 50%. That is coming here 22 lakh 62,500. Okay. So this much is the minimum paid up capital and free reserve we have to maintain. How much is the existing paid up capital and free reserve we have? So this much we should maintain that here now. How much we have the existing paid up capital and free reserve we have? That is, we have calculated already in the first test. That is 31,25,000. So write it down that here now. Present, or you can say existing paid up capital and free reserve. Okay, existing paid up capital and free reserve. Existing paid up capital and free reserve. Okay, how much that is? Go to first test. It is we calculated there 31,25,000. 31,25,000. So existing paid up capital and free reserve is how much? Is 31,25,000. Now please understand this point here. Now, if I say that here, write down that here now for a reference that here now. Okay, this is for a reference, this box. You don't have to write it on this box in examination. Okay. So how much is the existing paid up capital free reserve? I have 31,25,000. This is existing we have. So present, or you can say existing paid up capital. Okay, paid up capital plus free reserve. Okay. Now if I say out of this, I have to maintain how much? 22,62,500. This much we have to maintain. Correct? So we have 31,25,000. Out of that we have to maintain 22,62,500. Okay. We have to transfer to CRR, but we don't know how much. So we call it X. So this much we have to transfer to CRR. Whatever is the balance, we call it Y. That is the amount that can be utilized for buyback. Amount that can be utilized for buyback. So we can find it out through one shortcut, this shortcut. But you are going to use this shortcut only when we have to solve the MCQ question. Okay. But in a full-fledged question that here now, we have to solve it by the simultaneous equation that here. Okay. So what we'll do that here now, Keep the space of that here now here around 10 lines that here, and then write it down the working note. Write down the work, keep the space of 10 line, 10 to 12 line, then write down the working note. Okay, write down their working note. Okay, keep the space of around 10 to 12 line, and then then write it down working note. Write down there. Okay, write down that here now as per working note number 1 that here. Okay, as per section 68 of the Companies Act 2013, amount transferred to CRR and maximum equity to be bought back will be calculated by simultaneous equation method. Simultaneous equation method. Okay, suppose amount equivalent to face value or nominal value. Okay, face on, it's both are same. Okay, nominal value of, nominal value means a face value. You can write in the face value also, face value of share. Nominal value of bought back shares. Okay, bought back shares transferred to, write down, transferred to CRR account is X, and maximum permitted buyback of equity shares is Y. So what is X? The amount that we are going to transfer to CR. What is Y? The maximum number of the maximum amount of the equity share that we can utilize for the purpose of buyback. Okay. Now here we have, now we'll write it down equation in the equation form. Okay. Now write down that here equation 1. Equation 1. So how much amount we have? The existing paid up capital increase is 31,25,000. Out of that we have to maintain how much? 22,62,500. How much will transfer to CRR X? How much is permitted for the purpose of buyback? That is Y. First equation. Now equation 2. Okay. So equation 1 and then equation 2. Y is the maximum permitted amount divided by with the buyback price multiplied by with the face value is equal to X. Y. What is this Y? Y is basically the maximum permitted amount for the purpose of buyback. What is 20? That is the buyback price. So amount available for the purpose of buyback divided by the buyback price, we got the number of shares. The multiply with the face value, whatever come, that we are going to transfer to CRR, because we transfer to CRR the face value only. X is the CRR amount. Or the same we can write it down that here 2x equals to Y. By solving, write down that here, by solving the above equation, we get, okay, by solving the above equation we get X is equal to that is 31,25,000 minus here 22,62,500. How much is that we do X? How much is the Y we have here? Y is equal to 2x. So it is equal to 2x. Now solve the equation that now here is 31,25,000 minus 22,62,500 divided by 3. So X is coming 2,87,500. So 2,87,500. And if you put this, the value of X here in a 2X or here, you will get the value of Y. So just multiply by 2, that is coming 5,75,000. Okay, done. So we find it out the amount of X and amount of Y. Now, done. Now come here. Now write it down, the step number, the fourth. Okay, step number 4, write down there. What is step number 4? The future paid up capital and free reserve. So keep the space of 2-3 line. I will write it down later on. Just keep the space of 2 line only. And then the step number 5, that is the maximum permitted amount of buyback of equity. So maximum permitted amount of buyback of equity. Maximum permitted amount of buyback of what? Equity, that here. Okay, so we find it out in working note number 1. That is nothing but a Y. That is how much here? 5,75,000. So write down there 5,75,000. Step number 6. What it says, the maximum number of shares that can be bought back. Maximum number of, okay, maximum number of shares that can be bought back. Okay, maximum number of shares that can be bought back here. Okay, so at the rate of rupees 20 per share. So we are buying at what price? 20. So the how much is the maximum permitted amount is 5,75,000. With the buyback price 20. So divided by 20, that is coming 28,750 shares. So 28,750 shares. This is the maximum number of shares that we can do buyback as per these tests. Okay, now understand this point. This is the one shortcut also. No? What is the shortcut that here? That you're not, we can find it easily, but in examination only you have to use this shortcut when they ask me MCQ question. Okay, so here, what is the shortcut? Say existing paid up capital and free reserve. So I will say that existing paid up capital and free reserve is 31,25,000. Okay, minus is that minimum paid up capital and free reserve to be maintained, that is 50% of debt, which is how much? 22,62,500. 22,62,500, this much we have to maintain, divided by buyback price plus the face value. So buyback price is 20 plus the face value is 10. 31,25,000 minus 22,62,500 divided by 30. How much is coming? That is coming 28,750 shares. Same. Okay. So this is a shortcut. Okay. But you know what is the logic of this shortcut? Here I am not deducting the amount of that we have to transfer to CRR. It means the CRR is including here. So if in numerator CRR amount is included, so in denominator also the values per CRR we have to add. So here it is included, here it should also be included that here. Okay, that's why we add here, and here we don't have to add because that CRR amount is already part of 31,25,000. You got the point here? Okay. Now here, okay, done. Now we will write it down how much maximum number of shares we can do the buyback, the least of these three. We'll write it down that here. But here also one thing you have to write it down, that step number, what says this step number, the 4 that here, the future paid up capital and free reserve. So write it down that here, future paid up capital and free reserve. Okay. So write it down, the future paid up capital and free reserve. What is the existing paid up capital and free reserve? We have the existing paid up capital and free reserve that we have 31,25,000. So yes, 31 lakh. How much it is? No. Existing paid up capital and free reserve we have 31,25,000. So write down that here now. 31,25,000. Correct? Yes. Minus that here now. How much we are going to transfer to CRR? We are going to transfer to CRR 2,87,500. So minus 2,87,500. So 31,25,000 minus 2,87,500. That is coming how much? Again 31,25,000 minus 2,87,500. That is coming at 2,83,000. No, 28,37,500. Okay, 28,37,500. Done. Okay, that is just for the reference purpose. We have to write it down that because ICAI write it down, we also have to write it down. Okay. Now, as per the first test, we can do the maximum 39,062. Here 31,250, and here how much? 28,750, which is the lowest 28,750. So write down that here now. Write down maximum number of shares that can be bought back. Okay, that can be bought back. Now, first we find it on the basis of individual test, not on overall basis. Write down in bracket least of the above. Least of the above 3 tests, bracket close. That is 28,750 shares. This is the maximum number of shares we can do the buyback. Okay. How many shares we want to do buyback? So they say as per the test, if we take a list of these 3, we can do the buyback 28,750. But how much maximum, how much we want to do? It is mentioned in question, we want to do the buyback of how many shares? That is 25,000 shares. And how much we can do maximum? 28,750. So we want to do within the limit only. So maximum we can do buyback as per these 3 tests 28,750. And we want to do 25, which is within the limit. So there is no problem. So write down the conclusion here also. Write down that here now. Conclusion. Company. Okay, just give me a minute. Okay. Now conclusion that here now. Company qualifies. Company qualifies all tests. All tests. Why? Because if you seen all the tests, nothing is, all are more than 25,000. Okay, so no problem. Qualify all tests for buyback. All tests for buyback of shares and came to the conclusion. Came to the conclusion that it can buy maximum 28,750 shares. How many shares we can do maximum buyback? 28,750. However, the company wants, okay, however, company wants to buy back only 25,000 equity shares at the rate of rupees 20. Therefore, buyback of 25,000 shares are described by the company. Shares, write down the shares as, not are, okay, as described by the company is within the provision of the Companies Act, which is the provision of the Companies Act 2013. Okay, so they want to do the buyback. How many shares? 25,000. But how much maximum we can do? 2750. So nothing wrong in that. We are within the limit only. Okay. Now we have done all these 3 calculations only because they asked us in the question that here comment with your calculation. So that's why we have done all this calculation here. Okay. Now, simple is that here. Now we have to pass the journal entry. Simple is out of profit only. So we'll pass those three entry: buyback, cancellation, premium on buyback, write it off, and third one is transfer to CR. These four entry, then we are going to prepare the balance sheet. Okay. Now write down that here now. Journal entries. Okay, journal entries. In the books of in the books of what's the name of the entity? That is a competent limit. Now draw this for, I think, a little bit more than half page it will take. Okay, so here they are doing buyback, I think, on when they're doing the buyback here on first, it is mentioned that 1st of April 2021. So all entry will pass on 1st of April 2021. Okay, so here date, debit amount, credit amount. Okay, so 2021 April 1st. The first entry for what we pass the purchase of equity share. So equity share buyback account debit, equity share buyback account debit. Okay, buyback account debit, 25,000 shares. What is the buyback price? 20 rupees. So multiply by 20. So 25,000 multiplied by 20. That is coming how much? 5 lakh. To bank account, we are paying the amount. So to bank account, that is how much here? 5 lakhs. Okay. Then here, being, write on narration, being buyback of 25,000 equity shares, being buyback of 25,000 equity shares of rupees 10 each, okay, at the rate of rupees 20 per share, right, at the rate of rupees 20 per share. So what we do that first we purchase it, then what we do that here, then we are going to cancel it that here. Okay, so what is the face value of the share? 10 rupees. So when we do the cancellation, that you know that the equity all share capital we always be recorded at face value only, but when we want to cancel it, face value go in share capital account, remaining amount that we are paying, that we call in premium on buyback account. So write down the next entry that here, equity share cap decrease in capital should be debited, the basics of accounting. So write down that here now, equity share capital account, equity share capital account should be debited 25,000 shares multiply by what is the face value? 10. So it will come here 2,50,000. What about the remaining amount? That will go to premium on buyback account. So write down that here now, premium on buyback account should be debited here 25,000 shares multiply by rupees 10. So that will come how much here? 2,50,000. Now we purchase share, so we debited equity share buyback account. Now we are cancelling, so we have to credit them. So write down there 2 equity share buyback account. Write down equity share buyback account. That is how much? 5 lakh here. Okay. Now write down the narration there. Okay. Being cancellation of shares bought back, being cancellation of shares bought back. So what we have done first, we purchase and then we cancel. What third entry we pass? Do you remember or not? Okay, what third entry we pass? We pass the third entry that here now is the adjustment of premium on buyback. So first priority we give to securities premium account. How much is the premium on buyback? We have 2,50,000. How much balance we have in securities premium? That is also 2,50,000. Same amount. So we the premium on buyback is 2,50,000 and the balance is securities premium is also 2 lakh. The sufficient balance we have. Okay. So write down that here now. Premium on buyback we debited here. So to cancel it, we have to credit them. Which account should be debited? Securities premium account. We are utilizing reserve. Reserve has credit balance. So when we utilize, we have to debit them. So write down that here now. Securities premium account should be debited here 2,50,000 to premium on buyback account 2,50,000. So being premium on buyback, adjusted against securities premium account, adjusted against securities premium account. Okay, done. Now last entry, what we do then last entry, that here that's premium on, okay, not here, just give me a minute, that here now. Okay, now the last entry, that here. Okay, now the last entry, that premium on this, no, the profit we have to transfer, we have to transfer to CRA because we are doing the buyback out of profit. So which amount should be transferred to CRA? The face value of the buyback of shares. Do you remember this? We discussed these entries that here. Okay, so out of profit, so we are here now. So when we transfer to CRR here, so I'm first priority I will give to security, general reserve, P&L account, revenue reserve, whatever. But I will give the securities premium should be, we don't have balance also in this question. Even though we have a balance, we avoid it. Why? Because ICAI avoided that. Okay, that's it. So how always at what face value of the shares we have buyback. So how many shares that we have done? Face value of the shares of the buyback, that is here how much? 2,50,000. So what we'll do that here now, we'll go, we have a balance here in securities premium 2,50,000, but we have already utilized. So we don't have any balance in securities premium. Now, and when we transfer to CRA, we don't prefer to utilize it. Okay. In P&L account, we have balance of 1,25,000. So can we do that? Can we utilize it? Yes. So you can utilize 1,25,000 from here and 1,25,000 from the revenue reserve. No problem. But instead of utilizing 1,25,000, it's better. I will prefer to utilize complete because I have sufficient balance in revenue reserve account. So we have balance of 15 lakhs. How much we want? We want only 2,50,000. So what we will do that, I will prefer to utilize the revenue reserve account. So I will utilize the revenue reserve account. We have enough balance. If I will take 2,50,000, I will utilize from revenue reserve. If some student, they want to utilize 1,25,000 from the P&L and 1,25,000 from the revenue reserve, nothing wrong in that. That is also correct. Okay. Now, write it down that here now. Last entry, revenue reserve account should be debited 2,50,000 to capital redemption reserve account. Okay. So how we calculate this here? To 25,000 shares, we are doing the buyback and we transfer face value. How much is the face value? 10 beta. So here 2,50,000. Okay. Write on narration being face value of equity shares. Face value of equity shares buyback. Okay. Buyback out of profit transferred to capital redemption reserve account as per law. Done. Now we have passed all the journal entries. Okay. Now what we do that here after this, we are going to prepare the balance sheet. But when we prepare balance sheet, remember that, we discussed about these rule earlier also that here. So what's the rule that here now? Just give me a minute. If you remember this that here, okay, now always remember these rule when you prepare balance sheet that here. Okay, just copy paste. I have the option to do copy paste, no? Okay, so what we do that here now, we'll draw a balance sheet that here now, but remember these rule. Okay, I will discuss. Okay, now write it down that here now. Okay, now write down that here is balance sheet of Meses. Don't worry about those rules. I will discuss with you. Don't worry. Just write of Meses. Competent. Okay, of Meses. Competent. Limited. Write down in bracket after buyback. Okay, as on 1st of April 2021. Okay, as on 1st of April 2021. Draw balance sheet. Note amount, write on their note. Okay, amount. Write down their first. Equity and liabilities. So in equity and liabilities, okay, write down there first shareholders fund, shareholders funds, first share capital, okay, share capital, then reserve and surplus, reserve and surplus, then here non-current liabilities, non-current liabilities, that so long-term borrowing, long-term borrowings, then here current liabilities, current liabilities. Remember that in current liabilities we don't have to write all the things, because when you see question that here in current liabilities, that they have mentioned only what here is the other current liabilities. So no need to write it in all trade payable and all that. Just write it down that here other current liabilities, other current liabilities. Now total here, total here. Okay, now write it down that here now asset. Write down that here now asset, non-current asset, A, B, C. Property, plant and equipment. Write down there property, plant and equipment. Then we have intangibles. Then we have non-current investment, non-current investment, that here. Okay, done. Then we have here second here is current asset. Remember that here in current asset also we don't have to write it on the long list of what trade receivable and all that, because they have mentioned in current asset just other current asset. So write down that here now other current asset, other current asset. Okay, now total. Which notes to account we have to prepare? We have to prepare the notes to account on share capital, reserve and surplus, long-term borrowing and property, plant and equipment. That's it. Because they also have prepared in question 4 notes to account, and we are going to prepare only 4 notes to account. Now do you remember this rule that here in our previous session I told you that here now? Just give me a minute. Okay. Now what we discussed that here now is liability that here now. Okay. Liability, capital, reserve, they have a credit balance. Okay. They have a credit balance. If in our journal entry we are crediting them, we'll add them. If we are debiting them, we will deduct them. Asset has debit balance. If in our journal entry we are debiting them, so we'll add them. If we are crediting, we will deduct them. And whatever amount comes, we are going to write it down in a balance sheet, new balance sheet. Okay. Now, write down that here. Go to balance sheet that here. One by one, I will take item from it. For the share capital, they tell us to go to notes to account number 1. So, total amount is, okay, notes to account number 1, authorized, issued and subscribed capital, which is 12,50,000 is the total amount of capital, and we have a share of rupees 10. It means 1,25,000 shares we have here. But type in Calci first, 12,50,000. Type in Calci 12,50,000. Now go to journal entries that is. Here we have debited equity share capital account by 2,50,000. So I will minus 2,50,000. That is coming 10 lakh. We are debiting that here. Okay, capital as credit balance. We are debiting, so we have to deduct them. What we are doing that here now? We are debiting them. Capital, we are debiting them. So what we have to do? We have to deduct that. Okay. So how much amount is coming? 10 lakh. So write down that here now. Notes to account number 1. Notes to account. Notes to account number 1. Okay. Write down there in notes to accounts number 1. First, share capital. Share capital. That is authorized. Write down that authorized, subscribed and paid up capital. Okay, write down that 1 lakh equity shares of rupees 10 each, fully paid up. How much it is? 1 lakh. Okay, no, not 1 lakh multiplied by 10, 10 lakh. Okay, 10 lakh, the share is of rupees 10 each. It means the number of shares, how much? 1 lakh. Okay, write down in here in balance sheet 10 lakh. 10 lakh. Okay, now what we'll do that here now? We will go and we'll write it down one by one for the reserve and surplus. So write down notes to account number 2. That is reserve. Notes to account number 2. Write down there reserve and surplus. Reserve and surplus. Done. Now here first we have here reserve and surplus. They say go to notes to account number 2. We go to notes to account number 2. First is securities premium. So write down that here securities premium. Securities premium. How much balance? Write down inner column 2,50,000. But we utilize, if you go to journal entry, you will see that here we debited to securities premium account by 2,50,000. We debited to securities premium account by 2,50,000. What does it mean? That reserve has credit balance. We debited them, so we have to deduct them. Okay, so write down there less utilization for premium on buyback. That is 2,50,000. How much is coming here? 0. Okay. Then we have here second is that profit and loss account. So write down that here profit and loss account. No adjustment in that. So directly write down 1,25,000 in outer column that. Okay. Then next is revenue reserve 15 lakh. Write down in inner column. Revenue. Okay. Write down revenue. Okay. Reserve. How much given in balance sheet? That is 15 lakh. So write down in inner column 15 lakh. Okay. Write down how much? 15 lakh. Okay. Now here whether we have utilized. Now here, in our journal entry, we debited to revenue reserve by 2,50,000. It's a reserve. They have a credit balance. We are debiting it. It means we have to deduct them. So we will deduct less transferred to capital redemption reserve. How much we transfer to capital redemption reserve? 2,50,000. So in outer column it will come 12,50,000. Okay, the last one that here. Okay, remember that if one more reserve that we have created here, na, don't forget to write it on this capital redemption reserve account. How much? That is 2,50,000. So write down that here now is capital redemption reserve 2,50,000. Capital redemption reserve how much? 2,50,000. Done. Now do the total of all reserve and surplus and write it down in balance sheet. 1,25,000 plus 12,50,000. Okay, plus 2,50,000. That is coming 16,25,000. How much it is? 16,25,000. Write down there 16,25,000. Done. Now we have here return all reserve and surplus. Now long-term borrowing, notes to account number 3. There is a 14% debenture, 18,75,000. Unsecured loan, 10 lakh. There is no change in that, but we have to write it down in notes to account. Okay. So go to notes to account and write it down there. Notes to account number 3. That is long-term borrowings. Long-term borrowings that here we have. Okay, write down there 14% debenture. That is how much? 18,75,000. Unsecured loan, that is how much? 10 lakh. So total is going to come how much? 28,75,000. Okay, total is 28,75,000. Write down in balance sheet 28,75,000. Okay, now here if we go to balance sheet, then here there is no change in other current liability, that is 16,50,000. So write down here 16,50,000. Okay. Now asset side, for property, plant and equipment, we have to go to notes to account number 4. So there is no change in that, just we have to copy paste there. Land and building 19,30,000. So write down in notes to account number 4. Property, plant and equipment, okay, write down there in property, plant and equipment that land and building, how much is that here? That is here 19,30,000. So 19,30,000. Then plant and machinery 18 lakh. Then we have furniture 9,20,000. So furniture and fitting 9,20,000. The total is 46,50,000. 46,50,000. 19,30,000 plus 18 lakh plus 9,20,000. 46,50,000. Write down in balance sheet. Okay. 46,50,000 intangible dash non-current investment dash. Okay. Now other if you see that here, other current asset is 30 lakh, but cash and cash equivalent is also a part of it. So type in calci 30 lakh and it is asset. So it is asset. Whenever we are debiting the item, we have to add. If we are crediting, we have to deduct. So here if you see that bank we have credited, so we have to deduct 5 lakhs. So minus 5 lakh, that is some 25. Now there is no asset there. Okay, so do one thing for your reference, you can do that here. 30 lakhs minus 5 lakh. It is coming how much? 25 lakh. Write down that 25 lakh. Okay, now remember this. When I see that, you can see that there are certain items which we have not yet taken. So we have debited the share buyback account here. Share buyback account debited. Then we credited here share buyback account. It's get cancelled. Premium on buyback we debited here. And premium on buyback we credited here. It's get cancelled that here. So all items should be ticked. Then only you have to do the total of balance sheet. So all items are ticked here. Now what we'll do that? We'll do the total of balance sheet. Now do the total of balance sheet. That is 10 lakh plus 16 lakh 25,000 plus 28 lakh 75 plus 16 lakh 50. That is coming 71 lakh 50,000. 71 lakh 50,000. 46 lakh 50,000 plus 25 lakh. That is coming 71 lakh 50,000. Done. This is how we have to do the presentation. But it's very important that here now. Here in this question, they ask you to comment with your calculation. That's why we have to do the calculation of all these 3 tests that here. And we have to see that here the number of shares that they want to do buyback, there is 25,000 shares. Whether that is within the provision of the Companies Act or not that. Okay. So we have done that here now. They want to do the buyback 25,000, but actually the maximum number of shares that they can do buyback is 28,750. So there is nothing wrong in that. Okay. Then question number 3 we have it. Question number 2 done. Question number 3 done. Okay, just give me a minute now. First done. Second done. Third we solved it just now. Fourth done. Fifth done. Okay, now question number 6. Okay. Okay, now do one thing that now. What we'll do that here now. Now we'll take a break for 10 minutes that here and then we'll solve question number 6. Now break for 10 minutes. Hello all of you. Now come to question number 6. It came in, this question number 6 came in May 2016, similar in May 2019 and RTV 2018. Okay. Following is a summarized valuation of Complicated Limited as on 31st of March 2016. It says liability side equity shares of rupees 10 each fully paid up, that is 12,50,000. Then bonus shares 1 lakh. Share option outstanding account 4 lakh, revenue reserve 15 lakh, securities premium that is 2 lakh 50, profit and loss account 1 lakh 25, capital reserve 1 lakh, revaluation reserve 1 lakh, unpaid dividend 1 lakh. Then they have 12% debentures secured 18 lakh 75, advance from related party unsecured 10 lakh, current maturity of long term borrowing 16 lakh 50,000. Application money received for allotment due for refund 2 lakh. Total liability side, then here asset, fixed asset and 46 lakh 50,000, current asset 40 lakh, this total now. Then they say comment with your calculation. What does it mean, comment with your calculation? It means we have to do the calculation of those 3 tests. Okay. Then whether the buyback of shares by the companies within the provision of the act. How many shares they want to do buyback? Is it mentioned somewhere? Oh, I have not read this. Okay. The company wants to buy back. How many shares they want to do the buyback? 25,000 equity shares of rupees 10 each on 1st of April 2016 at the rate of rupees 20 per share. What is the face value of the share? 10 rupees. At what price they want to do the buyback? They want to do the buyback at rupees 20 per share. So here the buyback of share is duly authorized by its article and necessary resolution has been passed by the company towards this. Now the payment for the buyback of shares will be made by the company out of sufficient bank balance shown as a part of current. Similar to previous question, but something more about the calculation of the long term and the short term debt. I will come to that. But they ask you comment with their calculation. It means we have to calculate those 3 tests and we have to find it out. Maximum number of shares that they can do the buyback, and they want to do the buyback 25,000 shares, or these 25,000 is within the provision of Companies Act or not. Then they say if yes, then you have to pass the journal entries like in previous question we have done before the break, and then prepare the balance sheet after the buyback of shares. So first, what should be the approach? We have to calculate those 3 tests. But remember that very important thing that I want to discuss with you. When we are going to solve those 3 tests that here now, We need a long-term debt, short-term debt, reserve and all that. Okay. So here, understand this point. These points from, we'll make a working note on it. We'll make the working note on it. Now, but I'm discussing with you that here related to these reserve and surplus. These all are the part of reserve and surplus. So you will ask me, sir, that here, first of all, this bonus share that they have issued, they have shown separately here, but that is also part of share capital only. Now understand, all these are reserve and surplus, revenue reserve, securities premium, profit and loss account, capital reserve, revaluation. All these are reserve and surplus. These might be get confused, share option outstanding account. This is also part of reserve and surplus that we will discuss tomorrow. There is a concept of the ESOP, employee stock option plan. I will discuss there. But timing, understand, all these are reserve and surplus. But when we do the calculation of those three tests, we don't want all reserve and surplus. We want only free reserve. So all these are reserve. All these are the free reserve all these are reserve, but we want only the free reserve. So whether the share option outstanding account, is it a free reserve? No. I will tell you tomorrow. The concept of ESOP will come. I will tell you there. But that is not a free reserve. That is for the purpose of ESOP share. What is ESOP share? I will discuss with you tomorrow. But time being, understand that is not a free reserve. Now here, yes, revenue reserve is a free reserve. In general, securities premium is not a free reserve, but for the purpose of buyback, securities premium is also free reserve. In general, it is not a free reserve, but for the purpose of buyback, it is free reserve. Profit and loss account is also a free reserve. Okay. Now, capital reserve is not a free reserve. Revaluation reserve is also not a free reserve. Okay. So only these three are the free reserve. Now, when I come to that here, to the point of that here, if I talk about the remaining point, these are the point that here, okay, unpaid dividend, okay, unpaid dividend, all these are, you know that all these are liabilities. All these are liabilities. Okay, but which liability? Because when we talk about the debt in the third calculation, debt equity ratio test, we consider all of them, short term and the long term. We are going to consider all of them that, okay. But still, when we prepare the balance sheet, we are going to prepare as per schedule 3, but they have not bifurcate here. We will bifurcate, but short term, everything, non-current, current and all that. Just let's understand what is the unpaid dividend. Unpaid dividend is all these are the debt that here. Remember, all these are debt. Okay, all these are debt. You can say that all these are debt. Sorry, all these are debt. Okay, but short term or long term that. Okay, so this unpaid dividend is unpaid dividend. We are liable to pay the dividend. Okay, unpaid means we have not yet paid. It is declared, but we have not yet paid. It's a current liability and it will come under other current. For reference, I am writing. Just write it down. Other current liability in your question bank. Now, 12% debentures secured. It's a non-current liability. It will come under long-term borrowing. Okay. Advance from a related party. Now, unsecured. It is not mentioned that here whether it's a short term or long term. It might be short term. It might be long term. Suppose if I assume that it's a long term, so I will say non-current liability, long term borrowing. Generally, the loan is long term. So let's say long term borrowing. Now, current maturity of the long term. It is a portion of the long term liability that is going to mature within a year. So it will come under current liability, but that is a part of short term borrowing. Now, application money received for allotment due for refund. So we excess application we receive, application money we receive excess. You know, when we issue the share certain time, it might be happen more people offer, they want to purchase it. So it is a current liability, and if more amount they have given to us, suppose we can issue 1 lakh share, but actually application received for 1 lakh 10. So we have to give the refund on 10,000 shares. This is, I'm just giving an example here. So we are liable to pay. It's other current liability. So for a reference, you can write it down this here. But what happened when we do the calculation of debt and all that here? So all these are debt, or short term, long term, it doesn't matter when it's come to the debt equity ratio test. So there are how many items? 1, 2, 3, 4, 5. So we can write it down inner column all these 5, or we can make a one working note on also that, because there are 5 items. So you can write it on inner column of to do the total of debt. Or you can make a one working note on it also that way, because items are more. So we can make a one working note and we will write it on all these items here. Okay, we do the total and that will be the amount of debt. Okay. So what should be the approach that? First, they ask us comment with your calculation. So we have to do the test of all those 3 tests. So write it down that here now. Question number 6. Determination of buyback of maximum number of shares as per Companies Act 2013, as per Companies Act 2013. Okay, the first test, resource test. First test is resource test. Okay, what says resource test that here now? Okay, resource test says that available is maximum 25% of paid up capital and free reserve that. Okay, so write down that here now. Maximum permitted limit 25% of paid up capital and free reserve. Paid up capital and free reserve. So write down there how much equity share that we remember that equity share that they have mentioned is 12,50,000, but these bonus shares is also the shares that now they have shown it separately, but that 12,50,000 plus 1 lakh, that is 13,50,000. The share is of rupees 1, it means 1,35,000 shares. Okay, write down there equity paid up capital including bonus shares is how much? 12,50,000 plus 1 lakh plus 1 lakh. That will come here how much? 13,50,000. Okay, add free reserve. How much free reserve we have here now is 3 revenue reserve, securities premium, profit and loss, that is 15 lakh. Okay, then 2 lakh 50 and 1 lakh 25. So write it down that here 15 lakh plus 2 lakh 50,000 plus 1 lakh 25,000. So 15 lakh plus 2 lakh 50 plus 1 lakh 25, that is coming 18 lakh 75,000. Now do the total here, that is coming 32 lakh 25,000. Okay, now available resources. Okay, write down that here. Available resources, how much is allowed as per the law, that is 25%. Okay, how much is allowed? Available is 25% of the these paid up capital and free reserve. Okay, write down available resources for buyback 25% of 32 lakh 25,000. That is coming here 8 lakh 6,250. Maximum, write down maximum number of shares that can be bought back. Okay, as per these condition. Okay, not an overall basis, as per these tests, is equal to available resources divided by buyback price. So that is 8 lakh 6,250 divided by rupees 20 is a buyback price. So that is coming again remember that we discussed in our previous question, that is coming how much? 40,312.5. So you cannot round it off to 40,313. Okay, you have to take the previous 40,312 only. If you take 13, so 40,313 multiplied by 20, that will come 8,06,260 will come. It is more than that, so we cannot utilize more than this. So we are going to take 40,312 shares. 312 shares. Okay. Okay, not done. Okay, now write down second test. That is shares outstanding test. How much is allowed? That is 25% of, okay, shares outstanding. So write down 25% of the shares outstanding. So number of shares outstanding, normally the amount was 12,50,000, but the bonus share is of 1 lakh. That is also share. So the amount here is 12,50,000 plus 1 lakh. Okay, how much is the face value? That is here rupees 10. So 13,50,000 divided by 10, that will come 1,35,000 shares. Okay, 1,35,000 shares. Now here, write down that here maximum number of shares that can be bought back. Maximum number of shares that can be bought back is equal to 25% of shares outstanding. 25% of share outstanding. So that will come here, multiply by 1,35,000 shares. That is coming here 33,750 shares. shares. Okay, done. Now here, as per these conditions, maximum number of shares that we can do the buyback is 33,750. Okay. The third is debt equity ratio test. Debt equity ratio test. So what is the condition here? The debt, both long term and short term, okay, bracket close, after buyback cannot be in excess of cannot be in excess of twice the paid up capital and free reserve. So what it says that here, now after buyback, whatever my paid up capital free reserve, my debt cannot be twice of that. Okay, so write down step one by one here. First step number 1 is debt. So what we'll do that, we'll make a working note on debt. Working note number 1. We'll prepare it later on. This time being, do the total of all these items. That is 4 lakh. All these. Oh, sorry, not 4. All these items. So that is not 4 lakh. That is from here 1 lakh. Okay, 1 lakh plus 18,75,000 plus 10 lakh plus 16,50,000 plus 2 lakh. That is coming how much here? 48,25,000. So we'll make a working note on it. If you do the total of debt, that is coming 48,25,000. Okay. Now second step, is minimum, write down, minimum paid up capital and free reserve to be maintained after buyback, that is 50% of debt. So 48,25,000 multiplied by 1/2 or 50%. That is coming at 24,12,500. Okay. The third step, existing paid up capital and existing paid up capital and free reserve. How much existing paid up capital is that you have calculated first test? How much it is? 32,25,000. You can see that here, 32,25,000. Okay, write down here 32,25,000. Now understand this point here. Okay, now understand this point here. How much existing paid up capital and free reserve I have? We have, just give me a minute. Okay, how much existing paid up capital and free reserve we have? We have 32,25,000. This is existing paid up capital and free reserve. How much we have to maintain? That you can see the 24,12,500. This much we have to maintain. How much we have to transfer to CR? We don't know. We call it X. So that amount, that transfer to CR, that is X. So transferred to CR. Okay. Then is equals to Y. Okay. Amount for the purpose of what? Buyback. Amount available for the purpose of buyback. You got the point here? So how to find it out? We are going to find it out through the simultaneous equation that here. Okay. But remember, after this, keep the space of around 10 lines and then write it down. Working note. Working note. Give the space of 10 to 12 lines. But remember, in working note, first we have to prepare the working note on the depth. Okay, then we'll prepare a working note on simultaneous equation. Okay, so we write it down here. Now, working note number 1 is on what? Depth. So let's just write it down, all the depths. So write down there first working note, that is depth. So here we'll take all these figures from the balance sheet which is given in question. So take one by one there. So first is your unpaid dividend is 1 lakh. So write down here unpaid dividend. Unpaid dividend 1 lakh. Okay. Then we have here is it debenture that 18,75,000. How much it is? 12% debentures. Okay, 12% debentures secure. Okay, then we have here is advance from related party unsecured 10 lakh. Advance from related party. Advance from related parties unsecured, that is 10 lakh. Okay, then we have here is current maturity of long-term borrowing 16,50,000. Write down there current maturity of long-term borrowings. Last one is application money received for allotment due for refund. So write down application money received for allotment due for a refund. How much it is? 2 lakh. 2 lakh. Now do the total. That is 1 lakh plus 18 lakh 75 plus 10 lakh plus 16 lakh 50 plus 2 lakh. That is coming 48 lakh 25,000. 48 lakh 25,000. Done. Now for these 48 lakh 25,000 that here, you can see that we have write it on 48 lakh 25. Now here, working note number 2. Write down there. Working note number 2. Okay. Now this working note, now that is for the simultaneous equation to find out how much we are going to transfer to CRR and how much is the maximum fund available for the purpose of buyback. So write down as per section 68 of the Companies Act 2013, amount transferred to CRR and maximum equity to be bought back, equity to be bought back will be calculated by simultaneous equation method. Suppose amount equivalent to nominal value of bought back shares transferred to CRR account is X and maximum permitted buyback of equity is Y. Okay, so now two equation that will make, write down there. Equation 1, we have how much the paid up capital freeze at 32,25,000. We have to maintain 24,12,500. Okay, and transfer to X, remaining is what? Y. Equation 2. Okay, so Y is the permitted amount. Okay, divided by buyback price 20 multiplied by face value is equal to X, or you can say that here 2X is equal to Y. So by solving the above equation, we get, okay, what we get, that be careful here, one thing that I want to discuss with you, X and Y. Now please understand that when I say what we'll get that here now is what is the amount, that 32,25,000. You can see in equation 1 32,25,000 minus here 24,12,500 minus X is equal to, how much is the Y? Y is equal to 2X. So Y is equal to 2X, right, on 2X. But when I solve these equation, how much we are getting that? Be careful. X we are getting 32,25,000 minus 24,12,500 divided by 3x. Okay, now there is one problem here. When you solve this, you are getting that how much here? You are getting here 2,70,833.33. Now please be careful that here now. Now you will tell me, sir, let's take 2,70,833. We cannot take it. Let me tell you why. Here the problem is that here now, we are first of all, we are fine. What do you mean by X that here? Listen carefully. What do you mean by X? X is the amount that we are, that is the amount that we will transfer to CRR. What we transfer to CRR? We transfer to CRR the face value of the shares of the buyback. So here it is coming in 833.33. It cannot be, first of all, it cannot be in point. Second, it cannot even be 830. It cannot even be the 8, it cannot even the 833 also that here. Why? It cannot be 833 because the face value is 10. Okay. So here the amount will come, we'll say 2,70,830 will take. You'll say why 830, sir? Because the face value is 10 beta. This is a tricky point, not tricky, but it's a different point. You have to be careful here. What is the face value of the shares? 10. So when I say how can the face value be the 833? It should be 830 or 840 like that. Okay, so we cannot take 840, the previous one that I always take a previous 830. Okay, so here I will say here it is coming 2,70,830. Now here 32,25,000 minus 24,12,500 minus this 2,70,830. How much is Y is coming? 5,41,670. Okay, remember one more thing. If you calculate how I've calculated this amount, listen carefully. 32,25,000 minus 24,12,500. Okay, then minus here is this X. How much is the X? We find it out 2,70,830. Then I find it out the amount of Y here. Okay. If you say just if you multiply 27830 multiply by 2, so difference will come that here. The exact amount will not come because we have not taken 833. We have taken 830 because the face value is 10. Okay, so that's why we have taken 830. Okay, because if you multiply by 833 divided by 10, so that will be 83.3 that will come. Okay, so that is not accurate. Take 830 here. Okay, now here, so write it down that done. Now we have finding the value of X and Y. Now write down that next step is step number 4, future paid up capital freezer. So future paid up capital and free reserve. So how much is the existing paid up capital we have? 32,25,000. So 32,25,000 is existing paid up capital. And how much we want to transfer to X? 278.30. So 278.30 working note number 1. So 32,25,000 minus 2,78.30. That is coming here 29,54,170. Okay, 29,54,170. Done. Okay, that is just for the reference purpose only. Okay, now write it on step number 5th. That is here. What is step number 5th? That is the maximum permitted amount of buyback of equity. So maximum permitted maximum permitted amount of buyback of equity. Working note number 2. Okay, so we find, oh, I have written down working number 1 here. No, it is 2. Okay, write down working number 2. We find the value of X in working number 2. Okay, working number 2. So what Y is 541,670. So 5,41,670. Okay. Okay, now write it down that here. 6th step. Maximum number of shares that can be bought back is equals at the rate of rupees 20 per share is equal to 5,41,670 divided by buyback price 20. So 5,41,670 divided by 20. Again, remember the shares is coming in point here. That is coming 27,083.5 shares at here. So can I take in point? No. So can I round it off to the next one? No. We will previous one that always. So 27,083 shares. If you round it off to 84, that the problem will come that here. What is the problem will come that here now? Because if you multiply by with the 20, the more than the available amount will fund. So that is a violation of the condition. So we cannot take the higher one. We have to take the lower one that here. Okay. Now here. Now shortcut method. Okay. So what is shortcut method? Existing paid up capital for reserve 32,25,000 minus 50% of debt, that is 24,12,500 divided by buyback price, that is how much? 20 plus face value. So 32,25,000 minus 24,12,500, 32,25,000 minus 24,12,500 divided by 30, that is coming 27,083. So we have taken 27,083. How many maximum number of shares we can do the buyback? Least of the three: 40,312, 33,750 and a 27,083. We will take 27,080, least of the three. So write down maximum number of shares that can be bought back, write down in bracket, least of the above three test, that is how much? 27,083 shares. How many shares they want to do buyback? They wanted to buy back 25 within its limit. So write down that here. Conclusion. Company qualifies all tests for buyback of shares and conclusion is that can buy back maximum 27,083 shares on 1st of April 20, I think the date is 2016. Yes, 1st of April 2016. Okay. However, company wants to buy back only 25,000 shares at the rate of rupees 20. Therefore, buyback of 25,000 shares as described, or you can say that, okay, or described or desired by the company is within the provision of the Companies Act. Okay, within the provision of the Companies Act 2013. Done. Okay, so they want to do buyback how much? 25,000 shares. Okay, now I think similar to previous question, but just the calculation of the debt and all that we have done. If you see that the previous question is almost the same, that it was 28,750 was okay. Okay, now what we'll do that now? Now we will pass the journal entries of the buyback. Okay, so write it down there now. The journal entries in the books of Complicated Limited. Journal entries, write down there, in the books of Complicated Limited. Okay, same, just we have to pass the 4 entries here. Okay, we have to pass 4 entries here. So write down here date, debit, credit. Okay, so here 2016 April 1st. Okay, so first we'll pass the entry for buyback. Okay, we'll purchase it. So equity share, buyback account debit. Equity share buyback account debit. How many shares we are doing buyback? 25,000 shares at the rate of ₹20. So that will come here 5 lakh to bank account, 5 lakhs. Okay, then we being buyback of 25,000 equity shares of rupees 10 each at ₹20 per share. The share is of ₹10, but we are doing the buyback at 20. Now we purchase the equity shares. Second entry is the cancellation. So when we do the cancellation, share capital will be cancelled by face value. So equity share capital account debit, equity share capital account debit, 25,000 shares multiply by ₹10. That will come here how much? 2,50,000. So equity share capital account debit, premium on buyback account debit, that is 25,000 shares multiply by ₹10, that will come 2,50,000 to equity share buyback account, equity share buyback account, that is how much here is 5 lakh, being cancellation of shares on buyback. The third entry, premium on buyback will be cancelled. How much is the premium on buyback? 2,50,000. How much we have in securities premium? Same amount, 2,50,000. Okay, so we will utilize securities premium account completely. So write down securities premium account should be debited by 2,50,000 to premium on buyback account, premium on buyback account should be credited by 2,50,000, being premium on buyback adjusted against securities premium account. Okay, now here last one is that here we have to transfer to CRR. How much the face value of the shares we are doing the buyback? It's 2,50,000. So how much balance we have here in P&L account? 1,20,000 when capital. No, revenue reserve we have 15 lakh. It's almost like the previous question, but some more is a depth here. Okay, now write it down that here. Now we'll utilize completely revenue reserve on. So revenue reserve account should be debited by 2,50,000 to capital redemption reserve account 2,50,000. Okay, being face value of shares bought back, okay, out of profit transferred to CRR account, or you can say capital redemption reserve account as per law. Which law? Companies Act. Okay, so we have transferred to CRR account. Done. Now we have to prepare what? Balance sheet. But you know that here now, when we are going to prepare the balance sheet, these rule always remember that. Okay, these rule always remember that of these add or less when you prepare the balance sheet. Okay. Okay. Now write down format of balance sheet. Okay. So balance sheet of complicated limited, write down in bracket, after buyback. Okay, after buyback as on 1st of April 2016. As on 1st of April 2016. Note okay, amount. Okay. First, equity and liabilities. Okay. First is shareholders fund. Shareholders funds. Okay. Share capital. Reserve and surplus. Okay, reserve and surplus. Then here non-current liabilities, long-term borrowing, long-term borrowings that. Okay, now understand this here. Okay, now long-term borrowings done that here now. Okay, now current here, if we talk about the current liabilities, we have two. So this other current liability, other we short-term borrowing also. Okay, so write down that here now. Third, current liabilities, short-term borrowing, short-term borrowings, that is here other current
liabilities, other current liabilities. Okay, now we'll make a notes account on share capital, reserve and surplus, long-term borrowing, short-term borrowing, as well as other current liability. Also, there's more than one item, so we'll make a notes account on that as well. Okay, on the short-term borrowing. Okay, also short-term borrowing is one item only, but let's make a note because the current maturity of long-term borrowing. So here, second is assets. Okay, so here non-current asset. Property, plant and equipment. Property, plant and equipment. Intangibles. Then we have non-current investment. Then current asset. In current asset, remember they have not done the bifurcation. So we will just write it down, the current asset there. Okay. Okay, done. Okay, so no need to prepare a note stock on PP as well. The reason is that they have not done the bifurcation. They just write it on the fixed asset only. So no need for any bifurcation there. Okay, so we will write down there now. Notes to account number 1. Notes to accounts. First, share capital. Okay, so how many shares that we have here is 12,50,000 and this 1 lakh. So total is 13,50,000 and the share is of rupees 10. So that is whatever share we find it later on, this 12,50,000 plus 1 lakh, that is coming 13,50,000. Okay, now here is we have done the buyback, we debited by 2 lakhs, so minus 2,50,000, that is coming 11 lakhs. So write down that here, write down there 1,10,000 equity shares of rupees 10 each. That is coming how much here? 11 lakh. Write down in balance sheet 11 lakh. Okay. They mentioned in question about the bonus shares, but we don't know better but that when they have issued the bonus shares in the past and all that. Okay. So we have not issued during the year these bonus shares. So no need to write it down that here. Okay. Now just write down the total amount that is coming 11 lakh. Okay. Now notes to account number 2. Reserve and surplus. So we have reserve and surplus, that is share option outstanding account, no change in that. So write down shares option. Okay, share option outstanding account, that is how much? That is 4 lakh. Okay, then we have revenue reserve 15 lakh, revenue reserve lakh. Okay, when I go to these entries that here now, we have debited to revenue reserve by 2,50,000. So reserve have credit balance with, so we are debiting them. So we are debiting them, so we have to deduct 2,50,000. So write down there less. We utilize transfer to CRI. So let's transfer to capital redemption reserve. That is how much? 2,50,000. So here it will come 12,50,000. Okay. Then we have here securities premium 2,50,000. So write down securities premium 2,50,000
Here in journal entries, we debited to securities premium. So reserve has credit balance. We are debiting them, so we have to deduct them. So this 2,50,000 will be deducted. Okay, so write down here. Less adjusted against premium on buyback 2,50,000. So in outer column 0 nil. Okay, now write down here is after this they have here is the profit and loss account 1,25,000. Okay, so it is as it is the P&L account we have not utilized, so write down as it is profit loss account 1,25,000. Then we have here capital reserve as it is 1 lakh, so write down capital reserve 1 lakh. Okay, then we have revaluation reserve as it is 1 lakh, so revaluation reserve 1 lakh. Okay, but remember that we also created CRR account with us. So how much is the CRR account? We created CRR by 2,50,000 last entry. Write down there capital redemption reserve account capital redemption reserve. How much is 2,50,000? Now do the total here. 4 lakhs plus 12,50,000 plus 1,25,000 plus 1 lakh plus 1 lakh plus 2,50,000. That is coming 22,25,000. Okay, that 22,25,000. Okay, write down in balance sheet 22,25,000. Okay, then we have here is now debt long. There are some are do one thing that here. Write down here notes to account number 3 long-term borrowing. Okay, then keep the space of 3-4 lines, then write down 4th notes to account, that is short-term borrowing. Okay, keep the space of 2-3 lines, then write down that here is other current liabilities. Other current liabilities. Okay, other current liabilities. Okay, now write down here. Now one by one. The first is what? Unpaid dividend. Where this unpaid dividend will come? Other current liability. Write down in other current liability unpaid dividend 1 lakh. Okay, then we have 12% debenture, that is long-term borrowing 18,75,000 secured. Okay, so write down here secured 12% debentures 18,75,000. Then we have advance from related party unsecured 10 lakh. So here unsecured advances from a related party. Okay, it is not mentioned that whether it's a long term or short term. Debentures always be the long term. Okay, but advances from the related party, it might be short term. So write down in bracket assumed long term. Assume long term. How much it is? That is 10 lakh. Okay, then we have here is current maturity of long term. It's a short term borrowing. So write down here current maturity of long term borrowings. How much it is? That is 16 lakh 50,000. 16 lakh 50,000. Then we have here application money received for allotment due for refund. So here application money received, okay, due for application money received for allotment due for refunds. How much it is? That is 2 lakh. 2 lakh. Now we just have to do the total here and write it down in balance sheet. So 18 lakh 75 plus 10 lakh, 28 lakh 75,000. Okay, 28 lakh 75,000. So 28 lakh 75,000. Then we have short-term borrowing 16 lakh 50,000. Then we have here the long-term other current of 1 plus 2, 3 lakhs. Okay, write down here 3 lakhs. There is no change in fixed assets, so it will come as it is 48 6 lakh 50,000. PP, use the word PP only, 46 lakh 50,000. No intangible, no non-current asset. This is 40 lakh current asset we have. Okay, but if you see the entries that here, okay, that we have passed here, we credited the bank account by 5 lakhs. So asset has debit balance beta. We are crediting them. See this table here, asset has debit balance. So we are crediting them. So what we have to do, we have to deduct them. So we'll deduct 5 lakh here. So it will come here 35 lakhs. Now do the total here. Okay, one more thing. Before you do the total, cross check it. First item, equity share buyback, we debited here. Then we credited, it get cancelled. Here premium on buyback, we debited, then we credit, it get cancelled. All items are taken out. So now we can do the total here. 11 lakh plus 22 lakh 25,000 plus 28 lakh 75,000 plus 16 lakh 50 plus 3 lakh. That is coming 81 lakh 50,000. 46 lakh 50,000 plus 35 lakh. That is coming 81 lakh 50,000. Okay, done. Now we're done with question number, which question number this is? Question number 6. Okay, now what we'll do that here, we will conclude here only. Tomorrow I will take remaining questions, and then day after tomorrow there is, so this chapter is favorite chapter of ICAI to ask question on case scenario based MCQ. If you go to the MCQ book, you will find out so many case scenario based MCQs questions come from these chapter. So tomorrow there are some concepts that I want to discuss with you, that I will discuss tomorrow with you. We'll solve remaining question most probably, and then day after tomorrow we are going to solve exclusively so many case scenario based case studies only. Okay, so let me see, can I give you some homework today? 10 already given, 11 already given. Okay, 12 not yet given, but that is related to redemption of preferential that I will teach you tomorrow. So I cannot give you this question today. Now 13 already given to you. 14 also redemption of preferential that I will teach you tomorrow. Okay. 15, that is also related to redemption. Tomorrow I will give at least 3 homework, so be prepared for tomorrow. Okay. Now here redeemable, all are redemptions, so many questions on redemption of preferentials. Okay, that I will cover tomorrow. At least one question I have to give you, no? So come to question number 17 homework. Remember that infrastructure development reserve is not a free reserve. Okay, so question number 17 is homework. Same, comment with your calculation. Same 3 tests. They want to do the buybacks 35,000. Same, almost a similar question that we have solved in class today. So today's homework is question number 17. Write down their homework. Question number 17 for today. Okay, question number 17. 17, correct? Okay, can you solve few more questions? Yes, 18 is also, yeah, you can do 18 as well. Okay, the 3 tests. Okay, now 18. Okay, otherwise tomorrow there will be so many homework. So 17 and 18. Okay, few more. Oh, 19 is also there. Okay, that you can do that here. Okay, I will discuss with you tomorrow that 19, only 2 question homework today, 17 and 18. Be ready for tomorrow, because tomorrow or day after tomorrow I am to cover the buyback. Okay, the remaining question I will some question tomorrow, some question day after tomorrow. Okay, so please do these 2 homework, which is very important, that in the next 2 days this buyback will be complete, that we will complete this buyback of equity shares. Then the next chapter that we have here, simple, okay, investment account. Okay, one by one. So that is for today. Please do the homework properly. If you have any doubt, you can drop me a message anytime. That is for today. Take care, all of you. Bye bye. Hello, all of you. I hope you are doing good. So today there are some concepts that I want to discuss with you, like the redemption of preference shares. There are some other concepts also. So I will discuss those concepts, but before that, there is a one very small question that we are going to solve. That is question number 8. So come to question number 8. Come to question number 8. Okay. It came in RTP November 2019, RTP November 22, and RTP September 2024. Okay. Umesh Limited resolved to buy back 4 lakh of its fully paid equity shares of rupees 10 each at rupees 22 per share. It means how many shares that they want to do the buyback of, how many shares? 4 lakh equity shares they want to do the buyback, and the share is of rupees 10 each, but they want to do the buyback at what price? 22. It means 12 rupees is what? Premium on buyback, because the face value of share is 10 and they want to do the buyback at what price? 22 that is. Okay. They say these buyback is in compliance with the provision of the Companies Act and does not exceed 25% of the paid up capital in the financial year. So they are saying is that the conditions of the Companies Act 2013 regarding the buyback of shares that they have fulfilled. If you remember that in our previous session we discussed about the 3 tests that okay, resource test, okay, so share outstanding test. So where we discussed about the 25% it is allowed that maximum. So they are saying that they fulfill those conditions. Okay. So for the purpose, it issue 1,11% preference share of rupees 10 each at par, the entire amount being payable with application. So they are saying that for the purpose of these buyback, they issue certain shares in the market. It means that these buyback is out of fresh issue of shares, but it does not mean that here fully it is out of fresh issue of shares. So we will discuss about it. They say the company uses rupees 16 lakhs of its securities premium account apart from an adequate balance in general reserve to fulfill the legal requirement regarding the buyback. So they are giving us the indication that 16 lakh they have utilized from the securities premium account. So whenever it requires like to adjust the premium on buyback, so we should know that we have 16 lakh we have to utilize from the securities premium account, and remaining if when it requires we will utilize the general reserve account. They ask us to give the necessary on the journal entries from the above transaction. Now please understand this point here, as it is specifically mentioned in question that they want to do the buyback out of fresh issue of shares. Okay. So how many shares? First of all, face value. How we calculate that here? If you remember that here, this point I am discussing with you. Total face value of equity shares bought by. So how many shares we are doing the buyback here? We are doing the buyback of 4 lakh shares. So I will write it down that here now is 4 lakh shares. 4 lakh shares they want to do the buyback. Okay. What is the face value of the share? Is rupees 10 that. So 4 lakh multiplied by 10, that is coming how much here is 40 lakh rupees. The face value of the shares that they are doing the buyback is how much? 40 lakh. We'll make a proper working note on it. Just listen carefully here. Okay. But how much is what this says that here? Total face value of the fresh issue of fresh shares capital issued for buyback. So what is the face value shares issue? They issue a preference shares, 11% preference shares they issued at par. How many shares? 1 lakh. So they issue 1 lakh preference shares. How many shares they issue? 1 lakh preference shares of rupees 10 each at par. So they issue of rupees 10. So how much it is going to come? It is going to come how much? 10 lakh rupees. So 40 lakh is the amount of capital that the amount of share that they have bought back, and 10 lakh is the amount of what here is the buyback of face value of the share that they bought back. So here it means out of profit is going to come how much? 30 lakhs. So this is out of profit. So here in this question, it is not specifically fully, I mean to say, out of fresh issue of shares, and it is not fully out of profit. It is the combination of both of them here. So the face value of the shares bought back is coming 40 lakh, and the face value of preference shares issued is coming 10 lakh. It means remaining is out of profit. So be careful, we are going to pass the entry for fresh issue of shares, but at the same time that here now, we will also pass the entry for these 30 lakh, the shares that they have purchased out of profit. So we are going to transfer to capital redemption reserve account as per the Companies Act 2013. Okay. So they just ask us to pass the journal entries that here, and remember that they have issued the shares. Okay. This is the one concept that I will discuss with you after this question, that is regarding the redemption of preference shares. They're not talking to you here regarding the redemption of preference shares that I will discuss in the after this question. Here it's a normal issue of shares in the market. So they say they issue the 11% preference shares of rupees 10 each at par, and it's the entire amount being payable with application that year. Okay, so they receive, I mean, you should know that here. When we issue the shares, some amount with application, some amount with allotment, and some amount with the final call that year. But here, this is the complete amount comes at the time of application only. So I will explain you how to pass the entry, but you should know that we are going to debit to the bank account because we are going to receive the amount when we issue the shares in the market. So we issue the 1 lakh preference shares of rupees 10 each, so we are going to receive 10 lakh rupees. So bank account should be debited that year. Obviously, when we issue the shares, my capital is going to increase that year. So capital will be credited. But these entry we have to bifurcate into two entry. These, I mean to say, these adjustment will bifurcate into two entry. I will tell you why two entry. I will tell you the concept behind that also, because we have to create a share application account. I will tell you what we are going to do, but bank account should be debited because we want to receive the amount. So let's do one thing, that first draw a format for the general entry. It will take at least, I think, 1 page it will take that here. And we'll make a working note on to find it the amount of how much is out of fresh issue or out of profit that year. So write down that here now, question number I think 8. So write down there question number 8. Okay, question number 8. Okay. Now journal entries in the books of Umesh Limited. Journal entries in the books of Umesh Limited. Journal entries in the books of Umesh Limited. Okay. Now write down there. Debit, credit. Okay. Date is not given, so I will use serial number 1, 2, 3 like. So first we will pass entry for issue of preference shares. So write down that here now. Issue of, for a reference, I am giving the heading there. Issue of preference shares. Okay, issue of preference shares. Okay. Now write down there. First we receive the amount. Okay, when we issue the shares, we are going to receive the amount. So bank account should be debited here. How many shares? 1 lakh shares. We are issuing at par only, rupees 10. So 1 lakh multiplied by 10, that is going to come how much here? 10 lakh. So bank account debit 2. Now please understand what happened in real life. At the time when we receive the amount, we don't actually allot at that time immediately. We are going to allot them later on. So instead of crediting share capital account, first we receive them. So for that we're liable to give, we're liable to give something to the shareholder. So we receive the amount at the time of share application, the complete amount. So we are going to credit to 11, but the name of preference shares is 11% preference shares. So 11% preference share application and allotment account, that is coming how much here? 10 lakh that here. Okay, so we are going to get share application, preference share application account will be credited by 10 lakh. being entire amount received on application. Now please understand that we are going to cancel this account that I've credited the 11% preferential application and allotment that here now, because we receive at the time of application. So we receive the amount and then we'll allot it that. Okay, so we'll cancel it. Don't worry. Share application account that I've credited here. Why I write it down share application and allotment? Because we are going to complete amount we receive that here. Okay, of application allotment, all of them. Okay, so it is a way that we present the answer that here. We write it down. Share application and allotment account because we receive the entire amount that here. Okay. Now I'm going to cancel that. I'm going to issue the shares now. So this share application account will be cancelled. Second entry. So 11% preference shares application and allotment account should be debited 10 lakh. Now we are issuing the shares, so share capital account, but they have the name of 11% preference share. So write it down 11% preference share capital account. How much it is? 10 lakh. Being 1 lakh 11% preference share allotted at par. Now please understand this point that, okay, now please understand this one. For the reference, just I am writing like this. Okay, we have credited these share application share allotment account here, and then we debited your share application and allotment account, so it get cancelled that. Okay, if you see the net effect, we have passed the entry bank account debit to share preferential capital account like a normal share that we issue that. Okay, but it is a way to present the it is a way to pass the entry that because we received for at the time of application. So we say, okay, we received the amount, after few days we'll allot them. So that's why in two entry, first we receive, so then we cancel this and we issue the shares. Okay, so we pass the entry for issue of shares. Now what we'll do that, we will pass the entry for buyback of shares. Okay, so write down that here now, buyback of shares. Buyback of shares. Okay. Now, what we do when we do the buyback? First, we purchase the shares. So, how many shares that we want to do the buyback here? The 4 lakh. What is the price? 10. But we are doing the buyback at 22. Okay. So, first entry will purchase it. So, equity share buyback account debit. Equity share buyback account should be debited here. 4 lakh shares multiply by rupees 22. So 4 lakh multiplied by 22, that is coming 88 lakh rupees to bank account. To bank account 88 lakhs. Okay, write down narration. Being payment made for allotment. Okay, now we purchase and what we do? Cancel. Now we'll cancel it. But remember that when we talk about the cancellation that here now, in share, when we cancel the share capital, but only face value will come in share capital account. Face value will come in share capital account. Okay. Okay. Now here write down equity share capital account should be debited here. How much it is? How many shares? 4 lakh shares. But what is the face value? Face value is rupees 10. So you know that in capital account always only face value will go. So it will come here. How much it will come? 40 lakh. How much is the premium on buyback? 12. But you know, we will utilize premium. Let's first write it down premium buyback. Then we will write it off in next entry. So premium on buyback account debited, that is 4 lakh shares multiply by rupees 12. So that will come 48 lakhs. Okay. 2. We purchase in third entry, we pass the entry of purchase of shares. Now we are cancelling. The equity share buyback account will be credited. Equity share buyback account 88 lakhs being cancellation of equity shares on buyback. Be cancellation of equity shares on buyback. Okay. So first we pass the entry of it here of purchase of shares. Then we do the cancellation. Okay. Now third entry, the premium on buyback should be adjusted. How much is the amount of premium on buyback? Is 48 lakh. But it is specifically mentioned in question that they have a balance of rupees 16 lakh in securities premium account. So out of this 48 lakh, 16 lakh will be adjusted against the securities premium account. And they say they have an adequate, means they have enough balance in general reserve. So remaining will utilize from the general reserve account. Okay. They have not mentioned the amount of general reserve in question, but they say adequate, enough balance that they have in general reserve. So we don't care about that here. How much? They have enough balance. So freely we can utilize general reserve. But before that, obviously when we talk about the premium on buyback also, this is specifically mentioned in question that here now premium on buyback that they have here is how much they say the company uses 16 lakh uses from the securities premium account. So write down that fifth entry, securities premium account should be debited, 16 lakh. General reserve account should be debited. 48 lakh is total, correct? You can see the premium on buyback is how much? 48 lakh. 16 lakh we are utilizing from securities premium. So minus 16 lakhs remaining out of general reserve. So it will come 48 lakhs minus 16 lakh, 32 lakh. 2. Premium on buyback account. Premium on buyback account. How much? 48 lakhs. Then write down narration being premium on buyback adjusted against securities premium and general reserve done. Okay. Now last entry, you will say, why sir, why is the one more entry? You will say, sir, we purchase, we cancel, and then we adjust the premium buyback, and we have already passed the entry of issue of shares. But remember, this is not a buyback completely out of fresh issue of shares. As you can see that here, the face value of the shares bought back 40 lakh, face value of the shares issued 10 lakh, and remaining 30 lakh is out of profit that year. Okay. So we have to pass the entry of what? CRR that year. Okay. Or 30 lakhs only. And we'll make a working note on it. Okay. So first pass the entry. We have enough balance in general reserve. So write down that here general reserve account should be debited. Write down in bracket working note number 1. We'll make a working note number 1. Okay. That is coming 30 lakhs to capital redemption. Okay, to capital redemption reserve account 30 lakh, being face value of buyback of shares out of profit transferred to capital redemption reserve account as per law. As per law. Okay, as per law. Okay, done. Okay, now we'll make a working note number 1. Okay, we'll make a working note number 1. Working note number 1. Amount to be transferred to capital redemption reserve, write it down in bracket, out of profit. Okay, face value of shares buyback 4 lakh shares multiply by rupees 10, that is coming how much? 40 lakhs. Okay, less face value of shares, face value of preference shares issued for buyback, write down in bracket 1 lakh shares we issued at 10, multiply by the face value is 10, so that is coming how much? 10 lakh. So here that is 30 lakhs. This much is out of profit. This much is out of profit. Done. Okay. Now, done. Okay. Now, before I come to question number, we'll solve question number 7 that here. But before that, I want to discuss with you that here regarding one concept, that is the redemption of preference shares. Okay. So redemption of preference shares now is a part of CA foundation that here. But still here in these chapter, here especially these chapter, they ask you that here regarding the entries of the redemption of preference shares that here. Okay. So I will discuss with you the concept of redemption of the preference shares. And one more concept I think will come in question number 7. I will discuss with you there only that here. That is regarding the cancellation of own debenture. Both these chapter, that is the cancellation of own debenture and redemption of preference shares, both are the part of CA foundation now. But in these buyback of equity shares, they ask you certain entries on cancellation of own debenture and redemption of preference shares. So what I will do with you that I will discuss with you some concept there. Okay, I will discuss with you some concept that here regarding the redemption of preference shares, not some, all the concept regarding the redemption of preference shares, and one more concept that is on the cancellation of own debenture. So what you will do that now in your notebook, just write it down there. Redemption of preference shares. Redemption of preference shares. Give the heading redemption of preferential. Okay. Before I come to redemption of preferential, okay. Before I come to this, one thing that I want to discuss with you that here, what is the, you will say the same thing is that here, redemption of preferential is also we are cancelling the preferential. In case of buyback of equity, same thing, we are cancelling the equity share. But the way we are into flow of the journal entry is different in both of them. Let me tell you what is the different here. If I write it down that here now, in buyback and in redemption, what is the difference that they have? In case of buyback, the 4 entry we pass, first we purchase. Then if you issue the shares in the market, there's a different thing. We'll pass the entry for issue of shares. But we purchase. Then second we do cancellation. And third we do premium on buyback. Premium on buyback. Okay. These 3 entry we pass. But when it comes to redemption of preferential, first entry will come of due. What is due? I will tell you. Second entry will come for payment. And third entry is the premium on redemption of preferential adjustment. So, adjustment here also. Premium on redemption. Redemption of preferentials. Adjustment. Now understand what is the logic behind that. Okay. When I say that here now, is why we are going to pass the entry that here for the due. I'm not discussing about the issue of shares. Same logic. If I say that here now, in case of a redemption of preferentials and in case of redemption of preferentials, that, or in case of buyback, that is same. It might be out of fresh issue of shares, or it might be out of profit. So it might be out of fresh issue of shares, or it might be out of the profit that. Okay, now understand this point. Now I will come to these flow. I will come to that. Don't worry. Okay, but first I'm discussing with you regarding the issue of shares. The same that what we have discussed in case of that here now in the buyback of shares. So first entry that they will pass here is issue of shares for redemption of preference shares. Similarly what we discussed in case of with a buyback, that we have to either be out of profit or out of fresh issue of shares. So we issue the shares in the market. We are passing entry for issue of shares. Okay. So normal entry will come that here now. Bank account should be debited here, or let's in 2 part. At par. I'm issuing shares at par. So I'm going to pass the entry. Bank account should be debited here and share capital account will be credited here. Okay. Then here, or it might be when I'm issuing shares at what? Premium. Premium. I'm issuing shares at what? Premium. So bank account should be debited to share capital account will be credited. We know that capital account will always be credited by face value. So share capital account will be credited. Then here to securities premium account will be credited. Okay, securities premium account will be credited, whatever the amount of premium. Okay, I will come out of profit later on. Then we are going to pass the entry for a redemption of preferentials. Okay, redemption of preferentials. So those 3 entry we'll discuss it now. Okay, first for this issue of shares for redemption, issue of shares in the market for the same logic, out of profit. Okay, out of profit, out of fresh issue of share. Now when it's come to the redemption of preference shares, it is the same thing that here, the cancellation of, here we are talking the preference share. In case of a buyback, we discussed about the cancellation of equity shares. What we are discussing here, we are discussing here cancellation of preference shares. So you will tell me, sir, buy first the preference shares from the market, cancel them, and adjust the premium on redemption of preference share. Like that we do in case of a buyback of equity share. We first purchase the equity shares, then we cancel them, and then we adjust the premium on buyback. Do that here, sir. Also, I will tell you no. The flow is something different that here. First, I am to pass the entry for what? The due. What does it mean that here? Let me explain you what does it mean that here now. Write it down that here, due. Entry for due. Redemption of preference shares, okay? Now what happened in case of a redemption of preference share? We don't buy the shares from the market to do the cancellation. This is what we do in case of a equity, buyback of equity share. We buy them and then we cancel them. Here we don't do that. We don't buy the shares from the market, we don't buy the preference shares from the market to cancel them. The reason is that here, because when we issue the preference shares, we told them at that time only it's a redeemable preference shares. So it is pre-decided that what is that here? It is pre-decided that it is going to be cancelled at so and so date. Now suppose that dates come. So I will to say that I will not tell them I want to purchase then I will cancel. No, directly I will cancel them. What I will do that directly I will cancel them here. Because I will not purchase that here to do the cancellation. What we do this is what we do in case of like we purchase and cancel in case of equity share but in case of a preference share, when we issue the equity share, we don't call them redeemable equity shares. But in case of preference share, we call them redeemable preference shares. It means we are going to redeem them and cancel them. So when I say that here, now that due date comes and I am to cancel it that here. So to all the shareholders to whom we have issued the preference shares, and I am going to cancel them here. Okay. So what entry I will pass that here now is suppose I am doing the cancellation at par. It might be happen if the shares is of rupees 10, I am doing the redemption at 12. Or that is at premium. If I am doing the redemption at par only, suppose the share is of rupees 10 and I am doing the redemption at 10 only, so it at par. So we are not going to purchase and cancel. Directly we are going to cancel the capital. So decrease in capital should be debited. So I will write it down that here now. Preference share capital account debit. Preference share capital account debit. And I am liable to pay the amount to preference shareholders. So we cancel the capital. We are not going to purchase. Directly we cancel. And for these cancellation, obviously we are liable to pay to the preference shareholder. So I will say we'll pay them, but we are liable to pay to preference shareholder. Increase in liability, preference shareholder account. So what is going to happen that here now? Suppose we purchase at we are going to pay them at 10. We are not purchasing. We are going to pay them 10. So we decrease the capital. So here we decrease the capital. Decrease the capital here. Okay. Now here increase in liability. Why? Because we are liable to pay. So we are liable to pay. We are liable to pay to the preference shareholder. We decrease the capital. The decrease in capital. But we are liable to pay to the preference shareholder that here now. So decrease in capital should be debited and increase in liability should be credited. Basics of accounting that. So increase in liability that should be credited. So we are liable to pay to the preference shareholder that here. So we pass the entry to decrease the capital, preference share capital account debited, and we are liable to pay to the preference shareholder. It might be happen that now when we are cancelling them, it might be happen it is pre-decided that I am going to pay some more amount, not just the face value. It might be happen. So let's say B here. Premium. I am paying them more amount. Suppose the share is of rupees 10, we are paying them 15. But capital will always be cancelled at face value. So I will write it down that here now. Preference share capital account debited by 10. Okay, I will write it in the amount later on. 10. Premium on buyback account. Oh, not buyback. We are talking about preferential. Premium on redemption of preference share account should be debited to preference shareholder account. To preference shareholder account. Okay. Now, how much is the face value of share? That is 10. How much is the premium? Suppose hypothetically say 5. So total amount which I am liable to pay to the preference shareholder is 15 year. Okay. So we are not going to purchase the share. Directly we cancel them and we'll tell to the preference shareholder, now I will pay you. So first entry we are going to pass the entry of due. It might be at par in premium as per the information given in question. Now, second entry is the payment. We will do the payment to preference shareholders. Now here, next entry for the payment that here. So when we will do the payment, decrease in liability, we are going to pay to the preference shareholder. So preference shareholder account should be debited. Preference shareholder account will be debited to bank account, whatever it is decided, 10, 15, whatever, we will do the payment that day. The very interesting part, we'll discuss it now, that is related to the premium on redemption of preference shares. So what we discussed in case of premium on buyback that year, I told you that at that time premium on buyback that year now is premium on buyback. Okay. First priority we give to securities premium, correct? Here also, so first priority we give to securities premium, that premium on buyback that year. Okay. Now understand the entries are given that here. I will come to those entry that here now. But here when I talk about that here now, okay. So now write on the next entry that here. Premium on redemption of preference shares. Okay, premium on redemption of preference. Now understand this point. So we'll say that, sir, just write it off against the securities premium account. Now I will not write it off against the securities premium account. Just write it down that here. General reserve or profit and loss account surplus balance that we have in reserve and surplus account should be debited, and premium on redemption of preference shares will be credited. Okay, you will ask me, sir, why you are not utilizing the securities premium account? This is what we do when we talk about the redemption of them, when we talk about a buyback of equity shares, because there we utilize the securities premium account, we give them the priority. If you see those entries that here in the similar way, I pass the entry for that here. We discuss about the entries for these redemption of just give me a minute. Okay, yeah, you can see that here we debit to we debit to securities premium account, P&L account, or for first priority we give them to securities premium account that here now. But here when it's come to the that is a premium on redemption of preference shares that here now, we are not giving the priority to securities premium account. What is the reason that here? Now please listen carefully. When it's come to the premium on that or on buyback that here, so here we utilize that here. Okay, we utilize first priority we give to securities premium. Write it down, the securities premium. Then we give the priority to general reserve, and then we give the priority to the profit and loss account surplus balance. But here I give the priority to general reserve, then I give the priority to profit and loss account balance, and I'm going to avoid this securities premium account if I don't have a balance in general reserve. So last priority, last. We'll say why? Why is that last? If we don't have a balance in general reserve in the premium profit and loss account, then only I have to utilize the securities premium account. Otherwise, no, in case of a redemption of preference shares, to write it off the premium on the redemption of preference shares. But what is the reason behind that? Okay. Now, we are not going to, I will come to that point. What is the reason behind? Let me first discuss that. What is the reason behind that? Because there is in this section 133 in the Companies Act, which says that here, you cannot utilize the securities premium account to write it off the premium on redemption of preference shares. I'm repeating that here. Now, there is a section 133 in Companies Act, which says that you cannot utilize you cannot utilize securities premium account to write it off premium on redemption of preference shares if that company follow accounting standard. So almost every company follows the accounting standard that here now. So basically it is prohibited by the Companies Act. That's a different thing that here. If it is not going to happen ever, but remember that here, if you don't have a balance in general reserve and profit and loss account or revenue reserve, then only you can utilize the securities premium account to write it off the premium or redemption of preferential. Otherwise, you will never utilize that because it is prohibited by the Companies Act. So they tell us that here now. Okay, what they tell us that here now is section 133 of does not allow the utilization of securities premium account if the AS is followed. If the AS is what? The follow that here. Okay. So they say if you are following the AS, you cannot utilize the securities premium account to write it off. Redemption of preferentials. We cannot do that here. Okay. So that's why what we'll do that here now. Here we are not going to use it that. Okay. Obviously, we are talking about the out of fresh issue of shares. So we are not going to pass the entry of out of profit. So to transfer to CRR. Now, if it's come to the out of profit that here now, first entry is not applicable to me. First entry is not applicable to me. This entry is not applicable to me. Okay, why this entry is not applicable to me? Because I am issuing off shares for what? Out of profit. So we are not issuing the shares in the market. Now, what here second entry will be exactly the same. Just let me write it down here, same, the due entry. Third, it will be same, like in case of if it is out of fresh issue of share. Fourth, it will be same. But one more entry will come that here, that is related to CRR. This is additional entry here. So what is the entry that here? General reserve you can utilize, profit and loss account surplus balance you can utilize, and you are going to transfer to CRR account. Okay, here also we will not utilize the securities premium. So to make it simple, in case of redemption of preferential, we will avoid securities premium account always because of the Companies Act. So here this entry is the new, that this is the additional entry that when it is out of fresh issue of shares. Okay, and here it is. Okay, this is a new entry. Okay, same. But only thing you have to remember the flow here. So first we pass the entry for due. Okay, we'll cancel capital and whatever the amount decided, we'll pay to the preferential. Second entry, we pass the entry for the payment to preferential. Third is the adjustment of premium redemption of preferential, but we will not adjust against the securities premium. That's a different thing. If we don't have a balance in general reserve, then we can utilize, but we'll avoid them. Okay, same simple it is that here now. Okay, now I will come to that here now in question number the 7, but there is one more concept in question number 7. In addition to the redemption of preferentials and buyback, one more thing will come, that is the cancellation of own debentures. So do one thing that here now, in your notebook only that here. Now write it down that here now. Give the heading there. Okay, give the heading there. Cancellation of own debentures. Cancellation of own debentures. Okay. Okay, cancellation of own debentures. Now, understand the concept. What is cancellation of own debentures? Says that. Suppose this is the balance sheet of a company. This is the balance sheet of a company. You can write it down in T form to make it simple that way. Okay. Balance sheet. This is liability and equity side, and this is asset. Not understand this one. What happens is that here, when we issue a shares, we record always share capital at face value. We always record share capital at face value. Whether it is a preferential or equity share, it doesn't matter. Always capital will always be recorded face value. Whatever the surplus amount if we have received at the time of issue, that will go to securities premium account. But the same treatment we are going to give in case of a debenture also. When we issue a debentures in the market, it will always be recorded at what? When we issue a debentures in the market, it will always be recorded at what? I mean, the debenture will be recorded at face value. Surplus amount that will go to securities premium. That's a different thing. Okay. But like capital, face value will always come in capital. In case of debenture, always also the face value will come, only face value will come in debenture. Suppose if I say that now, I have a debentures. We issue a debenture. It's come on liability side. Suppose the debenture, and remember that here, this debenture we recorded at what? face value. We record this debenture at what? We record at face value. Suppose if I say the face value of the debenture is 400 that year. Okay. Now, if I say that out of, I'm bifurcating this 400 that. If out of this 400, two categories. First is suppose all are recorded. This 400 is face value. I want to do the buyback of 330 and 70 I am not talking about. And both are at the face value. I am talking about this 330 out of 400. I want to do the cancellation of these 330. I am saying just listen carefully. I am repeating it that here out of 400 that here now. Out of 400 that here now. I want to do the buyback of these not buyback. So I want to do the cancellation of these own debenture. Now how I can do the cancellation? In case of a buyback also we do the cancellation. In case of a preferential, ultimately we directly cancel the preferential capital, we pay the amount to the preferential shareholder. What about the debentures that here now? Now I want to do the cancellation of these debentures that I have issued in the market. So we have to purchase it that here. Now understand the difference that here. When we purchase our own debenture from the market, in case of equity shares, when we purchase it, immediately we have to cancel them. We purchase and cancel them. We cannot say I purchase my own equity shares from the market and I will show as an asset on asset side. We cannot do that as per the law. So when we purchase our own equity shares from the market, immediately we cancel them and we call them the buyback of equity shares. But when it's come to the debenture, we can purchase our own debenture from the market. Either we can cancel them or we can again sell it in the market. No problem in that. Okay. Now we purchase, we want to do the cancellation of suppose these 330 out of 400. We want to do the cancellation of these 330. And I purchase my own debenture from the market that here. So I will say that here, at what price I purchase? Suppose we purchase investment in own debenture account. So we purchase our own debenture from the market, let's say at 300. So the debenture, I purchased my own debenture in 300. That what is the face value of those debenture? The face value of those debenture is coming how much beta? 330. So when I say the face value is coming 330, it always be recorded face value. But the market value if the debenture goes down, so I purchase 300. Great. Now I want to cancel them that year. So what entry should be passed for cancellation that year? So just write it down that here. Cancellation of own debentures. Cancellation of own debentures that. Okay. Now what happened that here now is cancellation of own debenture. Now what is the face value that here now is 330. Okay. So similar, same like capital, decrease in capital, we debit, decrease in debenture, also decrease, this liability, decrease in liability should also be debited. So I will say debenture account should be debited. Debenture account should be debited here. I'm just talking 330. What is this decrease in debenture? Decrease in liability should be debited. 330, sorry. Okay, let me first write it. I will write it on 330 there. Decrease in liability should be debited as per the basics of accounting. It is 330. Okay. So debenture account should be debited. Debenture account should be debited by how much here? 330. So decrease in it should, the liability should be, decrease in liability should be debited because we are cancelling them. But at the same time that we have done the investment in the old debenture. We purchase our own debenture, not issue. We are talking the purchase. We purchase own debenture. So we are cancelling them. Decrease in asset. So here too, investment in own debenture account should be credited. But at what price we purchase? 300. So the investment that the own debenture that I have purchased, it is an asset for me, which is appearing on my asset. It is allowed to record as an asset of our own debenture that we purchase. It is allowed for the company. Like so, we write it down better. This 300 on asset side, and now we want to cancel this 330 against this. So this is 330. These debenture we purchased from the market. But what is the value of the debenture which is appearing in my balance sheet? 330. And I want to do the cancellation of how much? 300. So I will cancel this 330 against this what? 300 that year. So we cancel the liability, decrease in liability should be debited here by 330. decrease in assets should be credited by how much? The 300. Now here is, what about the 30? Because the value which is appearing in my balance sheet is 330. I purchased at what price? 300. So we make a profit of 30 here because we are cancelling the liability against the asset, and the decrease in liability is 330, decrease in asset is 300. So we have a profit of 30. Is it a revenue nature profit? What does it mean, a revenue nature profit? Is it a profit that will deal daily in the business? I mean, it is from the core nature of the business? No. It's not a revenue profit. We call them capital profit. So write it down that here, profit on cancellation of own debenture account, that is 30. So write it down in bracket, capital reserve. Why write it on capital reserve? Because the profit will transfer to capital reserve because it's a capital nature profit. This is the entry that we pass here. Okay. So why we credited investment in own debenture? Decrease in asset. You got the point, decrease in asset that. Okay. So write it down that here for your reference that. Okay. Now, understand this point. Okay. Now what happened that here? It might be happen that we have a profit on cancellation of own debenture. I say that here we cancel the liability of 330 against the asset of 300. So we have a profit of 30. But it might be happen that we purchase at higher price. It might be loss also. Suppose if I say that here, suppose, just give me a minute, okay? Okay. Now suppose it is 350. Suppose if it is 350 that here now. Okay. Now what happened that when I pass the entry of cancellation here, so what should be the entry in that case? So decrease in liability should be debited. So I will say debenture account should be debited here by 330. Okay, debenture account should be debited here by 330. Now we are going to credit to here that here to investment, decrease in asset, investment in own debenture account. Own debenture account, how much it is? 350. So we cancel the liability by 330, but we cancel the asset by 350. So we have a loss of 20. It is not mentioned in IC study material that here. What should be the treatment that of this loss? Here we have a profit. So this loss on cancellation that is. So loss on cancellation of own debenture that is. What should be the treatment of this loss on cancellation of own debenture? Profit we have. It's a capital nature profit. We transfer to capital reserve that here. Okay. But what about the loss? Now here, it is not mentioned in IC study material that here. And they never ask, I think, the question on this loss also. But if they ask you that here, if balance already existed, already of capital reserve, so first adjust against the capital reserve. If balance existed of the capital, because you cannot just directly debit to capital reserve. Otherwise, the debit balance of capital reserve will come. Reserve, how can the capital balance or debit balance that is? So if already balance existed of capital reserve, adjust this loss because this loss is of a capital nature, not a revenue nature. So adjust against the capital reserve. If you don't have a balance, then you can go for here general reserve balance. Okay, then profit and loss account balance. Very rare chances that they will ask you on loss. Rare chances they ask you on this adjustment. But if they ask you, they ask only on the profit that here. So this should be the treatment. So for your reference, just write it down that here, all these entries that here. Okay, done. Now, two things I discussed with you that now is first is that here now redemption of preference shares. What should be the flow? Due, payment and redemption of to write it a premium redemption of preference share. Then and the cancellation of what? The own debenture. Cancellation of what? The own debenture that here. Okay. Now here, what we'll do that here now, we will go to the question number 7 and we will solve that question. All these adjustments will come there. Now please come to question number 7. It came in November 2012. Okay, 2012 it came. Okay. Now here, M Limited furnish the following summarized balance sheet as at 31st March 2012. Okay. Now here all figures are in thousand as it is mentioned in question that rupees in thousand. Equity and liability, share capital, authorized capital issued and authorized capital they have 5,000. And then they have a issued, subscribed and paid up capital. Remember that authorized capital is just for the reference purpose. Okay. In our notes to account, we'll write it down this authorized capital just for the reference purpose. What is this authorized capital? That is the maximum number of shares that they can issue. Okay. Now here they say that here maximum amount of share capital this is. Now they say 3 lakh equity shares of rupees 10 each fully paid up, that is 3,000. 20,000 9% preference share of rupees 100 each, 2,000. Okay, total amount is 5,000. So complete authorized is also 5. They have issued also 5. Okay. Now this is interesting. They say issued 2 months back for the purpose of what? Buyback. Now listen carefully that here. What it says that here now, they issue these preference shares 2 months back for the purpose of what? Buyback. It means that, write down there, it means buyback. Buyback is out of fresh issue of shares. It means buyback is out of fresh issue of shares. Now listen carefully. Now what happened? If it is out of fresh issue of shares, generally they give us in the adjustment to pass the, generally in the adjustment they give us that they issued this much of shares in the market. Okay. But what happened? It is not mentioned. I will write a note on it that here. It is not mentioned in adjustment. It is already given in balance sheet. What does it mean? It means that just 2 months ago only, they issue a shares in the market for the purpose of buyback. So how many shares, what is the amount of capital that they issue for the purpose of buyback? That is the 2,000 that. Okay. So they issue, we will see that how much shares we want to do buyback. We will discuss about it later on. But they have already issued the share in the market for the purpose of buyback. Okay. Then they say reserve and surplus, capital reserve 10, revenue reserve 4,000, securities premium 500, profit and loss account balance 1,800, total 6,310. Now non-current liabilities 10% debenture 400. Now current liabilities and provision, that is 40. Asset side, fixed asset which is cost 3,000, provision for depreciation means accumulated depreciation 250, net amount is 2,750. Non-current investment at cost 5,000, current asset, loans and advances including cash and bank balance is 4,000. Okay. Now they say that if the company passed a resolution to buy back 20% of its equity share at the rate of rupees 15. So they want to do the buyback here. And the share is of rupees 10, but they want to do the buyback at 15. The premium on buyback is 5. For this purpose, it sold its investment of rupees 30 lakh for rupees 25 lakh. I will come to the point of investment, but fund they can arrange it from anywhere. They can sell the fixed asset, they can sell the, whatever they want to, they can do that here. Okay. But the point number one talks about, just give me a minute. Okay. Point number one talks about that here now is the buyback. So point number one is related to buyback. Okay. Now point number B, they say company redeem the preference share at a premium of 10% 1st of April 2012. It's talk about the redemption of preference share. It means in the same question that there is a point on buyback of equity shares and the redemption of preference share. Point number C is included in its own investment where investment in own debenture costing rupees 3 lakh. Face value rupees 3.3 lakhs. That these debentures were cancelled on 1st of April 2012. This is cancellation of own debentures. Point number C and D talks about a cancellation of own debenture. So in these question, the adjustment, there are adjustments are here on buyback, redemption of preferences and cancellation of what? Cancellation of what? The own debenture that is. Okay. Now understand this one. What we'll do that here now, they ask us we are required to pass the necessary journal entries and prepare the balance sheet on 1st of April 2012. So we'll pass the journal entries one by one that here. First for the buyback and then for the redemption of preferential like and then for the cancellation of own debenture. So write down that here now in your notebook. It's question number 7. Journal entries in the books of Journal entries in the books of, what's the name of the entity here? In the books of M Limited. All figures are in thousands, so write down rupees in thousand. Okay. It will take more than one page, but first draw for one page. Okay. 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 Now write down there. Debit, credit, here date is given, everything is going on 1st of April 2012. So first we will pass entry for reference I'm writing down buyback of equity shares. Okay, buyback of equity shares, write down there. Okay, first we'll pass entry for buyback of equity shares. Okay, now understand this point is mentioned in point number A. The company passed a resolution to buy back 20% of its equity share at the rate of rupees 15 per share. For this purpose, they sold an investment of rupees 30 lakh at rupees 25. So investment which is appearing here, it is 5,000. Okay, but remember that these figures are, and don't get confused, these figures are in thousand. This is in lakhs. So if I write it down in thousand that here, so it will come 3,000. If I write it, and it will come 2,005. If I write it on 1,000, because the figure here it is given in thousand, here it is in lakhs. Don't get confused. Okay. So if I write it down in thousand, we are selling out of this 5,000. Out of this 5,000, we are selling the investment of 3,000 at rupees 2,500. So we are not selling the complete amount of investment. Out of 5,000, we are selling only the investment of how much? 3,000. So we are selling the investment of 3,000. At what price we are selling? We are selling at 2,500. Okay, so we are selling at a loss. So write down there first is 2012 April 1. Bank account should be debited 2,500. Profit and loss account should be debited, because write it down in bracket. This loss will debited to P&L. Okay, as for AS 13, but it's okay. AS 13 is a different part, but loss go to P&L account. Okay, so loss on sale of investment. How much it is? 500 to investment account. 3,000. Okay, being investment sold for the purpose of buyback. For the purpose of buyback. Okay, now understand this point that. Okay, now what happened? We sold the investment here for the purpose of buyback. It's okay now. Now we are going to pass the three entry. Purchase of shares. We are talking about what? Do you remember the sequence that here, beta? That is purchase, cancellation, and premium on buyback. We'll adjust that. Okay, 3 entry. We are not going to pass the entry for issue to transfer to CRR. The reason is that here we are doing out of issue of share. The only difference is that issue of share is not mentioned in adjustment. It is already issued. Therefore, we are not even passing the entry for issue of shares. It is already issued 2 months back, and which is appearing in my balance sheet. That it is mentioned in balance sheet. Okay. So one by one, they say we want to do the buyback 20% of its equity. How much equity we have? We have equity 3 lakh shares. So 20% we want to do the buyback. So first we will pass entry for purchase. What entry we pass here in case of buyback? Equity share buyback account should be debited. So write down there equity share buyback account should be debited here. 3 lakh shares multiply by, we want to do the buyback 20% only, and what price we are doing? Rupees 15. So 3 lakh multiply by 20%, that is coming 60,000 shares. We are doing buyback at rupees 15. So multiply by 50, that is coming 9 lakh. But remember that not, yes, 9 lakh. But remember, we are writing rupees in 1000. So don't write 9 lakh. Just remove 30, write down 900. Rupees in 1000. We have to remove the 3 zeros. Okay. To bank account. 900. Being payment made for what? Buyback. Okay. Now we purchase shares. Now what we do? Cancellation that day. But remember the face value is 10. So equity share capital account debit. Equity share capital account debit. So how many shares we are doing the buyback? 60,000 shares. Okay. 3 lakh multiplied by 20%, 60,000 shares. And the face value is 10. So here it will come 600. 6 lakh, but rupees in 1000. So remove 30, 600 it will come. Now premium on buyback. Premium on buyback account debit here. 60,000 shares multiply by rupees 5. That will come how much here? 300. Okay. To equity share buyback account. That is how much? 900. Equity share buyback account, that is how much? 900. Okay. Being cancellation of equity shares capital, being cancellation of equity share capital on buyback. Now first we pass entry for purchase, cancellation, then adjustment of premium on buyback. How much is the premium on buyback? The premium on buyback is 300. Okay, now understand this point. So premium on buyback is 300. Do we have in a securities premium? How much we have? 500. So we have enough balance in securities premium. So we'll utilize securities premium. So write down that here. Securities premium account debit. Securities premium account debit 300 to premium on buyback account 300. Okay, we debited here premium on buyback by 300. Now we cancel them. So being premium on buyback, adjusted against securities premium account, being premium on buyback adjusted against securities premium account. Okay, now understand this point. The entry that we have passed in, the 3 entry I'm talking about, first is on what? Here, purchase of equity shares. Second is on what? Is the cancellation of equity share that we purchase. And third is on adjustment. Okay, adjustment of what? Premium on buyback. Now understand this point. Okay. Now will tell me, sir, transfer to CRR, because it is not mentioned in question that they issue shares in adjustment. I know that it is not mentioned in adjustment that they have issued the shares in the market. It is not mentioned in adjustment, not in point ABCD, but it is mentioned in balance sheet that they have already issued the shares for the purpose of buyback. Therefore, no need to transfer to CRR because it is out of fresh issue of shares. Now you will ask me, sir, if it is out of fresh issue of shares, pass the entry of issue of shares. No, because shares they've already issued in the past 2 months ago, and which is mentioned in balance sheet that these shares that they've issued 2 months ago for the purpose of buyback. Okay, so here for your reference, I am writing down here for a reference at the time of revision. You should not get confused there. So write down there now. First is the adjustment of premium on buyback. Okay, adjustment of premium on buyback for your reference. Okay, now write down that. No need here. No need to transfer to CRA. Refer note. So for your reference, I am just writing down that here. Okay, no need to transfer to CRA. Refer note that here. Okay, for reference, just I am writing down that here now, because at the time of revision, you should not get confused that. Okay, so what is what I will mention note at the end of the buy. First, we complete the entries, then you write it down a note on that that they've already issued the shares in the past for the purpose of buyback. Okay, so there no need to transfer to CRA. It is out of fresh issue of shares. Now, one more important thing. How many shares they want to do the buyback? What is the face value of the share they want to do the buyback? Face value is 600. How many shares that they have issued? 2000. So there is nothing wrong in, I mean to say, it should be the minimum fresh issue of shares that in the market, that the face value of the shares we want to do the buyback. What is the face value of the shares that we want to do the buyback? That is coming how much? 600. So we want to do the buyback, face value of the shares we want to do the buyback 600. But we issued the face value of the share that we issued in the market is 2000. So 2000 that we have issued in the market that year. So now please understand. So when I say that here 2000 that we have issued the face value, it is more than. So there is nothing. It should not be less. If it is less, then I say some remaining is out of profit. For example, if I say the face value of the shares that you want to do the buyback 600, face value of the shares issued in the market, suppose hypothetical 400. So 200 is out of profit. But it is more than 600, there is nothing wrong in that. Already they fulfill the condition. Minimum it should be 600. Otherwise, remaining we are going to call them out of profit. If it is more than that, no problem. Here it is 600. The face value of the shares that they have issued is 2000. No problem. Okay, that they have issued more than the requirement that they've issued. Okay. Now we'll pass the entry for what? Redemption of preferentials. Now write down that here now. Redemption of preference shares. Redemption of preference shares. Okay, now understand this one. Now we are going to pass the entry for redemption of what? The preference shares. Now what is going to happen in case of a redemption of preference share? Understand the sequence that here. Due, and then what entry do we pass for due that here now? Is the preference share capital account debit to preference shareholder. So are we doing the redemption at premium? So it is mentioned in point number B. The company redeemed the preference share at a premium of 10%. So what is the face value? The face value to 20,000 shares and 100 is the face value. Okay. Now pass the entry. Capital will always be debited by face value. Okay. So write down there. What name of the shares is 9% preference shares. Okay. Write down that 9% preference share capital account should be debited. How many shares? 20,000 shares. Face value is 100. So it will come 20 lakh, but rupees in 1000, 2000. Premium on a redemption of preference shares account should be debited here. It is mentioned that is 10%. The 2000 is the amount of capital multiplied by 10%. That will come 200. And this much amount will liable to pay to preference shareholder. So to preference shareholder account 2200 being redemption of preference shares due, being redemption of preference shares due. Okay, Now this entry that we have passed on what? Due. Then we pass entry on payment to preferential. Remember, sequence is important. Okay. Now we do the payment to preferential. So preferential holder account debit to bank account. So preference shareholder account debit. How much we are liable to pay to them? 2,200. So preference shareholder account debit 2,200 to bank account 2,200. Okay. Being payment to preference shareholder, being payment to preference shareholder on redemption. Okay, on redemption. Okay, what's the third entry that here? Third entry we pass here for the premium redemption of preference share will be adjusted. But remember, in case of premium or redemption of preference shares, we don't adjust against the securities premium, we give the last preference. So how much is the premium or redemption of preference shares? We have 200 that here. So we have, we will see that here. We have here it is total is 500, but we utilize for the purpose of premium and buyback, we utilize 300. Okay. Still they have 200, but we will not prefer them. So we have enough balance in revenue reserve 4,000. So utilize that. Okay. So write it down that next entry. Okay, write down that here now. Revenue reserve account debit. $200 to premium on redemption of preference shares account. Being premium on redemption of preference shares adjusted against revenue reserve account. Okay, adjusts against revenue reserve account. Okay, it's the premium adjustment entry. Premium adjustment. Okay, whenever I change the color, that is just for the reference purpose. Okay, now here should we transfer to CRR? Yes, beta. The premium or the buyback of equity share was out of fresh issue of share, but it's a different thing. This is out. This is what here? This is this redemption of preference shares. So write down that here for a reference. You can write it down here. Buyback. Write down here buyback of equity shares. And here redemption of preference shares. Now here is out of profit, out of issue of shares. Out of issue of shares. How I come to know it is out of issue of shares? It is mentioned in balance sheet. Out of profit. Out of profit. Transfer to CRR. Therefore, transfer to CRR. Okay, therefore transfer to CRR. Okay. Now here we transfer to CRR. What is the face value of the preference share that we are reading? Same logic like the buyback, 2,000. So, but we have enough balance in revenue reserve 4,000. We just utilize only 200 here. So write down that here now. Revenue reserve account debit. $2,000 to
capital redemption, reserve account 2000 being, okay, write down there, being face value of preference shares redeemed out of profit transferred to capital redemption reserve account as per law. The last adjustment is given on the cancellation of own debentures. So write down, give the heading there, cancellation of own debentures. Cancellation of own debentures. Okay, now understand this point here. One more entry will come here. Okay, now listen carefully. What it says that here in last point, that it is mentioned that here now is included in its investment in own included in investment. So they are talking about this investment. Here in this investment, it is included in investment in own debenture. So we purchased our own debenture from the market, which is already included there in these 5,000. That is investment own debenture costing rupees 3 lakh, face value rupees 3.3 lakh that here. So they say here, just give me a minute, how it can be possible. Okay, it was 30. Okay, then it's okay. Okay, now understand this here. So they say that investment in own debenture. Okay, so they say the cost rupees 3 lakh, but the face value. So they purchase that rupees in 1,000. They purchase at what, 300, but the face value of the debenture is 3.30 lakhs. 330 it is. How much it is? 330. So it is 330 rupees in 1,000. So it means that here the face value of the debenture is how much here? The face value of debenture is 330, and we purchase at this price. So this is face value and this is cost, or you can say, yeah, purchase price, cost. So we investment, we have same figure that I have considered here, same treatment will come that like this. What is the face value? 330, we purchase at 300. Same exactly like this entry will come that here. Okay. Now they want to do the cancellation. They are doing the cancel on 1st of April 2012. So write down their entry. Now what is the name of debenture that here that they are cancelling is a 10% debenture. Okay. Now write down here 10% debenture account debit, decrease in liability. How much? 330 is the face value. So we debit by face value. It's similarly like the capital, it also recorded face value. Okay. Now decrease in asset to, okay, to investment in own debenture account. Okay, it is basically it is included in investment account. How much it is? 300. So we have a profit of 30. So it will go to capital reserve account. Capital reserve account, because it's a capital nature problem. We'll write it on in bracket. Profit on cancellation of own debenture. Okay, write down in bracket profit on cancellation of own debenture. Okay, being own debentures cancelled. Being own debentures cancelled. Okay, done. Now write down one note that related to, you might get confused, that related to the buyback. It is buyback of equity shares out of fresh issue of share, issue that they've already issued, which is mentioned in question. Write a note here.
Note 1. In the given solution, buyback of equity shares, buyback of equity shares has been out of fresh issue of preference shares, right in bracket, as mentioned, right in bracket, as mentioned in balance sheet, okay, bracket close. Therefore no amount is transferred to capital redemption reserve account for buyback of equity shares. Okay, done. Simple. Now they ask us to prepare what? Balance sheet. Okay, they ask us to prepare what? The balance sheet. You know that the basic rules of when we prepare the balance sheet, you have to keep in mind these rules right here. Okay. Okay, so now we'll prepare a balance sheet here. But remember these rules, okay? Liability, capital, and reserve. They have credit balance, okay? Asset has debit balance. Okay, these rules, remember that, okay? So we'll draw the format of balance sheet and notes to account. Then we'll start writing one by one. Write down the balance sheet of M. What's the name? M Limited, correct? Yes. Of M Limited as on 1st of April 2012, rupees 1000. Okay. Now write down their note amount. Okay, now write down the first equity and liabilities, shareholders fund, share capital, reserve and surplus, non-current liabilities, long-term borrowing, then third point, it is just mentioned in question, current liability. So we'll just write it down, current liability. Total asset. Okay, write down asset here. Non-current asset. Three things: property, plant and equipment, intangibles, non-current investment. Oh, non-current investment. Then here current asset. Okay, done. Now, how many notes to account? That they have not prepared any notes to account. Okay, we'll prepare our favorite 4 notes to account. That is here: share capital, reserve and surplus. Okay, share capital, reserve and surplus, long-term borrowing and PP. That's it. So notes to account number 1. Notes to accounts. Number 1. Okay, notes to account number 1. Share capital. Okay. How much share capital that we have here? Authorized is mentioned. Okay, 5,000. Write it down. First, let's write down authorized that. Okay. So authorized capital. $5,000. Then write an issued, subscribed, and issued and subscribed capital. Issued and subscribed capital. Okay, now understand this one by one. First, we'll talk about the equity shares. That is 3,000. Type in calci 3,000. Now go to journal entries at here. Here we debited equity share capital account by 600. So minus 600, that is coming 2,400. So write down there 2,40,000 equity shares of rupees 10 each, 2,004. Remember that all figures are in thousand. That should be 2,40,000. But no, that should be 24 lakh. But the figures in thousand, that's for 2,400. Okay. Now we have in balance sheet that is preferentials 2,000. So type in calci 2,000. You can see that in entry we debited to preferentials capital account. We debited to preferential capital account by how much? 2,000. So minus 2,000, that is 0 now. Okay. Now reserve and surplus. So you can write it down this share capital in balance sheet, which is how much? 2,400. Okay. Now notes to account number 2, that is reserve and surplus. So write down there reserve and surplus one by one. So first they have mentioned capital reserve. So it is 10, but you can see that here we have a profit on cancellation of own debentures, so where we credited the capital reserve by 30. Okay. So in reserve and surplus, we have to give the detail. What is the opening? How much is the change? What are the reasons for the changes? Okay. So write down there now capital reserve. Okay, write down in inner column 10, add profit on cancellation of own debentures 30. Total is how much? 40. Okay, remember that these rule, never forget this rule that reserves as credit balance. In our entry, we credited them, so we are going to add them. Okay, now we have here, next is what? His revenue reserve is 4,000. So write down their inner column, then we'll do the adjustment. So revenue reserve. Revenue reserve. How much is revenue reserve? That is 4,000. Okay, revenue reserve is how much? 4,000. But if you go to journal entries that here now, we have a revenue reserve that we debited here by how much revenues that we debited by here? How much? 2,000. So that is for the purpose to transfer to CRR. And here also we debited 200 by 200 to adjust the premium redemption of preferentials. Okay. But it's a reserve when we are debiting them here. If you're debiting them here, so if you're debiting them here, we have to deduct them. Okay, less. So write down there. Now here, less. Okay, premium on redemption of preferentials 200 less
transfer to capital redemption reserve 2000. So write down in outer column, that is 1800. Okay, 1800. Okay, done. Now the next item that we have here is securities premium 500. So write down this securities premium 500. But if you see that in our journal entries that here now, we debited securities premium account only one time by 300 here. So it's a reserve that they have a credit balance. If you're debiting them here, we have to deduct them. So write down here less premium on buyback. Premium on buyback, that is coming how much here? It's 200. Okay, premium on buyback is how much? 200. That. Now we have here profit and loss account. So write down there profit and loss 1800. Okay, profit and loss how much? 1800. In my journal entries that here we debited here bit of profit and loss account, so we reduce the profit. Okay, the reserve and profit, the credit balance, we're debiting, we have to reduce them. Okay, now any other adjustment? Only this one. So write down that here now less loss. It's because it's a loss, we sold it loss. Okay, loss on sale of investment 500. So in outer column it will come 1300. Done. But remember that before you do the total of this reserve and surplus, long list, but don't forget to consider capital redemption reserve. So we credit a CRR only in case of redemption of preferential by 2000. So write down here capital redemption reserve, that is how much? 2000. So here it will come 40 plus 1800 plus 200 plus 1300 plus 2000, that is coming 5340. 5340. Write down in balance sheet 5340. That. Okay. Now here better that we have here this next item is that non-current liability 10% debenture. How much is mentioned in balance sheet? 400. If you go to entry, we debited to debenture here by 330. So 400 minus 330. Debenture is a liability. If you are debiting them here, so we have to deduct them. So go to notes to account number 3. That is long-term borrowing. Long-term borrowings. Write down their 10% debentures. That is 400 minus 330 because we debited by 330, correct? Yes. So how much it will come? 70. Write down in balance sheet 70. 70. Done. The next item that no change in current liability 40, as it is it will come 40. Then we have here we will take proper notes to account on it. Okay, fixed asset accumulated depreciation 250 2750. So notes to account number 4. So write down there property. Don't use the word fixed. Fixed it's an old fashioned. Okay, now we use PP. Property, plant and equipment. Property, plant and equipment. So here how much is the cost? Okay, how much is the cost? Is 3000, which is mentioned there, less provision for depreciation or accumulated depreciation. Provision for depreciation, that is 250, which is mentioned, and here it will come 2750. Okay, write down in balance sheet 2750. Okay.
2750, no intangible. Okay, remember that in case of investment, it is appearing in balance sheet at 5,000. Okay, 5,000 for a reference, I am writing it down. So it is appearing at, okay, 5,000. Now if you go to journal entries that here, in first entry we credited by 3,000. So minus here 3,000 because it's an investment. That is asset as debit balance. If you're crediting, deduct that. 3,000. Any other changes? I think, yeah, here also cancellation of own debenture, this investment here. Okay, how much it is? 300. So minus 300. Now how much it is coming? 5,000 minus 3,000 minus 300, that is 1,700. Okay, now in current asset, that now in current asset here, now it is how much? 4,000. So current asset including all cash, bank, all it is including there. Okay, if we, let me write it down for your reference that here. Okay, so 4,000 which is given in balance sheet. Now how much is given that here in journal entries that here? Now first entry we debited the bank by 2,500, so add 2,500. Then first entry done, second entry we credited the bank by 900, so minus 900. Then third entry, no current asset. Fourth, no current asset. Then no, yeah, in a these 2,200 payment to preference shareholder, 2,200 minus 2,200, and there is as such no bank there. Okay, now do the total that here now is 4,000 plus 2,500 minus 900 minus 2,200. Okay, how much? Okay, 4,000 plus 2,500 minus 900 minus 2,200. Okay, that is coming 3,400. So write down 3,400. But before you do the total here, be careful. Cross check whether we have taken all the entries or not. So first entry, yes. Second entry, remember that we debited equity share buyback account here and then we credited here. So it get cancelled here. Then here we debited here 300 and then we credited here 300. So it get cancelled. Okay. Then here we debited here 200, that premium on buyback. Okay. Wait. Okay, no, okay. So premium on buyback, yes, correct. Premium on buyback, we debited here premium on buyback 200 and we credited here premium on buyback. Correct. Okay. On all items are ticked. So now we can do the total of balance sheet. That is 2,400 plus 5,340 plus 70 plus 40. That is coming 7,850. 7,850. Do the total here. 2,750 plus 1,700 plus 3,400. 7,850. Okay. Done. Now what we'll do that now? We'll take a break. Question number 7 done. Okay, a little bit lengthy question. There are so many concepts that we discuss here. Redemption of preference share, cancellation of own debenture. Okay. Question number 8 already done. Okay, but before question number 9, I want to discuss with you one concept, that is ESOP, that I will discuss with you that concept after the break. So we'll take a break for 10 minutes now. Hello all of you. Now this is one concept that I want to discuss with you. Write down in your notebook, that is employee stock option plan. Write down there, employee stock. Write down there, employee stock option plan. Okay. So employee stock option plan, in bracket you can write it on ESOP. Okay. What does it mean? We'll discuss the concept that here. It is not a part of CA Inter, but still there is a one adjustment given in IC study material in our notebook. In our question bank, it is question number 9. There is a one adjustment on it, and it's IC study material question only. Okay. So previously it was in old syllabus, the one whole chapter on the employee stock option plan. Okay, but now it is not in the syllabus. Still they have given one adjustment on it. So I have to discuss with you what is the concept behind that. So write down in your notebook, employee stock option plan. Okay. Now suppose that here now, listen, and you have to write it down with me as well. If you want to write it down at the end, so no problem. First listen and then you can pause the video later and then you can write it down. Okay, now understand this point here. Now it is obviously that here, the company, they have, if they don't want that their good employee should leave the company that here, they don't want it. So what happened? They give them some offers. What offer they give them? They tell them, listen, work with my company, whatever XYZ year, let's say the 3 years. Okay, work with my company for next 3 years. I will offer you shares after 3 years, which will be much lower than the market price. So what I'm saying that now, suppose today we have done the announcement here. Okay. Let's say that here, grant date. The first term that you are learning here is that grant date. What do you mean by grant date? Date of announcement. Date of announcement. What we are doing in the date of announcement? I'm offering you to my existing employee, listen, the market value, okay, the expected market value is suppose rupees 30. If you work with my company for the next 3 years, so I will offer you at just rupees how much? 20. So I'm not saying I'm offering below the face value. Face value, we cannot offer below the face value. Face value is suppose 10, but we are offering at 20. But what is the market price? 30. We'll offer them rupees 20 and we call it exercise price. Exercise price. So first is the market value. Second is the exercise price. So, or you can write it down, the exercise price, offer price. So now understand that here. Now we are offering them the share of rupees 30 at what price? The market value of the share is how much, beta? 30. But we are offering them at how much? 20. So we are giving them the discount of 10 and we call them what? We call them option discount. What we call them? We call them option discount. So we are offering to our existing shareholders, we are offering to our existing employees, if you work for me for the next 3 years, I will give you the shares. It is expected market value at that time, suppose rupees 30. I will offer you at 20 only. Okay, but I put a condition example that you have to work with me for a period of how many years? For a period of next 3 years. That okay. Now suppose that these are the 3 years that okay. Let's say that here. So here, these are the 3 years. So 3 years passes. Okay, in accounting that here, to these 3 years, we call them what? The vesting period. What we call them to these 3 year? Vesting period. So from the accounting point of view, if I say that here, first of all, that do we need to pass any entry do we need to pass any entry on the date of announcement, on the date of grant date, on the date of announcement? No. No entry, no accounting entry on the date of announcement. No accounting entry on the date of what? Announcement. Now understand this point that here now. Okay. Now here, what is a grant date? Grant date is a date of announcement. So there is no accounting entry. We are just doing the announcement that here. Now what happened? First, you have to understand we have given a period of how many years? 3 years. That you have to work with me for a period of next 3 years. 3 years hypothetically, and it can be any period, 2 years, 3 years, 5 years, whatever. You have to work with me. So, do we have to pass any entry that year during this vesting period? The answer is yes. We have to pass accounting entry here. So, what happened? So, journal entry. Okay. During the vesting period. Okay, so what entry should we pass? So entry that we have to pass during the vesting period are the amount of discount. Do you know there is a concept of conservatism approach in accounting? So that loss is going to happen in future after 3 years when they will purchase these shares. So the loss is going to happen in future when they will purchase these shares. So how much will the option discount is 10. So it is an expense for me. So I have to pass the entry here. Employee compensation expense account should be debited. Employee compensation expense account should be debited that year. Okay. Suppose they're offering them how many shares they're offering them is 1 lakh shares. So 1 lakh shares and discount on each share is coming how much? 10. So I will say that here 1 lakh multiplied by 10 is the amount of discount. So here it will come 10 lakh. So employee compensation expense account should be debited here to ESOP outstanding account. What we call ESOP outstanding account. Okay. Now understand this point. You can call it ESOP outstanding. Now I will explain it. There is a one point which came earlier also that here. I told you that here in this chapter also there is an account share option outstanding account. I told you that is a part of reserve and surplus. Is that account reserve and surplus in financial statement of company chapter also? Share option outstanding account. I will explain you what is this. Okay, you can also call it ESOP outstanding or share, write on bracket share option outstanding account. Both are correct with different names. The share option outstanding account we credited by how much here is 10 lakh. Now please understand that, you know, these employee compensation expenses due to the conservatism approach, the loss is going to happen in future when they will actually purchase the shares by the existing employees in future after 3 years after the vesting period that year. But what happened that here now? Today, due to the conservatism approach, we know that here we are offering them 1 lakh shares, and we know that in future that you know when they will purchase it, we are going to give them the discount of 10. So that is an expense. So conservatism approach says that we have to recognize these expenses right now that year. Okay, but over a vesting period, I mean to say that. Now what happened? So these employee compensation expense over a vesting period, which will go to profit and loss account, and ESOP outstanding or employee stock option plan. Okay, employee stock option plan is a part of reserve and surplus. Okay, employee stock option plan. Okay, or ESOP outstanding, same thing. It is a part of reserve and surplus. I think in these chapters also one of the question it came. So I told you that these employee stock option plan is a part of reserve and surplus, but it's not a free reserve. Okay. Now it is a part of reserve and surplus. Why it is a part of free reserve and surplus? I will explain you just in 5-10 minutes only. Okay. So we pass this entry during the vesting period. So what is the first date? Beta? Granted, the date in which this is the date on which we do the announcement that year. What is this vesting period that year now? Vesting period is basically it is the period during which the employee should work with us. So for example, in our example, 3 years. So whatever expected amount of discount we have to recognize in the P&L account over a period of those vesting period. Now I am coming to that. Now here after 3 years, these are my employees that year. Okay, these are my employees that year now. Okay, now these are my employees. We are giving them what here is option. Very important. We have given them option, no compulsion. So we tell him that you have an option. If you want to purchase, you can purchase it. There is no compulsion in that here. If you want to purchase, you can purchase it. It is an option. There is no compulsion in that here. So what is going to happen that here now during the option period that here now is during the option period that here now we will we are doing option and we have given them the you have to take your call within a period of example 6 months that. So once 3 years has been completed in our example, we tell them, listen, I'm giving you 6 months now. Well done. You have worked with us for a period of 3 years. Now I'm telling you, I'm giving you 6 months to take your decision whether you want to purchase these shares or not. To these period, we call them exercise period. What we call them? Exercise period that. We call them exercise period that. Okay. So, during these period, they have to take their call whether they want to purchase it, not that. So, suppose how many shares we offered them? We offered them how many shares? 1 lakh. But they want to purchase that, not 1 lakh, because it is an option, not compulsion that here. So, it is an option. If they want, they can purchase it. But there is no compulsion. So it is an option that is. So suppose they accept here. Suppose they accept 50,000 shares. How many shares they accept? 50. Because there is no compulsion on that. So should we pass the entry that here when they accept it? Yes. So here the journal entry will come. Journal entry. Journal entry. Okay. Here the journal entry will come that here. When they accept, okay, when employee accept option in exercise period. In exercise period that is, okay. So what is the option? What should be the entry that? Now please understand that, we are going to receive the amount that, and this is the only entry. This is the only entry asked by ICAI. This is the only entry they are going to ask you that. Okay. This is the only entry. They will ask you that here. Okay, now understand that here. So now those shareholders is those existing employees going to purchase those shares that here. Okay. So we are going to receive the amount. So bank account should be debited here. But we offer them 1 lakh, but they want to purchase how much? Only 50,000. So we are going to receive the shares on 50,000 shares. At what price we are offering them? 20. So they will give them per share 20. So multiply by rupees 20. That will come 50,000 multiplied by 20. That will come how much? 10 lakh. Correct, 10 lakh. So this is the price of what? Amount that we have received here. So amount received. Amount received. Okay, by the company. Now here, keep the space of 1 line there and then write it down that here now is we issue the shares. So equity share capital account should be credited. How many shares we issue? 50,000 shares. What is the face value of the shares beta? 10. Face value is 10. So here it will come 5 lakhs. This amount represent what? The face value. Face value. Write down their face value. Okay. But understand this part. What is the amount of discount that here? The share is of rupees 30. Market value is 30. We are issuing them at 20. Discount is 10. So we will not write it down here discount because we have already created stock option share stock option plan. So here or ESOP outstanding account. So here what is going to happen now? Here we will adjust against these balance. It goes to P&L. These balance will adjust. So we'll write it down that here now. Okay, we will write it down that here now. Share option outstanding account. Share option outstanding account or share stock option, whatever you can call it. Okay. Share option outstanding account. So 50,000 shares. Okay, 50,000 shares. What is the amount of discount that they have? 10. So 50,000 multiplied by 10, that will come how much? 5 lakh. Okay. Now here, that is the amount of discount. Okay. It's a coincidence. The face value is also 10 and the discount is also 10. That is just a coincidence. There is no connection there. Okay. That is just a coincidence. The face value of the share is also 10 that here now. And the amount of discount is also 10. Okay. Now we will credit to one more thing. And we call them securities premium account. So here I will credit securities premium account. How many shares? 50,000 shares. Multiply by rupees 20. So how 20 I will tell you. So that will come here 10 lakh. Okay. So how we calculated this premium account? What is the mark? Here we calculate market price minus how much is the face value. Suppose not suppose it will be in our example market price 30 and the face value of the share is 10. So that 20 is the premium. So this entry only with the ICAI will ask you in exam. Only this entry. So but I have to discuss with the logic here now. So first grant date, done the announcement, vesting period. During this period they have to work with us. So whatever the amount of discount we are expecting, we record it, P&L account debited and the share option outstanding account credited, and that is a part of reserve and surplus. Now when they exercise, so we will debit with the amount that we receive, we will debit with the amount of discount, we will adjust against the share option outstanding account, share capital will be credited with the face value, and all the remaining amount will come as a part of securities premium. But still you might have one doubt here. What's the doubt that you might have? Because we credited the share option outstanding account by 10 lakh here, but we debited share option outstanding account here by 5 lakh because we offered them, we were expecting that because we offered them 1 lakh shares. So we are expecting them, they will purchase 1 lakh shares, but they didn't purchase 1 lakh, they purchased only 50,000. So I have some balance in my, because this bank will go as a current asset, share capital will go to share capital, securities premium will come as a reserve and surplus. But what about the share option outstanding account? After a week, because we credited here by 10 lakh, but we debited by 5 lakh. Still they have a balance of how much here? 5 lakh. So here, write down here after vesting period. After exercise period. After exercise period that. So what happened after exercise period? This is my share option outstanding account. Share option outstanding account. Initially
we credited to them by 10 lakh. Then we debited here. You can see that here. Then here we debited here by 5 lakh. Still we have a balance of 5 lakh here. Still we have a balance of 5 lakh. Okay. They will not ask you this, but you have to understand. If it's still okay, they will because what about this? I don't want you just to be I want to say just to solve. I want you to understand the concepts here. So how much we credited by 10 lakh, we debited by here. We debited here by how much here? We debited here by 5 lakhs here. So we have a balance of how much here? We have a balance of here how much? The 5 lakhs here. So these balance here, we transfer it to these because we pass the entry for is ESOP outstanding account will be debited here, or share option outstanding account is share option outstanding account will be debited here, and we transfer it to general reserve account. Okay, we transfer this balance there of this 5 lakhs. Of this 5 space is not, that's why I'm doing 5L, that is 5 lakh. Okay, so this is the complete accounting of ESOP. I discussed with you, that is the complete accounting of ESOP. What we have done, listen, I'm talking to you carefully, listen me better. First is the grant date. We just do the announcement there. Okay, no entry on that date. Vesting period, whatever shares that we have offered to them and whatever the amount of discount we are expecting, we record it as an expense in P&L account over a vesting period. Once vesting period has been done, then we tell them now purchase it. When they purchase it, we pass the entry that they purchase it. So bank account should be debited, discount account should be debited, the discount we adjust against the share option outstanding account, capital will create and premium will go to securities premium. But after that, it is not necessary they are going to purchase the whole amount of share that we are offering to them. So if they don't purchase the whole amount of share that we offer to them, then remaining, because still we have a balance in share option outstanding account, the balance we have to transfer to general reserve. Let me tell you the logic also, because when we created this share option outstanding account, when we created that here share option outstanding account, we created through the P&L account, a P&L account debited. So they say transfer it to general reserve, don't credit to P&L account, otherwise unless the profit will jump. Okay, so they say general reserve is also free reserve that will come as a part of reserve and surplus. So they say okay, transfer it to general reserve. Okay, but they will not ask you this much of entry in examination, but you have to understand the overall totality. Always you have to understand the concept in totality, otherwise you won't be able to score 80 plus in advanced accounting. If you want to score 80 plus in advanced accounting, it is mandatory, it is compulsion that you have to understand the concept in a totality. So they will ask you in exam only this entry. They have one question only in IC study, one question only on this point that here. Okay, so it will be too heavy on you for today. So what I will do that here, only one question is pending, that is question number 9, that I will discuss with you tomorrow. Okay, we will solve question number 9, and there are 6 case scenario based MCQs here on this buyback of securities chapter. Those all 6 will solve it tomorrow, and this question number 9 will solve it tomorrow, that and the chapter will be finished tomorrow. Okay, but what's the homework for today? So write down their homework for today. Okay, now understand homework. Question number 10 done. Question number 11. Question number 12. Okay, now I will give the homework. Question number 12. Now understand this point. Very interesting point. I mean to say, generally people realize later on, then they send the message to me. Now please be careful that here. The same that we saw in class today. I think here, no, this is very simple that. Thus they have done the redemption of preference shares. Very simple that. Okay. Okay. They want to redemption and buyback. Simple. So question number 12 is very simple. Homework. Now 13 I already gave you. Today I will give at least 3 questions. Now question number 14. Do you remember that we discussed in class today that issue of 2 months back for the purpose of buyback? Now here the twist will come that. Now how much share that you have issued? The capital is of how much? 3 lakhs. But when how much shares that you are doing the buyback that here? You are doing the buyback, the face value of the share that you want to do the buyback is how much? 4,80,000. Okay, now understand that here. So what happened? You have the face value of the shares that you want to do the buyback
face value of buyback shares. That is how much here? It is given in question 4,80,000. Face value of shares issued, which is given in balance sheet, 3 lakhs. So remaining 1,80,000 is out of profit. In the class, that question that I've solved, they have issued they issued 2 months whatever back more than the amount that you want to do the buyback. So there was no issue, and the complete amount is covered from the out of fresh issue of shares. But here we want to do the buyback 4,80,000, but they've issued, which is given in balance 3 lakh. So remaining is out of profit. That's why this 1,80,000 is coming here. Now please write it down. This is in your question bank page number 63. So write down between page number 63 that 1,80,000 is out of what? Is the profit. So this is how they have done the calculation. Write it down. Okay. Pause the video, go to page number 63 and write it down there. Okay. Now, so question number 13 is homework. Not 13. Which question number it is? 14. So question number 14 is homework. Okay. Now here, question number 15. Similarly that here. Okay. They issued 2 months back here. How much issued? 200. How much they want to do the buyback? The face value of the shares that they want to do the buyback is 500. So what is the face value they want to do the buyback? That is 500. Okay. What is the face value that the shares that they issued, which is given in balance sheet? 200. So remaining is out of profit. This is how they calculate 300. Go to page number 66 and write it down there. Go to page number 66 and write it down there. Okay. This is question number 15. Okay. Write it down, question page number 66. Okay. Question number 15. Okay, I think 3 is enough for one day. Okay, 3 questions. The question number 14 and 15, remember that here, remaining is out of profit. Okay, but in the class that we have solved today, you can pause the video and write it down this point. Okay, but in the class that we have solved the question today. Okay, so remember that here, in that question here, it is mentioned that here now, it is 2,000. How much it was? 2,000. And when we had done the buyback, that was just, I think that it was just, how much it was that here? That was just, 600 that year. So 600 was the face value of the buyback. An issue is more than this, so completely covered. More it can be, an issue can be more, but if it is less, it means remaining is out of profit. Okay, so that is for today. Okay, I don't want to take the last question because there is so much concept that we'll discuss in class today. Redemption of preferential, buyback, or then the cancellation of own debentures, these ESOP. Just go through this. Okay, just do the revision and solve those 3 homework questions. And tomorrow we'll solve one last question on it, and then we are going to solve all the case scenario with the MCQ of this buyback of securities chapter. That is for today. Take care all of you. Bye-bye. Hello all of you. I hope you all are doing good. In our previous session, we discussed about so many things about the redemption of preferentials. Yes. And then we also discussed about the employer stock option plan and cancellation of own debenture. Okay. So what we'll do that here, one question is pending. We have to solve that question. That is question number 9. And here in question number 9, all those points are covered here. That is redemption of preferentials, buyback, cancellation of own debenture, and ESOP. Okay, if that is employee stock option plan. So I hope you have solved question number 12, 14, and 15, which I gave you as homework. So now come to question number 9. Come to question number 9. Okay, now it's IC study material question. Now they say Extra Limited, a non-listed company, furnished you with the following balance sheet as at 31st of March 2021. All figures are in lakhs. Okay, rupees in lakhs. No. Now equity and liability shareholders fund, note this A point share capital, note 1, 120, reserve and surplus, note 218, non-current liabilities, long-term borrowing, note 3. There is amount is 4, current liability only trade payable 70, asset, non-current asset, property, plant and equipment 50, non-current investment 120, current asset, cash and cash equivalent 142. Then here notes to account, first share capital. Okay, that is authorized, issued and subscribed capital. Equity shares of rupees 10 each, fully paid 100, 9% redeemable preference shares of rupees 100 each, fully paid 20, 120 is total. Then your reserve and surplus, capital reserve 8, revenue reserves 50, securities premium 60. Long term borrowings, that is a 10% debenture, which is 4. Okay, now here the company redeemed the preference shares at a premium of 10% on 1st of April 2021. So what they are doing first, they are doing the redemption of preference shares. Okay, redemption of preference shares. So this is the point which is on redemption of, is it visible? Yeah. Redemption of preference shares. Okay. It also bought back 3 lakh equity shares of rupees 10 each at rupees 30 per share. The payment for the above was made out of huge bank balance. It is not mentioned that they're issuing shares. It means this buyback is out of profit only. So one adjustment is on what? Buyback. Then it includes that here in its investment, where investment in own debenture costing rupees 2 lakh, face value rupees 2.2 lakh. These debentures were cancelled on 1st of April 2021. And then this is point on cancellation. Cancellation of own debenture. Cancellation of own debenture. Okay, now what we'll do that? We'll do the revision as well here. I will explain you again that a cancellation. Then okay, then is the 4th point is on ESOP. This is the ESOP means employee stock option plan. The concept that we discussed in our previous session. The company had 1 lakh equity stock option outstanding on the above mentioned date to the employees at rupees 20 when the market price was rupees 30. This was included under the current liability. Let me tell you one thing is that still it is mentioned that in the IC study material that it is a current liability, it is mentioned there. But in reality, as I told you yesterday, this employee stock option plan is not a part of current liability, it is a part of reserve and surplus. So on liability side, it was previously, I mean to say previously that it is amended few years ago that it should be part of reserve and surplus now. But in ICAI question it is mentioned this was included under current liability, which is not correct. It should be part of reserve and surplus only. But it's okay if it is mentioned current liability. Okay. On 1st of April 2021, employees exercise their option for 50,000 shares. So don't worry, I will explain you in detail this point. This is ESOP. ESOP means employee stock option plan. Okay, employee stock option plan. So employee stock option, the plan that here. Okay. Now we'll start that here one by one. They ask us to pass the journal entries of the above and to prepare the balance sheet. So first we'll pass the entries one by one. So write down here journal entries in the books of Extra Limited. Write down your rupees in lakhs. Okay, it will take around 2 pages because there are so many entries. Okay, okay. Draw this for 2 pages. Okay, now write down here. Okay, now write down here date. Now your debit amount, credit amount. Okay. Now one by one. First, what we'll do that we'll pass entry for, because it is mentioned in point number A that first that is related to redemption of preference shares. So write down there redemption of preference shares. Redemption of preference shares. Okay. So when we talk about redemption of preference shares, beta, do you remember that I discussed with you that yesterday? First we pass entry of due. Okay, that first due, then payment. Okay, then write it of premium. First we'll pass that here now. Preference share capital account debit to preference shareholder account. Okay, so we are doing the redemption at what? Premium. So preference share capital will always be debited by face value because we record capital always at face value. The premium will go at premium on redemption of preference shares. Okay. Now pass entry there. Date 2021. Okay, 2021 April 1st. What's the name of preference shares there? It was a 9% preference shares F20. Okay. So 9%
preference share capital account should be debited 20. Premium on redemption of preference shares. How much is mentioned there? 10%. So 20 lakhs, this is multiplied by 10%, that will come to the preference shareholder account. To preference shareholder account 22, being redemption of preference shares due. Okay, being redemption of preference shares due. Okay, now what entry we pass? Then payment to preference shareholder. Okay, so write down there what entry we are paying to the preference. We are liable to pay to preference shareholder, so we are paying them. So preference shareholder account debit to bank account. So preference shareholder account debit 22 to bank account 22, being payment to preference shareholder on redemption. Okay, now please understand, very important point that I want to discuss with you here. What are the entries that we pass in case of redemption of preference shares? That the entries that we pass in, just give me a minute. Okay, now first entry we pass for the due, so that is we are liable to pay. Okay, second entry we pass payment to preference shareholder. Correct. Third, premium on redemption of preference shares adjusted. Correct. Premium on redemption of preference share adjusted. Now I told you yesterday only that these premium and redemption of preference shares we don't adjust against securities premium. Buyback it's okay, but here we don't. In case of redemption of preference shares, we don't adjust against the securities premium. So how much is the premium and redemption of preference shares? Just 2. You will tell me, sir, what's the problem? So you don't want to adjust against the securities premium account. We have enough balance in. We don't want to adjust in securities premium. We have enough balance in revenue reserve. So adjust against the revenue reserve. I will tell you that here now. We'll do it. We will do it that way. Just for a reference, we will do it at the end. So it is not like I am not passing the entry. We will pass entry at the end. Let me write it down at the end. We'll do that. I will tell you later on. Why? I will tell you later on that here now. Okay, but we'll pass entry. How much? Premium or redemption of preference, we'll write it up at the end. Okay, don't worry. Now, why I'm doing it, I will tell you later on. Now, the fourth entry that here. Then it is not out of profit. Sorry, it is not out of fresh issue option. It is out of profit. So we have to transfer to CRR. So how much you have to transfer? The face value. The face value of the preference share capital, we are doing the redemption here 20. So do we have a balance in revenue reserve? Yes, we have balance of 50 here. So no problem. So we'll transfer from revenue reserve to CRR. So revenue reserve account debit, revenue reserve account debit. How much is 20? To capital redemption reserve account 20, being face value of preference shares redeemed out of profit transferred to capital redemption reserve account as per law. Okay, so we pass the fourth entry, that is transfer to CRR. Okay, now understand this one. So don't worry about to write it of the premium or redemption of preference share. We pass that entry, but we'll do that at the end. Okay. Now the second point here, it is on, first point done. Now second is on the buyback. Okay. So we will pass the entry on buyback. So write down there. Buyback of equity shares. Buyback of equity shares. Okay. What entry we pass for buyback? We purchase, we do the cancellation, premium on redemption of premium on buyback, we adjust, and fourth is CRR. Okay, first we purchase here. So write down the equity share buyback account debit. Equity share buyback account debit. How many shares we are doing the buyback here? 3 lakh shares. What is the price? 30. The share is of rupees 10. We are doing buyback at what? 30. So equity share buyback account debit. 3 lakh shares multiply by rupees 30 we are paying. So that will come how much? 90 to bank account. 90. So being 3 lakhs equity shares, 3 lakhs equity shares of rupees 10 each bought back at a rate of rupees 30 per share. At a rate of rupees 30 per share. Okay. So what entry we pass that here now? We pass the entry of what? Here we purchase. Okay, then what is the sequence? Then we do the cancellation. Okay, now what entry do we pass when we talk about the cancellation? Share capital should be debited, but share capital will be debited by face value. But the share is of rupees 10. We are doing the buyback at 30, so that is a premium on buyback 20. Okay, so write down that here. Equity share capital account debited. Equity share capital account should be debited here. That is 3 lakhs shares multiply by face value is 10. That will come 30. Now premium on buyback account debit. Premium on buyback account debit. 3 lakh shares. How much is the amount of premium? 20. Because the share is of rupees 10. We are doing buyback at what? 30. So 20 multiplied by 3. That will come 60. 60. Now we debited your equity share buyback account. Now we'll cancel them, credit them. So to equity share buyback account. How much it is? 90. Okay. Being cancellation of shares bought back. Of shares bought back. Okay. Done. Now here. Now understand this one. Now what is third entry? That the premium on buyback should be adjusted. Just listen carefully. Now here, third entry, premium on buyback, it should be adjusted. But I will do it same here also at the end. So in both the cases, in case of redemption of preference shares beta and in case of what? Buyback, I will pass these two entries at the end. Okay, premium on redemption of preference shares. What happened? Okay. Now premium on redemption of preference shares and premium on buyback, that
premium on buyback, it can be adjusted. It should first priority should be given at least against the securities premium. So both the cases I will do that, but at the end, and I will tell you why. Okay, I will tell you why. Okay. Now, third point. What is the third point? That is included in its investment. What is the price of the investment? That investment in own debenture, it is included. You purchase at what price? 2 lakh. But the face value of those debenture is 2.2. So we want to cancel them. We cancel actually in 1st of April. So debenture is a liability. So I will cancel these liability of 2.2 and I will cancel these assets that I have purchased this investment own debenture from the market or own debenture. I will cancel, but difference will come 0.2. That is the profit because we are cancelling liability by 2.2 and asset is again the asset of 2. So 0.2 is our profit. Okay. So now write down there. Now we'll pass entry 4. Okay. Okay. One more entry will come that here in case of buyback. Okay. That is transfer to CRR. Okay. So pass entry first, transfer to CRR. Okay. Write down there. Revenue, reserve account debit. What is the face value of buyback? That is 30. Okay, so revenue reserve account debit 30 to capital redemption. Okay, to capital redemption. Reserve account 30. Write on being face value of buyback of shares out of profit transferred to capital redemption reserve account as per law. Okay, so we transfer to CRR also. Okay, now what we'll do that here now, we transfer to CRR. Okay, because it is out of profit, not out of fresh issue of shares. Now we'll pass into cancellation of own debentures. Give the heading there, cancellation of own debentures. Cancellation of own debenture. Now understand this part. What is the face value of debenture there? Which is mentioned that here now. What is the face value of debenture? Is 2.2. And we purchase these own debenture from the market at what price? 2. So we are cancelling the liability by 2.2. The same thing that we purchased from the market at 2. So first we'll cancel the liability. Okay, we will cancel the debenture and the debenture is liability. So decreasing liability should be debited. So write down that here. What is there any name of debenture? Yes, 10% debenture. Okay, write down there. 10% debentures. Account should be debited here. That is 2.2 to investment in, not decrease in asset. Okay, investment in own debentures account. Write down in bracket investment. That is 2. Remaining will go to capital reserve. To capital reserve account. Write down in bracket profit on cancellation of own debentures. 0.2. Okay, now write down there. Now being cancellation. Why we transfer the profit to capital reserve? Because it's a capital nature profit. Okay, being cancellation of own debentures and profit on cancellation. Profit on cancellation recorded. Okay, profit on cancellation recorded. Okay, now understand this one. The next one. Now here, if you go that here, last point is on ESOP that here. They say the company had 1 lakh equity stock option outstanding on the above mentioned date to employees at rupees 20 when the market price was 30. So how much was the market price that year? Market price was how much? 30. So market price was 30. I discussed with you the same thing yesterday. Okay. How much is the exercise price? That is the offer price is how much here? 20. So market price is 30. Offer is 20. So here the discount, the option discount will come how much? 10. This was included under current liability. It should not be included under current liability. It should be part of reserve and surplus as in that stock option plan outstanding. Okay, but okay, ICAI say current liability, say current liability, but they also know that it is a part of reserve and surplus. Now on 1st of April 2021, employees exercise their option 50,000 shares. Not the time. We discussed this entry yesterday that year. Okay, how much that they have received, bank account should be debited. So they offered 1 lakh shares. They offered how much? 1 lakh shares. But how much they accepted? Only 50,000. So it is an option, not compulsion. So we are offering them that 1 lakh shares, but they don't want to purchase 1 lakh. They purchase employee how much? Only 50,000. So write down there. Now write down there. Exercise of ESOP. Exercise of what? ESOP. Write down their bank account should be debited here. 50,000 shares multiplied by rupees 20. Why 20? Because we are offering them at 20. So we receive at the rate of rupees 20 per share. So how much it is? 50,000 multiplied by 20, that is coming 10 lakhs. So rupees in lakhs, so just write down there 10. So what is this? This is the amount received. Okay. Now how much is the here? The discount amount, that is 10. So we call it ESOP. We call it ESOP outstanding account should be debited. So where we do the adjustment of it, we discussed it yesterday. ESOP outstanding. Okay. So ESOP outstanding will adjust only for 50,000 shares because they are purchasing only 50,000 shares. How much is the amount of discount? 10. So here it will come 50,000 multiplied by 10, 5 lakh. Okay. Now we are issuing the shares. So equity share capital account should be credited. Equity share capital account should be credited here. That is 50,000 shares. And what is the face value of share? 10. So it's just a coincidence that here now, here it is also coming 5. Okay. There is no connection of ESOP outstanding and equity share capital. 5. They are not like brother and sister there. Okay. It's a coincidence. Now remaining amount will go to securities premium. So securities premium account. Securities premium account. That is 50,000 shares multiplied by 20. It's market price minus face value. That will come 10. It's just a coincidence. 10, 5, 5, 10. Okay, but there is no. I'm to say it's a coincidence. Here 10, here 10, 5, 5 like that. Okay. Anyways, now understand this point here. What is this bank account? What this bank basically represent there? This bank amount represent the amount received. So amount received. Here what this is amount of a discount. We are adjusting ESOP outstanding. Okay. Now equity share capital, this represent what? Face value. And this is the amount of how we calculate here security market price minus face value. Okay. The market price how much? 30. Face value how much? 10. So 20. Okay. Now write down there being 50,000 shares allotted under employee stock option plan. Okay, under employee stock option plan. Now remember that I told you that here that premium on redemption of preference shares and premium on buyback, we'll do the adjustment of those, but at the end. So now we will do that. Write down there premium on buyback and redemption of premium on buyback and premium on redemption of preference shares written off. Okay. Now please understand that here.
I told you earlier that here now, to write off the premium on buyback, we give first priority to securities premium. So how much balance we have in securities premium? We have balance in securities premium 60. How much is the premium on buyback is? Premium on buyback is 60. Okay, here 60, but we issue shares in premium. So we have basically securities premium, we have these 60 we have it, and here we issue, here 10 we have. So that's 60 and these 10. So total we have 70. How much is the premium on buyback will adjust? Premium on buyback is how much? That is 60. So we have total in securities premium 70. We'll adjust this 60. What about the premium on these premium on redemption of preferential? That is 2. Now I told you yesterday, I know that these two we don't adjust against the securities premium as per section 133 of Companies Act. Okay, because if the specific company were following the accounting standard and all that, so it is not allowed to them to write off the premium on redemption of preferential against the securities premium. But that's why we avoided that. But we have no other option. You know why that here? Because these revenue reserve has been fully utilized. Because why fully utilized? Here you transfer to CRR in case of redemption of preferences. So you utilize 20-year revenue reserve, and here you utilize revenue reserve 30. So 20 plus 30, 50 full amount that we have already utilized here. So we don't have any balance in revenue reserve. So we have no other option but to adjust the premium redemption of preferential also against the securities premium. You got the point? Okay. So write it down that here now. If we have no other option, that's why we are doing that. Okay. Premium or redemption of, premium and buyback, no problem. But premium and redemption of preferentials, we generally don't write it off against the securities premium. But we have no other option because we don't have any balance in revenue reserve now. That's why we have to adjust against the securities premium only. The securities premium account should be debited here by 62. You will buy 62, 60 plus 2. You will understand. I'm passing combined entry here. To premium on redemption of preferences 60. Sorry, premium redemption preferential not 60, it was 2. To premium on buyback account 60. So being premium on redemption of preferences and premium on buyback adjusted against securities premium account. Securities premium account. Done? Okay. So we passed all the entries at it. Okay. But remember one thing is that when we will solve the question that here now, okay, basically these two things that I want to discuss with you. These ESOP outstanding is a part of reserve and surplus that here, okay. But it is mentioned in question that here now, write down there, included in current liability, mentioned in question. So we will also consider it as it is a part of current liability only. But in reality, it is not a part of current liability as per Schedule 3. It should be a part of reserve and surplus. But okay. Now one more thing. I don't want to, I'm to say here when I discuss with you, I want all of you to go in depth. Then you will get 80 plus in advance accounting. Now understand that here. I told you yesterday that here the same figure that we debited a ESOP outstanding by 5 lakh. And there was, we offered them 1 lakh. Same figure. What I have considered. Same figure mentioned in question. So you offered them 1 lakh shares. The amount of discount is how much here? 10. So 1 lakh multiplied by 10, that is 10 lakh. But still there is a balance in that ESOP outstanding 5 lakh. I told you yesterday that
balance of ESOP outstanding be transferred to general reserve. But it should be done after the expiry of the, or once the exercise period has been passed. It is not mentioned in question that here that exercise period has been done and okay, now there will be no offer open for the if they want to purchase and all that. So we will not do anything that time. So we will not pass this entry that day. They ask you only this exercise entry. Okay. So still there is a balance in ESOP outstanding which is a part of current liability. So okay, it is not mentioned that exercise price has been expired. That no, it is not mentioned that. So we will not do anything there. Just we have to pass the entry of what these exercise that we have already done. Now what we will do that here now. They also ask us to prepare the balance sheet. You know that here when we prepare a balance sheet, you have to keep in mind these rules that which is very important. Just give me. Okay, we have to keep in mind. Okay, so what we'll do that here, we'll draw a format of balance sheet. Okay, but remember these rules, very important. Okay, now write down there. Balance sheet of Extra Limited, name of entity is Extra Limited, as on 1st of April 2021, rupees in lakhs. Okay, now here rupees in lakhs. Write down there, note amount, equity and liabilities. Shareholders fund, share capital, reserve and surplus, non-current liabilities, okay, non-current liabilities, then long-term borrowings, then current liabilities, in question and current liability only one point is mentioned, trade payable. So we'll say only, we'll write it down trade payable here only. Okay, then we have here asset, non-current asset, non-current asset. Write down there in non-current asset 3 items: property, plant and equipment, intangibles. Write down there beta, intangibles, non-current investment, then we have current asset. In current asset they say cash and cash equivalent only, cash and cash equivalents. Okay, now do the total there. I'm going to say, okay, now here write down the notes to account. How many notes to account that they have prepared in question? We'll prepare the same notes to account. 1, 2, 3 only. We'll make a notes to account on trade payable also. The reason is that there is the adjustment of ESOP outstanding and they say which is a part of current liability. So we make 4 notes to account that here: share capital, reserve and surplus, long-term borrowing and trade payable. Okay, all of you have written this. Now one by one we'll go to balance sheet that here. Go to balance sheet and we'll start from notes to account number 1. The first is notes to account number, that is 1. How much is the amount of share capital? That is what happened. Okay, 120. You go to notes to account number 1. Authorized, issued and subscribed capital, that is 100. But these equity share capital, sorry, first that is 100. But we have done the buyback here. But how much buyback that we have done? If you go to equity share capital, we debited here by 30. So you remember that, type in your calci 100 we debited by 30, so I will minus 30. Why 30 minus? Because capital has credit balance. Capital has credit balance. So what we do, that if we are crediting them, we have to add. If we are debiting, we have to deduct. So what we have done that here, we have debited them. We have debited them by 30. So what we'll do, that we will deduct by 30. So we have 70 now. But also we have issued capital here of 5 here, this 5. So we credited equity share capital. We have to add them. So plus 5. That is coming how much? 75. Okay. So write down there. Write down there. Notes to account number 1. Notes to accounts. So here we have authorized. Okay. So notes to account number 1. Share capital. Share capital. Okay. Now authorized, issued, write down there, authorized, issued and subscribed capital. Okay. Subscribed capital. Okay. Authorized, issued and subscribed capital. Okay. Write down there, equity. What is the price of the share? Equity share of rupees 10 each. Okay, equity shares of rupees 10 each. 75. How we calculate this 75? It is mentioned in balance sheet 100. Then we have done the redemption of buyback of 30. Then we again issue that here of 5. So that is coming how much? 75. Now, if you go to balance sheet, that now the next item is how much? 9% redeemable preference share 20. So 20, but in our journal entry, we already have done the redemption of, we debited by 20. So 20 minus 20, that is how much it is coming? 0. 20 minus 20 is 0. Okay. So write down this share capital, beta. How much is the amount of share capital? 75. So write down your share capital 75. Okay. Now next, notes to account. Notes to account number 2. Reserve and surplus. Write down there, reserve and surplus. Okay. If you go to question that here now, for reserve and surplus, they tell us to go to notes to account number 2. That is totally 118. When we go to notes to account number 2, we have a capital reserve. So type here capital reserve. Capital reserve. How much is capital reserve that we have here? The capital reserve here we have, which is mentioned in question, that is how much? 8. So write down there 8 in inner column. But if you go to journal entries, you will see that here. I remember that is the profit on cancellation of own debenture. So we transfer to this capital reserve here. So we credit it. The reserve has credit balance. We credit, so we have to add them. So we'll add this 0.2 there. So write down there, add profit on cancellation of own debenture. Profit on cancellation of own debenture. That is coming here 0.2. The total is how much? 8.2 that here. How much is the total that here now? 8.2. Now what is the next item that here now? When you go to the next item, that is what? Revenue reserve. So write down there revenue reserve here. Revenue reserve. How much is total revenue reserve? That is 50. That how much is total revenue reserve? 50. But we utilize this revenue reserve that here. Where we utilize that bit to transfer to CRR. So you can see that here. Here we utilize this revenue reserve 20 to transfer to CRR at the time of redemption of preference shares, and at the time of buyback we utilize this CRR 30. Okay. So write down there. Let's transfer to
transfer to capital redemption reserve on redemption. How much? 20. Again, less transfer to capital redemption reserve on buyback 30. So here it will come how much? Nil. Okay. Now next is that securities premium 60. Write down here. Securities premium 60. Okay. Now securities premium. Okay. First we issue. So we have credited here the securities premium by 10. So crediting, reserve as credit balance. We are crediting them. So we'll add here. Okay. 10 will add. Then we utilize that here by 62. Against that premium, we adjust premium redemption of preferential, premium on buyback. First we'll add. Write down there. Add. Okay. Shares issued against employee stock option plan at premium. How much we? That is 10. Then we utilize against the premium or redemption of preference shares and all. Okay, so write down less adjusted for premium on redemption to adjusted for premium on buyback. That is how much? 60. So in outer column it will come 8 only. Okay, so we have written all reserve and surplus which is mentioned in balance sheet beta. But one thing, we created CRR. So write down here capital redemption reserve. Capital redemption reserve we create how much? First we credited here by 20 and then we credited here by 30. Total is 50. So 20 plus 30, that is how much? 50. Okay. Now do the total of all reserve and surplus and write it down in balance sheet. 8.2 plus 8 plus 50. That is coming 66.2. 66.2. So write down there 66.2. Okay. Then go to balance sheet. Third note stock on long-term borrowing. That is a 10% debenture. That is 4. But in our entry, we debited to 10% debenture by 2.2. So it's a liability. When liability here, when we debit them, we have to deduct them here. So what we'll do that here? These debenture will be that here. Where is that debenture? It's 2.2. We'll deduct from them. So write down their note stock on number 3. Note stock on number 3. Long-term borrowings. Long-term borrowings there. Write down the 10% debentures. That is 4 minus 2.2. That will come 1.8. Okay, write down in balance sheet 1.8. 1.8. Okay, 1.8 it is not 18. Okay, 1.8. Then here, next is that we have here is a trade payable is 70. But remember that in these trade payable beta, that ESOP outstanding is already part of this trade payable which is mentioned in question. So trade payable is 70, but here in our entry we debited to this ESOP outstanding this 5, and they said it is a part of the current liability only. So we have to deduct this 5 from there. First of all, it's a liability. When you debit to liability, it should deduct that. So how much is appearing in my balance sheet? 70. We debited here by 5. ESOP outstanding. So we will deduct 5 there. In reality, it is a part of reserve and surplus, but it is mentioned as a part of current liability. So we will not argue there.
So ICAI will say, okay, it is a part of current liability. Okay. So go to notes to account number 4 and write down there. Write down there trade payable. Write down there trade payable. Trade payable is how much here? Is 70, which is mentioned there, but we've debited it. Okay, but 5. Let's adjusted for ESOP outstanding. ESOP outstanding. 5. So it will come 65. So write down in balance sheet 65. 65. Now what we'll do that? We'll write it down of these PA, this asset side. So PP, no change in PP, as it is 50 will come there. As it is 50 will come. Intangible, no intangible. We have investment here 120. Okay, we have investment. How much investment we have? We have investment here. For reference, I am writing here 120 we have. Okay, in our entries that here, now we credited to investment account that here by 2. Okay, it's an asset. When we credit, we deduct them. So minus 2, it will come 118. 118. Okay, now we'll write it down. Cash and cash equivalent balance. How much is given in question? That is 142. Okay, so I will write it down here 142. In our entries, first entry, no cash or bank. Second, we have credited by 22. We have credited by 22. Okay. Then here, no bank, no, we are credited by 90 here. We credited here by 90. Okay. Then here, again here, we debited by 10. So we have to add them. Okay. Add 10. 10 or 20 it was 10. Okay, 10. Now do the total. 142 minus 22 minus 90 plus 10. How much it is coming? 40. Now do the total of balance sheet. That is 75 plus 66.2 plus 1.8 plus 65. 208. Now total of assets side should also come 208. 50 plus 118 plus 40. Okay, now 208 total is coming that here. Okay, now understand. Now there are so many things that here now, small thing that I want to discuss with you that here. Okay, so I will discuss with you now. First, for my reference, I am writing that here now is we'll do the revision of chapter. Okay, we'll do the revision from the repeats all the concept. Quickly we'll do the revision. Okay. Then we are going to solve the MCQs, but remember that here in these chapters it is going to take so much of time for MCQ because there are 6 case study based MCQ. So here I will teach you what should be the approach when you solve the MCQs question of case scenario based. Okay, so we'll solve those, and then at the end I will tell you the last minute mastery question, and tomorrow we'll start a new chapter. Okay. So I think there's no need for the break now, okay, because we'll do the revision that here now. Then we'll solve some questions and the MCQ question that here that will take some time, case scenario based question. Okay. Now here, come to rapid this. As you can see that we'll do with here, you can see that the meaning of buyback. Let's do it from here only. Okay. So we'll do the revision here of each and every point, and then what we'll do that, then we'll solve MCQs. Okay. Now understand this. Because I want to mean a buyback. Buyback means to purchase our own equity share and then cancel them. What are the objectives here? To boost EPS that here. I told you that earning per share is going to increase because when we do buyback, a number of shares is going down. So we calculate EPS, basically profit divided by number of shares, that you will learn in detail in accounting standard 20. So if denominator goes down, obviously the value will increase. So EPS will increase here. Promoters holding also increase because when you do the buyback, you do the buyback of outsiders shares. Okay, we discuss the hostile takeover. So we don't give so much of share to outsider. We do the buyback. Okay, so that's why we discuss the hostile takeover. It should not happen all of a sudden. One day we come to know that here all outsider come together and they form a company and they take over our company. Okay, it should not be happen. Support the share price if it is undervalued, correct? Because we purchase at a higher price. if you have surplus cash that we used to do the distribution at the time of buyback. We can do the buyback out of profit, out of fresh issue of shares. When you say out of profit, we can utilize free reserve as well as securities premium. Not important these conditions. Okay, now this is important. Three tests, resource test. 25% of paid up capital free reserve, and that is divided by buyback price. Here in case of share outstanding, 25% of the outstanding number of shares. Third is the debt equity ratio, that here a debt that is a long term and short term after buyback, it cannot be more than the twice of the paid up capital and free reserve, that is. So we calculate in these three steps. First we calculate, write down the debt amount, then we take the 50% of that should be minimum maintained existing, and then we through a simultaneous equation we find it out how much is the fund is available that for the purpose of buyback. The reason is that we have to transfer the CRR as well. So we find out the value of X and Y through the simultaneous equation. Now this will help you so much today when you solve MCQ, that here the shortcut way to find it the maximum number of shares that we can do buyback as per the debt equity ratio test. So I will tell you that existing paid up capital free reserve minus 50% of debt, whatever comes, divided by buyback price plus face value per share. That's it. You will find it out there. Okay. Now journal entries, no need to do it. It's very simple that we have already done so many times that here. Okay. Still okay. Where out of fresh issue, what the new thing is that when we issue the fresh issue of shares, so we pass the entry bank account debit to share capital. If it is premium, bank account debit to share capital, securities premium. Now three entry purchase, equity share buyback account debit to bank account, then we do cancel. Equity share capital to share buyback. If it is at premium we purchase, the share capital face value will come, equity share capital account debit, premium and buyback account will debit, and equity share buyback account will credit here. Now premium on buyback will adjust against the securities premium, profit or loss account, and then general reserve, that is. Okay. Now redemption, it can be out of profit or it can be out of fresh issue of share. How we pass entry in case of out of profit? When it is out of profit, only one thing that here we have to transfer to CRR. Okay, so we utilize general reserve, profit and loss account, and if no balance is here, then we utilize the securities premium. Okay, then we transfer to CRR. Now, if it is a combination of both of them, so write down first we say face value of the shares bought back minus face value of the shares issued, whatever comes, then the balance is out of profit. Remember that if it is specifically mentioned in the question that it is out of fresh issue of share, then only we consider. Otherwise, always you have to assume that it is out of profit only. Now, what entry do we pass for the sale of investment, that here now? If it is a profit, so bank account debit to investment, that is a cost, balance is the profit. If it is loss, the loss should be debited. So we are debit to profit and loss account. Now general entries on redemption. Remember the sequence that here now is the redemption of preference shares. It may be at par or it may be at premium, that here. The first entry pass of the due. So share capital account debit to shareholder account. If it is premium, so share capital at face value, premium on redemption debit to preference shareholder. Second entry pass for payment. So preference shareholder account debit to bank account. Third is the adjustment of premium. I told you that in section 133, say we cannot utilize the securities premium to write to the premium or redemption of preference shares. If we don't have a balance in P&L account and general reserve, so then we utilize on the year. Okay. Then we transfer to CRR if it is out of profit. General reserve debit, P&L debit to CRR account. Now, same thing that what I've discussed, that it may be combination of both of them also. Okay. Now bonus shares always give first priority to CRR account. Why first priority should be given to CRR account? The reason is that CRR account can be utilized, capital redemption reserve account can be utilized only and only one purpose, that is for the bonus, that is. So if you are issuing the bonus shares, always try to utilize them first. The CRR account debit, general is the profit and loss account debit to bonus to shareholder. Then we pay to them. So bonus to shareholder account debit, what we are giving in equity share. Okay. Now general entries on cancellation that we discussed in our previous session. Debenture account debit by face value, investment in own debenture by cost, and balance will come to profit, and this is a capital nature profit, it will transfer to capital reserve. ESOP entry bank account should be debited with the amount received. ESOP outstanding will be debited with the discount amount. Share capital will be credited by the face value, and the balance here, the balance will come securities premium account, that is market price minus the face value. Okay. Now investment tomorrow. Okay. But new chapter will start obviously tomorrow. Now what I will do that here now, I will, one more thing, then I have to discuss with the homework as well. Now. Okay. Now what we'll do that here now is the second, that is MCQs. Okay. Now come to MCQ book that. Okay. Come to MCQ book that. Now understand this point here. In MCQ book that here, we have questions here, two type of question that here now. First is on the chapter individual basis that here. Okay. So go to page number 4 plus. 4 first, go to page number 4. Okay. Now here, this is a very simple ICAI study middle question. Very simple that. They say, as per section 60 subsection 1 of the Companies Act, buyback of own shares, okay, buyback of own shares by the company shall not exceed how much? 25%. This 25%. First answer is correct on 25% of paid up capital free reserve. Okay, 20%, 15, 10. They have not mentioned in law. Okay, maximum is 25%. The company are permitted to buy back their own share out of free reserve and securities premium. Correct. Out of from proceed of the issue of any shares. Yes. So both answer A and B. That it can be out of fresh issue of share and it can be out of profit. Answer is C. Now here, when a company purchase, okay, when a company purchase, okay, when a company purchase its own share out of free reserve, the sum equal to the nominal value means face value of shares so purchase shall be transferred to where? CRR, capital revenue, capital redemption reserve account. Answer is B. Now state which of the following statements is true. Buyback is for more than 25% of the total paid up capital and free reserve of the company. If they say which of the statement is true, so buyback is more than, not more than, maximum 25%. So this is not correct. Partly paid up shares cannot be bought back. Yes, one more thing. If you remember that here in this condition, it is mentioned in rapid that here. Okay, partly paid up shares here. No, where is it? Yeah. All shares for the buyback must be fully paid up shares. Partly paid up shares cannot be buyback here. So partly paid up shares cannot be bought back. This is correct answer. This answer is B. Buyback of equity share any financial exceed to 20. It cannot be exceed the 25%. Partly paid share can be bought back. No, it cannot be bought back. The correct answer is B. Now fifth one. Now premium that is excess of the buyback price over the par value paid on buyback shall be adjusted. Okay, the premium on buyback it can be adjusted against the free reserve, it can be adjusted against the securities premium. Answer is C. Both A and B are correct. Okay. Then here, okay. Then here, advantage of buyback of shares include to encourage others to make hostile. We are not encouraging, we are discouraging them. Decrease the promoter's holding will increase. Now here, discourage others to hostile. Discourage others to make a hostile bid. Okay, so answer is C, the correct answer. Okay, done. Now very important part here in this chapter. Okay, if you go here, you can see that here now case scenario based. I'm not talking the normal MCQ. The main MCQ now we are going to start that here. So you can see that here now in index that on a case scenario base we have here how many questions that we have? We have 6 questions on case scenario based on buyback of securities idea. Okay, so you have to, how many questions that we have? 6. So we'll solve all of them. It will take time, but no problem. We'll start from question number 90. Page number 91. Okay, so go to page number 91. Go to page number 91. Okay, page number 91. Okay. Okay, let me tell you what should be the approach to solve these questions. That there are 6, the case scenario based we are going to solve now. Okay, now what should be the approach to solve these questions? Never ever read these para. You will say what you are saying, sir. I mean, first, never ever read this para. As you can see that here now, here I will tell you what should be the approach beta. Here you can see that here. Okay, this. Don't never in examination read it first. Otherwise, what is it? It is time. You will read it. Then you can see the how many questions they are asking on those para. 1, 2, 3, 4. 4 questions? Yes, only 4 questions. Okay. Now, what happens if you read these para? If you read these para, and then you will read these again. Okay. Then again you have to read these para. That is time. In examination, you know that these case study come for 8 marks. Okay, 8. I'm going to say whatever 8 marks generally one case study come. It might be come for the 10 marks. Let me take 8 marks only. So to make it simple, you have total 180 minutes divided by 100 marks, that is 1.8. 1.8 multiplied by 8. So one case study that you can give 14.4 minutes on an average. Let's say the 40 minutes you have for one case study. So if one case study you have to cover in 14 minutes, how it can be possible that here? If you read the para, if you read the question, then again you have to read the para. It is time consuming that. Don't do that. Your target in examination should cover these in 10 to 12 minutes. That's it. So what should be the approach? Step number 1, here just you have to go there. Find it out what they're asking. By using the share outstanding test, okay, number of share that can be bought by. The share outstanding, number of share that can be bought by. Keywords is highlight. Okay,
Keywords, just highlight that. Okay. It means your outstanding of the number of shares that can be bought back as per the share outstanding. Okay. Second, by using a resource test, number of shares that can be bought back. No need to read this option. No. In 1 minute in examination, you have to first highlight all keywords there. Third, using the debt equity ratio test, number of shares that can be bought back. That's it. No need to read option law. Now on the basis of all three tests, maximum number. So on the basis of these three, maximum number, least of the above. Okay. Now it means they are asking us that here, calculate the maximum number of shares that can be bought back as per the share outstanding test, resource test, and debt equity ratio test, and on overall basis. Simple. Now in examination, just in 1 minute, you have to highlight the keyword of the case study. Case study with no need to read these paras first. From the question that they're asking you, just highlight what they're asking you. That's it. It should not take more than 1 minute. For 4 questions, you can give the maximum 15 seconds for each. Just to highlight, you have 15 seconds. Just read the title, 15 seconds, that's it. So within a minute in examination video, you have to highlight the keywords here. Okay. Now we'll read that here. Now you know what they have asked you that. Okay. Now you'll read it that here. Now your mind automatically think from the point of view what they've asked you in the question that here. It automatically will think like that because you know that what they're asking us. Okay. So what happened here? It says that Caser Limited, a company engaged in a various business activity, has decided to initiate a share of buyback on 1st of April 2023. Now the company plans to repurchase how many shares? 25,000 equity shares of rupees 10 each at a price of rupees 20 per share. So they want to purchase share of rupees 10 at what price? They want to purchase at rupees 20 per share. I'm making a circle here of the key. These buyback initiative is in the compliance with the company's article of association and the necessary resolution has been passed by the company as part of the financial arrangement for the shares buyback. Caser Limited intend to utilize its current asset. Current asset, then look at there, basically give the indicate out of profit, particularly the bank balance, to make the payment for the repurchase share. So what happened that here now? It's one. We read the first para here. But what happened when we read it first para, that only 3 things is important for me. The 25,000 share they want to do, 10 is the face value and 20 is the buyback price. Now, here is snapshot of the Caser Limited balance sheet as 31st March 23. Share capital here, equity share capital fully paid up share of rupees 10 each. How much? 12,50,000 is the equity share capital. So I will write it down that equity share capital 12,50,000. Okay. Now what we do that here? We add the free reserve that here. Correct. So then here it says that free reserve securities premium is free reserve. Yes. So I will write it down here 2,50,000. Then profit and loss account is also free reserve plus 1,25,000. Revenue reserve is also plus 25 lakh. Okay. Long-term borrowing debt, it might be useful when we talk about what? When the debt equity ratio test. So debt debenture that have 28,75,000. Unsecured loan that they have 16,50,000. Okay. Land and building that 19 like this, it is not relevant for me anything that here. Land and building 19 lakh 30. What should I do here? Plant and machinery 18 lakh, furniture 59 lakh 20, other current asset 30 lakhs. So it is irrelevant for me. Okay. Now quickly we'll solve it. What's your outstanding test say beta? 25% of outstanding shares. Quickly. So you have to write it down like this. Okay. In the question bank book beta. So how many number of shares that we have? We have here total amount is 12,50,000, share of rupees 10 each. So 12,50,000 divided by 10, that is coming 125,000 shares. So 25% of 1,25,000 shares. That is coming here 31,250 shares. So answer of first is 31,250 shares. Okay. Now second, resource test. So resource test, how we calculate in resource test? That is 20 available. How we calculate? Available resources. So available resources is how much that here now? In examination, just to tick the correct answer. But here our focus is not on presentation. Just do the calculation and correct answer should tick there. Okay. So 25% of paid up capital plus free reserve. So paid up capital, you can see that is 12,50,000 plus free reserve is 2,50,000 plus 1,25,000 plus 25. How much that is coming? That is coming 28 lakh. 28 lakh. Just give me a minute. to 2 lakh 50, 1 lakh 25 and 15 lakh, not 28 lakh. Wait, oh sorry, revenue is right, 2 lakh 50, sorry, 2 lakh 50,000, 1 lakh 25 plus 15 lakh, not 25 lakh. Okay, so 2 lakh 50,000 plus 1 lakh 25 plus 15 lakh. How much it is coming? 18 lakh 75,000. If we do the total here, plus 12 lakh 50,000, that is coming here 31 lakh 25,000. How much? 31 lakh 25,000. So available resources is 25% multiplied by 31 lakh 25,000. That is coming here 7 lakh 81,250. Now if we say number of shares that can be bought back, okay, bought back, here is available resources 7 lakh 81,250 divided by buyback price. So what is the buyback price? That is 20 divided by 20. How much it is coming? Oh, it is coming in point. So 39,000. Okay, 39,062.5 shares. So I told you that here, should we take 63 or 62? 62. Okay, 39,062 shares. So correct answer is 39,062 shares. Answer is D. Okay, simple. So first we calculate the available resource, then number of shares. You know now, we all these steps, this is what I am doing that exactly here. Okay, now again that here now. Okay, now third, debt equity ratios. So we will solve by this shortcut trick. By shortcut trick, that is existing paid up capital and free reserve. So existing paid up capital and free reserve. Okay, we'll calculate here. Existing paid up capital and free reserve is how much? We already calculated 31 lakh 25,000. So 31 lakh 25,000 existing paid up capital free reserve minus what they say 50% of debt. So how much is debt that here? Debt, you can see that here is 28 lakh 75,000 and 16 lakh 50,000. So if I say, just give me a minute, let me write it properly for you so it will be easy for you. I will say that here now. How much is the existing paid up capital? That is coming 31 lakh 25,000. Then here, how much is the debt here? Debt is that here 28 lakh 75,000 plus 16 lakh 50,000. 16 lakh 50,000. So 28 lakh 75,000 plus 16 lakh 50,000. That is coming how much? 45 lakh 25,000. Okay. How we can for our reference we write it down. Okay. Let me just give me a minute. 39,062. Okay. Now here how we calculate it now. So existing paid up capital 31 lakh 25,000 minus 50% of debt. Debt is 45 lakh 25,000 divided by buyback price, which is 20 plus face value. Face value is 10. Why? I told you earlier also that we have not deducted is the amount of CRR that we have to transfer. So in numerator it is included CRR amount. So denominator also we have to include. So we add back. It is already included. That's why we didn't add back here. But here we have to add back 10. Okay. So here 45 lakh 25,000 multiplied by 50%. Okay. 20. Okay. 30. 25 divided by 30. That is coming as through this shortcut 28,750 share. So should we solve that here by 27? Should we solve by the simultaneous equation? No, we don't have enough time for that. Okay. So answer is 28,000. In examination, you don't have time. So this shortcut method. Okay. Done. Now last one is the on the basis of the above three, how many maximum least of the above three test. Okay, so here how much is that here now is 31,250, 39, 20, 28, 750 the least. So therefore the 28, 70 is the least. Now you got your 8 marks in exam. Okay, this is how you will get it. Okay, so please understand this point here. What is the approach? So we solve in I think in 10, 11 minutes because we didn't read this para first. Never ever read it that. Okay. Okay, simple. Okay, now we'll come to second question. Okay, now whether we have to read this para? No, we'll read it, but later on. Okay, now come here. Based on the above information, answer the following question. What is the minimum equity share that needs to be maintained after buyback according to the debt equity ratio test? So what they're asking us that here basically, minimum equity needs to be maintained. So how much should we maintain that? How much should we maintain that here? That is 50% of debt. Yes or no? As per the debt equity ratio test, how much amount should be maintained? Minimum equity that should be maintained. That is 50% of debt. Okay, for reference, write it down. Okay, then they ask you that what is the maximum permitted buyback? Now, maximum permitted buyback. They have not mentioned which method because there are three tests. Debt equity ratio test, resource test, and share outstanding. They have not mentioned point number 2. The twist will come in point number. How many shares of Kumar Limited can be bought back at rupees 30 per share according to? So here they say, here they're talking about how many shares as per the debt equity ratio test. Now understand this point. This is one connection here. First point is talking about debt equity ratio test. Correct? What the first point is talking about? First point is talking about debt equity ratio test. Correct? Third point is also talking about the debt equity ratio test, the number of shares that can be bought back. But in point number 2, what is the maximum permitted buyback equity they are talking about? Okay, I will come to that point here. Okay, what is the maximum permitted buyback of what? Equity. So that also I will assume that a maximum permitted amount they are talking about, the maximum permitted amount for the purpose of buyback. They are asking you that here. Okay, so when I say the maximum permitted amount of buyback, when we talk about that here now, this also I will consider from the context of what? Debt equity ratio test. Why? Because the point number 1 talks about the debt equity ratio test. Point number 3 also talks about the debt equity ratio test. So they are saying the maximum permitted amount they're talking about, okay, of equity for the, okay, permitted for buyback. Okay, so that also I will consider from the debt equity ratio test only. Very simple. Now we know what they have asked. They asked the 50% of the debt. We have to find it out. How much the maximum number of shares that can be bought back. So the same formula we'll calculate here. Here that is how much is your existing formula is existing paid up capital. Okay, paid up capital plus free reserve. Okay, plus free reserve minus 50% of debt divided by buyback price plus face value. Simple. This is a formula. We'll get the answer there. Okay. Now understand this. They say now, Kumar, there's so many things which is irrelevant for me in these para. We'll find it on that here. Okay. Now here also we have find out through these formula. How we have calculated this here? Through these formula only. Okay. Through these formula only. Okay. Okay. Now understand this point here. What they say that here now is Kumar Limited, a privately held company, operates in the manufacturing industry. Founded in 2008, the company has steadily growing its operations, establishing strong pressure in presence in the market. As of 31st March 2023, the company's capital structure reflects a blend of equity and the debt financing. The capital structure overview: the company has a total capital of 30 lakh invested in equity share, each value of rupees 10 and each fully paid. So how much is the existing paid up capital? 30 lakhs. Okay. Here they say reserve and surplus. Kumar Limited accumulated reserve and surplus 49 lakh. Total is 49. But we talk about the free reserve only. Comprising contribution from various, including general reserve is how much? 32 lakh 50,000. So how much free reserve we have? 32 lakh 50,000 plus then securities premium 6 lakh and P&L 4 lakh 30. Revaluation reserve is not a free reserve. 6 lakhs plus 4 lakh 30. 6 lakhs plus 4 lakh 30. Okay, this is free reserve that. Okay, 6 lakh, these three amount. 32 lakh 50, 6 lakh and 4 lakh 30. Then here it says that here, debt. How much is the debt? The company has acquired loan for an amount to raise 42 lakh. Done. So simple. Okay, so just give me a minute. Minus 50% of 42 lakhs divided by buyback price plus face value. Face value is 10 rupees. On a buyback price, they will mention. Now, buyback decision. Considering its financial position, the market condition, Kumar Limited decided to initiate the buyback program. This company intended to repurchase at the rate of what? At a price of rupees 30 per share. In accordance with the financial regulation and internal policies, Kumar Limited aim to assess the maximum number of shares can be repurchased while maintaining a prudent debt equity ratio. By utilizing the debt equity ratio test, the company seeks to strike a balance between its equity base and debt obligation. Based on the above information, answer the following. Okay, very simple. The buyback price is 30. Now calculate this. 30 lakh plus 32 lakh 50 plus 6 lakh plus 4 lakh 30 minus 50% will come 21 lakh divided by 40. That is coming 1,29,500 shares. So answer is here the B. Answer is B. Simple. This is a formula. Simple it is. So should we solve by a simultaneous equation? No, beta. Okay. Now here debt is how much? Come to first. I will come to second later on that. Okay. How much is the debt? Debt is 42 lakh. So answer will come 21 lakh. So that much should be maintained. Na? Minimum paid up capital should be maintained. Paid up capital freezer. That is 50% of debt. Okay. Now what happens? First you have to solve this and then you have to solve the second one. Why? Because they ask you what is the maximum permitted equity, permitted buyback of equity. It means what is the maximum permissible amount, available amount. That is X and Y we calculate. Okay. Now anyways that is. We can, how much shares we are doing the buyback? 1,29,500 shares. So 1,29,500 shares as per third MCQ. Okay. Multiply by what price we are doing the buyback? 30. So 1,29,500 multiply by 30. That is coming how much here? 38,85,000 that here now. Okay. So maximum permitted buyback of equity for Kumar Limited is how much that here? That is 38,85,000 that here. You got the point here? 38,85,000. Okay. So that is the maximum permitted that here. So maximum number of shares we can do 1,29,500. At what price we are doing? 30. So this is the this is coming maximum in terms of amount. Okay. This is in terms of shares. This is in terms of amount. How we find it out in terms of shares? From third MCQ. Simple. Done. So here second case study done that. So you like this approach that here beta? First you have to read the question. It will save so much of your time that. Okay. And when you will read the question, you will think from which point of view that is? You will think from the question that they ask you. So from that point of view only you will think here. Now come here. Just 1 minute. Okay. Now come to question number 3, third case study. So third case study. Now here super limited. Oh wait. First what will do that? First will be third case study. Okay. First read here. As per the Companies Act 2013 under section 62 subsection 2 68 sorry subsection 2 the buyback option any financial year. It's simple answer 25%. Okay. Now how many shares can super limited can buy back according to share outstanding? So share outstanding test, how many maximum, how many shares they're talking about. So how we calculate their share outstanding? 25% of outstanding shares. Simple. Okay. Now what is the maximum number of shares that can be bought back according to resource test? So how we calculate resource test? Okay. Available resource, that how much that is? 25% of how available resources, when they say that here now, how we calculate that here is a 25% of paid up capital, paid up plus free reserve. Now number of shares, when I say maximum, that is available resources divided by buyback price. Okay, simple. Now according to the debt equity ratio test that here now, maximum number of shares. So how we calculate? existing paid up capital plus free reserve minus 50% of debt divided by buyback price plus face value. Simple it is. These are the formulas that, okay. Now we'll calculate one by one. You have to write it down like me only that, okay. You have to, okay. Now we have to read it that here. So they say Super Limited Manufacturing Company has the following summarized balance sheet as of 31st March 2024. Equity shares of rupees 10 each. So they have, we can calculate here existing paid up capital free reserve, that is 70 lakh is equity share capital. Okay, then free reserve, revenue reserve, yes, 23 lakh is 50,000 plus securities premium, yes, 2 lakh 50,000 plus profit and loss, how much? 2 lakh. Infrastructure development reserve is not a free reserve. It's a statutory reserve, generally people create it because of the income tax, some rules in income tax. It is on a free reserve. Debt, okay, 38 lakh and 8 lakh 50. We can, okay, for our reference, you can see that that is a debt. How much is debt here? 38 lakh plus 8 lakh 50,000. So it will come here 46 lakh 50,000. Simple. Now PP current all are irrelevant for me. Okay. Super Limited plans to buy back 35,000 equity shares of rupees 10 is fully paid up on 1st of April 2014 at rupees 30. So face value is 10 rupees and they want to do the buyback at 30. Now the per share, the buyback is authorized by article and necessary resolution have been passed. The payment for the buyback will be made using the company's bank balance. Okay, which is a part of current asset. Okay. Now simple it is. Now how many number of shares that they have outstanding here is 17 lakh is the total amount, 10 rupees per, so 1,70,000. So 25% multiplied by 1,70,000 shares. So 1,70,000 multiplied by 25%, that is coming how much is 42,500 shares. So answer is B. Okay. Then here, what is the maximum number of shares that can resource test? So available resource 20 is 25% of paid up capital plus free reserve, that we have already calculated here. Okay. So free reserve is how much? Do the total of these three, 23 lakh 50 plus 2 lakh 50 plus 2 lakh. That is coming 28 lakh. So this is 28 lakh plus 17 lakh. That is coming 45 lakh. Okay. 45 lakh is the total. Then here available is 45 lakh multiplied by 25%. That is coming how much? 11 lakh 25,000 is available resource. Now 11 lakh 25,000 divided by buyback price is 30. Correct? 30? Yes, 30. So divided by 30, that is coming here how much? 37,500 shares. So simple in examination, it will take 5-6 minutes that here. Okay, to score 8 marks. 37,500 is the correct answer. Okay. Now debt equity, as per the debt equity ratio maximum. So this is a formula. The existing paid up capital free reserve that we have already calculated here, that is 45 lakh. Okay. 45 lakh minus 50% of debt. How much is the debt? We already written there 46 lakh 50,000. So 46 lakh 50,000 divided by a buyback price is 30. Face value is 10. So how much it is coming? That is coming 54,375 shares. So correct answer is D. Simple. Okay. We can take a break, that not so much spending that. Only 3 more case study and I will give you LMM then homework. Okay, let's take a break for 10 minutes. Okay, let's take a break for 10 minutes and then we'll solve the remaining question. Okay, now break for 10 minutes. Hello all of you. Okay, now come to the 4th case study. So what I ask you that here now, the first they say what is the amount of profit or loss on sale of investment that year. Okay, we have not yet covered the investment chapter. The next chapter is the investment only, but we can find it how much is the profit or loss on sale of investment, because in the buyback chapter they give us the amount that is a sale value and all that here, but here we have to find it at the profit amount. Okay, where when we solve the full-fledged question, so it was an easy figure. There is a sale value, there is a cost. The difference will be either profit or loss. But here we will find it, no problem. Second, the securities premium available balance of after redemption of preference. They ask us how much is the balance in securities premium account after redemption of what? Preference shares. Okay. Then here they say total amount of transfer to Ciara. Ciara will transfer the face value of the buyback and the preference shares, redemption of preference. And they ask you the cash balance after buyback. Okay. Now here they ask you that Azad Limited has the following particulars: 10% preference shares, capital of rupees 10 each. Figures are in rupees in lakhs, 2,500. Equity share capital of rupees 10 each, 8,000. Capital redemption reserve already they have 1,000. Securities premium they have 800. General reserve 6,000. Profit and loss account balance 300. Cash 1,650, and investment. What is the cost of the investment? 3,000. But what is the market value here of that is 1,500 that is. So here the book value is 3,000 that here, but the market price is lower. It happened that the price fluctuates of the investment. For example, you purchase a shares of some company, suddenly their value goes down. So how should we do the treatment? That we'll discuss in next chapter. But here the book value is 3,000 and the market value is 1,500. Okay. Now the company decide to redeem all its preferences. They want to do the redemption of all preferences at a premium of 10% and buy back 25% of equity share at rupees 15 per share. So they want to do the first redemption of preferences at 10% premium, and they want to do the buyback 25% of their equity share at rupees 15. It means face value is 10. They want to do the redemption at 15. It means the premium is 5. Investment amounting to market value is how much? 1,000 rupees, 1,000 lakh sold at rupees 3 lakh and raises a bank loan of rupees 2,000. So what is this point? I will discuss with you. Don't worry that this point is related to what? Investment. I will explain you. Okay. And they raise a bank loan as well of 2,000. Okay. The amount of profit or loss on sale of investment. Now understand that. So when I talk about the sale value, I will write it down that here. Minus here, when you will write it down the cost, difference will come either profit or loss. Do you agree that here? It will come profit. If it is negative, that is what? Loss. Simple as that. Okay. So they tell us that here in question that now they sell, the one thing is that here it is mentioned that here now. Please understand that here now. This point is important that, or let me write it down here only. Okay. So what happened related to investment? I'm writing something that now. What is the book value, or you can say what is the cost here? Is 3,000. Do you agree that what is the cost? 3,000. What is the market value? The market value of those 3,000 is 1,500. Do you agree that? Yes. When they sell it that here, they say investment amounting to market value 1,000. It means when they sell that, they're talking about this 1,000 out of, okay, market value of 1,000 sold at rupees 3,000. So sales value we know that is, sale value is 3,000. So sale value we know that 3,000. But what is the cost? They are not selling all the investment. Please understand that here. They are not selling beta all the investment. Some portion of investment they are selling. The book value of investment, yes, I am talking to you. Please listen carefully. Book value of the investment which is mentioned in question, that is 3,000. And the market value of those investment is how much? 1,500. Okay. So they have given the information that here out of this 1,500, the market value, they have sold. Sorry. They sold the investment that is, whose market value how much is? 1,000. They sold at 3,000. So, but what should be the cost of the investment that they have sold? So, can we find it out? Yes. So, how we can find it out? Can I say that here now? If this 3,000 is 1.5, if this 3,000 is 1,500, then how much is 1,000? So, can I say that here now? If this is 1,500, how much is 1,000 that here now? Or you can say 2/3 also, that is coming 2,000. So what is, how much is the cost? That is coming 2,000 here now. Okay, so you understand, you have to, now we have a profit here of 1,000. Therefore the answer is B here. Okay. How I find it out that? I'm repeating this one, listen carefully. What is the sale value here, Peter? That is 3,000. Okay, what is sale? How much is the sale value? 3,000. Now, how much should be the cost? They have not given the cost directly of the investment that they are selling that year. But the whole investment cost is 3,000 and their market value is 1,500. The investment they are selling, their market value is 1,000. So we can find out the cost here. If this 3,000 is 1,500, then how much is 1,000? That is coming 2,000 is the cost of investment that they have sold. So this 2,000 and they have a profit of 1,000 because they're not selling the 100% investment. Basically, they sell the 2/3 of investment that year. Okay, done. So now they say here in second MCQ that securities premium balance available after buyback. Now please understand that here. Balance of securities premium which is given in question, that is how much here given in question is 800. So I will say that here balance given. Okay, how much is the balance which is given in question? Balance 800. Okay, now understand that here. Now after that they are doing the redemption of preference shares, then buyback. But they ask you how much is the position after redemption. Okay, after redemption means before the buyback. That okay, first they are doing the redemption of and then they are doing the buyback. Okay, now please listen carefully. Very interesting point here. What entry we pass? We pass entry preference share capital account debit, premium on redemption of preference share account debit to preference shareholder account. Correct, to preference shareholder account. This entry we pass here. Okay, not understand. This to preference shareholder account. This entry we pass here. Okay. Now what happened here now? When I say that a preference share capital account debit, we debit with the face value. So what is the face value of preference share capital? 2,500. So 2,500. And they are doing premium is how much here? 10% here is the premium on redemption. So 2,500 multiplied by 10%, that is coming 250 to preference shareholder 2,750. Now the question arises, this premium, be careful that here. Okay, this premium on redemption of preference share, I told you that here. It should be avoided to write it off this premium or redemption of preference share against the securities premium account. I told you that here. Okay. It should be avoided that here because as per section 133 of the Companies Act that here, which say if the company is following the accounting standard, they cannot utilize the securities premium account to write off the premium redemption of preference shares. So I will say that here now, the two options are available that here now. If I say it is not specified in question that here, but if I say that a premium on redemption of preference shares, they write it off this premium on redemption of preference shares against the securities premium account. In that case, I have to reduce this 250 here. Okay, premium on redemption of preference shares that here. So your balance will come here 550. After balance will come after redemption of preference shares. Let me write it down. Okay, balance after redemption of preference shares. Balance should come 250 that year. But if I say no, we don't want to utilize this that we have enough other balances. We have like a general reserve, we have 6,000. So they might have utilized this 250 to write it off to these against the general reserve. That it might happen, and the possibility is very high. In that case, if we have not adjusted this premium redemption of preference share against these 800, so my balance would be 800 only. But they have given in the answers 550 also that they have given this answer. And if we don't write it off this 250 against the premium, against the securities premium, so answer would be 800 also that they have given. So answer might be A or answer might be B. As I know that here, this is given in the ICAI mock test paper May 25 and onwards, mock test paper 3, and MTP series to September. Okay, which September, but whatever. But 2 times they have given the same case study at 2 different places. That in those 2 different places they have given the answer. In one case they ICAI given the answer 550, and in one case they have given the answer 800. Both are correct because they have not clarified the information properly. They have not given the information properly here. So both are correct that here. What should we do now that here? I think that here both are correct. If you say 800, that is also correct. If you say 550, that is also correct that here. So we assume that here, if I assume that here now, assume that write it off against securities premium account. Write it off against securities premium account. If you assume that it is write it off against securities premium account, then answer would be 550. And I say let's take 550 only. If some student takes 800, that is also correct. Nothing wrong in that. But let me take here the 550. I say I've taken 550 both two times they have asked same case study, and in one time they have given answer 550, and another other case they give the 800. Both are correct. But let me take 550 only. Why I'm taking? I'm not saying the 800 is incorrect. That is also correct. Okay. I'm assuming that they have premium on redemption of preference share. They write it off against the securities premium account. The reason is that here because securities premium available for buyback is specifically after redemption of preference share. So might be they're indicating that here that they have utilized the securities premium account to write it off the premium redemption of preference shares. Might be. That's why they're giving an indication there how much balance we have in securities premium account after adjustment of redemption of preference shares. Okay, so that's why they're giving the indication after redemption of preference shares. They're giving the indication, it means that they write it off that here. Okay, so let's take 550. If someone choose 800, that is also correct. Okay, now they say total amount to be transferred to CRR face value. So face value that we are going to transfer to CRR here. So CRR for buyback and for buyback of equity shares and for redemption of preference shares. So redemption of preference shares, we have redeemed all. What is the face value? 2500. So I will write it down here, 2500. And we have done the buyback 25%. What is the value of equity shares? 8000 meter. So what is the face value of that? 8000 multiplied by 25%. That is coming 2000. So to CRR we transfer 4500. Answer is B. Okay. Then they ask you that how much is the cash balance we have. So how much balance is given in question? The balance of cash which is given in question 1650. So I will write it down the balance here which is given in question 1650. Then this says that here now how they've raised the fund. Now one by one. In first point it is that they have done the redemption of preference shares. Okay, so they have done the first one by one, redemption of preference shares. How much they paid that a redemption of preference shares is 2500. This much that they have 27 premium, so 2750. So minus redemption of preference share 2750. Okay, don't say it's a negative figure. They have done other thing also. The amount will also come. Okay, then they say buyback 25% that year, and they have done the buyback at what price? There 50 rupees 15 per share. Okay, so buyback. Okay, buyback if I say 8000 is the total amount at here, or if I say number of shares, so is the 8000 divided by 10. 800 shares multiply by, they are doing the buyback 25%, they are doing buyback at what price? 15. 800 multiply by 25% multiply by 15. So that is coming 3000. Okay. Then it is mentioned they sold the investment. At what price they sold? 3000. So I will add investment sold. So their investment sold. How much they get? 3000. Okay. Then they have here. They also raise the bank loan of 2000. So bank loan taken, they receive amount 2000. Now do the total. That is coming 900. So correct answer is D. Simple. Okay. The correct answer is D. Okay. Now next case study. Okay. When I will give you homework today, same question is mentioned. I think figures might be some change, but there is one correction here. That let me read what they have asked you first. Okay. What is the maximum number of shares that can be bought back as per the debt equity ratio test? What is the formula that here now for it? Existing paid up capital. Existing paid up capital plus free reserve minus 50% of debt divided by buyback price plus face value. Buyback price per share plus face value. Okay. What is the maximum permitted equity? What is the maximum permitted equity means what is the maximum fund available to do the buyback that year. So we will find it at the maximum number of shares. We will calculate there. Okay. We will discuss there. Okay. Then this says that here now is the what is the maximum permitted equity. Okay. Now here this says that here basically they're asking you that amount of Y. Okay. So no problem. We'll discuss there. Okay. Then this says that here now is the what will be the future, okay, the future equity shares. Okay, so future equity shareholding. So if you remember that here existing, this here this they are talking about that here now is this amount. Where is this? The future paid up capital. So how we calculate that? If you remember that here now, just for the okay, existing paid up capital plus free reserve minus the amount that we have to transfer to CRR. Okay. Now, what is the maximum number of shares that can be bought? Resource test. So, resource test, what it says that here now, available resource, if I say that here now, is 25% of paid up capital plus free reserve. Maximum number of shares, when I say, is available resources divided by buyback price. Okay, so one by one we will solve it here. Okay, now we will read it here. Now come here. Okay, now this is Petroleum Limited non-listed company has the following capital structure as on 31st of March 2021. So how much is the equity share capital? 24 lakh. Okay. Now reserve and surplus, the share is of rupees 10, so number of share 2 lakh 40. Okay, reserve and surplus, general reserve is free reserve, correct. So that is 20 lakh 50,000, correct. Securities premium is also free reserve for the purpose of buyback, 7 lakh 50,000. Profit and loss account is how much here? 2 lakh. Okay, then infrastructure development reserve is not a free reserve. Revaluation reserve is not. Okay, so you can find it out the existing paid up capital. Existing paid up capital and free reserve, that is 24 lakh plus 20 lakh 50,000 plus 2 lakh, that is coming 46 lakh 50,000. No, how it can be possible? 20 lakh 50,000 plus 7 lakh 50 plus 2 lakh plus 24 lakh. Okay, it's 54 lakh it is. 54 lakh. Okay, now loan fund is 52 lakh. Okay, loan fund is 52 lakh. Okay. The shareholders that here now of Petroleum Limited on the recommendation of their board of directors have approved that here on 12th of September 20x1 a proposal to buy back the maximum permissible number of equity shares considering a large surplus fund available at the disposal of the company out of profit they are doing. So then in order to induce the existing shareholder to offer their share for buyback, it was decided to offer a price for buyback price at what price? 25 is the buyback price. Okay. You're also informed that the infrastructure development reserve is to satisfy the income tax requirement. So they are saying it's a statutory reserve. It's not a free reserve. Okay, we know that. Now, interesting part. They say you are required to compute the maximum number of shares that can be bought with. These para that they have given, basically what happened. But let me read it first, then I will explain. You are required to compute the maximum number of shares that can be bought back in light of the above information. Also under a situation where the loan fund of the company were either rupees 1,200 crores or 1,500 crores, assuming the entire buyback is completed 9th of December 2021. Now what happened? Similar question I will give in homework, but that is not for the MCQ purpose. We will see that I will discuss with you. But we have to do the proper calculation of that. So it is almost the information that they have taken from that question by the ICAI here, okay? But they forget that here, these is for the different situation that they have created in that question. I will give in here today in homework that here. So they have done just the copy paste here. So a full-fledged question that they've asked you to the maximum number on the 3 scenario and all that. But here that they've given the MCQ, I will calculate on the basis of MCQ only, okay? Different situation, what is the answer in that situation? If here the loan fund is 1,200 crore, if it is 1,500 crore, how much should be the loan funds and all that? So that is going to be asked there. They have done just the copy paste. So by mistake,
they have, write it down these also here. Okay, just ignore this para, which is page number 96, or cut it down there. Okay. Now, what is the maximum number of shares as per the debt equity ratio test? What is the formula? Existing paid up capital and free reserve. So we already calculated existing paid up capital and free reserve, that is 54 lakh. So we'll write it down that here now. 54 lakhs minus 50% of debt. How much is debt that here? We find it out there, 52 lakh. It is given in question, 52 lakh. 52 lakh divided by buyback price, which is given in question, is 25 and the face value is 10. Now calculate it that here. 54 lakh minus 20, 52 divided by 26 lakh. 54 lakh minus 26 lakhs divided by 35, that is coming 80,000 shares. So answer is 80,000 shares. Now they ask you what is the maximum permitted equity as per. Permitted equity means, do you remember? Permitted amount. Okay, so in two ways we can find it out the answer here. So okay, let me show both of them to you. The first way, answer will come same in both the cases. First, how many shares we are doing the here buyback? 80,000. So I will say 80,000 shares. I am doing the buy maximum. I can do 80,000 shares buyback. I am doing buyback at 25. So 80,000 multiplied by 25, that will come how much? 20 lakhs. So is it is in terms of shares, it is in terms of amount. So this much shares I am doing the buyback, and I am doing the buyback at the rate of rupees 25. So this is the maximum amount. So point number 1 is on shares, point number 2 is on amount. So answer is 20 lakh. And the other way also. How much is the existing paid up capital and free reserve? 54 lakh. How much should we maintain? 50% of debt, that is 26 lakh. Okay. How much we are to transfer to CRR? The face value 80,000 multiplied by 10, that will come here 8 lakh. Remaining is available. So 54 lakh is the total existing paid up capital free reserve. I have to maintain 26 lakh, and 8 lakh will be for what? To transfer to CRR. So balance will come how much here? 20 lakh. In our simultaneous equation that here now, this is what you know, Y. You remember the Y, okay? And this is your X CRR. Okay, done. Now here, future, so existing paid up capital we have 54 lakhs minus CRR, we transfer to CRR how much? That is 8 lakh. This, if you remember that here, this is a step number that here now is 4, that step number 4. Okay. Now, okay, so it will come 54 lakh minus 8 lakh. That is coming 46 lakh. Answer is D. Now, what is the maximum number of shares that can be bought as a resource test? So, 25% of paid up capital on free reserve. So, paid up capital free reserve 54 lakh. Take 25% of that. That is coming here 13 lakh 50,000. Buyback price is 25. That is coming 54,000 shares. As per the resource test, this much we can do. 54,000 shares. Answer is A. Done. Okay. Now here. Okay. Now here come to 6th, that is. Now it came in September 2025. Now it is Quick Limited is in the business of production of life-saving medicines. It has sufficient. Okay. First, read what they've asked you. Okay. What is the maximum number of permissible share of equity that can be bought back on loan fund? Okay. So they have a loan fund, means they are basically talking from the debt equity ratio test point of view. Loan come there and debt come there. Okay. So what the formula here? Existing paid up capital plus free reserve minus 50% of debt. Okay. Divided by buyback price plus face value. Second, what is the maximum permissible number of equity share that can be bought in the loan fund? They are changing here. The loan fund is 350. Here the loan fund is 300. So I have the option to do the copy paste. You have to write it down. Okay, same. But what's the change here? In point number 1,
The depth is how much? Because 350. Point number 2, the depth is 300. Okay. What will be the maximum number of shares that can be bought back as per Companies Act 2013 according to the decision made on the basis of the above two question. So this on the basis of the above two, what should be the number of shares that we can do buyback? Okay, I will discuss with you later on. Maximum on the basis of above two. Okay. What is the equity share capital after buyback? What is the equity that is after the buyback? Okay, so we will calculate how much they want to do buyback. Existing minus buyback they have done. Then we'll talk about the equity share capital. So existing share capital, and they're doing the buyback. That much capital will be reduced. Okay, they're talking about the equity share capital. Okay, now understand that here. Now we'll read what they say that here now is the okay. Now, Quick Limited is in the business of production. Okay, is in the business of production of life-saving medicine. It has sufficient cash funds available with it. It decided to buy buyback shares to the maximum permissible limit on 4th of July 25. So when they want to do the buyback, 4th of July 25. On 1st of July 25, the company has the following capital structure. So all figures are in lakhs. Equity share capital, share of rupees 100 is fully paid 45. It is 45 point. Okay, the 45 lakh. Reserve and surplus. General reserve 74. Securities premium account 30. Profit and loss account 25. Revaluation reserve 4. Statutory reserve 6.5. And the loan fund is 350. They say the Quick Limited is considering to reduce the loan fund amounting to 300. So they want to reduce the loan fund from 350 to 300. So they will repay before the buyback. They will repay 50 and to loan fund will be the 300. Okay. So by paying the loan fund amounted rupees 50 lakh before the 4th of July. So on 4th of July, they are doing the buyback. Before 4th of July, they are paying the loan fund. So their loan will reduce from 350 to 300. The current market value of the company share is 250. So that is the market value is 250. And to induce the existing shareholder to offer their share for buyback, it is decided to offer 20% over the market price. So 250 is the market price, but they are offering 20% over that. So 250 plus 20%. So 300 is the buyback price. Okay, buyback price is 300. Based on the information given above, scenario, answer the following question. Limit. This should not be 11 to 14. It should be 1 to 14 in examination. Okay, it came 11 to 14 here, 1 to 4. Okay, anyways. Now they say what is the maximum permissible number of equity shares that can be bought back if the loan fund is 350. They have paid the loan from 350. They have paid 50, so it is 300. But they ask you if suppose it is 350. Okay, so existing paid up capital of reserve. Let me write it on. Equity share capital is 45. Free reserve is 74 plus 30 plus 25. How much it is? 74 plus 30 plus 25. That is coming here. How much? 129. Okay, revaluation reserve is not a free reserve. Okay, so here it is coming. Existing paid up capital and free reserve is how much? 174. So 174 is existing paid up capital plus free reserve. How much is the existing paid up capital free reserve is 174. So I will say 174 minus 50% of debt. Debt is how much? They say if it is 350 divided by buyback price is 300, and how much is the face value is 100 plus 100. So can they do the buyback here? The answer is not. Tell you why. Do the calculation here. 350 multiplied by 50%. It's coming negative now. 174 minus 50% of that is coming 175. It is negative. They cannot do that. Nil. Why? Because it is coming negative that way. I'm going to say their existing is 174 and they have to maintain after buyback 170. Already they are below that. They cannot do buyback. The answer is C. Nil. Now here existing paid up capital free reserve 174 minus 50% of debt that they have mentioned 300 lakhs divided by that here. Divided by here 300 plus 100. So 174 minus 150 divided by 400. Okay, let me write it in lakhs. These figures are in lakhs. Okay, remember that. So 174 lakhs minus 150 lakhs, that is coming 24 lakhs divided by 400. That is coming 6,000 shares. Perfect. Answer is D.
Now they say what will be the maximum number of shares that can be bought back as per Companies Act 2013 according to the decision made on the basis of above two questions. They have already done they paid the some loan now. So in first case, if the loan fund is 350, then they cannot do buyback. If the loan fund is 300, they can do the buyback of 6,000 shares. But they've already paid the amount now before the 4th of July. So actually their loan fund is 300. So don't say lowest of the above. Don't do that. These are not different tests, resource test, debt equity. It is not like that. They are say two situations. First situation, the loan fund is 350, it is 300. They already paid 50, so actually now it is 300 only. So what they're saying that here now, on the basis of this, what should be the maximum number that they can do the buyback here? So it is 6,000 only now. Why it should be 6,000 only? And don't say least of the two. If you say least of the, you're doing mistake here, beta. Because they are not, these are not different tests. It is not like resource test and debt equity ratio test. Both are debt equity ratio tests that here. But in first case, the loan fund was 350. Second case, it is 300. Okay. So what happened? They paid already. So now how much actually existing? 300 only. So this much they can do. Okay. The answer is 6,000. See, the answer is 6,000. Well, how much is the capital? They are not saying the equity share. Sorry, they are saying equity share capital. They are not saying. I mean to say how much is the available fund and all that here. Okay. They are saying share capital actually. So they are saying share capital we have here. How much is the share capital I have here? Is 45 lakh. Let me write 45 lakh. I am doing buyback. Okay, on buyback, how much share we are doing the buyback? 6,000 shares. What is the face value? Because capital will reduce by face value only. That will come how much is 6 lakhs. So here it will come 39 lakhs. So answer is D. Then this how will get 8 marks. Only 4 questions that. Okay, only 4 questions. They will 8. It will come for the 8 marks. Okay, now these questions are on other chapters that. Okay, so done. So you solve all the case studies that here. Okay, MCQ done. I will come to LMM, but let me come to homework part. For the homework that you have today. Okay. Okay, write it down that here now. Homework. Okay, write down there now. Homework. Whatever. I mean, if you see that pending question will be homework that is simple. It is that here. Okay. Now write down there. So 10. I already gave you that 11, 12, 13, 14, 15. Already gave you 15. Okay. Then here 16 is for today. Okay, homework for today 16 is homework. Okay, just let me write it down that here now. Homework 16. Okay, now after that 17 already gave you that here. 18 and 19. Okay, now understand that here. 18 and 19. Now write down 16, 18 and 19 beta. Okay. Now understand in 16 that here, what they're saying you that here now, they are just similar question that here. Okay. 16 is simple that here. Okay. Nothing special. Now in 17 that here now is the 17 that it is interesting. That similar that we have solved, but the figures are different. Okay. Now they have given you that here now is the simple situation. The loan fund is 3 situations you will find it that here. The first is that they have given you that here now is the loan fund is 1800 and they ask you that what if the loan fund is this 1200 and 1500. This is what they have done the copy paste and MCQ I was discussing. So when you will solve these 3 tests, 3 situations. That's it. First and second, there is no change because in first and I mean the 3 situations, but in 3 tests, first and second test will be same. Where the fund is come in the third test on debt equity ratio test. So then you have to do the calculation. Okay, you have to do the calculation. Okay, that's it. So the homework for today, these 3 questions 16, 18 and 19. We're done with the buyback of buyback of securities. But remember that very important thing is that please don't forget to write it down in a Rapid Gist book. Go to Rapid Gist book page number 12. Go to Rapid Gist book page number 12. Now here the sum question which is on the journal entries and balance sheet, that is question number 29 and it is 14. It is 14. Oh my God, just give me a minute. Which question it was? Okay, you can little bit go back that is 3-4 seconds you can find it out, but I don't know what I have written there.
You can just, okay, no problem that here. Now here the question number 2, 9 and 14. I think it was not question number 18 or You can go back 4-5 seconds and you can I'm to say you can see which number it is there. Okay, here journal entries and balance sheet with 2, 9 and 14 that here. And buyback of test question here, buyback test, it might be happen they ask you the 2, the 3 tests that here, okay, and they so ask you to pass journal entry in balance sheet. Question number 4, 3 and one more question. I think it was the last one as I remember, 19 or just give me a minute. How it can be happen? No. Just give me a minute. Which question it is? I don't know. Okay. I think it is question number 4. Just give me a minute. I think it should be 19, I think. Okay, wait a minute. Just give me 1 minute. Nine I have considered there, no? Yeah, 9, 14. Okay, just give me 1 minute. 14, I think that because of this point I gave you. Okay, correct. Just give me 1 minute, okay? Then here. Okay, I think it should be a 19 here. It doesn't look like 19, na? Okay, you can find it, but I am not able to see that. And one more thing in question number 12, there's a point related to, I think I gave you homework today, this question number, no. Maybe that in past I gave the question number 12, this is one point, the market value is given. That is just for the reference purpose, the market value is given. So for the reference purpose, when you prepare the balance sheet, you just have to write it down like whatever they've given the question, market value in inner column for the reference purpose, okay? So you can find it out which question it is that here now, okay? How it can be happen, okay? Anyways, you can find out which question it is that here, okay? Now, otherwise I have to pause, I'm to say that here, stop the recording and I have to see that and again I have to add. Anyways, that here, okay? Just give me a minute. Yeah, I saw that portion, okay, it is 6 and 19 it is, okay? Okay, just give me a minute. 6 and 19. Okay, write it down, okay? So second, 9, 14, 4, 3, 6 and 19, okay, done. Now this question number 12, which is on beta, that here is on the market value is given. Let me show you that, otherwise you should not get confused that here. Question number 12 that. Okay, this is just for the reference purpose. As you can see that they have given you the market value of the investment is how much? 400, okay? So I think in the question that they have given you 400 like that. Okay, so you just have to write it down there also in a column only, okay? So now we are done with, and please write it down these, the LMM that here, okay? Please write it down this LMM here, okay? And it is very important that here now, you have to properly follow the sequence into, okay? If you watch daily one lecture, at least you have to watch it that here. And it's very easy. It is not at all a difficult chapter that here, okay? It is not at all, and advanced accounting itself is not at all difficult. When you will the accounting standard, you will enjoy so much to ace that. I will go in depth, I will discuss with you, will enjoy those, okay? So, and I'm very much sure that you're going to score 80+ in advanced accounting that year. You just have to follow my instruction that year, okay? So that is for today. Tomorrow we'll start with a new chapter, and the next chapter is that the investment account. Simple, all are this subject itself is simple subject, okay? Investment account will start tomorrow. That is for today. Take care all of you. Bye-bye. If you have any doubts, any question, you can drop a message anytime, okay? Take care. Bye-bye.